Morning, Dan Caplinger.
Good morning, Jason Hall.
How are you, sir?
I'm doing okay.
Well, that's just okay. Well, it is a okay kind of day up here in the Northeast. It is gray. It is dreary. It is going to be rainy and snowy later. Wherever you are watching us here on Fool24, hopefully the sun is shining on you, even if it's just metaphorically speaking. Let's kick this hour off. We're going to start the 8 a.m. Eastern hour here with what we're watching this week. We're going to take a look ahead. We'll look back over the weekend too. I'm sure there's some stories and some things going on that are worth weighing in on, and we'll certainly do that. And of course, we want to answer your questions. I'm Jayson Hall. That's Dan Caplinger. Two longtime fools. We've been around here for feels like forever, and I've been here about half as long as Dan. So between the two of us, it's a long time, and we can answer lots of questions. Get those to us in Slido. Whether you're watching on Motley Fool and you're behind the paywall, or you're on the YouTube stream, same way you get questions to us. Go to slido.com. The event code is Fool24. Please remember, when Dan gives an excellent answer to your question, or I give a mediocre answer to your question, we are not telling you what to do. This is not a forum where we are going to provide anyone with personalized financial advice or individual investing advice. So please remember that. All right, Dan, where do you want to go first?
All right, let me geek out for a little bit because last week we had news from the Federal Reserve. They held their every 6 weeks, 8 times a year meeting. They left interest rates alone. They did sort of a minor tweak to the quantitative tightening process that they've been going through, reducing the amount of tightening that they are doing in terms of letting their balance sheet. You're going to be letting their balance sheet grow more or shrink, but more slowly than they did in the past. And so a lot of people watching that, they're kind of thinking interest rates are going to keep going down, but not sure exactly how far. The Fed's own officials kind of changing their views on that from time to time. A lot of uncertainty economically. We're looking at new tariffs that have been in place. We're looking at potentially a new set of tariffs that are coming in not this week, but next week, according to the current schedule. This week, what we get is something that is truly sounds like it would put you to sleep on a Monday morning, 8 a.m. Personal Consumption Expenditures Price Index from the Bureau of Economic Analysis. Why are we paying attention to this thing?
So we go from the FOMC to the
PCE. You got it. Yeah.
Yeah.
Yeah. If
Yeah.
you want to play alphabet soup, that is where we are. And the reason we look at this thing, it gives you a sense of consumer behavior, but it's also, everybody looks at everybody's paying attention to inflation. Inflation's been on the mind for 3-4 years now.
Mm-hmm.
And everybody's kind of like, well, okay, I'm tired of the prices going up. I'm tired of paying more than, what happened to used to be able to buy a box of Oreos for $2. Now it's $4. When is that going back down? I got bad news, folks. It's probably not going to go down. But the question going forward is, does it keep going up as fast as it's been going up, or is it going to slow down going up? And the answer to that is what we get in an economic data release like this. Most people pay attention to the consumer price index. It is a little bit closer to home. It's a little bit less economics, PhD kind of stuff. But unfortunately, or depending on your point of view, the Fed doesn't pay as much attention to CPI as they do to this personal consumption expenditures index that will come out this week. And you can bet that there's going to be, certainly in the bond market, people watching this. And it has been known from time to time to have an impact on stocks as well, because what we're looking for, if inflation is under control, then the Fed can cut interest rates in order to spur economic activity. As we start to hear rumblings of a slowdown, even the R word gets thrown around every once in a while. We're there. And so a lot of policymakers are like, okay, can we get this? Can we nip this in the bud? Fed's done a pretty good job of avoiding recessions in recent years. And so, maybe we'll get it done again. But that's probably, from an economic standpoint, that's probably the thing I'm watching the most. Jason, what are you watching?
So where my big nerd brain's living right now, and it's around housing and home building.
Yeah.
So tomorrow's is a big day there. We get the Case-Shiller Home Price Index. So those that don't know, it's an interesting index, and I think it looks at 20 cities, something like that. So it's a pretty big.
Yeah, I think that's right. And there's a 10
geographically
city index and a 20 city index, if I remember right. Yeah. Something
Yeah,
like
and I
that.
think we get the 20 city this month for January. So it's when we see it, it's for a couple months prior. It takes time to put the data together. So, and it's interesting because it is across a geographically diversified mix. But to me, it's just interesting to see because it's more data around where home prices are continuing to go up. Home prices are up 40% since 2000. Dan, they're up a ton, maybe more. Again, this is very market dependent. Some markets they're not up as much. Some they're up more.
Since 2020, you mean?
Yeah, 2020.
Yeah. Okay.
Yeah, right. They're up a lot. So, the other thing we're going to get also tomorrow is new home sales data, which I always look at really closely because, again, I think looking broadly across the housing sector, I do think home builders over the long term are going to continue to be a big opportunity. And there's a likelihood that the prices that we're starting to see are going to prove through the cycle, through the softness that we're in right now, are probably going to do really well because we are just so underbuilt in the core markets where there's lots of economic growth and where population trends are moving, where people are moving to. So I continue to look at the new home sales data just to get some idea, because I follow a few home builders closely. I follow 7 or 8 home builders pretty closely, and there are hundreds of home builders across the US. Most of them are very small versus a concentrated group that do the vast majority of building in a lot of markets. But it's just another data point to kind of look at what are the trends. Are we seeing a big slowdown on a national basis? You'll also, in some of the home sales report, you'll start seeing some geographical information as well, so you can kind of start parsing how things are looking. So I always like to look at it. It's not a big thing in my thesis, but it's a piece of information. Like if you follow any sector closely, any specialized industry closely, especially the ones that are very cyclical, like home building is, it's always good to kind of keep your pulse on what's going on in the market during that period, especially, Dan, if you're actively looking to invest new money or you're approaching a financial goal and you have a lot of exposure to that particular highly cyclical industry with your stock portfolio, where that might be a good place to think about turning stocks into money because of the near-term risk of volatility.
You got it.
That's what I'm looking at.
Before we move away from home builders, I'm wondering, there's one that's reporting earnings later today, and do we want to talk about that, or always curious? I'm always sort of like,
who am I missing?
So I'm gonna risk it, and if Jayson can't say anything,
I'm not restricted on any right now. I'm good.
Okay, so KB Home, ticker KBH.
Okay, yeah, that's right.
Is reporting after hours today, and just to give you kind of state of where we are right now, I'm looking off screen here at the data that I've got. Looks like consensus forecast for earnings is $1.59 a share. It's down about 10% from where it was this time last year. When you punch out to the full fiscal 2025, you're looking at earnings that are projected to drop slightly, doing the math, about 3% year over year from where we finished fiscal 2024. Revenue estimates for about $1.5 billion, up very slightly, like about a 2% up move there. And so that's kind of in some ways reflecting the price increases that Jayson is talking about. And so, yeah, it's a tough deal because you've had that structural deficiency, that structural shortage in the housing stock, rather the housing supply in the U.S. for years and years. And, but we've also had in recent years kind of this lockup of the existing home market because a whole bunch of people took advantage of low interest rates. They got mortgage rates that were really attractive. And if you want to replace your home, we generally don't let you take your 3% mortgage with you. You got to pay off the 3% mortgage, and you got to go find yourself a new mortgage now. And that's going to cost you what, 6%?
Yeah.
Maybe even 7%, 5, 6, 7%, somewhere in there.
So even if you downsize
Nobody
to a
wants
house
that.
and your mortgage is 30 or 40% lower, your payment is potentially still going to be higher.
Your monthly could go up for less house. And and good luck finding less house, because everybody's in the same boat. And so everybody's like, oh, I'm hanging on, it's like I'll borrow the crypto term. It's a hodl. It's a hold on for dear life to that house, because once you move, you're suddenly exposed to all these volatile price swings, especially in hot markets. Rental availability kind of hit or miss, and the character of rental properties can be really hard to find exactly what kind of property you're looking for, especially in a single family home area. And so I'll be curious. Yeah, between the economic data and KB Home reporting this afternoon, you should get a good sense of where the home building, where the home housing sector is right now.
Yeah. So just a little, I want to hit on that a little bit more, because I think it is such an important, because we're talking 16 to 18% of the economy broadly around housing. So it is a lot of money that, whether you're directly investing in a company that's directly tied to housing, like a home builders would be, or a Home Depot, or an apartments REIT, right, where you're like directly plugged into the money, or it even starts to get more ancillary, like home furnishings businesses that a lot of their big catalysts often are a hot housing market is almost always good for business for them, right? It's such a big thing. It's worth having some understanding of what's going on and thinking about where KB fits in the mix. They're top 5 or 6. They're one of the bigger home builders, but they're substantially smaller than the largest. We just heard from Lennar late last week, and Lennar revenue's down. Earnings were down. I think the number of houses in their order book was up a little bit, but the total revenue size of the order book shrunk. Partly because of mix, because the biggest hole in supply is entry-level housing and affordable housing, smaller. When I say affordable, I mean single family and condo and townhome and that kind of stuff. The smaller first home kind of thing. And the founder, and I believe he's still the chairman of Lennar, hasn't been the CEO for a while, really talked about the concerns that they have and the amount of money they're having to spend on things like buying down rates for buyers, and was very, very muted on his expectations for the next year or so. And I've talked about that. It's going to be just a tough year for a lot of home builders. So we could see, as much as Lennar stock is down, depending on what KB's management says afterwards, which is probably going to be pretty muted too. This could be a challenging environment, but you have to think countercyclically about these sorts of businesses, Dan, where when the management is very muted and they're saying not really great things about the environment, the market's usually going to telegraph that as things are bad. It's time to get out of the stock, and the momentum traders move on, and you start seeing prices come down. And that's almost always, for these high quality home builders over the past decade, has I won't say almost always, every time we've seen a sell-off since 2014, 2015, every time in these quality home builders has been an opportunity to buy. Like you look at Meritage, for example. My first buy of Meritage in 2013 is up, call it 170, 180%. It's pretty substantially underperformed the S&P 500 since then. I added pretty aggressively in 2015 or 2016, 2017. Those positions are up more than 300%. And it's the business quality and their focus on that hole in the market and meeting that demand that has really, really, really paid off. So, All right. We got questions coming in, Dan.
It's hard. I mean, it's hard when you're dealing with this stuff, though, because we were talking about this with we've got Dollar Tree coming up. You know, dollar stores have been kind of a difficult area lately, and they're going through the same thing. You know, you have a period of earnings expansion. Everybody knows how to deal with stocks that are going through earnings expansion, but it's when the earnings start to go down that a lot of the valuation metrics, that a lot of valuation methods that people use, they stop working well when you have earnings that are flat, earnings that are going down, earnings that are volatile one way or the other. And so I think that it becomes a little bit difficult to deal with when you're in that situation. And so, yeah, the home builders, cyclical stocks, you know, valuing cyclical stocks is an art, and it's a different art than if you're used to trying to deal with tech stocks that aren't earning any money yet, or if they are, you know, seeing big revenue growth but not yet profitable. You know, that's a different skill set to value those. Let's take a question. I got Florida Fool here asking, what are your thoughts on the trade desk, ticker TTD? Market seems to think that they are dead. I can't, Jayson, I didn't mean this to be a segue from your comment, but I think that it's
it's
perfect
time to
segue.
move on, Dan.
It's a
it's
segue.
time to move on.
It's a perfect segue from the comment, though, because, you know, the trade desk is something that, you know, we had our first quarter where, as trade desk is a public company, where the company fell short of what its expectations were. And, you know, founder CEO Jeff Green all over that and saying, hey, you know, it happens and it was inevitable. And here we are. But you do have this core of momentum investors, of high growth investors who don't like to see that. And you know, some of them have very, very strict guidelines, investing methodology, where it's sort of like, yeah, I'm going to, as long as this stock is growing, as long as this stock has momentum in the right direction, I'm going to stick with it. But as soon as you start to see cracks, some of these folks can be brutal. It can be a very abrupt shift in investor sentiment among folks who follow momentum and stick with the momentum high growth trade. I think that's probably what's happened here with the trade desk. And so the question going forward is, often it takes a little bit of time for companies to demonstrate to, you know, that kind of, to an investor base that's kind of shaken a little bit, whether the company is still going to be able to go in the right direction, whether the course corrections that company management put in place, whether it's going to be enough to turn the ship, and how quickly the ship turns. But it can be a difficult process. And so, you know, short term, you know, these, after you see a big downturn, you know, a lot of people are sort of like, yeah, when are we going to get that bounce? When are we going to get that bounce? It can take a while for a bounce to materialize, just because there is so much uncertainty, and it takes time. It just takes time for businesses to react to changing circumstances and to, again, rebuild that investor confidence enough that that people get excited about the business again.
Yeah, I think we can actually use Netflix as an example, and whether the trade desk business and stock respond in the same way that Netflix did is, you know, remains to be seen. But I just sent a screen. Actually, don't share, Natasha, don't share the screen share yet. But I want to go back to the summer of 2011, Dan. The summer of 2011.
It was a good year.
I guess it was a good year. Something special happened in Dan's life. Maybe we can talk about here. It was, so for Netflix, the summer started off good. The stock was just rocketing higher. Management announced stock buybacks that summer. And at the time, this was pre-split adjusted. The stock now, they were buying back stock for over $300 a share. I think this stock has been 10 for 1 split since then. So they were buying back shares at like $300 a share. And then they started making some announcements. So you go back, you know, 13, 14 years ago, streaming was only starting to emerge as a potential powerhouse business for Netflix. It had become stable. It had become cash generative, but still it was a minority of houses in the US had it. I don't even know if they had done any international expansion at that point, Dan. If they had, probably Canada, maybe that's about it, right? At that point.
Yeah, I'm gonna have to look it up. I don't remember for sure, but I thought definitely a nascent part of their business.
Yeah, 100% right. That's the best way to describe it. So the plan that they rolled out was they were going to spin off the DVD by mail business. And what you have to remember is that this was still the majority of their subscribers were getting DVD by mail. And that business was steady and was starting. There were the first signs of it starting to go into a decline. So they were going to spin it off. It's a separate company. They were going to name it Quickster. And the markets absolutely rejected this idea.
Thought it was stupid. They just thought it was
ridiculous.
Dumb.
It was a terrible idea. It was a terrible idea. So it was a great idea. 5 years too early.
And a terrible name. I tell you, that name never showed up again. I tell you that.
Well, here's the thing. So the funny thing about it, like some random dude already had Quickster as his Twitter handle. So they didn't even like vet if they could get like all of the social properties. Like it was really rushed. But at the same time, Dan, I think this was the bigger thing, and this was probably the biggest thing that caused subscribers to rebel, was they raised prices pretty substantially as part of this separation of the business. The stock fell. Now we can share the screen share, Natasha, if you don't mind sending that over. Now the stock fell. You can see that mountain there. The stock fell, 75% from the summer through the fall of the year. I mean, it absolutely gutted. Here's the thing, Dan. This was the first quarter where they had a subscriber decline, like sequentially in the company's history.
Mm-hmm.
Yeah, right. Exactly. So happened right here. They actually, because that happened and some other things that they actually realized, well, you know what? We actually need capital. They were buying back stock here. They were selling stock. I think it was in 2012. They were selling stock. It was about a year later. They were actually selling shares at a 70% discount from what they were buying shares for.
Ouch.
So you would think this business has just fallen apart. What is going on? What is going on? I'm going to clean up this chart a little bit, and let's go to July 3rd, 2010 or 2011. Again, so this is what happened. All of this big collapse. And this is going through 2013. Let's go from that peak price, like the dumbest time to have bought Netflix for years, and go through today. It's worked out okay, Dan. At 25 bagger.
Yep.
Again, I want to be clear. That's the worst time to have bought. That is the very worst time to have bought. So that's buying here, not buying here. Let's just move it to December of that year when you're down in that low price point. How's that worked out? It's a 100 bagger, right? To buy at that bottom. So again, I'm not saying that the prices we saw 2 months ago for the trade desk in a dozen years are going to be, 25 bagger prices. And I'm not saying that today's prices are going to be 100 bagger prices. But what I'm saying is that right now it's so easy for us to myopically focus on the stock. And everything that I'm doing right now with the trade desk, which is not much at this point because there's not much out there. But when I do come across something that's interesting, something from a trade or trade group meeting, or something from an insider in programmatic advertising that talks a little bit about what's going on, maybe from some of their clients or some of the things that are going on internally with the trade desk, it's entirely focused on business execution as they try to transition more and more of their customers from Solimar to Kokai. And right now it's going to boil down to the risk averse customer spending tens of millions of dollars on this platform a year or more in some cases of their ad spend, getting them to make that transition to what the trade desk is saying is going to be a better product in the long term. It's going to generate better returns for their customers' ad spend. And the company doing things that in the short term, because of the situation they're in right now, in the short term may hinder revenue, but in the long term should pay off.
Yeah.
I trust Jeff Green and his team that they're being honest with the market, and that they're making the right decisions. We're just going to find out whether those right decisions are going to generate market beating return from it. I think they will. But again, we're freaking 6 weeks into this, Dan. We're 6 weeks into something that it's really going to be a year or two before we have a lot more clarity about it. Next quarter, we'll get a little more clarity. The quarter after that, we'll get a little bit more clarity. But you're talking about moving 100% of your customer base of the biggest ad spenders in the world to a new platform without data that 100% supports whether or not it's the right move. So a lot of those customers want to see more data before they make this transition. So,
and I think the thing to remember here is that, you know, we get this information all in one big lump. You know, we find out about stuff when the company does a quarterly report, but CEO Jeff Green and everybody inside of that company, they see it happening in real time. I mean, they you know, they'll get a report from a customer. Maybe a customer doesn't renew their service. Maybe they make a change to their contract. Maybe something else happens. They see a change in the character of the ad market, like whatever it is. I mean, I'm sure there's somewhere out there where they've got the perennial, you know, wall of screens that are giving them real-time data on what's going on. And so they can kind of see these things in a smoother view than what we get. We get it all at once, every 3 months or so, occasionally more frequent when there's an extraordinary thing or you got to do an industry conference or something like that. But yeah, to us, it's always going to look like this kind of lumpy, oh yeah, we just had a bad quarter. Oh yeah, things aren't quite as bad. But when you're there, it's, you know, you've got the wheel and you're turning the wheel, but it's a big ship. And so, you know, it takes time. And there are just these incremental gains that we aren't necessarily going to see. You know, maybe today's better than Friday was. Friday's a little bit better than Thursday was. So, yeah. But, yeah, unfortunately for us, if you don't work in that inner spectrum, you just got to wait for the next earnings report and hope that all those incremental gains add up to something that is noteworthy.
Yeah, that's it. So it's that simple, Dan.
Yeah.
But simple is not easy, right? I think that's the thing.
No, patience is hard. I mean, you know, you're sitting
Super
there,
hard.
your stock is way down, and you're sort of like, let's get something done. And it seems like, from your perspective, that nothing is getting done and that nothing will get done. You know, you've been waiting 6 weeks, and it's going to be another 6 weeks. And then you're going to get a view into what's been happening. And then you may be satisfied or you may not be satisfied. In whichever one of those you are, you're going to wait another 13 weeks until you get the next one. It's frustrating. It's difficult. But it's also why we're here as the community, because you don't have to wait 13 weeks to hear from us. You ask the question, you're going to get a new view every day. Now, it may well sound the same because we're all working off the same information. Nobody here's got inside information about what's happening with the trade desk. But, you know, you get different views. You get Motley views. And you can kind of hear what everybody's saying. Hopefully that adds together into more insight than you had. And hopefully that makes you feel better, gives you some value, gives you some certainty about what you want to do for yourself.
Before you take the next question, I know there's a couple that you're going to combine together. Yeah. For context about how long ago this was, like the Netflix moment that the trade desk is having now, the Netflix moment.
Yeah.
This was the year that Osama bin Laden was killed. The Fukushima earthquake happened. The tsunami and earthquake happened. And the year that Steve Jobs passed away. So if that feels like a long time ago, it's a reminder that these winning stories, we go through these periods of time and then you snap your finger and a decade's gone by and it's like, wow, that was a long time ago. And then you look in your portfolio and it's like, yeah, I think that worked out. So we don't know if that's going to happen, but the hardest part is what the management is doing and what the people operating the businesses are doing. That's really the hardest part. The hardest part for us is just not meddling unnecessarily while the people that actually do the hard work are doing the hard work.
Yeah.
All right, go ahead.
So, and I just, you picked up, and our backstage folks picked up on the idea that, you said we were talking about 2011. I was saying, yeah, it's a pretty good year. And your eyebrows kind of went up, and it's sort of like, oh, wait, Dan's got a story. So let me tell you a story about 2011. 2011 is the year that I opened my position in Vanguard Information Technology ETF, ticker VGT. And the reason I say that 2011 was a good year is that 2011 was a good year to get that started. I'm going to share my screen here. I don't do this very often, and fools, I promise you, you have better stories than I do about gains that you have been fortunate enough to do. And rest assured, I have plenty of long-term positions that have not done this kind of performance. But you kind of see a lot of running around towards the bottom here for the first few years, as happens with these sorts of things, and then suddenly you get 2020, you get the big pump. Look at that. Look at that beginning of 2020, Jayson. Don't you remember when the world was ending?
They're seeing it from 35,000 feet within the greater context, but then there's living through it.
I'm trying to do this. I can't do it. You know what I wish I could do? I wish I could put my finger up against the screen and have the magic of screen share pick up my thumb. It is tinier than my thumb.
Yeah. Oh yeah.
And then suddenly, a few months later, we were back up. There's 22 bear market. You kind of still see that. That still looks pretty big. But then we're back up, and then suddenly, yes, we're having 10% correction. Everybody's freaking out. Whoa, wait a minute. What did I just lose? I just lost back to where I was in summer of 2024.
Right.
So I'm not gloating, and I'm not saying that downturns can't happen, because they definitely can happen. But yeah, so that's why I like that's why when 2011 came up, it kind of sparked my memory there. So. Let me turn. There were a couple of comments, questions from a little while ago, and I'm going to link them together because I love when our members do this. I don't think that they did it deliberately, so I hope that no one will find this offensive. But Let It Ride, about 20 minutes ago, asked, are more people basing their purchase decisions on ethical and political values? Matt answered that 5 minutes ago. I don't think he intended to answer it that way, but Matt said, Dan, I'll tell you the one thing I'm watching this week is the O.J. Simpson estate auction, selling various items from the O.J. Simpson collection, including the Heisman Trophy that O.J. won as a football player for USC. I think.
Yeah, the Southern California Spartans. That's right.
Yeah, and so
Trojan, sorry, I just Michigan Stated the entire
good job,
California nation. Trojan, sorry about that.
Yeah.
It's Monday. It's early. It's Monday morning. Give me a little slack, people here.
There you go. Yes, please. But I have it's a little bit tongue in cheek because if you're bidding at an O.J. Simpson estate auction, then you've made a decision. You made a personal decision about where your ethics lie potentially, and so that's a situation there. I do think. I mean. We have in the news a whole bunch of stuff going on, and a lot of people, I mean, for a while, and on both sides of the political spectrum, you've seen increasingly a crossover of political and economic activity, whether it is proxy campaigns, whether it is boycotts, economic, shifting purchasing from one brand to another brand based on certain views. It's been happening. I don't know. This is one of those questions that, and Jayson, I'm curious what your take is. This is one of those questions that I'm never really quite sure is it happening more, or is it just that we know about it more because the information exchanges that we have, the networks that we have to get to stay up to date on things that are happening, those are so much closer to the ground that we just know about it more. So I don't have any hard data. Let it ride. I don't have hard data that says that more companies are seeing big changes in purchasing behavior. I mean, there's anecdotal examples that I could throw out, and they probably do have a significant impact on some individual businesses. But, you know, I mean, if I had to throw out conjecture and speculation, which is all this is, but you know, when people feel like they are powerless and can't do things to change a situation that they may be uncomfortable in, oftentimes they will look to whatever levers they have to pull. And one lever that every consumer has to pull is what they choose to spend money on. And so, you know, does that mean that maybe we're starting to see that bleed over more? It could be. I just don't know, and I haven't seen any good data that you know, will tell me one way or the other whether this level of activity we seem to hear about all the time, whether it's actually any more significant than it ever has been, or if it's just that we're paying attention to it more.
Well, I mean, these things come in waves. I think that's an important thing to remember. Is, you know, looking back through my history as an investor, I can remember multiple times when individual companies were affected by different things. I think this is top of mind, in front of mind for a lot of people right now because of everything that's happening with Tesla, right? And there is some data that supports with Tesla. And this is, I mean, if we were just to distill everything down, this is the most heat and light on any one company from ethics, political, like put all of that stuff together, and there's so much focus on it because of Elon Musk. And I think multiples of us have talked about this before, but the data that supports maybe there's something there. Look at Germany. The number of Teslas that are being sold in Germany is down 70%. There's some similar reaction in France. You look in the US, California is a massive market for EVs. The latest data shows a double-digit decline in Tesla registrations last year. And I think every other automaker was up at least 1.4% in registrations. So you say, well, okay, well, it's not necessarily an economic thing. Then you look in China, way down, totally different market. Certainly the things that Musk is doing that maybe are alienating a certain political cohort in the West, it's not affecting Tesla sales in China. Tesla sales are down a ton in China, but the now the biggest automaker, electric automaker in the world, BYD, right? BYD's kind of they're growing, like,
Oh, yeah.
But if you look, BYD sells $10,000 electric cars, so there's also the potential, like even in California. There's a lot more lower cost, lower price cars. So even in the Tesla case, outside of a certain markets where it seems to be really concentrated, it's not clear that it's the case. What we don't know, and as investors, this is the most important thing, is just as we're seeing with home builders with their temporary cyclical pressures, we don't know if these things are going to be persistent problems for a Tesla of the world. I think we can also look at, Dan, and I know this is something that I'm sure you've followed over the years, is ESG investing.
Yeah.
We've gone through a change there, and it may feel like a political change, but we could go back 3 or 4 years ago, 5 years ago, even during the pandemic, when a lot of ESG funds started adding oil and gas into that mix because of the idea of shifting away from the environmental harm to, there's a massive cohort of the world's population that should have access to energy, and not capitalizing companies that are developing affordable energy is not an, ESG thing. So
Yeah.
again, it ebbs and flows, and I'm yet to see anything that persistently makes it clear that there's incremental change, of course, but whether it's a permanent and measurable shift in any way that should inform how we invest in, I don't know that there's anything there.
Well, I mean, there's nuance too, Jayson, and you pointed out there. I mean, there are some policy, what do you call them? Like policy analysts, policy makers, not policy makers, because I'm not talking about like members of the government or anything
Talking
like
about
that. But
pundits.
no, it's more than that. I want to say activist, but activist definitely has the wrong connotation here. The
Okay.
people who try to implement and guide policy
Right.
have different views on how to do that, and they run the spectrum. I mean, some of the some people would like ExxonMobil to cease to exist because of what it's done. Other policymakers, other policy folks, even though they may have the same long-term goals, believe that there is a different way to achieve those goals, and that may well be to allow ExxonMobil to exist, but to urge it to consider making moves that change its business over time to be something closer to what their long-term goals may be. And I'm not in a position to say which one of those strategies is most likely to work, or if either of them is likely to work. But you throw out any of these alphabet things, whether it's ESG or anything else, and it hides the fact that there's so much nuance, and there's not necessarily unanimity among people who are proponents of those views as to the specific strategies to use. The implications can be different. And so I think that's kind of what we're seeing here is, it kind of doesn't matter whether a company has, whether you mention certain words in your annual report. What matters is what you do. And if
Right.
the results are the same, then if you chose to couch your language one way or the other, like, I don't necessarily care that much if you achieve the end purposes, the end results that I wanted you to achieve, then I'll be satisfied with that, because I'm pragmatic about it. And that's a thing. But not everybody's like that. Some people want that to be a more visible thing. And companies, frankly, I think companies have really gotten behind that. Oftentimes you are seeing reports that are separate from annual reports that are specifically geared to explain to all interest groups, not just shareholders, but customers, community members, what a given company is doing in certain areas that may be of interest to those groups. And, I mean, is that something that like do you think that Rockefellers and Carnegies were doing that a century ago? No, I don't think so. Not in their annual reports, they weren't.
No, not at all. All right, what's next? My turn. You want me to grab one?
So I'm going to want to get Ed's question before we run out of time. But we don't have to do it now.
Let's do it.
Okay.
Okay, so are we going to do? There's two actually. Which one?
Oh, geez. All right, not the Korean chip startup that I have. Oh, okay, yeah. Sorry. All right. Let's do Ed from 14 minutes ago. These three stocks are big individual percentage losers in my portfolio. You got PayPal, ticker PYPL, down 55% for Ed. You've got Elf Beauty, ticker ELF, down 52% for Ed. You got Moderna, ticker MRNA, down 43% for Ed. Which of these three stocks would you have no problem adding? Ed, I'll tell you what, I did 11 hours on the Fool24 this weekend, and that's an eye-opening experience for me, because I think I might, I don't know. I'd love to. I wish I could have all of the viewers. I may have watched more Fool24 than anybody else this weekend, because like a viewer. I think those viewers, they'll tune in for a show because they like the show, and then they'll tune out, and it's all good. But 11 hours is a lot. 11 hours you get to. I talked with several different hosts. I'm trying to do the math in my head. I think it was 5 or 6 hosts. One of the hosts that I spent a good amount of time with was Brian Orelli, who is a PhD and has a huge scientific background that he applies to healthcare and biotech stocks. And he is very bullish about Moderna, ticker mRNA, and and I understand why, because I've seen it firsthand. And Ed, I feel your pain, and I double your pain, because I was early to Moderna. Moderna went from 0 to like $500 a share, almost $500 a share briefly, and then it fell back. It lost like 50, 60% of its value. It was down in the 200s at some point. And I was like, yeah, that looks good. I believe in what Moderna is doing. Yes, they are going to see a drop in the product sales they have from their COVID-19 vaccines, but it was a proof of concept. They should be able to take the technology that created those vaccines, create vaccines for other problems, other diseases, and we should have a long and prosperous future. Well, since then, I'm down like probably 85% on those positions, because we were down somewhere in the 200s, and now we're around $35 a share last I checked, somewhere between $30 and $40 a share. And that stinks. I mean, it's a painful thing. It is by far the worst position that I've had. And the sad thing is, I still have conviction in the company. I think my investment thesis is still intact.
Yeah, absolutely.
I just goofed up on the valuation. So if there's one of these
that's the key,
that I
Dan.
would buy,
that's so important, Dan. That's being willing to acknowledge not that something external happened, but there's a mistake that you made.
Yeah,
right. And not throwing the baby out with the bathwater.
I cannot blame anybody but myself for this one. I mean,
that's so powerful.
Yeah.
But also being able to acknowledge, hey, this is a wonderful business. I goofed. I bought at the wrong price because of the detachment from their commercialization and all of the potential products that they have still working through the regulatory process, and acknowledging that mistake and not making reaching the wrong conclusion. Dan, I want to focus on that for a second. Go ahead.
And I've hesitated, Ed. I've hesitated to pull the trigger on doing another buy, because frankly, that's enough of a hit to me mentally, that it's sort of like, okay, my process, like in that particular situation with this particular company, my process was broken. And I'll admit, this was something that, like, I'm not a biotech guy. I have no scientific background. If I look at a clinical trial, I can understand the statistics, but I can't understand the medical science. I can't understand whether, sure, the study folks picked primary endpoint, picked secondary endpoints, but I don't know whether like are those ambitious? Are they meaningful, or did they just pick them so that they could achieve them? That's something that I don't have nearly as much expertise as Brian does. And so, I have learned the hard way that you buy stock at 200 and then it goes down, and you're sort of like, well, I still feel good about this. I'm going to buy a boatload more at 150, and I'm going to buy a boatload more at 100. I've seen people really cause damage to their portfolios doing that.
Mm-hmm.
And, because the market doesn't have to agree with you. And, even if the market's being irrational, it can be irrational for a long, long time. And so, but at 30, at 35, we're starting to get to the point where, there's no more damage that can be done from, the COVID-19 franchise. Investors basically, almost counting the COVID-19 franchise out entirely.
Yeah.
And so, now it's just a matter of, are they going to go forward with their other products, and how are those products going to be received on the market? I tell you, probably my only hesitation there is that I think public confidence in vaccines overall has deteriorated in a way I never anticipated. That there's a large group of people that are just going to be distrustful of any vaccine for any disease, no matter how well received it has been, no matter how efficacious it has been in preventing that disease from coming up. That's a shift that I didn't anticipate, and it's one that can affect sales. But it doesn't change my conviction that Moderna, ticker mRNA, it has the technology, it has the know-how. We're going to get medical advances from them. And so That's my pick from the three. Jayson, do you have a pick from those three, or do you want to give us a wild card and give us number four? I don't know.
So I could give a wild card, but for the sake of brevity, which nobody ever expects from me, so surprise everybody. I will say that so Elf, there's some business things they need to work on. There's been a little bit of, they've had some challenges, right, with just weakened demand. But with PayPal, the turnaround's largely worked. I think that's the thing I want to just sit on with PayPal, is that the turnaround has worked. And with the right expectations going in, that this is a deep value stock. We're talking less than 12 times, 11 or 12 times free cash flow. You're buying a solid business that doesn't have zero growth prospects, that they have some decent growth prospects now that they've kind of shrunk to get bigger. They've shrunk and really refocused. They're going to start accelerating growth a little bit, I think, over the next couple of years. That you're getting a deep value. And I think the risk reward profile is incredibly attractive for PayPal right now. That's not a right fit for every investor, right? So, I mean, there's going to be a little bit of expecting the multiple to increase here and expand as part of the thing that makes the value go up, not just growing earnings. But I do think PayPal is pretty attractive right now. It could get ugly, if we go through more economic uncertainty, if they lose any of their white label payments processing business, if they lose a big customer there, that could be a meaningful impact on their revenue and bottom line. But again, looking out 4 or 5 years, I think today's PayPal price is going to work out really good. I really do. All right. I want to take one more. There's another question. We've got about 7 minutes left before we turn it over to we call it the late morning show.
Exactly.
With the
slackers.
So, those guys showing up at 9 o'clock with their fully caffeinated bodies. All right. So I need input asked earlier in the show, said, good morning to us. So good morning to you. I need input. Any small mid-cap industrial stocks that could be, he said, would be long-term investments with potential onshoring themes if that starts to taking shape. So I'm going to talk about a couple that I like a lot. And I've talked a lot about these before. And then I'm going to throw a wild card in on top of it, Dan. But the two that I particularly like that I think are compelling,
man. Remember, you got 8 minutes.
I know. It sounds like I'm being too ambitious, but I can do this. So
I know you can. Let's do it.
Trex would be my wild card stock, one that's down a lot.
Yep.
That would be my wild card for the prior question, which is the reason I saved the wild card. So Trex's business is composite decking. That is their largest business. They do some railing as well, nice railing that matches with their decking, the accessories to install the decking. Trex has become the brand, right? It's the Xerox, the Kleenex, the Coke. It's the established brand in its industry. It has by far the largest market share because they have some of the best products and they've done a better job with distribution. And I'm not even talking about the Lowe's and the Home Depots, where they have a very good presence. Where they have won and where they continue to win is with distributors that work directly with commercial installers, that work with the pros, because those pros drive the bulk of the deck installation. So you have good relationships with professional deck builders. You have a step ahead of your competition. Now, in different markets, there are other products in other regions that do well, but on a national basis, nobody has done a better job of getting in front of more professionals in their specialization than Trex has. They are the low-cost leader in terms of their manufacturing process. They manufacture at scale. They already manufacture domestically. So they were in onshoring, nearshoring before it was cool, right? So they're the OG of this because it drives their costs down, because it's a large, heavy, expensive product. And if you're manufacturing it overseas, the cost of getting it to your markets doesn't help you. So they've been smart there. They're actually expanding in Arkansas right now. And over the next year, they're going to be bringing that facility online that gets them closer. They already have manufacturing in Virginia, but Arkansas, you get a little bit deeper into the Sun Belt, and it positions them really well. Talking about housing, that demographic trend in the Sun Belt, it's the same thing for decking. So, and that's an area that decks are more of a year-round thing. So being closer to that market, driving out cost is smart. They're exceptionally good at that. I don't know how long it's going to take for the investment in this stock to pan out. Again, all of the pressures on home building are there for deck builders too. So we'll see how it pans out in the near term. But I think as a long-term investment, Trex is going to do what it's always done, and that's be a really, really good investment. One, we're nearshoring. I think we're going to see continue to drive in. There's more focus on the domestic energy infrastructure. Chart Industries, ticker GTLS, I think is a good play on that. But also, internationalization is going to continue to happen too. That we're not going to have 50 bubbles around the world where everything happens inside those bubbles. We're going to continue to be international in a lot of ways, especially with energy. So I would put Chart Industries in that. I'm going to throw a steel company in there too. That doesn't fit based on like the traditional, Dan, the mid cap size, which I think is like 2 to 7 billion. We've been saying that for 20 years, Dan, and I'm pretty sure inflation, $2 to $7 billion is a lot bigger number now than it was when whoever defined the market caps got to say they were 2 and 7. Right?
I was talking about this yesterday. I don't know where the line is anymore. Yeah, agreed.
Yeah. So I am arbitrarily making a ruling that an $18 billion steel company is a mid cap company, because if you put it in the world of steel companies, a lot of which are much, much bigger, like Nucor, for example, which we had somebody, I believe Ed might have mentioned it in here. Steel Dynamics, I think, is a really compelling company. It's the smallest, newest U.S. steel company. They exclusively use mini mills, electric arc furnaces, so they don't have these giant blast furnaces. That gives them competitive advantages, that the same thing that Nucor has at a larger scale in the cyclical steel market, where they have variable cost structure, where they can bring down their operating costs a lot more quickly than the blast furnace operators like U.S. Steel and like Cleveland Cliffs can do. So that's a competitive advantage when the market gets weak, that allows them to be strong when the market recovers. So I think Steel Dynamics is compelling and interesting at this price. Again, we have the wild card of the cycles and the economic uncertainty with tariffs potentially affecting the economy and big industries. Like we just saw Cleveland Cliffs is shuttering some of their factories that primarily produce iron that's then used in the steelmaking. It's an input into the steelmaking industry, largely tied to kind of what's going on with the auto industry. So with the cycles, we never know what can happen. So today's interesting price could turn into a super compelling price if we do go into a downturn. But I think Steel Dynamics, we overlook it sometimes because it is a small player. How'd I do? I left minutes, Dan. I left minutes.
I know. I'm nonplussed. I'm not quite sure what to do, but I do know what to do. I've got to. If I wish I had. I was never a football official. I was a soccer official. I don't have my yellow card with me. But we got to get a penalty flag on Jayson for Steel Dynamics, ticker STLD, because while I agree that an $18 billion market cap might be on the fringe between large cap and small cap most of the time, I have bad news for you, buddy. Steel Dynamics is actually in the S&P 500, which I'm sorry, but pretty much by definition makes it a large cap stock.
That's because people are making bad rules. Hey, we're Motley and we're foolish.
Oh, here. let's not get started about people making bad rules or breaking bad rules, or we'll be here for another hour. Let's see. So, fools, what do we got? We got a minute.
Yeah,
we got a minute. A minute is not enough for me to take any questions that we've gotten. So I'm just gonna throw out there, fools, as you see what happens this week. Just bear in mind, we've been in a period where market turbulence, a lot of people think market turbulence has been up, but I'm just going to say it. Corrections happen. 10% down move in the S&P, it is painful. It can be scary, but it is par for the course. It is not something to be alarmed about in terms of long-term investing strategy. It's just something that happens from time to time. Doesn't mean you shouldn't pay attention to your portfolio. Doesn't mean you shouldn't take the opportunity, look at the individual stocks that you own and make sure that you are comfortable with them, that you continue to have conviction in their ability to adapt to changing economic conditions and still thrive. You should definitely do that. But it definitely does not mean that you should go into panic mode and start doing a whole bunch of stuff that you may later regret. That is not what you need to be doing right now.
It is. We're at the top of the hour here, Dan. So I want to share Fulio's comment. I think this is great. One thing I like about the pre-morning show, and I'm going to start calling it the morning show. Questions of all kinds are answered. This is no halls barred. I think we could also say caps off. Caps off. No halls barred. All right, let's bring the morning show crew to the stage as we wrap up the first hour.
Fools, thank you so much for joining us. Have a great day.
See you, fools.
See y'all. Good to see you, Jayson. Good to see you, Dan. Welcome in, fools. It is Monday, March 24th, 2025, and this is the morning show on Motley Fool 24. I'm Nick Sciple with my friends and foolish colleagues, Emily Flippen and Jim Gillies. How are y'all doing this morning?
Hey, doing well. How are you?
Hey, no complaints. We had a great weekend of college basketball. Wicked was available on streaming, so my wife was excited. And now we've got stock market news to talk about. As always, nothing to complain. Let's kick it off. Obviously, if you look at the market this morning, S&P 500 and the Nasdaq both up more than 1% in the pre-market. This largely appears to be in response to some tariff reporting we've had out this morning, according to reports from Bloomberg. I believe was the original reporter. I've seen in Wall Street Journal everywhere. The White House intends to narrow its tariff plans when they are announced on April 2nd, which, believe it or not, is coming up in about 2 weeks from now. Sector-specific tariffs on autos, pharmaceuticals, and semiconductors no longer expected to go forward, according to the reports, although reciprocal tariffs still planned. Reports suggest the tariffs will be now targeted at the so-called dirty 15 countries. That's the 15% of countries with a persistent trade imbalance with the U.S. Countries that have been called out are Australia, Brazil, Canada, China, the European Union, which that's not an individual country, a bunch of countries, India, Japan, South Korea, Mexico, Russia, and Vietnam. Although that's still going to hit most of the imports that come into the U.S., this dirty 15 approach, still a narrower one than many observers had been anticipating back when federal agencies were ordered to design reciprocal tariffs back in February. And it's likely what's driving the rally this morning. I guess, what do you make of, I guess the market's response here? We've certainly been in a macro-driven environment really all throughout 2025, high levels of uncertainty, and maybe you get a little bit more clarity this morning and a little bit of a relief rally, but it doesn't seem like we're out of the woods yet.
I actually feel like this is maybe the opposite of clarity here. Not to say that there can't be a relief rally. And I do think that the flexibility around some of these tariffs, especially given the fact that they seem more limited than a lot of people feared. And it does seem like there's the potential for individual country by country negotiation, individual industry negotiation. All of that leaves the potential for the impact on consumers, on businesses, to be less than what, again, a lot of people feared. But I do feel like the uncertainty about exactly who will be impacted and how severely they'll be impacted. We don't even know the countries that are going to be impacted. Nick, the list you mentioned are just the companies that we have a trade deficit with. They haven't actually announced which countries it will be. Just means that the market's going to, up until April 2nd, and then probably there on out, going to be dealing with just a lot of uncertainty around who will be most impacted by tariffs. And when you're a business trying to make decisions about purchasing or employment, that just adds an element of unknown into your decision-making process. That being said, it is good to see that this is heading in the direction of potentially less impactful than what, even a week or two ago we thought was going to happen.
So, as the token Canadian in the room, one, I think you should be viewing this as an off-ramp. This is, we're only going to do reciprocal tariffs on countries. So the fight that we started, I'm speaking here from the American perspective, apologies. You all know how I feel about you. The trade fight that I started, or we started, depending on if you want to take the president as the personification of America or not, and that other countries responded to, we will now respond only to their responses. That's an off-ramp. That's basically, hey, Canada, if you drop your reciprocal tariffs, we'll drop ours. I think that's a positive. I agree. I have to admit that Emily's comment of being able to engage in country-by-country negotiations is hilarious, because we actually did that. It's called the Free Trade NAFTA USMCA, whatever you want to call it. Which president was it that negotiated that one again? Or was president during that? Right. Okay. Yeah. Okay. Anyway, let's move on. That could get awkward. It was a beautiful deal 5-6 years ago when it was done. The next thing is the concept of dirty 15 it is true that America has a trade deficit with Canada. Why? It's
Energy,
one
right?
product.
Oil. Yeah.
One product. You are free to not buy it. And what this has done, I mean, and again, I don't want to get terribly political because A, it's political. B, who cares? It's Canada. And I say that as a Canadian. We are largely apathetic most of the time. This is really, at least talk. It's very hard to build a pipeline or two in a couple of months, as you all know. This has really engaged the country in, you know what? It's time for national projects. It's time for things that basically to sell our oil to other places more willing to pay for it. Now, there have been historically two hurdles to that. The first is the type of oil that largely predominates in Canada. It does trade at a discount. It's called, it's Western Canadian Select because apparently we like our oil with a side of sulfur. And so it's sour crude, or what do you want to call it? It takes a lot more specialized refining talent, and you guys have that refining talent. And of course, it's the cliche. It's very, very hard to get a new refinery approved, right? Because the environmental aspects of it. And hey, you guys have got perfect. We've had this wonderful trading relationship for however long. We send you our sulfurish oil at a discount. You process it. Everyone's happy, except now everyone's not happy. I think this is going to be a natural, a natural catalyst for Canadians to get off their maple leaf posteriors and, actually make a serious pledge and a serious play to not only moving oil better within our own country, but as well probably build our own refining capacity. At least that's certainly the talk. Again, it's only been a few months. You don't build these overnight. The second thing, and it's a good start, was the twinning of the Trans Mountain Pipeline, which the government of Canada bought from Kinder Morgan in 2018, Nick? 2019?
Somewhere.
I'm roughly
2010s.
Right.
Before
it's late 2010s. Okay. And it like all government projects, it ran horrifically over budget. But it is complete now, and the government of Canada is probably going to sell it off to other investors at this point. One wonders if they'll recoup their investment. I know which side I'll bet. But that's a good start, and that gets oil from the center of Alberta, the center of the Western Canadian Sedimentary Basin. That's too much of a mouth feel. It gets it out to tidewaters, mainly in British Columbia, obviously. So that is a good first step to diversifying. So my take on this, this trade deficit and looping Canada with a dirty 15, and yes, I'm taking umbrage to this. Part of it's because we're doing a show. You guys could have a trade surplus with us overnight. And as I have been informed, reliably informed, that we have nothing you want repeatedly. I encourage you to take us to trade surplus for yourselves, and that way you will. You'll be paying more at the pumps, of course, but it's not no sacrifice is too large, right?
No.
Anyway, that's my sarcasm Monday, non-caffeine fueled.
Yeah,
and I had an inch of snow outside of my driveway this morning. Okay, we're supposed to be done with this nonsense, and I'm in a mood.
Yeah. Well, yeah, and just to reiterate your point, if you snap your fingers, tariffs disappear tomorrow. I think there have been some changes to global trade and kind of the assumptions that the participants have that will endure beyond the year 2025.
Trade surplus is good, or a trade deficit for you guys is good. I mean, you guys are an export economy. That's good for you. Right. To attack other countries because you sell more to them is odd. Or sorry, that you buy more from them is kind of odd. Anyway, that's whatever.
So I guess my last question before we move on here from tariffs, right? As we've said, there's been some uncertainty around what the policy stance will be. There continues to be some uncertainty in the market, as to what exactly will happen on April 2nd. Do you think uncertainty has peaked at this point? Or do you think there are chances that things get that much more uncertain? Because I kind of get the feeling that we're headed towards a more concrete, easy to understand idea of what things are going on. And if we have reached peak uncertainty, then maybe on the margin it's a time to think about looking for opportunities. I don't know. What do you think? Do you think that we are starting to see light at the end of the tunnel, or are we just as deep in the tunnel as we've been the whole time?
Emily?
I need to find a piece of wood to knock on here because I'm very much inclined to agree with you, Nick. It does feel like we're kind of seeing the light at the end of the tariff tunnel, so to speak, which is causing a lot of the uncertainty that we're seeing in economic data. The reason why our GDP estimates have been all over the place, the reason why the Fed doesn't really understand what they're going to do with interest rates. Nobody really has a clue what's going to happen to inflation. All of this kind of coming down to what consumers are going to behave like, which depends on prices, which again depends on tariffs. So all of that is to say, with some certainty coming, hopefully in April, about the exact impacts of the tariffs, I think that removes the uncertainty, and I think that's kind of what the market needs, for better or worse right now. And but how many times have I said this in the past and been horribly wrong? So I'm knocking on my fake wood desk right now, recognizing I'm probably cursing it.
I'll get you. Maybe it might be the end of tariff uncertainty, although a couple of things, and again, I'm in a snarky mood, but first off, I thought, and this is actually not meant to snark. This is actually meant to serious. They're taking policy statements as as at their face value. I was under the impression that the plan was to use tariffs to offset a great amount of taxes paid by, charged, like, the thing that was thrown out, no income tax, no taxes on tips, no taxes on overtime. Sure. And in order to have that shift from, government revenue coming from here, income taxes, to here, tariffs, you need to charge tariffs.
Yep.
Right? And I'm not sure they're fully willing to walk that back yet. Or, I mean, aside from the notion, I think it's not likely to succeed, but be that as it may, I'm just kind of curious how this will play down, in the U.S. when a lot of people were getting excited over $5,000, Doge dividends and what have you. So I find it's kind of interesting. But for me, even if tariff uncertainty is done on April 2nd, which I in fact do not expect, I think we'll just continue doing this because I think the present administration likes this kind of volatility, frankly. And what is it, Nick, from Game of Thrones? Chaos is a ladder.
Yes, Littlefinger.
Yeah, exactly. So even if this is the end of tariff uncertainty, I don't think it's the end of uncertainty. And I find it useful to look back at the first Trump administration from early 2017 to early 2021. There were some very good market times during that period, and there were some not so great market times during that period. And I'm not thinking of COVID, actually, because I think it would have been irrelevant as to who was in the White House at that time, frankly. You can look at literally any other stock market in the world besides the US, and they performed exactly the same. But no, like 2018, I wrote a column in December of 2018. I think I titled it "The Year No One Made Money," because literally every asset class went down, and that's the year that pot was legalized in Canada, and Canadian pot stocks went down in 2018. Like everything went down across the board, and that was neither the present administration's fault at the time, nor was it to their credit when the market bounced back the following year. So I think that we need to, I think we need to kind of strap in for enhanced volatility, which is perfectly fine. You just, if you're the kind of person who freaks out when your portfolio moves 5 or 10% in either direction, although really no one freaks out when it goes up 10%. But if that unsettles you, that could be a little problematic. The way you deal with that is mindset. You say, I'm going to check my brokerage statement once a month. I'm going to check my brokerage once a month. I'm not going to change how I'm saving every paycheck, or I'm not going to change my investment strategy. If you want a little less volatility, you can raise a bit of additional cash, but you recognize the trade-off of that cash won't be deployed to potentially go up. So there's a bit of a hedge there. If you were feeling terribly sophisticated, there are option strategies you can use to kind of hedge things away. As the former advisor for Motley Fool Options, I do not, in fact, advise using options for hedging, but you can. It's expensive protection. But I think that we're going to have uncertainty. I think history has shown when we've had uncertainty, it's been okay. And if we don't, then it's a bonus, right? So if you kind of reframe your mindset and go like, the uncertainty and the volatility is going to be here. It's probably a function of the present administration who kind of likes a little bit of that. Okay, fair enough. And it's just kind of like, okay, this is the new normal for the next 4 years or however long after that, depending on, the next administration. The one thing we do know is the page will turn. So.
Yeah, I think Cena nailed it. Only certainty I can see right now is fluctuating lack of certainty, which that's the true of the market at all times, and maybe especially true here in 2025. One area of uncertainty, Emily, is what is the FDA gonna do with these GLP-1 drugs? The branded drug makers are supposed to have the market cornered now. Doesn't look like that is the case, at least as we sit here today.
Yes, and I love that this has now become the thing I talk about every Monday on the morning show here. And it actually is a really interesting industry that, to your point, Nick, we seem to be getting news out every week. And the big news that we got out this week in regards to the access and disposal of GLP-1s is that as of this week, manufacturers are supposed to stop compounding and giving out access to trizepatide. Am I now pronouncing it correctly? Let's hope I am. That is the active ingredient in Eli Lilly Zepbound. So during the first initiation of these GLP-1 drugs, Wegovy and Zepbound, which are two competing GLP-1 based weight loss drugs, were both in shortages. And so there was, the FDA allowed compounding pharmacies to effectively produce these drugs and distribute them to make up for the shortages. Trizepatide went out of shortage first. As of this week, compounding pharmacies are supposed to stop compounding the drug and giving access. In May, I believe they're supposed to stop compounding the active ingredients in Wegovy and Ozempic. That's semaglutide. That's out of shortage now. So it's supposed to be this kind of like tapering off period. But we're still seeing, as of today, a number of compounding pharmacies still marketing these drugs, still theoretically providing access. Some have gone offline in regards to this, but others are presumably fighting it. And Nick, we had talked about this previously, about the idea of kind of betting the farm on these drugs. And for a lot of these compounding pharmacies, these digital pharmacies, that's effectively what they're doing, is they're kind of calling the FDA's bluff here. And they're saying one of two things, and maybe a little bit of both, to be frank. They're saying, we're still going to produce these drugs. And not only do we think that we are exempt from the rules for X, Y, and Z reasons, for instance, we're changing the dosages for each individual patient, we're adding in vitamins, we're doing something to change the formulation that would exempt us. And the second reason being, we just don't think the FDA is going to do anything about it, right? Come and get us. The consumers have access to a cheap alternative drug for what is, for many people, a life-saving, life-changing medication here. And they're just kind of betting that the consumer backlash that would come against the government in the case where they remove access to these compounding pharmacies would be pretty dramatic and pretty extreme. So it's definitely an interesting situation to be in. I'll be very intrigued to see what the FDA does. Part of the reason why I want to talk about this, Nick, I was scrolling through Reddit, I believe it was on Friday last week, and I was seeing ads from Hims and Hers, who is one of the largest compounding pharmacies here in the United States. And they're actually a publicly traded company as well. I believe the ticker is just Hims. And they are, putting ads on places like Reddit saying, hey, click this link to send an email to Congress, to the FDA, saying you want to retain access, basically putting the consumer pressure onto the government to allow compounding pharmacies to continue. And I think a lot of people can interpret this different ways for recommendations like Novo Nordisk and say, oh, well, this is a really bad thing, right? Because cheaper access means that potentially there's less demand and less sales for a business who actually has the patent on these weight loss drugs, who is making them and selling them for a more expensive price. But Nick, I think it's something we talked about previously, and I want to hear y'all's thoughts about this. But this is something that I think is just exemplifying what a massive opportunity the weight loss drug market is. And if you are a business who is willing to bet this future of your entire business on whether or not you can sell GLP-1s, that tells you everything about the demand for GLP-1s long term.
Yeah, for me, I think about who are the people who are going to win here, right? It's the people who own the underlying rights. I mean, at least provided they're able to enforce that, right? As you mentioned, there's not a third party enforcement of these FDA restrictions. You need the FDA to come in on their own and kind of make that enforcement take place. But I mean, incredible demand out there in the market, just be signified by the legal risk that folks are willing to take. And obviously the lawyers are a winner here too, because there's going to be some lawsuits and some folks are going to have to kind of defend these stances. And I think Hims and Hers, while they're not have backed off from selling some of the compounded GLP-1 drugs, semaglutide, that sort of thing. As I understand it, they're also trying to use that I guess, custom formulation loophole where we use a custom dosing regimen for our customers, which allows us to keep the product out there on the market. Yeah, for me, it just says that these weight loss drugs are going to be huge. I mean, that's already been pretty clear from what we've seen the past several years. But the fact that you have people lining up to sell your product can only be good for kind of the underlying demand. You just hope that, again, the folks who own the rights to these chemicals are able to actually enforce the patent and capture the earnings stream. That's the kind of the one risk here, but the risk is certainly not demand. Demand is more than can be met by the market. And
yeah, I'm not sure I can spell GLP-1 or GPL-1 or whatever you call it if you spot me the G and the L. So, it's. I find Emily's comment of come get us to be amazing. I think that if they're basically just challenging other players. Like it's almost like it's a gold rush and a land grab. And I historically have a really bad track record in gold rush and land grab type things. So I'm just gonna say this is on my personal too hard pile and let the rest of y'all play. I agree. I've talked to a few people on Ozempic, and both spoke very glowingly of the hey, this really works, and I'm thrilled for them. I really am. I'm doubting when I was in Mexico a month ago. I'm doubting the sign saying Ozempic at the side of the Mexican Wharf pharmacy was legit. I'm imagining that probably wasn't real. But they were offering it there. But I know that's about $1,200 a month from the people I've talked to that they're paying largely out of pocket for. And I think if I was making that kind of expenditure, boy, I'd want to know that it's working. So by all accounts, it really is effective. But I stumble over the concept of like I said, the gold rush, the land grab. Everyone's playing. You don't know how it's going to unfold if it's too hot of a sector. I like my investment to be boring. I mean, hands up, who's surprised? And this is nothing but boring, or this is anything but boring, I should say. So I just, I think it's a God bless and good luck to all involved. But I think I can't call the winner here, so I'm not going to play.
Well, I will challenge you, Jim, to take a second and look at. I love that comment because I think it is entirely true. And when you see this kind of craziness happening in an industry, it's a lot easier to say, let me see how this shakes out a little bit. To have that certainty, we talk a lot about uncertainty, have a little bit more visibility into what this can look like long term. Then you can make, you're not making a bet at that point. You're making an investment, right? You have a real thesis underlying it. That being said, there is one business that I think, and Eli is an incredible business, but valuation I think is really stretched right now, and that adds that uncertainty. That being said, their business in Zepbound and Trizeptide, that to me is a drug that has gotten a ton of approvals for extra things. Again, compounding pharmacies aside, that could just expand in the future. That is incredibly effective, incredibly accessible. But Novo Nordisk, I think, is in my personal favorite play on the GLP-1 market. And it's largely because its valuation has been de-risked to the point where I think it makes a much more compelling risk-reward valuation for this company. Expectations for Novo Nordisk are, I would say, near at, if not at, all-time lows. They're the business that creates Ozempic and Wegovy. They just launched a direct-to-consumer pharmacy here in the United States that allows consumers to have access for $499 a month out of pocket. So they're now slashing their out-of-pocket prices to be more competitive with the Zepbounds of the world, and that's great from there. But I will say there is a couple of pieces of news out this morning that I think is worth interesting and worth talking about. One of which we have a question here from Let It Ride, who says, any thoughts on Novo Nordisk's deal with United Labs obesity drug? So as of this morning, Novo Nordisk has made a deal with a Chinese company called United Labs, basically to help bring and distribute their weight loss drug that they're, I believe, in phase 2 development in China right now, to global audiences. This isn't anything super groundbreaking. We don't know the exact price of this deal, but Eli Lilly made a similar deal with another Chinese competitor. So this is Novo Nordisk just trying to keep their options open. And that's coming off the back of what has been a couple of subsequent failures of CagriSema, who was one of their new weight loss. They thought it was going to be the Wegovy killer, right? And it's turning out not to be. It's effective, it's fine, but it's not more effective than Wegovy. It's a little bit better. I think the trials, again, we still won't have the news trial, I believe, out until early 2026 at the latest. But basically saying it's not as good as we thought it was going to be. Everyone's really focused on total weight loss right now as opposed to weight maintenance. Again, all of that leads to what I think is a really compelling valuation for a company that has dominating market share, strong partnerships, incredible levels of profitability, which I believe includes a dividend if memory serves correctly. And then dominance over the obesity care market as well, especially globally. Now, the tariffs that we spent a lot of this today talking about could negatively impact a business like Novo Nordisk should they be implemented. This is a Danish company. So obviously, if there's some sort of like tax or tariff that goes into effect for EU-based companies into the United States, that could negatively impact them. But the benefit of Novo Nordisk versus an Eli Lilly of the world is that a lot of the ingredients that are used to create GLP-1s are actually from China. There aren't a lot of alternative sources for the ingredients that go into production of GLP-1s. And Novo Nordisk, obviously being an EU-based company, isn't levying tariffs against China right now. The United States is. Eli Lilly is a US-based company, so they may have a harder time or a higher price getting access to their core ingredients, which may hurt their margin profile. That was a long-winded answer to say I like Novo Nordisk. I think there's some uncertainty there, but the price is cheap enough that I think it's worth it.
Now, it is out of curiosity, and I do not know the answer. Is Novo Nordisk in the S&P 500?
I don't believe so, and I think that might be because they're not based in here in the United States.
It's extra. Oh, so it's extra domiciled. Okay, yeah. So, but it would be in broad, for those like me who are uncomfortable investing directly in this space because track record of investing in hot things in the past. If you have a portion of your portfolio dedicated to index funds, so I've said many times, about 40% in this house is against index funds, and about 60% is actively invested. And of the index funds, it started out 40. Basically, let's just call it. It's 50% S&P 500, 25% TSX, so Canada, my home, obviously, and then 25% a broad rest of the world, your pan-European, pan-Asian index. So I probably have some minuscule exposure to Novo Nordisk, and I do take, when Emily says something is cheap, I do take that as okay, that's probably worth me looking at. I have actually, paradoxically, I have looked at Eli Lilly in the last couple months, and I thought, wow, this is a dominant business. Wow, that's a big price or big valuation. I don't think I would willing to pay that. So
that's fair. And one additional follow-up here before we move on, because I know we spent a long time talking about it, so I apologize. It's possible that Eli Lilly is in the S&P 500. I'm not positive about that. Yeah, I know. I apologize. Thank you for checking, Jim. But one question here from Shotgun Santa, who asks if the compounding pharmacies are subject to the same rigorous testing and approval process as commercially manufactured drugs. This is a great question, and one that is a little bit more complicated than a sheer yes or no. The FDA reviews and approves the labs that compounding pharmacies use, but not the drugs themselves. So it's this kind of like gray area. Now, we haven't really seen, that I'm aware of, any extreme negative outcomes from using compounded drugs. They're largely safe. That's why people have access to them. But I do think there is a perception that the process of review is not as strict as your branded drugs. And that can lead people to be like, if I'm going to be, injecting myself with stuff that could potentially lead to, some mild to moderate side effects, maybe I want to use the branded stuff, not the cheap stuff.
Yeah, and the FDA put out a statement about these compounded drugs, I believe, like last week on the 17th. And they say specifically, unapproved versions do not undergo FDA's review for safety, effectiveness, and quality before they are marketed. So it's certainly something the FDA is aware of and put some statements out. And maybe that is a glimpse at whether there will be some enforcement action coming down the pike. We shall see. But that'll be something for us to talk about next week. Maybe there'll be a lawsuit filed, but before we come back and talk.
I'm kind of missing merger Mondays, actually. And just very quickly, Emily, not only is Eli Lilly, I learned this today, so now you get to as well. Not only is Eli Lilly in the S&P 500, it's the number 12th largest weighting in the S&P 500. Like it is almost Mag 7 Berkshire Hathaway-esque. Like, yeah, boy, well done, guys. And it reinforces what you said earlier about how large this opportunity is with these types of drugs. So
yeah, I say this because it is a massive opportunity and a massive valuation. That's probably 10 times the price of a Novo Nordisk.
So all of us with S&P exposure, which I believe is all three of us here, we all own a piece of expensive Eli Lilly, and probably not enough Novo Nordisk, according to Emily. So.
Well, maybe consider the GLP-1 exposure already in a portfolio before adding Novo Nordisk.
I just think it's cool. I think it's cool. I'm still waiting for my two favorite companies in the S&P 500 to make it into the top 10. That would be MasterCard and Visa.
There you go. Jim, what's on your radar this morning?
Not a lot, to be honest. There's not a lot of news. I was quipping earlier. I kind of regret the loss of, I don't know, like I like merger Mondays. Usually historically a lot of deals show up on Monday. We haven't had a good one for a while, or at least one in my orbit. I was monkeying around with Y charts this morning because I was usually at breakfast. I'm the only one left in the house by then, which was the case today. And, so I read the Globe and Mail online, of course, because who buys newspapers anymore? But I saw a comment in the investing section saying, talking about Berkshire Hathaway. And it was where can you, the theme of the article, where can you go in this uncertain world, to kind of go back to our early comments about uncertainty. And any financial publication, including the Motley Fool, I will point out, including this show, will talk to you about, when you have uncertainty, maybe you want to look over here instead of over here. And, it's just follow the trends, right? But, no, it was interesting because the comment was Berkshire Hathaway has tripled in the last 5 years. And that made me stop and go, because I think most people who've seen us before on here already know this, but I'll repeat it. My largest personal holding is Berkshire Hathaway. And my longest held holding is also Berkshire Hathaway. I've never sold a share, and I think I bought my first shares in 97 or 98. Maybe 96. Anyway, it's been a while, and I'm not going to go dig out. I'm not going to find the box where the brokerage account I had at the time, verified that for me. But it's to me, it's interesting because I don't know that I noticed a triple in 5 years from my largest holding. And I would like to argue that is probably a good thing. That you just kind of get, and like, we do this for a living, fools. We like, it's fine for us to say to you, don't look at your portfolio for a month. Market's down, ignore it, go. But like, literally, it is our job to follow these things, to watch these things. And yet, the investment that arguably will have the largest impact on my future, because it's the largest source of cash for my future, I largely ignored it. I added a couple of times. And so I'm like, okay, well, that's interesting, but it's been kind of an interesting market over the past 5 years. You had COVID, you had the rebound, you had 2022, which was a complete disaster for a lot of people, particularly growth investors. Then you had 2023 and 2024, which were particularly good for growth investors. So, but I said, well, let's look at how Berkshire, because Berkshire, let's face it. I mean, we talked this long about Berkshire. I'm shocked Emily's still awake, to be honest with you. Emily, I
only tuned out for about a minute there. Don't worry.
And as well you should. Well,
not given how strong its performance has been. Apparently, I need to be tuning in.
I'm dead serious. Wait a minute, Berkshire triple, and again, I am a huge Berkshire Buffett follower, and how did I miss that? So I pulled up. I decided arbitrarily, because the article said 5%. This is just something I found interesting. If you don't find this interesting, don't worry. We're going to move to questions in about 30 seconds. But I threw up the major indexes from North America, or the major indexes plus Toronto, shot at Toronto. So the TSX, S&P, the QQQs. Then I pulled up the Mag 7 stocks and Berkshire Hathaway. I wanted to see how over the past 5 years, was Berkshire tripling in 5 years an outperformance, or just was it kind of, it meanders along? And look, no one will be shocked about the Mag 7, Berkshire major indices. No one will be shocked to figure out the best performer, right? I mean, y'all know it's Nvidia. Don't even have to say it. And Nvidia, as good as Berkshire did over the past 5 years, Nvidia 10x'd it. Okay, so again, there's an argument for either owning Nvidia standalone or owning an index. Anyway, the second one was Tesla. But Tesla, there's a bit of a curve. and as this is measured, it's 5 years, so it's measured from March of 2020. Tesla was added to the S&P 500 in December of 2020. Since it was added to the S&P 500, it has gone down. It's done nothing. But if you got the first 9 months of that 5-year period, you've got about an 8-bagger. It's good. Then Meta platforms. Okay, I think a lot of people, and a lot of fools who I respect have been in Facebook and Meta for a long time. So okay, it's well done. The fourth best performer was Apple, which I remember going on writing various articles and going on various publications and talking about how Apple was never going to grow again, or that was the perception because it was so cheap. Apple, you could have bought just over about 6.5-7 years ago. You could have bought it for 10 times cash flow, the greatest cash flow generating story of our lifetime, and you could buy it for 10 times that. It's amazing. And then the fifth one out of my little pool of 11, if you count it out, Mag 7, Burke, and the 3 indices, the fifth one was Berkshire. So, I'm actually thinking Berkshire, it's about 215% in 5 years. That is actually, to be honest with you, better than I thought it was going to be. And it's outperformed names like Alphabet, Amazon, Microsoft, the QQQs, the NASDAQ 100, and the S&P 500, and the sad little, slow growing Toronto stock market. So I found it interesting because it's been literally, it's a walk away from it. What's the cliche of the Fidelity? Fidelity did the apocryphal study of their best performing accounts, and they found the best performing accounts were ones where people either died or forgot about it.
Yep.
So last I checked, I've not died, but I guess I did forget about it. So it can work. And also that study never happened. But like I said, it's apocryphal. Anyway, move to questions or more news, wherever you want to go.
Yeah, let's go to some questions. Are we seeing one we want to jump on?
I have a lot here at the GLP-1 space. I don't know if we've already hit this
Please.
to death, but there's a fair number of questions that I think are interesting.
Yeah.
And one asks is there any evidence that with the use of GLP-1s for a period of time, you will never again gain weight, like the problem with diets? And this is a great question because I think it gets at one of the limitations that exists in the GLP-1 space is the evidence actually suggests that when you stop taking GLP-1 based drugs, you're more likely to gain the weight back. Now, there's anecdotal evidence that's not true for everybody, so I hesitate to say that it'll be this way forever. But the data that we do have right now does suggest that when you stop taking the drug, your habits kind of return to normal, right? What's basically happening right now is we have an appetite suppressant alongside a slowing in digestion. When you stop, suppressing your appetite and you stop digesting things slowly, you get hungry. You go back to eating. It's natural. So there's a big push right now, I think, for people who have access to GLP-1s to get insurance commercial paying to increase, right? So they can then stay on them. But the problem is these drugs are so expensive right now that insurance companies don't want to be paying out of pocket for them in perpetuity. So as much as we talk about the GLP-1 being a interesting, but potentially commoditized space, right? Where there's going to be so many competitors on the market that the price is going to come down. I actually don't view that as a headwind so much as it is a tailwind for access to these drugs, because right now I believe there is sufficient evidence to suggest that these drugs in some form, in some formulation, in some dosage are likely to be lifelong based drugs that somebody has to take. And it's not viable commercially for them to be $1,000 out of pocket every single month for you to be taking it. So I think our accessibility is likely going to increase, and it's going to be a drug for right now. We have 5% of the people in the United States on them who are able to be on them. That number is probably going to normalize. I don't know to what percentage, but accessibility is going to increase.
Yeah, just a couple points. So for these to get coverage and be willing to keep folks on these drugs for a long time, for the payers, the insurance companies, or if you think about the governments in the case of Medicare, or in countries that have a more nationalized healthcare system, the calculus is not, oh, wow, this drug is super expensive, is what is the cost of this drug relative to the expense it is saving me on the back end. So if you think about, the thing that everybody is top of mind for everyone when you think about these GLP-1 drugs is used for obesity and weight loss, but the original indication was for type 2 diabetics and helping limit the ability for folks to progress from pre-diabetes to type 2 diabetes, or for type 2 diabetics to progress in their disease. And it's a crazy stat. 1 in 4 healthcare dollars in the US is spent on treating diabetes because of all the complications related to, you have organ failure, limb loss, all those sorts of things. These GLP-1 drugs can be incredibly expensive and still be cheaper than the follow-on cost of diabetes, heart disease, all these other various healthcare indications that you've heard that the GLP-1s, improve outcomes for. So, we're early days here and data is still coming out, but I think there's a building body of evidence that even if these drugs are quite expensive, they will save dollars for the healthcare system as a whole as a result of the other expenses that you'll no longer have to bear, the catastrophic kind of healthcare outcomes that come as the result of chronic diseases that just don't get treated over time. So just because these are expensive doesn't mean that they're not cheaper than what we're already doing out there in the healthcare kind of market. So also from an investment point of view, the fact that you have to use these for a lifelong makes it an attractive investment opportunity. If it was a one shot and done, this would be great for society, but probably less attractive for investors. There's a couple things worth noting.
I guess my question to that, Nick, would be, again, this is apologies as a Canadian who does not live in your healthcare system. And there are problems with our healthcare system. Believe me, if you have a couple hours, I'll give you a list. But you talk about being able the issue I wonder about is in a healthcare system with a profit motive. The drug companies have a profit motive. The insurance companies have a profit motive. The for-profit hospitals, these are all things that do not exist in my system mostly. Canadians might, be a little surprised at how many things there maybe are for payment, but that's not about the Canadian system. Are you not, what stops, even if it is better for the system as a whole in the US to have people on these types of drugs rather than the downstream limb loss, organ failure, all the wonderful things that go along with diabetes? I have a number of diabetics in my family, so I'm aware of some of these issues. But what stops the insurance company going, well, yeah, we might save down the cost down the line, but there's no guarantee we get those cost savings. It might go to other people in the system. And since we have a profit motive over here, I don't care about you getting a profit. I want my profit. I don't care about you lowering expense. Does that not something that kind of acts as almost kind of like a check on what you've just said? Or am I barking up a non-existent tree?
So, not an expert on healthcare policy here. I would just look to something like or in kind of the decisions here. But the parallel I think about is in diabetes treatment. If you look at the kind of shift in standard of care there the past 20 years, I would imagine finger sticks and glucose test strips are a heck of a lot cheaper than continuous glucose monitors. However, continuous glucose monitors have become the standard of care because the increased kind of efficacy of data. You're getting hundreds of readings throughout the day. You're able to transmit that back to your doctor and kind of improve your outcomes.
And my father, I will just say, I know you've said this to you privately, but I'll say it publicly. My father's a type 2 diabetic. He's 81 years old, great health. But other than, he's 81 years old with type 2 diabetic. And he just didn't do the finger pricks, right? He would do them when my mom made him. He's had the continuous glucose monitor for a couple of years now, and he's not a technological guy. He thinks it's great. He is an evangelist for this technology, and which made me very interested in Dexcom for obvious reasons. But I find it curious. Please continue. Sorry.
Well, but yeah. Anyway, and that's an example of where a much more expensive replacement for something that had been on the market for quite a long time has become standard of care and had a radically. I don't know how to say it. Their coverage has been expanded.
It's making him my father's case. Several years. It makes him do what he should have been doing, which improves longevity and quality of life, right? But pricking your finger sucks, frankly. Yeah. It's just this is just simply better, and it has been. But I do wonder about I wonder about who carves up the cost savings. Is kind of where I was going.
Sure.
Because if I don't get the cost savings, then it sounds horribly mercenary and borderline evil. But if I don't get the cost savings, do I want to do the things that's going to get the whole system as a whole the cost savings?
Yeah.
Sounds horribly mercenary and libertarian, I realize, but
Yeah. I don't have a good answer to your question, Jim. I would just say I don't think that's going to be an impediment to kind of penetration for these drugs.
Emily or
Yeah, I'll have two additional thoughts. One being treatment for obesity in the United States is, I think, the single most expensive aspect of healthcare. So I think from the perspective of even the insurance companies, anything that reduces the amount of money that they're spending on treatment for obesity long term is likely going to be a cost saving for them, even if that 100% doesn't accrue to them, right? Even if that's accruing to the consumer or pharmaceutical company or something like that. And I think the move towards value-based care is maybe just one example of that, right? And how they're kind of extending the calculation on what cost saving looks like. It's not just immediate. It is 15 years from now. What am I looking at the expense associated with insuring this person versus today? But I do want to add one thing here, which is a couple of comments from Dave and Dwight asking around oral formulations for GLP-1s. Dave saying, GLP-1 is more than I need right now, but if it could just reduce my cravings for carbs, that'd be great. Me too, Dave. And then Dwight mentioning that
gummy candy.
really any sweet thing for me is my kryptonite. And then another comment basically saying, do we think that the oral formulations are likely to be commoditized? And I want to bring this back to some of the trials that we're seeing for businesses like Novo Nordisk and CagriSema, who is their next generation weight loss drug. Now, this is not an oral formulation. I will recognize that there's lots of oral formulations that are in development. They haven't been as commercially viable as the injectables, but I think it's only a matter of time until we get there. So very much so, this could be a commoditized space. Oral formulations could increase accessibility, increase the number of people who are willing to take it, because I imagine there's a lot of people who the idea of pricking themselves, I believe it's once a week, I'm not positive, with injectables is just not particularly appealing, even if it has health benefits. But I'll note the trials from CagriSema that a lot of investors were concerned about was around the efficacy and how often people were keeping up and ramping up on their drug usage, right? How many people actually stayed to the prescribed treatment plan versus changing it? And so far, all of the trials that they're doing with CagriSema, the same way they did with the Wegovy and Ozempic, are flexible dosing, which means the patient can change their doses depending on, how they're feeling and what their outcomes are. And just speaking anecdotally from the people in my life who I know who have taken GLP-1s, a number of people have actually chosen to not increase their dosage at the prescribed rate as their doctor would normally recommend, because they're already seeing the results they want to see at a much lower dose, which reduces their symptoms or side effects, I should say. So I think some of the concerns around the long-term viability of these drugs, while fair, should focus on what does it look like for somebody who's taking this drug for 5 or 10 years? It's no longer how much weight can I lose the most over the period of 6 to 12 months, right? Let me lose 25% of my body weight here. It's maybe I'm okay losing a very, very small amount of weight over an extended period of time, reducing the dosage to the point where I just don't gain that weight back. And that to me is, regardless of the commoditization of the space, kind of the commercial viability. But as I'm sure y'all will point out, we're probably a decade away from that happening. So it's very, very much a long-term thesis.
Yeah, I mean,
I was going to say, you just reminded me, Emily, this is not value additive at all, but I used to work in my engineering days. I worked with this is not a joke. I worked with a one-armed draftsman. He had lost his arm in an industrial accident. He'd lost his right arm, and he was right-handed, and he'd retrained himself with his left arm to do computer-aided drafting, so CAD, AutoCAD, that sort of thing. And he was very, very good. He was my preferred draftsman when I was in the engineering world, and we would talk about things, and we would joke about stuff. And and he had talked about weight loss. He says, I can tell you how to lose 10% body weight in 1 minute. And I'm like, oh, dude, it's too soon. He's like, what is with my arm? Yeah, so it's, as soon as you said, lose 25% of your body weight, I'm like, it always goes back to, don't know where Alex is in the world anymore, but, he was a good guy and a success story. And I was kind of a little inspired by him to retrain after something that I think would have knocked a lot of us out of the game. Anyway, I had a question if you want me to take one too, Nick.
Hop on it, Jim.
Well, it's kind of a one that we can all bounce around if we want, or I can just blather about it for a bit. But Real Madrid fan asks about the opinion about what to use with regards to cash flow or revenue for discounted cash flows and reverse discounted cash flows. He says not sure if you like reverse discounted cash flows. They're a tool I like or dislike them no more than any other tool. It can be very useful. A reverse discounted cash flow can be useful to say what are the expectations baked into a share price today, which then should move you towards asking questions about, am I willing to pay for this, or do I find these forecasts reasonable? The thing I like to say about all discounted cash flow analysis, whether forward looking or whether a reverse, is they're all wrong. They're all wrong. They're all going to be wrong. Okay, they are probably best as a directional tool, and they are best when they are not viewed in isolation. I'm gonna give one of Emily's favorite companies here, and that would be Academy Sports and Outdoor. She's being polite, which is why I didn't get the middle finger. No, but in all seriousness, yeah, she's like, oh, I'm gonna get you later, Gillies. But no, like in all seriousness, like one of the reasons that I am more comfortable with Academy Sports and Outdoors than perhaps Emily is I didn't grow up in Texas, and so I don't have the inboard. Well, no, seriously,
that's a value add. Trust me, because I'm just biased against them from my own personal experience.
I like Texas when I've been to Texas. Not crazy about Dallas, but what? It's fine, I suppose. Love Houston. Anyway, how many times have people? I know. I
had never heard that before.
You know what it was? I think it's the people I was dealing with down there. We were looking at a couple of companies. Bill Mann and I were down there a couple of times, and the people at all the companies I went to, it was great. I'd written a critical article about one of them. They printed it out and put it on every table in their lunchroom about this. And then I walked in and I got into a friendly sparring match with the CEO, but it was sparring match nonetheless, because I said, you don't have a chance of paying off your debt this year. We're going to pay it off this year. You don't have a chance. We're going to do it. If you do it, I'll buy you flowers. I'll send you the picture later, Emily, of the flowers I sent him, because he did it and proved me wrong. I love that. Anyway, but no, when I was in Houston, I met a lot of, I thought, really good people, and you meet the people, it informs your opinion of the place. Anyway, back to Academy Sports and Outdoor. Because it was around you growing up, and because you have a perception of it as try to be nice and call it a lower tier retailer, a not Dick's Sporting Goods retailer kind of stuff. Yeah, that doesn't need to exist. Perhaps it might fail David Gardner's snap test. But one reason that I probably feel a little better about it than other people do is because a DCF is only on your forecasts and your cash flow, but what's the capital allocation story? What has management been doing there? And, by and large, and I understand Emily's argument about, well, they're building stores right now that ain't earning their cost of capital, or at least are not earning, they're not earning what they should be to invest that capital. And, in some cases I might push back, in some cases I might agree, but on the whole, their capital allocation so far strikes me as reasonable. But when you're building a DCF, if you're just going to work to the model, which will be wrong, but if you're just going to work to the model and not ask yourself what's going on with the rest of the business, not ask yourself how management is deploying the cash flows that you are discounting, if you're not going to be rigorous about, again, you are going to be wrong anytime you forecast. It will be wrong. How do you combat that? Well, a year down the line, what did they generate versus what I expected in my model? Were they higher? Were they lower? Were their margins better? Were they narrower? How did it work? And you want to always be continuously refining and then asking yourself in the model, do these assumptions make sense? And that then takes you to the reverse discounted cash flow. Do these assumptions make sense? Because again, when you're basically equating what assumptions have to go into your DCF to equate to today's share price. And when you do that, and I'll pick mythological overvalued company number one kind of thing, right? If you find out that to justify today's price, you need to compound revenue and free cash flow at 35% for a decade, at double the current margins, you should probably be asking yourself and answering, honestly, some very difficult questions about that, because that might be Nvidia. That might be Nvidia. So again, you start asking yourself all those questions that talk about the quantitative stuff and how has management done, and that might be Nvidia that you're selling. It might be eToys as well. Because I've done reverse discounted cash flows on a lot of time, or it might be the one I did. It's a former darling stock, but I'm not sure how many people really remember it. It's used to be called Select Comfort. It's now known as the Sleep Number Company. Doing a reverse DCF on those guys, circa 2007 was eye-opening. because it's like they really needed to sell a lot of beds to justify the price at the top right before the tech bubble and that, or the tech bubble, the housing bubble, and that was a problem. So anyway, I hope that answered the question. Do you guys just throw away DCFs and our DCFs, or what do you like about them?
I like, my favorite thing about DCFs is that it makes all of the implicit assumptions explicit. And nothing drives me a little bit more insane than when somebody comes to me and says company XYZ is overvalued or undervalued because its price to earnings ratio is this. Yeah. And I'm like, okay, well, explain to me your thesis. Explain to me the thesis that is underlying that. And they're like, nothing. The PE ratio will change. And I'm like, okay, you're making a lot of very implicit assumptions with taking that approach to valuation. It can be a shorthand, but in my opinion, it's best used in conjunction with something like a DCF. So you can really get into the nitty gritty to say, what are the value drivers for this company? And it's less so I'm trying to find a price target or I'm trying to determine if this company is under or overvalued, and more determining like, okay, what are the assumptions that are going into this valuation today? Do I agree with those assumptions? What do I actually think is going to happen? And that will drive potentially a change in a relative valuation ratio. So I actually really enjoy DCFs, but in maybe a different way than a lot of people approach it.
Y'all nailed it. I don't have anything interesting to say on DCFs. I want to answer this question from Swing for the Fence 88 quickly before we get out of here. I said, Nick, how are you thinking about Match Group these days? Ticker MTCH. Is it still thirsty guys continuing to willing to pay access for days? Thesis still intact. Match has not worked out the way I would have hoped. It's one of these companies that's gone through the full growth to value cycle. So when we put it in the scorecard in Canada, we were at the kind of the peak of the pandemic, and that was the only way people were dating. And I think we're still in an environment where the vast majority of folks are dating online, but maybe the peak popularity of maybe online dating hasn't continued marching upward in popularity over the past several years, like maybe we would have hoped. If you look at kind of Match's revenue dynamics, it was back when we recommended it, you saw both payers and revenue per payer increasing, moving up and to the right. Match has continued to have success in increasing revenue per payer, taking price, getting folks to buy more add-on services. However, that focus on improving monetization has led to declines in overall payers on the platform, which largely is what the market focuses on quarter to quarter. So if you look over the past year plus, you've been in a dynamic that kind of looks like a tobacco business where the declines in users are more than compensated for by increases in revenue per user. Now, that leads to a company that can generate quite a bit of cash, but also doesn't create the kind of growth story that the market wants to reward. So you look at Match Group out here today, trading about 15 times earnings, buying back a heck of a lot of stock, initiated a dividend back in December, has got about a 2% yield today, changed over management back in February. Bernard Kim, who had been leading the company for the past 2 or 3 years, and ineptly, if you look at the market performance, has been replaced by a board member and former CEO and co-founder at Zillow, Spencer Raskoff. He joined as CEO back in February. Here at this point, this is a cash cow business that I don't have any concerns about its kind of viability as a business. That said, it's hard to tell a story of how we're going to get payers moving back up and to the right, particularly at Tinder. I think Hinge growth continues to be robust, and I think is headed to be the leader in the online dating space. But realistically, I think the outcome for this business is because it's such a cash cow, because the market doesn't seem to want to bid the stock up meaningfully, because we just had the change in Spencer Raskoff coming in CEO. I kind of think this is a company that's going to be taken private at some point in the next year or two. It's at a valuation level where I don't want to sell it. I'm happy to kind of collect my dividend and let management continue to retire shares. About a $7.5 billion company, probably $10 billion or so enterprise value, and they plan to buy back $1 billion plus in stock this year. So it's a cash cow story. The growth plan didn't play out the way we expected when we recommended it. However, I think there's a pretty decent chance that the company ends up going private here in the next couple of years, given its cash flow generation and some of the tea leaves we see out there. And so if that happens, I'll be happy to not have to worry about Match anymore. But it isn't an environment where at today's price, it's not something that I would be kind of rushing to sell, even though the thesis didn't play out the way we expected. This is still a business that generates tons and tons of cash and is basically giving it all back to shareholders, even though the market doesn't seem that excited about the prospect. But that's the status of match here today. All right, folks, we are at 9 o'clock. It is 8:59 here Central Time. So I think it's time for us to hit the road. Hopefully we were roughly good. Thank you to Jim and Emily for joining me. Hope to see you next time on the morning show. Until then, we're now going to be followed up with the new group coming in for a deep dive on Roku. We'll let those folks take it away. See ya.
Cheers, fools.
Only nice things to say about Roku, right, guys?
That's
Okay, just
Hey,
putting it
don't
out
put
there.
your finger on the scale there. Come on.
Hey, that's not yeah.
Consider that my
This is our
waiting.
deep dive.
I'll
Gotta
come
keep
back
the
on an
audience in
hour after
suspense here.
this and give the counterpoints.
You can give the rebuttal. Yeah, sure.
Yeah, no, yeah, I would enjoy that. All right, thanks to the morning show crew there. Yeah, my name's Jeremy Bowman. I'm here with Brian Orelli, and it's 10 a.m. on a Monday, so it's time for our weekly deep dive. How's it going, Brian?
It's only 7 here, so I'm drinking coffee still, but I'm good.
Well, thanks for getting up
ready
with
to
us.
get into it.
Yeah. Right. Yeah. So this is, I think it's a company that, everybody knows by now. I like to say when we're doing a consumer stock like this, if you are a Roku customer or, have maybe strong opinions on the product or the stock, of course, please share comments, questions with us on slido.com. Code is Fool24. The format we're doing, so this is a 60-minute show. So, I think we'll try to leave the questions for do a Q&A in the last 10 or 15 minutes at the end, but so just be patient if you put in some questions. But yeah, Brian, are you a Roku? Do you use Roku?
I'm not. We have a Samsung TV, so we use that for the living room, and then for our bedroom, we have a very old Vizio that isn't smart at all. It's a dumb TV, but our cable company has a smart. Has its own platform that I can get all my streaming services off of. And then we have in the past used Amazon's Fire Stick to make our dumb TVs smarter.
Yeah, I feel like everybody's used, probably a lot of us have used a range of different smart TV solutions. I have a Samsung TV also, so I'm not a Roku, not really a Roku user right now, though I do own the stock. Which we're going to get into. So let me bring up our slideshow here for the day. So that's showing, right?
Not yet. There we go.
There we go.
Up.
Okay, so yeah, as we usually do it.
I'm going to run the slide just so it's full screen.
There we go. Right. Okay. So I'll do the intro and business model. Brian's going to talk about the financials, go back to potential opportunity and management, risk, competition, and valuation, and then we'll conclude with our stock ratings and general thoughts. So yeah, I mean, Roku, I think most of us know it as the sort of seller of dongles and the streaming platform. Just to mention Samsung. So Samsung has its proprietary operating system that they use for their smart TVs. But Roku it's the leading TV streaming platform. Based on the operating system and the smart TVs it enables through the devices it sells. Leader based on hours streamed in North America, all 3 countries there, US, Canada, and Mexico. Devices are available in over 15 countries now. They primarily focused on Latin America in addition to the US. US is the biggest market. They're also available in the UK. And it was founded in 2002. I don't think, Anthony Wood isn't really maybe thought of as on the level of, say, a Reed Hastings, the Netflix co-founder, but, was really an early pioneer. We'll talk about him a little bit later in the show, but, sort of early to catch on to the streaming revolution. 2002, I think, Netflix didn't even launch streaming until 2007. So, they were certainly ahead of the curve in this, first mover. Launched their first streaming player in 2008, sold 10 million devices over the next 6 years. Today, really, the business is more about integrating the operating system with their OEM, their TV OEM partners, and they sell their own proprietary branded TVs as well. So sort of cutting out the middlemen there. They tend to sell their devices, those sort of dongles, you traditionally just plug in to your TV at, cost or near cost, to drive the platform growth, which they then monetize through primarily advertising and then a subscription revenue share. They report into those two segments, devices and platform. So they have a wide range of devices, kind of from sort of ultra 4K TVs kind of thing to something at the lower end. So I think they're trying to serve any customer who wants to make their TV a smart TV. They're also streaming players, branded TVs. They also have smart home products like cameras and doorbells. They entered that market a couple years ago. They do audio products and accessories as well. As I mentioned before, they've been doing this licensing program with their TV operating system for more than 10 years. So I think I think the company would argue, at least, so that provides a better experience than what you would get from maybe a competitor like Samsung or another company that is offering a smart TV but isn't sort of a uniquely dedicated company to that technology the way Roku is. They launched their own branded TVs in 2023. Allows allow them to compete at the higher end performance range in televisions, and they can test more directly with their the end audience. So I think there was some debate about that among investors when they launched that product, but I think it makes sense when you look at it from that perspective. I think I mentioned Roku Ultra. They're now has voice remote, so they're continuing to update and advance their technology. And the company talks about so the platform is really the core of the business now, and driving almost all the profit. The company talks about this Roku experience a lot, which is this kind of end-to-end comprehensive, the experience that you get when you stream, go to stream on Roku, and the experience just for viewers and advertisers. And the homepage is central to this experience. They have, I believe it's now close to 150 million people using, who log in and see that when they go to stream. So I think in some ways, Roku is, wants to be, or in a best case scenario, this is sort of like the Google search page of streaming. You go to stream, you pull up your Roku home screen, and then that's kind of your portal into, your various streaming apps and live TV and whatever else you're, you could want to watch. They're started organizing content, into these zones as well. Sports is I guess an obvious one, and they have genres. They'll do sort of specialized packages for an event, like the Oscars. And then Roku Channel is another big initiative of the company. So they have, again, a bit like making their own TVs. In addition, they're primarily used to watch, larger streaming service like Netflix, Max, one of those. But the company does have its own free streaming app and channel. It's one of these free ad-supported TV content. So you don't have to. This is available even if you don't have a Roku device or a Roku-enabled TV at home, you can just download the Roku channel app. So I think this also gives this company a sort of a wholly owned streaming channel, and they can drive advertising. See what works. They also even have their own original programming. They have some sort of creative partnerships with brands as far as advertising, which I'll get into in a minute. And they also gives the company its own advertising inventory, wholly owned, that it can sell to its brand partners. So, that's a key growth element to it. And I think primarily Roku is really it's an advertising business. I think it's not really ad tech exactly, but I think it's it's a unique company. They have hardware, software. I don't think there's really a close peer to it as far as what they're doing in streaming. So they kind of got their hands in a lot of different buckets. But I think as far as a business model, advertising is the best way to think about it. I just want to show these two screens as well. So this on the left is a example of the home screen. What you see when you log in, you see that ad for Sling. At the bottom left, there's a lot of ad space here that company can potentially sell with a banner or wallpaper or something like that. I mean, that's a good example of that. Historically, their top advertising partners have been what they call it M&E, or media and entertainment. So other streaming, or these MVPD, multi-video channel player devices like Sling, or streaming services themselves. And then Roku City, this image on the right here is their screensaver. So they also use that to sell advertising as well. You see that marquee, or the Roku label in the bottom left. There are opportunities to post ads in that. I have this here. So this NFL zone here, this is an example of a promotional or a zone, one of those zones they used to promote the Super Bowl, or the NFL use. So you go to this, you got your I guess sort of an engaging, I guess that's a New Orleans theme there with the cable car, and your previews and that sort of thing on the bottom there. So I think something like that makes it maybe a little easier to get all the content you want to see around a certain event in one place, which I think can be a problem with streaming. Again, another kind of ad kind of package they could do. You have this Neutrogena ad on the right of the homepage that user can click on that, get a sort of full traditional video ad. You can have a QR code, something like that, to buy the product at the end of it. So these are all, I think, newer features or experiences the company's added. So I think they're really focused on monetizing that homepage, because I think that does make it unique. I mean, they do monetize connected TV ads, on their streaming partners. But this is sort of an asset they have that no one else really has. And then this is a Roku channel sort of brand promotion they did with Pepsi. I guess they called this a micro series for different recipes around the holidays. So another example of that there. Okay, we'll talk about the business model a bit. And devices is pretty simple. It's pretty direct. They make money primarily through selling to customers, licensing the OS to those TV OEMs. I believe TCL is their biggest partner. And then platform, it's primarily driven by advertising, and then this streaming service distribution or revenue share. So Roku, with these ad-driven, what's sometimes called AVOD, or advertising video on demand. One of those apps is on the platform. The agreement Roku typically makes is Roku just gets 30% of ad inventory that is shown through the Roku ecosystem, and they can sell that as they wish. And then streaming service, it's a bit like I think maybe what Amazon Prime does. For those of you who are familiar with that, or maybe Apple is a better example. If you add a new subscription through Roku, they'll take they get 20% of that subscription revenue share. So and the transaction revenue, you're just watching a one-off pay per rental movie on Roku, they'll also take a cut like that. And then they have this premium subscriptions. I think that's more what I meant with Amazon Prime, where you can go to the Roku channel and just subscribe to any of the streaming services, Max, Netflix, or at least as long as they're available, I should say. But then that allows you to just have all your subscriptions on the Roku channel, and it's easy to just see anything you'd want to watch in one place. And then I think this is the branded app button. Probably isn't as big as it once was, but if you've seen the Roku remote, typically has Netflix or Amazon Prime buttons, something like that. I think I remember seeing one for Crackle once upon a time. I don't know if that one's still around. Then this sort of sum up what I've been talking about. I think their overall growth strategy, growing streaming households, streaming hours, growing the user base leads to consumption growth. The keys to that, I think, are customer satisfaction, continuing to improve and innovate around the product. Advertising is key component of growth. So I think the Neutrogena ad I showed would be an example of that kind of marquee homepage ad that is now can now be enabled as video. Make it easier for advertisers to work on the platform. Enable programmatic campaigns. They have an integration with the Trade Desk, which is the leading demand side platform in ad tech. So Roku has been happy with that. I generally have nothing but good things to say about the Trade Desk partnership. Expanding their offering to small, medium businesses. Those can be harder to serve just because they're might not be working with a big ad agency or something like that. The way a Pepsi or a Neutrogena or the NFL is going to have a big marketing division. And then adding features like shoppable ad formats, something like a QR code, or these technologies that allow a user to just buy something straight from seeing an ad. Premium subscription growth, I mentioned. The company sees this as an opportunity. It says it's behind some of its competitors as far as how many premium subscriptions it has. Growing, Roku channel usage as well. I believe that was up. Consumption was up 82% on Roku channel. I'm not sure how many hours that was, but so growing fast. So there is a market for that free content, and then I think and expanding and monetizing in international markets. They've reached about, I think they have more than half of broadband households in the U.S. So I think for the long term, growing internationally is key as well. 3 phases of the business model: grow, scale, engagement, grow, monetization. I think as a tech platform and as an advertising business, you can see. I mean, the company hasn't been profitable recently, but you can see how the scale should lead to healthier monetization and profits over the longer term. I think I mentioned these as well already, as far as the home screen and growing ad demand, and Roku build subscriptions. And the company, I'd like to share this employee figure. Just it's another way of sort of getting a sense of the size of the company, I think. But a little more than 3,000 employees. They have been through a few rounds of layoffs, in the last couple of years or so. Just to see this is their 5-year performance. So like a lot of certainly streaming in the streaming sector, and maybe the broader tech sector as well, or some software companies. I mean, the company, they did very well during the pandemic. Growth was soaring, as everybody was streaming, and then it's been, certainly rough. Kind of hangover after that. They did go through a few rounds of layoffs. I mean, I think the business has gotten healthier over the last couple of years than the stock chart might indicate it. But it has been a frustrating few years for the company. So I think that wraps up.
Yeah. Do you want to leave it up so that Natasha doesn't have to switch back and forth between me and you?
Sure. Yeah.
Yeah, I feel like it's a very like razor and blade model, right? That they're just they're not even selling their devices at cost, and then they're basically just giving them away practically, and then they're giving away the razor, the handle, and then they're using the fact that people are on their system to sell advertisements and make money that way. So even though they have negative cogs for the devices themselves, they still have fairly high gross margins, in like the 40% range.
Yeah, definitely. The razor blade model there.
Okay, so let's get into the financials.
Sure. Here it goes.
Yeah, so I mean, plenty of cash, 2.16 billion, up slightly because they are cash flow positive, even though they're not GAAP positive. So looks okay. The only thing really to note here is that they have 161 million in goodwill, presumably from acquisitions, and that's remained constant. So the bean counters have decided that the value that they purchased it for hasn't materialized, and so but it hasn't gone down either. So they've kept it at the same level there. The intangible assets did go down between 2023 and the end of 2024. Not much else to say here. And then on the liability side, looks pretty clean. Not really any, a little bit of this other long-term liabilities, but no long-term debt. So nice balance sheet with quite a bit of cash on hand and not much in terms of liabilities. They have the accounts payable is obviously going to be variable, but less is more in this case. So that's moving in the right direction. And accrued liabilities being bigger is better. So again, 2024 improved over 2023 in terms of their ability to manage their cash flow. So everything looks pretty good on the assets and liabilities side. So if we can move on to the profit loss statement. So I just note that the gross profits for the devices are negative, and especially in 2024, they grew substantially over 2023. There was a bit of a competition on price between its competitors, and so that pushed down the selling price. And since the price to make it is constant, when you sell it for less, then you end up with a bigger loss. So they certainly are negative there. But as you can see from the revenue, from the platform revenue, their revenue was 3.5 billion, and it only cost them a little less than half of that, and so that's helped drive up and of course that's a much bigger percentage. Their revenue from platform is much bigger than the revenue from the devices. So even though the devices are negative, they've got so many devices already in the system from selling them for so long that those are all driving revenue on the platform, but the amount that they're actually selling of devices in any given year is pretty small. So even though there's a loss, it doesn't affect the gross margins all that much. And then on the research and development line, they a little bit less expenses actually overall. Less expenses in 2024 compared to 2023. So they're really I think they're trying to get to profitability, and they're moving in the right direction. Even sales and marketing were a little bit less. So anytime you can increase your revenue but decrease your costs, that's obviously going to help, increase your decrease the loss that you're having, or increase your profits depending on where you are in your growth cycle. So you can see that they went from a $709 million loss in 2023 to just 129 million in 2024. So moving in the right direction, certainly on the income statement. And then if we go to the cash flow, you can see that on the bottom line, they were cash flow positive in 2023 and in 2024, and so they increased their cash flow a little bit, not by $2 million, so not a whole lot, but overall, I don't think there's a whole lot to say here in terms of the cash flow, except that they're doing fine. They did actually have less cash provided by operating activities in 2024 compared to 2023, and I think that's probably due to the fact that they were selling their devices at such a low margin, or negative margin, larger negative margin, and so therefore that contributed to the lower cash flow from operating activities in 2024 compared to 2023. But overall, I think they're doing just fine in terms, they're not going to run out of cash anytime in the near future, since they're actually cash flow positive, even though they're not GAAP positive. And then if we can move on.
Was that?
That's it.
Yeah, you're right. Yeah. Yeah, you can definitely see the impact of those layoffs, I think, in the that change in the operating expenses.
Yeah, definitely.
And then yeah.
I mean, I guess as long as I mean, you sort of worry a little bit about the research and development and the sale. I mean, the sales, they cut the sales expenses and the sales still went up. So obviously there was some fat to cut there, right? So I think that you can say that was a good move. Whether the research and development, cutting research and development was a good move, we'll have to wait and see, how much that effect, that's obviously going to be a longer term effect on the sales, right? So it's not necessarily going to affect it in the year. The research and development for this year is not necessarily going to result in higher sales this year. It's probably going to result in higher sales next year or the year after that. So we'll have to wait and see that impact. But obviously there was a lot of fat or really some fat in the selling divisions, because and how much they were spending on advertising or whatever, because obviously they cut that down, and they were able to grow their revenue. So moving in the right direction there.
Yeah, I like what you said about the liabilities as well. Yeah, that I don't know if I've seen that little that few line items on a liability statement.
Yeah.
But yeah, and like a lot of tech companies too. If you go back and look at their financials from 2022 or so, I mean, they were profitable in 2021, and then I think like a lot of these companies, they just overexpanded and kind of bet on those pandemic trends. Lasting forever or longer than they did, and that didn't really happen. So they were forced to retrench. Do you see one comment from Harold? My Roku is one more forced home screen ad away from being replaced. Screensaver links to ads have already ruined the experience and put it on the way out. So yeah, I mean, there's always a delicate balance, I think, with advertising of you don't want to lose your customer, but you have to make money as well. Yeah, I'll carry on with the potential section now. Yeah, so I think as far as a growth in the core business, maybe I'll share a couple other numbers here. Still pretty solid growth. Streaming hours were up 18% in the fourth quarter. Streaming households were up 12% to 89.8 million, and the overall revenue was up 22%. They did get some benefit from political ads as well. But so I think I think for a stock that struggled as much as it has, I'm saying I think top line growth has still been pretty good, and connected TV, the CTV advertising market, it's a very large opportunity. Expected to grow to 47 billion there. And Roku, I think, is in as good of a position as any other company. You hear ad tech companies like the Trade Desk talk about CTV all the time. Obviously, we've seen Netflix get into advertising, and it seems to be doing very well with it. So, I think the streaming ecosystem generally is moving towards advertising, and some of those fast channels, which include Pluto TV and Tubi, those have actually been, as far as sort of underlying growth in streaming, those have been some of the best performers. So that seems to be a pretty good business model, actually. Rather than asking users for subscriptions, you just basically show them TV like we used to do, and just sell ads. So that seems to be working well for Roku channel as well. The company is still very much focused on those homepage ads and monetization in the Roku City as well, despite the complaint I just shared. Smart home products, I don't know if I'm kind of a bit surprised that the company went in that direction. It's not something they really talk about in their quarterly reports or shareholder letters or anything. So I think it's a pretty small business at this point. But I guess looking at it positively, it shows that they're looking at expanding beyond entertainment, which is certainly their core business, and see other smart home products, or they are spending that money on R&D, so it's could be going to other new products as well.
I think it's probably a good idea, right? Because you would think that you'd be less likely to drop your Roku if you also have a doorbell with Roku. And something else. So maybe it's a good idea. It's just the down. So that's the upside. The downside is that you're competing at a large market against a whole bunch of companies that have quite a bit of money that can probably compete on price, and you don't really want. How much do you want to be losing on some auxiliary service that doesn't actually, it's only indirectly driving your retention rate, I guess, but not actually not actually driving the amount of programming that you're getting, and therefore the advertisement revenue. You're not advertising on a doorbell, so I think there's pluses and minuses.
Yeah, if you already have the Roku app, and then you can use that to control other smart home kind of things. That makes sense. I wonder if there's a Roku power user, or the most loyal Roku customer. I don't know if they're out there, but I'd be curious in hearing from them. They have made some smaller acquisitions, including an ad tech platform or some ad tech technology. I'm just speculating with a company like Sonos, but I think Roku feels like the kind of company that they have a lot of pieces of a successful and dominant business, but maybe they're not quite there yet. So, I certainly wouldn't be surprised to see them go out and make another acquisition. And then management, talked a little bit about Anthony Wood before. So 59 years old. He's basically a serial entrepreneur. Sort of grew up both in Europe and the U.S. And he actually invented the first digital video recorder. The company at the time was called Replay TV. I feel like DVRs kind of just got rebranded as TiVo, but sold that to DirecTV. Also worked at Netflix for a brief stint. I mentioned Reed Hastings before. I think these two companies, were really in at the, and Wood and Hastings specifically, in at the dawn of streaming, and I think you could give Wood a lot of credit for driving, helping to create the industry as well. Generally well respected in the industry. He is the founder, controls 57.4% of the voting power as of the last proxy statement, and about 18.6 million shares total. So the last check, that was somewhere around $1 billion. The stock has been bouncing around a bit, but yeah. So it's definitely his company. Some people don't always like the majority shareholder thing. Looking at the Glassdoor ratings, the company does okay. There's definitely been some frustration with those layoffs I mentioned and the kind of general management structure. And as far as the rest of the management team, this CFO Dan Jetta came to the company a couple of years ago. Left Stitch Fix. So I think. Sometimes I think when you see a move like that, it's maybe reflects more poorly on Stitch Fix, or the company that they leave than the company that they're going to. But Roku is also a bigger company, and I think Jetta seems with that, you see that experience at Amazon there as well, digital video. So seems like a good fit for the company. A couple other executives, Charlie Collier. Kind of the video experience head there, previous some pretty good credentials there as far as CEO of Fox Entertainment, the AMC networks, which were credited with some pretty good TV for a while, Sundance and AMC Studios, and then Gil Fuchsberg, sort of in charge of a lot of things there with subscriptions and partnerships. Built a startup in Hearst, so has sort of a range of experience with growth in mature companies. So I think I don't the management team here doesn't. I don't see any red flags there. I mean, I think I don't think Wood's going anywhere. So this is the kind of category you sort of look at for risks as well as benefits or opportunities. So I think, looks fine to me. Pass it.
All right. Yeah. So moving on to competition, the company lays out their competitors. If you go to the next slide, Jeremy.
Sorry.
So they lay out their competitors in their 10K. So it's really nice to have to do much in terms of research here. But so the companies, obviously other companies that offer streaming service devices that compete with Roku. So think the dongles by Google and by Amazon, and then TV brands that offer their own streaming solutions. So think the Samsung and that sort of thing. Streaming applications, so just something that you pull up on the internet on your phone or your tablet or your computer. Companies that produce aggregate TV streaming content, so that would be their Roku's channel versus all the other streaming services, Disney Plus, Netflix, that sort of thing. Companies that offer advertisers the opportunity to reach viewers on other content, advertising, including ad-supported streaming services. So again, like now, not only is our Amazon and Netflix offer ad-free subscription content, they also add ad-supported content, so that now they're competing directly against them there. Companies that offer other news sources for news and entertainment, and so we're talking more broadly about everything from your cable TV stations to your newspapers and magazines. Obviously, if you're reading a book, you're not watching television probably, and so that's obviously a direct competitor to them in terms of they're getting paid per eyeballs. So if your eyeballs aren't on Roku screen, then they're if they're on something else, then they're not getting paid for that advertisement. And then companies that compete with audio products and their other home services. So think Amazon Alexa, Google's home services, Apple has one, I guess. And then companies that operate in the same location as them, just in terms of competing for employees have the ability to go to Roku or some other tech company. And so if they go to some other tech company, that could hurt Roku in terms of their ability to compete if they don't have the highest quality of employees. And then if we can move to the risks. So, obviously there's lots of competition here, and I think that's probably the biggest risk to Roku, in my opinion. So then there's competition for advertisers, including from traditional media. So they have to convince advertisers to go on their platform versus on, traditional over the airwaves media, as well as, newspapers and all the other places that, billboards or however else they can advertise to potential people. They have to convince the advertisers to use Roku's system versus other options. And then if their advertisements aren't converting, then that's a problem too, right? So it's not just convincing them that to use them for advertising, but they have to actually convert those advertisers. And hopefully they have a little bit more information than other media sources do in terms of the ability to serve the right type of advertisement. And so hopefully they can provide a lower cost per conversion to their advertisers, and therefore, potentially be able to compete there. And then viewership is based on their program. So if the programs on the Roku channel aren't very good, then nobody's going to watch them. Then they're not going to have any advertisers. And then financial risk, there's obviously volatility between quarters and some seasonality in terms of sales. Obviously, they get more sales in the fourth quarter around the holiday times especially for their devices. And then, you can imagine that viewership is going to vary depending on the quarter. Probably in the wintertime, there's more people watching television than in the summertime. And then obviously, any risk associated with future acquisitions that we can't really figure out right now. They have a revolving credit facility of up to $300 million. That was a 5-year deal. I can't remember what the date was, but obviously that's going to come up, and they're going to either have to pay it off, or more likely renegotiate it and get a new credit facility. And then there's potential to need for additional capital, although currently they're cash flow positive. So, hopefully that's not an issue, but they list it as a risk. And then on the execution side, they're integrated with a lot of third-party partners. So obviously if the third party screws up, then that could screw them up. And for their programmatic advertising, they're integrated. And then also for their televisions, when their Roku is integrated into televisions, again, third party could mess things up. Their top 3 streaming services represent almost 50% of the hours on streamed in 2024. So obviously, if somebody pulled out of a deal for the revenue share, then that could be a huge problem, especially if it's one of those top 3 partners participating in the new Roku home screen feature menus. They've got to get those partners, and if they don't, then they can't monetize that home screen. And then they're trying to expand internationally, and that's obviously they need, that introduces a little bit more risk in terms of international expansion versus expansion in the US, but it's a big growth opportunity for them. And then on the legal and regulatory side, they've got, data security, which, maybe they have a little bit more data than the average tech company. It's debatable, but it's certainly every tech company has to make sure their data is secure. They have intellectual property that they have to defend, including patents. There's some child-oriented regulations from regulatory government bodies that they need to make sure they're following. And then there's some net neutrality things. If cable companies were able to block, the use of Roku or something because they wanted to force streaming, they wanted to force their customers to use their streaming services, that could certainly affect Roku. Hopefully, net neutrality is, stays fine, and we're, and they're not able to do that, but obviously there's concern there. And then moving on to valuation, I mean, Jeremy said in the beginning, there's not really a direct competitor. There's, obviously like Netflix and Disney have, competitors in that but they're also like partners. And then, EcoStar, which was DirecTV, has Sling TV, and Disney has Hulu. So those are pretty close to being somewhat competitors. And then the Trade Desk has programmatic advertisements, but is also a partner. So they're sort of all over the place. It's sort of hard to figure out whether the valuations of any of the other ones matter compared to the valuation of Roku. It's trading at a low price to sales ratio, but I think that's largely because it has gross margins that are pushed down by the fact that they sell these products at a lot, at least the devices at a loss. But I mean, if you just look at the the 22% growth in the last year, some of that was due to political ads, so maybe it'll be slightly lower. But in general, they're growing fairly quickly, and they're not profitable, but on a price to sales ratio, their gross margins are pretty, pretty similar to at least the first three. Obviously Trade Desk has a much better gross margin, and therefore has a much higher price to sales ratio, and they're profitable, and so they have a price to earnings ratio there. But I think the valuation looks okay here. It has been cheaper on a price to sales ratio basis, as recently as a year or two ago. And so I don't know. I think that it's an okay valuation right now, but not super great.
Yeah, and it's hard to know how to compare them to the peers. I mean, I wonder too sometimes that maybe is a disservice to a stock, but they also certainly could do more as far as showing profit and that sort of thing. Well, before we, I think we have a couple more comments here before we do our ratings wrap up. Yeah, Jeff Mulvaney says Roku was a high flyer and I made money. Currently have a small position down 38%, close to selling. Dog to me, put money to work somewhere else. Yeah, I can sympathize with that after the performance over the last few years. And then I see Ed here tried to sneak in a healthcare question, so maybe Brian could get to that at the end. And then Sanjar says, can Roku original content compete with the likes of Netflix or others? I think with what Roku's doing with that channel is a lot different from I think what Netflix is doing, and certainly their budgets are much different. So I think Roku is just trying to, in the way that maybe free TV has done traditionally. It's like, oh, you turn on the TV and you watch what's on, or you see. Something comes up at that menu and it catches your eye, and maybe you click on it for a bit. I mean, I'm maybe a little surprised they're putting money into originals, but I don't know. Like, they maybe see a potential for ROI with that. But yeah, I don't think Roku is ever going to be sort of a powerhouse of original programming like Netflix.
Yeah, I mean, I don't think they have to be, right? That's not really their thing, right? It's just one more reason to keep your Roku if you're watching the occasional, random cooking class that you see at the on the top of the thing. And obviously they have, I don't know, they have a lot of data on you because they know exactly what you watch on what shows you watch, and so that could potentially help them in terms of having the ability to figure out what shows they should put on the thing and what shows they should advertise to you. So I'm assuming that if I go to Roku's homepage, it's going to look different than if you go to Roku's homepage, because in theory we're watching different things. So
yeah, there's so much just content. I mean, legacy content and licensed content available for licensing too. That it's certainly an opportunity for them to monetize that stuff, and they're probably in a better position than other people are.
Samsung has like a Conan O'Brien TV channel where they just for some reason it always pops up when I turn on my screen. I don't know if my kids are watching it or what, but every time I feel like I turn on my TV, it's on the Conan O'Brien TV. Maybe it's just because I never turn it off and I just immediately go to whatever I'm trying to watch, not on Samsung, and so therefore every time my TV turns onto Samsung, it shows me the Conan O'Brien TV thing where they just
that's funny. They do have those free channels that occasionally there's a movie one that'll come up for me that if there's something odd, maybe I'll watch a bit of it occasionally. So they do get you like that. Well, why don't we we'll go into our conclusion here. Brian, you want to go first?
Yeah. So, I think it's a hold for me. The valuation looks better certainly than it did 5 years ago, when it was, growing maybe faster, but also, had lower overall sales because they've grown sales over the last 5 years. But, if you look at the price to free cash flow, it's still at 53, which seems, a little on the high side to me. And then there's just so much competition that, I don't know, obviously they have negative gross margins on their devices. And so, they do seem to be able to make up for that because they have so many devices currently being in use. But, I don't know how sticky it is, right? So that's the big question, right? It's, like one of our comments said, there one wrong advertisement, one extra advertisement away from, ditching Roku. And so it's, they have to like push that envelope of giving people what they want, but not so much as much advertisement as they can, because that results in them having the highest revenue per viewer, user, but also not so much advertisement that people leave the system, because then they have less viewers. So that doesn't help them in terms of the total revenue. And then they've got slowing device growth expected in 2025. In 2024, it was 20%, and they're only guiding for 12% growth in 2025. So those were my main reasons, just because it seems like it's slowing down a little bit, and the valuation isn't great. It's okay, but it's not great. So that's why it's not a sell. But it's definitely, I don't feel like it's a buy for me.
Yeah, I really struggled with. I don't know. I was on the fence between a hold and something more positive, I guess. So I kind of split the difference there. I think I bought the stock pretty early on in the pandemic, sometime in 2020, and wrote it up and wrote it down, and made a couple small additions on the dip, I think. So I was looking forward, I was hoping to do this, research and I thought it would give me maybe a more positive view on the stock, but I think I've been more disappointed than I wanted to be. So I'll say, the points I have there, I think, there are definitely positives here. I mean, top line growth is still good, and, user growth as well. So, I think the core elements you want to see for a growth stock are there, and certainly the market opportunity is there. The company seems to be doing pretty well in Latin America. Europe they don't talk about as much, and it, maybe it's one of those issues. I mean, with any of these publicly traded companies, you hear a lot more about the successes than you do with the failures, and if something goes wrong, the company isn't really shouting about it in the earnings call or anything like that. So I mean, it's as far as international expansion, I mean, you need to make a lot of partnerships there with your you need to be in with the retailers and your OEMs with the platforms, and I mean, some of those companies are global. Advertising, the streaming service landscape is different in some of these companies. So I mean, I think maybe it's an opportunity, certainly, but also maybe growth has been certainly in Europe, I think more disappointing than.
Yeah, it's probably a challenge with different languages, right? Plus different different cultures in terms of setting up the right systems to make sure that they're successful. And they're smaller markets, right? So, each time you're developing that, the cost of developing it is the same, but the market size is smaller. So, I mean, obviously you can use some of this, obviously using a lot of the same tech, but in terms of the actual development of the partnerships and everything, those can be, completely separate because they're, in different languages at the very least.
Yeah, I think it's it's easy to sort of look at Roku and look at Netflix, a company like Netflix that has had a lot of success globally, and think, oh well, Roku can just do what Netflix did, but it's not quite the same thing. As Netflix is really just creating content and telling people to download an app. The lack of profit, I think it's I'd like to see that improve, and actually the company is targeting, or they said they expect to be operating income positive for the full year of 2026, so next year, and margins are improving, so I think even with profitability too, I feel like they have a scalable business, and it does feel like they should be able to demonstrate that kind of margin growth. I think that those the sort of disruption or dislocation of the pandemic was maybe a setback for them over the long term, and having to go through those several rounds of layoffs as well. The business model, I think, is I feel like there needs to be sort of this unifying element. I mean, I get what they're doing with the Roku channel and even some of these the smart home products, and everything sort of makes sense, but it also feels like when you have a business like that, it's harder to sell it and pitch it to investors. I think it's even for customers. I mean, Brian, you basically said something like this, but I'm not really sure if Roku has a competitive advantage. I mean, maybe they do with advertisers. I mean, they do have the leading platform, but you and I, as we said at the top of the show, we have Samsung TV, which uses their own TV OS. And I mean, it's hard if you have that. I'm not going to just go out and buy a Roku. It's hard to think of what would be a compelling reason. And even if I were shopping for a new TV, would I, is Roku better than the alternatives? I mean, I really don't know. It's not something you hear about either. So, I mean, that's just my personal perspective as a consumer, but it does feel like, Roku it's not doing what Netflix has done, in streaming, for example, where it's, or it feels like a must-have kind of thing, or there's some show that everybody's talking about that you have to watch on Netflix. So, I don't know. I mean, I know they're doing, maybe in some way. I mean, I'm sure the company thinks that the product's better, but it does feel like maybe too much of a commodity. So it's, in some ways the stock feels like one of those. Maybe it's too hard, but I think, personally, based on the growth, I mean, I'm not selling it, still waiting around for, see how that growth story, and I like the fact that at least they're targeting profitability next year.
Yeah.
So.
Yeah. I mean, I think the other thing is just that I think Walmart bought Vizio. So I think that could be a potential issue in the future. What are they? Because I think Walmart might have their own operating system because they have another, don't they have like an operating system or something that they use in one of their other brands? And so now, with Vizio being owned by Walmart, maybe that's a competitor in terms of their ability to, get additional devices. I don't know how, I don't know how much additional devices are driving the programmatic sales compared to just them doing better job at, getting more partners and whatever, growing the programmatic sales, right? So from a revenue standpoint, it doesn't seem like the devices are really driving that much of sales, but I don't know how many people are going off of the revenue, off of the program as well, right? How many people are updating their TV, and now they have a smart TV with a different operating system, and therefore stop using their Roku dongle. And so how much is it replacement of devices, of or either somebody replacing their own device, or somebody getting a new device, but there are just as many people going off of the system because they're no longer they're no longer a user, and they're no longer want to be a user.
Yeah, it just feels like a messy industry in a lot of ways. And another point I was going to make, I mean, even Disney is struggling to turn a profit in streaming. So it's if a company like that with all their IP is not doing great, that maybe tells you something about the dynamics. We're going to pass it off to Tim and Asit, but I was laughing a minute ago. Jeff Mulvaney said, "Thanks, guys. Great analysis of Roku. Just sold my shares at IRA at a 37% loss. Good riddance. Good luck. Good luck, Jeff. I'm glad we could help you with that. And I think this is a good point as well from Jalexand. I see Roku at short-term rental apartments in lieu of cable box. Landlord can reset the visitor's settings upon exit. Doesn't seem like a great model otherwise, but I think that is that Airbnb certainly right, a vacation rental market makes sense. But yeah, we're at 11 o'clock. Thanks a lot, Brian, for doing this with me. Thanks to those of you at home. We're gonna pass it off to Tim and Asit for the mindset hour.
All right. Thanks, Jeremy. Thanks, Brian. Fools, welcome to the mindset hour. I always wanted to say mindset half hour, Asit, but that is not the case. Get your sleep numbers in. We got a full hour here to get to. Let me see. My sleep number, Asit, I was up about 6 hours and 20 minutes. 6:20.
Not bad, Tim. For me, my sleep number was something like 8.5 hours.
Oh, very nice.
But I am still exhausted. I think the variability of my sleep patterns is getting to me. So for this week, I have a goal to be a little more regular on when I get to sleep.
Okay.
So, but yeah, get your sleep numbers in, folks. Let's see how the rest of our members did. Maybe an average of where Tim and I fell. I don't know.
Yeah, could be. So this week's topic is something, I don't know why I have it in my head, but when my kids were small, they loved did they all love them? Maybe the youngest two. Actually, I think they all did. They all liked SpongeBob. I don't think they loved SpongeBob, but they liked SpongeBob.
How can you not love? Well, how can you not like SpongeBob? I should draw the line there.
Yeah, you have to at least like SpongeBob.
At least like him.
I think that's fair. But I remember there's an episode where SpongeBob and he was making a point and would say imagination. and so we're going to talk about imagination and using imagination as a tool, because there's different types. I think we don't tend to think of it this way, but when our minds go crazy, there's this axiom that we all know that says we can let our imaginations go wild. They can go wild. Sure. And when they go wild, they can go wild in a positive direction or in a negative direction. So when you are letting your imagination run wild in a positive direction, you could call that fantasizing. or aggrandizing, things like that. You are imagining unbelievable things. And if you apply this to the stock market, I've done this, where you imagine what magnificent returns you can get spread long out into the future. And then at that point, you are a multimillionaire. And then you start making plans in your head about money that you do not have. That is fantasizing. That's imagining.
Sure. Where I'm going to donate all this money to that I'm going to make when you get to that stage.
Yeah.
There you go.
And then on the other side is catastrophizing. The negative use of imagination. This is the worst. This is, I am about to lose everything. I'm going to have to move back my retirement by 5 years. This sort of use of imagination. And much like attention, as we've talked about during this show, if you thought of imagination like attention as a resource that you can harness and use as a tool, you can focus your attention and you can focus your imagination, that may benefit you both as a human being and as an investor. So we're going to talk about the properties of imagination. We're going to talk about the uses of imagination, particularly the poor uses of it. And then we're going to talk about it in the context of the environment we are operating in. Like, if we're going to use imagination as a tool, how would we use it now? Like, that's kind of the way we're going to go through the program today. So, Asit, I'll kick it to you here for a few thoughts before we kick it off.
So, Tim, after we met last week, I went and did a little bit more reading. I'm very interested in the subjects of imagination, something related, creativity. It shouldn't come as a surprise to any of us. One of the brief articles I read, put this in a great way. It said that, we've got 86 billion neurons, roughly, in our brains connected by synapses. And when we exercise our imagination, that whole network lights up. The whole thing is buzzing. So that shouldn't come as a surprise, because we know that if we engage in imagination and it's uninterrupted, it can be extremely pleasurable. As you said, Tim, we could start imagining success as investors and what we'll do with the proceeds once we realize the gains on our investments. And it can go the other way as well. Not surprisingly, two regions that figure a lot in this are the prefrontal cortex, where a lot of high-powered computation occurs in our brains, and the amygdala, which is, we know to be our friend, but it can also be not so great. Tim likes to refer to that part of our brain as the lizard brain, if I'm not mistaken.
Yeah.
So, yes.
Front of the head, back of the head.
Front of the head, back of the head. Both are in play when we use our imaginations. And as I think about this, I realize that really it is sort of a tool that we can put to use rather than being a force that overcomes us without our input. And so I'm very receptive to the idea of being able to practice imagination. How can I do that in a positive fashion so that the outcomes of what I'm imagining are going to be useful to me and I can perhaps pursue them? So this is, laying out in some ways an ideal, and then perhaps we're working on a plan. How can I understand when I'm letting that tool get hold of me? If anyone's ever used a chainsaw, this effect, you're going through some wood and it sort of kicks back at you, right? It hits a little bit of knot, and the tool starts controlling you. And,
I would imagine that's very scary, by the way, if it kicks back at you, because I don't want it kicking back and hitting me in the chest.
And I'm no lumberjack, Tim. I'm a pretty scrawny guy. The last time I used a chainsaw, it was an electric chainsaw that I borrowed from my parents, and I still experienced that. This is not some big old gas-powered He-Man lumberjack chainsaw. This was like a sort of Fisher-Price version, and I still had that moment where wow, it's a little bit out of control and pushing back at me, so I have to exert some strength. So I think when we look at how imagination can be utilized, for us it's about the free-flowing exercises that we then put to use. And I'll stop here so we can continue. We've got a lot of great things to talk about. But just to say, if we can agree as members today to look at this as something that will put to positive effect, and for good reason, then we can go forward with some more practical ideas.
Yeah. So if imagination is a tool, this is the way I kind of want to frame this up here, Asit. If imagination is a tool, it has both positive and negative properties. So as a tool, just like, again, I'm going to use attention as a corollary here. If you are unfocused on your attention, then your mind can wander. And there are multiple ways this can work. You can either get completely fixated and lost on something that is unhealthy, and you are not in control of your mind. Your attention is controlling you. You're fixated. Or your mind is wandering and you are totally unfocused. Imagination is somewhat similar. So if you are letting your brain go crazy with positive thoughts, if you are fantasizing, what you're not doing is planning. This is the point that you were making. You're not planning. You are engaging in wishful thinking, aggrandizement. This is stuff that is what you're doing is you're attempting to soothe your fears, probably. I mean, it may not be exactly right, but I think it's from the perspective of endorphins. When you're talking about this from a financial perspective and you're letting your imagination run wild, it's very similar to buying a lottery ticket. I'm buying this lottery ticket and I'm going to, this is my ticket to freedom. And you're imagining, when you are imagining a fantastical future financially from an investing perspective, because you have bought the stock that is going to unlock your financial freedom, it's very similar. But there's no plan attached to that. That is just blind hope, expectation. I don't feel great. I want to feel better. I will, fantasize this amazing future, and I'm not really even hopeful. I'm just deluding myself for the moment because I just don't want to feel what is real right now. I'm using my imagination to dissociate from the reality that is in front of me. Or, and this is the stuff that I sometimes struggle with, you are catastrophizing and things are not great, but you aren't deluding yourself. You are punishing yourself with horrible thoughts about how much worse it could get. And you are gripped by fear, pain, and it can get really dark. And so what your brain is telling you in that situation is you got to do everything. Everything is bad. Everything is terrible. If you don't protect yourself right now, so taking this from the financial perspective, if you don't shut this thing down right now, everything is going to hell. You are doomed. And so you must do something now. And so you end up catastrophizing. This is when your imagination. So in those situations, you were talking about the amygdala versus the prefrontal cortex. That's all when you're in the back of your head, in your amygdala, and you are having emotional reactions to soothe or combat or fight feelings that aren't great. And so you're not using imagination as a tool unless you are talking about using imagination as a tool to cope in some way. You're using an unhealthy coping mechanism. And as a longtime, really awful user of unhealthy coping mechanisms, I know this far, far too well. So that's the framing. Like, imagination can be great. It's how you use it. And those are some unhealthy ways we are using it. You can be an investor, and this is one way to know. Like, if you are getting lost in your imagination, are you doing it to cope or are you doing it to plan? So that's I think an important question, Asit. Let me kick it back to you there, and we'll pause for your thoughts.
Sure. I want to share a quote here from William James, who was the brother of Henry James. Some of you may have come across Henry James in your assigned reading in high school or college.
Literature, yeah.
Exactly. So William James was a famous psychologist at Harvard in the early 20th century. And he wrote an essay, which, it has a sort of very old school title, The Energies of Men and the Gospel of Relaxation. But it's a great little essay. And he says in that, when you are making your general creative resolutions and deciding on your plans of campaign, keep them out of the details. In other words, don't let the details get in the way when you're making your plans and your resolutions. Let that imagination just keep going. Once a decision is reached, and execution is the order of the day, so you sort of imagine what you want, dismiss absolutely all responsibility and care about the outcome. And what he's hinting at here, Tim, is that don't then let the back of your brain take over. So you have this great exercise of imagination. You imagine a positive outcome. Now it's time to sort of begin to pull those details in and have a plan that you can execute. Don't let the worry and the stress start to come in, because that can sabotage the exercise of imagination. Then he says, unclamp, in a word, your intellectual and practical machinery and let it run free. And the service it will do you will be twice as good. So this idea of unclamp, meaning we have something we've imagined as a plan, we're going to start executing it, and we start letting that catastrophizing part of our brain take over and clamp us. He's saying, look, unclamp. Just let that intellectual machinery, the practical side of you, be free from the worries that we bring, sometimes the baggage from past mistakes and failures, the fear that we can bring, uncertainty and doubt, which we talked about over the last few weeks. Let all that stuff sort of go to the side. Let yourself be free to also, in the same mode of the imagination, start to build our plan. So keep that part of it extremely positive, and be aware that sometimes, even if you take Tim's and my advice at face value, that, hey, you should focus on the positive side of imagination. Just in trying to build your game plan, the other stuff, the not so positive things can creep in. So it's almost like we want to create a protective space for ourselves to do both things, to have the imagination and then the practical side, which accompanies that imagination, which we can get into more. And we're going to the ideas of thinking ahead and forecasting and trying to evaluate the signals we get.
Yeah. Before we get to that, there's something that our producer, Matt Greer, said in responding this morning, and we would love your thoughts on this. So here is your member participation point to let us know how you deal with this. What Mac wrote, and I'll just read this quickly, is I can try to imagine what it would feel like if my portfolio gets cut in half, but I think that exercise only takes you so far. For me, a better indicator is my history. Know thyself and let that behavior inform my imagination. So maybe that plays into how not to let our imaginations run wild. Let your own investing history guide your imagination. So here is the member participation point. What is your history? How have you dealt with this in the past? Do you have a history? As with all of these things, knowing ourselves is very important. Do you have a history of letting your imagination run wild? Has it run roughshod over your brain? Have you been sort of subject to catastrophizing or euphoric thinking, and you've either overbought or you've sold too early? Like, what is your history with how your imagination has run wild, even to the positive or the negative? Because we start talking up here, 30,000 foot level. Imagination is a tool. Well, yeah, okay, but it's a good point to pause, and I'll start us off here on what our history is. That sounds great. but what's our actual history here? Well, my actual history has a long arc that started with a lot of catastrophizing, because I struggle with that a lot in my general areas of life, much less so in investing. In investing, I rarely struggle with it anymore, but I started to. My early days, I totally started with that. And my response was to sell way too early. That is how my imagination got away from me when I started. Now, where my imagination gets away from me today, Asit, is I will start game planning out ridiculous returns and say, like, okay, I can do, I take this amount of excess risk and I think I can generate, this. And then I quickly have to reel myself back in and say, like, whoa, 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 hold on here. Like, just because you know how to do that doesn't mean it's going to work out that way. Just because and you've had in the past, enormous returns over a short period of time, that doesn't mean that's going to repeat here. Let's get more practical. And so now I was very much catastrophizer. Now I have to reel myself back in. And that allows me to use imagination more as a tool today, because I know so I think Mac's point is important here. I know what my history is. So now I have a better idea of how I can use this as a tool. Asit, thoughts on this?
Yes, it's funny. My own history is an interesting one, because while I've had experiences I've talked about in terms of learning why investing is important, I've also had the chance to observe certain things almost by accident, which have convinced me to let my imagination reside in the space of what I believe is essential to very powerful long-term investing, is just the duration of things. When a company that you own grows its balance sheet and grows its annual revenues over a long, long period of time, there's a corollary there. You have resources to do better. And if it's a truly great company, then it also has the power to increase earnings. So it's so hard to visualize this, that you could hold a company for 25 or 30 years, and it could start with pretty small earnings, but at some point, if it reaccelerates, let's say you're 20 years in and it has a reacceleration for 5 to 7 years, that can produce an amazing chart relative to the position that you first entered, or the position that you built along. I was on Fool24 with Dan Caplinger yesterday, and he was showing how Nvidia's chart looks really volatile over one 10-year stretch, but with everything that it's done in the last 5 years, that smooths out, because the gain when it reaccelerated, that business gain was so big. And the corollaries I have are investments that I forgot about. So when I was very young, I put some money in something called the 20th Century, I think it was the Ultra Fund. I think now this group it's so old, it's owned by a different ETF company that used to be a mutual fund company. The mutual fund is now the American Century, I think is the name of the funds. But way back, Tim, this would be the late 70s. I was just a kid, and there was a brokerage across the street from the library where my mom used to live, believe me, when she went to work. And I would stroll over to the brokerage house because he was the dad of one of my friends. Anyway, long story short, I think I put some very small amount, and he humored me into a mutual fund. But I saw that grow because I sort of forgot about it. Years later, like when I was, I might have been in college or something, I looked, and that money, while it was minuscule to begin with, wasn't a fortune for me. But just looking at the percentage gain of that, I was like very surprised. And it was good for my imagination. It seeded something in there. The other thing, which was so interesting, is watching in one of my dad's accounts. Again, you've heard me say this, my dad has a speculative bent, so he likes to trade. But there was one account that he virtually never touched his whole career, and it was the account that he was investing in via a pension that he received. He's a physician, so he did some work in private practice, some work for a local government, the hospital, and just not paying attention to that account. And it was in an early Fidelity, again, mutual fund. So this, when you go back in the day, was no concept of ETFs. There weren't ETFs around.
Yeah, it was all mutual funds, right?
Yeah. So I'm not saying that he was invested in any of Peter Lynch's stuff, but just a fidelity fund that sort of followed the market over time to see how that grew was really interesting me on an intellectual level. And that supported my idea of imagination, that you can imagine if you've seen something over time. I mean, for some of us, this might have to be the same circumstance. You're sort of a kid when you start looking at these numbers, and then you grow into your 20s or 30s or 40s and you look back and you see what's happened. It makes the ability to imagine, I think, more powerful. And lastly, something that Tim's heard me talk about, just seeing my wife's family in India who lived in the shadow of the Mumbai Stock Exchange, just buy stocks in the 70s, 60s, and 70s, I think, and just hold on to them for one reason or another to see how things can work out. For me, that's very powerful. And it counterbalances a lot of the catastrophizing that I do when I look at how bad I was early on as an investor, when I look at my mid-career as an investor, even a few years ago when I thought, it value's the way for me. I'm going to be a value investor. I got this. I can analyze financial statements and I get narrative. All of this is hard, and you'll build strengths as you go along. You'll become better at almost any type of investing style you choose, folks, if you spend the time and you're earnest about it and you take it as a learning exercise. But one of the most fun things your imagination can do is just to tell itself, hey, let me plant some seeds today. It's going to be fun. And for as long as I can, let me follow those along, add to some, prune some. And for this concept of like visualizing from what I've observed, I've like translated that, Tim, into other parts of my life. If I see someone who has a really great way of dealing with children, I'll try to incorporate that in, my ability or whatever I can do, my desire to be like a better dad. And I'm much more apt to draw from the real world for the things I imagine. So see something that works, let that sit in your subconscious somewhere. So when you have that exercise of looking forward, you've got that piece of data at that point. And this is, I think, for many people, why we read, why we try to listen to audiobooks, why we talk to friends, why we look around in nature, because you need the outside stimuli, you need the outside data to help you become someone who's much more powerful in imagination. If you're insular and not taking in a lot of good information, it's going to be hard to exercise the imagination. Actually, the neurological inputs are fewer in nature, so you better be doing a great job with what you have inside the noggin. So this is a sort of roundabout way to encourage everyone, as we always do, to read widely, to research widely, talk to folks, watch Fool24, ask us questions. As a community, it almost always comes down to supporting each other, but also learning together and being in that learning mindset. That's very correlated with what we're talking about today.
No, there's a lot of good stuff in there. I think the most important thing is, once you are, letting history and experience fuel your imagination. That is, I think that's pretty useful. Okay, I'm gonna move us forward here, and we'll get to some questions and comments shortly here. So let's talk about imagination and forecasting. We talked about catastrophizing. Catastrophizing is imagining the worst, and then you take some steps to cope with, these awful feelings that you have because you are catastrophizing. When you are forecasting, I think this, as an investor, this is the ideal use of imagination. You are imagining what could be, or what you are after, and then developing a forecast for what it would take to get to that future. And you can apply that to a company. Like, this is, for example, when I do any kind of valuation work, it's always forecasting. All right, a company in 10 years, in order to triple from here or whatever it is. What do they have to do? Like based on the current trajectory and what they say they're going to do, what needs to happen? And then working back from that future. And in some way, you can do that as a discounted cash flow analysis. You could do that as, the way I tend to do it, which is break out the units, and then what does the unit growth have to be? And then at that point, what kind of cash flow does that kick off? Because what's the free cash flow margin? And then value it according to a terminal free cash flow yield. All of that valuation is forecasting, but also in your own personal planning. Like, what is it that your retirement planning? What do I need? I've often done this one too, Asit. This is, I think, a good use of imagination. Like at some point, I know what my ideal would be. Like I know how much money would be required. I have like a set target in mind. And then once I hit that target, it's like, okay, I know how much money I would want to put up under a, in essentially high interest bearing, like bonds, cash, and dividends of at least 3%, because then I know that bucket of cash, or that bucket of capital, if it's largely stable, it'll throw off a certain amount of money every year. And then post-tax, I know that's enough. And so like I can work back from that. I can see it. And that is forecasting to a future that I know I would like to have. And so then I can take practical steps towards getting there. So forecasting, it can be valuation. It can be allowing yourself to imagine along with the company you are following, like what is it that they're aiming to do? And what do we think they can do over the next 5 years? What have we seen them do in the past? When you're forecasting, you're taking bits of information you have, combining it with patterns you've seen in order to come up with a forecast of something that seems achievable. And you're allowing your imagination to take you down that path. And then if you're going to use that as a tool, then all you need to do is just check for signs of directional accuracy as you go along. So if you need to write it down, write it down. If you don't need to write it down, it doesn't matter. But have an interval where you're going and checking back in. Are you getting where you want to be? Was this, forecast reasonable? If the signs of directional accuracy aren't there, time to adjust the forecast. And that's a broad way to use imagination as a tool. But just pulling it back in, and then we got 28 minutes left, so that leaves us plenty of time for questions and comments. I think it's important to know when your imagination is running wild and if you are using it as a coping mechanism because you don't feel so good. You feel anxious, you feel, unsafe, you feel fearful, all of these sorts of things. You can use your imagination to cope. We all have that capacity. If you can instead point it towards, okay, I'm going to imagine the future that I want, or which is possible, using the data that I've got, and then I'm going to check in on that. That's pointing it in the direction of a tool that can be highly useful for you. And this we're going to find, and I'm sure we'll do more sessions like this, Asit. There are so many mental resources we have available to us that we can choose to not use as intended. Imagination, attention, all of these things are resources. The thing of it is, and I hate to be the person that sounds like, I'm not trying to sound like dad here, but like you are the one that gets to choose how you use this. Are you going to use it responsibly? like, unfortunately, the brain left to its own devices doesn't always serve you all that well. Not really. You have to point it in the right direction. And so this is why we sometimes have sessions like this. You're like, yeah, imagination's great. Are you using it as a tool or are you using it for something else? Because that happens to us all the time. Asit, I'll give it to you, and then we'll start picking off some sleep numbers and some comments. Oh, you got to get off muted.
Sorry about that. When we think of ourselves as those who can imagine, we're thinking of like so many possible outcomes. And you and I are saying now that let's spend time in that space where we're looking at the totality of like positive outcomes. When we get to that next step, I want to verbalize something you said last week when you and I were preparing for this. You said, what are the things we can really see? We might call that forecasting. So you've just been talking about forecasting, the things that we can really see. And you gave two great examples. One is yourself looking ahead to a number that'll get you times a percentage to something you feel comfortable with. So a lump sum of capital you've gathered times, I don't know, 0.03 divided by 12, thinking about tax consequences and feeling good about that number. For us, it could be, as you said, evaluating a business. So we're looking at a business and trying to figure out, okay, what does it need to do either to justify its price or maybe to get to a share price that I think can be great for me if I invest today. And to do that, I have to work backwards. Yeah. I wanted to give one piece of practical advice. I think everyone should have a few companies of their own that they do some kind of valuation exercise for. It could be very simple. And maybe you get really interested in this and want to have some models of your own that help you understand a company's like future cash flows, what those eventualities will be. But there should be a few, I think, for everyone where you just try to figure out either on a quarterly basis or a few times a year, okay, is it delivering the cash flows and or the earnings that I thought it could? This is what Tim is getting to when he says, keep up with the data, with the signals, and reforecast if you have to, meaning thereby you understand you did an exercise on the back of a napkin, or maybe you did it on a spreadsheet. Hey, the cash flows aren't really panning out. So my forecast is proving to be too optimistic because I thought, and it could be anything, that these products would roll out or management would do a better job executing, or I didn't foresee this competition. This is really, really good for all of us because for the businesses that matter most, they're going to eventually make up the brunt of our wealth. Over time, if you buy everything else we're saying, you're going to have some winners that become, in some cases, an uncomfortably large part of your portfolio. You may have to make some decisions. Do I trim a little bit of this business? So having the methodology, even if it's really simple, of forecasting and trying to understand where a business can go from here is something that we're all going to use at some point if we stay in this business, this game, this fun thing long enough. And so try to figure out for yourself, even if it's an exercise which doesn't include a lot of numbers, the forecast. I think Kava will continue to expand in the US, and I can see on the map in their investor relations or on their website all the locations, and I think it can expand to other cities. Even if it's as simple as that, you've got a forecast, which you can then look at a couple of quarters later, and maybe you see that the map is stalling out. That could help you. This is just a random example off the top of my head. But we're really interested in this idea of forecasting because it is the next very powerful step after the imagination. And I really love the way that you gave examples both for yourself, Tim, and for businesses. And we should all try to do a little bit of this for ourselves and for a few of the businesses that we own.
Yeah. All right. Couple of comments here. I hope this is our friend Luella from not all that long ago. If so, I'm so happy to see you, friend. If not, welcome. We're glad that you're here. But Luella says, my investing imagination is akin to my weather expectations. Even when sunshine's predicted, I keep a raincoat nearby. Help me weather immediate negative 60% crash, which is that's fantastic. I love that. And there's a couple. I'll just mention a couple of here. I'm sorry to hear this, Spiffy. Only 5.5 hours. Had a sad day yesterday. I ended a 13-year relationship when I realized our future was no longer aligned. Just need time to heal now. I'm really sorry. That, I mean, don't when the heart hurts, everything hurts. So yeah, take the time you need. I'm really sorry to hear that.
Yeah.
It's just
Sorry to hear that, Spiffy. We're thinking about
rough.
you.
Yeah, it's super rough. And Matt said this a few times, so I'll just address this and then kick it over to you here. It'd be fun to see you and Lou do a segment on Fool24 together, where the theme of that hour is about science projects businesses are doing with AI. I can ask Lou about that. I mean, we'll see. I mean, I don't know. I'm not sure how many science projects I'm fully aware of, but yeah, okay. Noted, Matt. All right, Asit, what do you got? You can pick up some sleep numbers and so forth.
So let's look at this observation from Jeff Mulvaney. Imagination, interesting investment mindset, but I think psychology is as good, if not better. Contrarian mindset is psychological, react to a reaction of the market. And yeah, I think they're not exclusive at all, Jeff. I think that we talk a lot here about different things that dance around or sometimes dance with or just are basically psychology. This is part of the big, broad definition we have of mindset. And I think, too, understanding what I often call your temperament is very important. Understanding what your personal psychology is like, how your brain is wired, how you deal with money, your money personality, your money psychology is so important. So I think here you're showing evidence that you've already thought through that. And I think I have a memory that you might have indicated this before, that, hey, I have a mindset that's contrarian. And so I like to observe how everyone else is falling on a particular business or industry or sector or the market as a whole. And I like to stand outside that and evaluate it and maybe go against the grain. And I think that's good to know oneself in this adventure is pretty strong if you're going to stick with it and, try to be a successful investor. Rebel had a comment from about 19 minutes ago. Here it is. Finding negative imagination is most active when in transitions of life, especially 100%. Large transitions, life and finances. Sure. I mean, I take Tim by negative imagination. Rebel probably means the part that's more towards the risks, the uncertainties, the catastrophizing, the uncertainty, all of that. For me, in my big transition,
it's disruption. It's just disruption.
Yeah,
every time there's a big disruption in life or finances, your brain will go off a negative doom loop. And I have said this. I have a great friend who we talk sometimes about this. And when our brains try to take us down a path of doing some kind of whatever mechanism we use to cope, and sometimes those mechanisms are very unhealthy. I have those for sure to the extreme. And what your brain is trying to do is protect you. So I fully understand this. Like, you feel terrible. You are going through emotional turmoil because, you've been hit with something that is highly uncertain and highly anxiety inducing. So what does your brain do? It tries to protect you and sends you down a negative doom loop to try to get you to hunker down and protect yourself. It's
very much so.
It's trying to help. It's just being really stupid in trying to help.
It wants you to survive.
It wants you to survive. The
mechanism is like, I feel threatened here. I feel a little bit of existential threat here. So I'm going to try to help in the best way I can.
Right.
Which is send you into sometimes not always, into overdrive, that imagination into overdrive. But our brains do try so hard to protect us. Just hitting a few more numbers here. Tim Rebel said 6 hours right on schedule. That's great. Investment Vertigo, which, by the way, I think I've said this before, but I love that name. I love that handle, Investment Vertigo. Good morning, Tim and Asit. Sleep number equals 6.5 hours. Team, I think we're averaging out somewhere closer to what Tim got last night. Yeah. Lovely Lily comes in with a solid 7 hours. It was warm out yesterday, and I enjoyed the weather. Yeah, it was pleasant where I am as well.
Yeah.
And one more comment I'll read here from Ted Zilla. Excited to watch Fool24/Mindset on my TV now that you are all streaming on YouTube. That's good feedback to hear. I don't know if it helps also with audio. I think maybe it might be easier to pick up audio on YouTube for people who are listening later. I'm not sure, but thanks for providing the feedback.
Yeah, no, that's great. And I think you covered this. I think you covered all the sleep numbers. Like Matt had 7 hours,
7.
Random Lake 6.5. So yeah, good stuff in here. And I'll just come back to what Luella said. Hi all, same old Luella YouTubing it.
Great.
Spiffy hoping for fast healing, deep rest, and plenty of rest. So glad you're here. Welcome back, friend. That's great. So that's wonderful. I hope that we're on YouTube regularly so you can join us. Yeah, and MA, I want to address this one from MH. Retired early 70s, but fighting hoarding money because mom lived in 96 versus spending the money to improve my life, making it much easier. Catastrophized to the extreme. I get this, MH, because when it's very easy. I get sucked in by the fear all the time of, the fear of negative consequences. And in this case, what it sounds like, if I'm hearing it correctly, is the fear of running out of money. If you're in your early 70s and you got 20 plus years to go, how do you make sure that you are handled? And, you probably can't plan for the entire 20-year cycle perfectly, but I wonder if you could use the tools we're talking about today. So imagination as a tool, and you could forecast, and let's say it is 20 years and you have 20 years of expectations, and you broke those 20 years into 5-year chunks. And so you had a plan that was like, all right, the next 5 years, this is what I know I need. And my 5 years of cash are set aside in this way. And maybe it's in a CD ladder or a bunch of bonds or something that is highly fixed, highly predictable, not subject to market fluctuations. And so you are set with that. Those 5 years are handled. And then the succeeding 5 years after that, maybe slightly more variability, take some extra risk, try to get some additional income. And then the 10 years after that, whatever the money is for that, then you take some more risk there in a way that is comforting to you, but you have the money that you are not going to touch for at least 10 years is where you take additional risk to try to make it last a little longer so you can live maybe a little bit more comfortably. It's hard though. I do get this. Like, you don't want to deprive yourself, but at the same time, you want to protect yourself. And so this catastrophizing, but one way to think about it when something seems too big and too hairy is, can you break it into smaller chunks? Like it's a book on writing, but I also think it is a great mindset book. Asit, you may have heard about this. It's from Annie Lamott, and the book is called Bird by Bird.
I don't know the book, but I know Annie Lamont. Yeah.
Okay.
But I don't know the book. Yeah.
So the book Bird by Bird it's a book about writing, but there's a story in it that I think is perfectly attuned to this thing that MH is talking about here, which I think it was her brother. They were growing up, and their dad says like he had this project and it was just absolutely brutal. It was just like it was the night before, and there's way late, and had to do a whole big thing of like, I guess it was maybe like a whole diorama with a bunch of birds, and it had to do a presentation, and it was just daunting. This thing was massive, massive project. And the question, I'm paraphrasing here, the question came back like, I don't like, how am I going to do this? This is too big. This is too massive a project. And the dad said, like, just bird by bird, buddy, just bird by bird, so essentially chunk it, like take this thing that feels massive, daunting, too big, too ugly, break it into smaller pieces. So you got 20 years, plot out the next 5 and see how that goes.
Tim, can I just put in one more thing on the behavioral side that maybe will supplement this really great advice that Tim has given structurally? If you find yourself looking at a long time frame potentially, which is a good thing, let's face it, if you've got those kinds of genes, power to you. But this is something that savers often find, even those who are young. And I've read a lot recently about young kids in the FIRE movement who become habituated to saving and as the member put it, hoarding. That mentality is, certainly not a fun one to get caught in.
Yeah.
Perhaps for someone who's closer to, very old age, it feels a lot more relevant, so it feels more justified. But I would say if you can find some mini exercises to alleviate that feeling, it could be splurging on a hot fudge sundae just because I like hot fudge sundaes. Or it could be a hobby that you like, just re-upping the tools that you use. But a mini splurge sometimes is a rational way to let your brain relax from the feeling that, gosh, I am feeling like I've got to hold on to every penny because I may need these funds later on. The truth is you need a plan. And Tim just gave an example of a great plan. And then for your mind itself, give it some breaks, do something that's rational, treat yourself to something small but meaningful. That helps a lot. It brings some bit of perspective in as you're going through, and it may help over the longer term too. If you do find that, boy, it's going to be somewhat tight for a long, long time, there's usually still space where you can do something that is a small treat and helps you just cope a little as you go along.
Yeah. I want to just quickly hit on Mike D's update, 6 hours from chemo day. Must stay strong and be thankful for every little blessing. Feel that one. Do that all the time, Mike. Possibly a new drug for the summer, AOH 1996, Mike D. Great that you're here. Love that you're here, Mike.
Same.
Still praying for you.
Same.
I hang in there. Really appreciate you being here. Zach saying, tuning in late, work stuff, but I got a solid 7 hours. Good to see you guys. Great to see you, Zach. And Rebel said something here that I think is more, from, relative to what you said. External noise can initiate a cycle of negative imagination, determination to throw out the noise, to forecast and implement, freeing the mind. From what William James said. I think it's great. And you do, freeing your mind is important. And Rebel also, speaking of Mike D here, going through similar. Oh, I hope not, Rebel. If you're going through chemo as well, don't let it get to you or allow doom to take over. Stay thankful, active, and positive. Yeah, I have to say, because I struggle with this, just to I hope this is something we can all do, particularly as we get older. But I do this as much as I can. I often forget it, but those little moments of gratitude are so important, especially when I get caught in just I think I've said this before to folks. When I get physical anxiety reactions, which it doesn't happen to me a lot, but it's happened recently where, my leg will just not stop shaking uncontrollably. I'll be rocking. I'll just like the anxiety is so bad that the only way to get it out is to physically get it out. It's just, I'm shaking in in order to get it out. And on those days in particular, um, little moments of gratitude. And I think, sometimes we get hit with really bad moments in the market too. You get hit with a big one, and it feels like, and this is real, this pain. I mean, we know this, Asit. This pain is very real. It really hurts people if a stock is down significantly and you look at the portfolio, you see how much red is there. And let's say you have a big portfolio. Sometimes the loss can be like in the 5 figures. And if you're not used to that, let me tell you how much pain and panic that can put somebody through in those moments. So this is true of all things in life, but I'm just keeping it in an investing framing for a second here. Reorienting to the things that are amazing, genuinely and objectively amazing, can help you breathe and reset and get back to forecasting. So for me, for example, I'll go out for a walk on those really bad, anxious episode days. And I'm like, you know what? I see a lot of people every day on the bus who are on wheelchairs, and I get to walk. And I can walk. I am actually capable of walking 10 miles. I'm 55 years old. I'm capable of walking 10 miles, and I can still do that. Like, that is unbelievable that I actually can do that. And I find those moments are pretty great, to help us reorient. If for no other reason, it's like a palate cleanser for your brain to
It's
get
mysterious,
you to
Tim.
reorient. Yeah.
Gratitude works in mysterious ways. When we stop and count our blessings, or we feel thankful for something, or we appreciate something, we don't really understand. Cognitive scientists don't understand the mechanism with which this becomes everything that you've just described, sort of a cleansing palate, also something that frees us up. It allows us to get back from maybe not positive imagination into forecasting. But we do know on just a level of common sense, like focusing on things that make us appreciate what we have. And that's in part what gratitude is. If you say I have a lot of gratitude because I have a close friend who's always there for me, you stop to think about that. You're focusing on appreciation, and this muscle, this cognitive muscle, while it's mysterious, we could say like it's related to so many things. The endorphins, the pleasure of remembering, thousands of moments with that friend. You don't remember those like in real time, but your brain is going back to all that positive feeling. Anyway, we're towards the end of the hour. It might be something that would be fun for a future episode, just to talk about the mystery of gratitude. But I'm a strong believer in that, Tim. I'm going to take a walk myself this afternoon. Like I said at the beginning of the today's hour, like I had a lot of sleep, but I have this feeling of like not catching up and feeling invigorated quite. And for me, like you, it's getting out in nature and taking a walk. I may put the low power symbol on or shoot the walking symbol up on my Slack today at midday, because it might help me the rest of the day to do that. But for all of us, we can take those lessons as Rebels said, and we know Mike D practices this as well. That, and it's such a great lesson for all of us as we head out. So let me stop here so we can take 2 minutes to wrap up and then move on to the next hour.
Yeah. I'm sure that Natasha's going to give us a heads up on who is up for the next hour, so we can introduce them there. But yeah, great messages from Luella. We'll just quickly address what Sanjar said. Should you pay off all debt before investing in the stock market? It's a great thing to do if you can do it. I prefer that. I would also say, Sanjar, if you are trying to orient yourself towards fixing up your finances, I think something else you can do. It kind of, you got to make your strategy fit you, but paying off, if you have a ton of debt, I think having a practice of like strategically paying down your debt, refinancing as much as you can, paying down the highest interest stuff first, and then something, if you want to reward yourself, if you want to give yourself some positive reinforcement with every bit of interest savings you get on paying off your debt, if you took that interest savings and say, "Up, my interest payments are down. I'm now paying $100 less in interest per month." That's $100 into an index fund. And then you start rewarding yourself by putting some money into the market via just an index fund. I think it is generally good practice to get the debt cleared away before you are doing any kind of individual stock investing. But if you want to give yourself some positive reinforcement by saying, like, every time I'm knocking the crap out of my debt and making some progress, I reward myself with some savings into the market, I think that can be a good habit that allows you to feel like, yeah, you know what? You get a double benefit. You are knocking down your debt and you are rewarding yourself by getting like, yeah, I'm in the market here. I'm building this habit. I'm taking a bad habit and flipping it on its head, which is great. Yeah, and I didn't reference the Williams James article. That one was Asit. Asit has got way more literary references than I do, but I did mention the book Bird by Bird by Annie Lamott, which I really think is excellent. But gratitude, great topic. It was really good. We're at the top of the hour. I don't know who's up next.
Looks like we've got Seth and Tyler. Oh, there
brilliant,
we go.
Tyler.
Brilliant, better,
Dun,
upgrade.
dun, dun.
Upgrade. All right, great. Well, thanks, fools. We appreciate you being here for the Mindset Hour. Remember, we love you, and we'll see you again next time. All right, off you go.
Have a great
See you,
week,
fools.
Mindsetters. See you soon. Bye-bye.
So there we go. Tyler, from mindset to mindless.
I very mindless because I have to admit I just crawled out of like a off the grid week yesterday. And so we talk about mindless. I am very behind because obviously when it comes to news, I have no idea what's going on.
Yeah. Tyler, in case people don't know, is in Georgia.
I am.
Right? And my wife was
Yes.
like, "Oh, that's a nice state." I was like, "No, not that Georgia. It's it's the farther away Georgia."
No, it's the Russia, between Russia and Turkey, Georgia. And
Yeah.
spent a week up in the Caucasus Mountains doing some backcountry skiing. So haven't really seen what's been going on in the news headlines.
Oh, there's nothing at all in the U.S. news headlines, as you can imagine. Nothing going on at all. Let's see, what do we got? We
I'm
got
sure.
market panic, or are we market euphoria today? Today I saw a lot of green, so I guess we're back to euphoria today. And well, we're answering questions here. Usually the topic here I've auto-filled is our tech stuff, so clouds and more, but we will talk about whatever stocks folks want to talk about, whatever topics they want to talk about that are related. And if there's nothing that's popping up for you right now, I will talk a little bit about, we should probably do this more often, maybe something that you've been researching recently. And one of the things I've been doing, it is a kind of get to double dip on the benefit, I guess, is try to figure out what like the market for LLM services and inference is going to look like going forward. And one of the ways I've been getting some help doing that is, interestingly enough, or maybe not interesting or strange at all, is by using LLM tools. And so we've gone through, like, in 2 years, we've gone like warp speed from like, chat interfaces where you got just these terrible answers that were hallucinated and you had no idea what was going on, to like, okay, here's an answer and here's a footnote or a link for it, and maybe or maybe not it was a real footnote or link, to these agentic, quote unquote, solutions, where they take many more steps before they kind of deliver an answer. And one of those released just a couple of weeks ago, if I recall correctly, to the public, including for free, is Google's Gemini deep thinking model. And Google, if people remember, like 2 years ago, Google seemed to be really behind the times on LLMs in general, even though it was research inside Google that started the whole thing when people jumped ship with it and went to other places. But they caught up very quickly. And I've been using a lot of Google's models inside of coding systems, or just, in the chat window at aistudio.google.com to do code production for me and to change code. And it works really, really well with really long context windows, longer than you can get in some cases than if you pay somebody like Anthropic. But I've been using their deep research tool. These tools all kind of rub me the wrong way because they're not really deep research. That word deep dive, I think, is way overused. Deep research is also overused. But I will say I've compared Perplexities and a few others, and I find Gemini's deep research tool to probably be the best one I've seen. And so you can put in like a 4-sentence prompt and ask it to do some research for you. And what you get back is probably a 10 to 11 page report. Now, it's a real snooze to read. If they could put this in a bottle, they would have the sleep aid market down. Like they're really terrible to read. However, as a first literature search tool, that's where its strength is. So in general, you get a pretty decent reflection of what it could find. And since it's based on kind of Google's search index, it's fairly in-depth, especially if you're talking about asking it about kind of contemporary subjects. So it may search from like 30 to 90 pieces of information, and it'll give you all of that in footnotes at the bottom. Well, in the window itself, it'll give it to you closer, but you can, with one click, you can export it. And if you're signed into your Google account, it'll go into a Google Doc, which will have all the footnotes. And at the bottom, all those footnotes will have the links. So I find it like a really useful literature search tool to kind of ground yourself as in a kind of a first pass at a topic you don't know a lot about. One of the questions I've asked it the last couple of days was like to try to tell me, to give me a sense of the direction of price for LLM inferencing among the different providers, and to, break it out by the different models they're providing, which cost different amounts of money and so forth. And then if they can, to relate that back to the hardware that they may or may not be using, if we know. And it's gotten me some pretty good information and some pretty good sources to look into that further. So it wouldn't give you what I would say was a finished product that you would hand your boss, but it gives you a really good starting point that would probably save you 2 or 3 days worth of web search hunt and peck. And so that is a really good tool. I have used it on the machine behind me, which has my personal Google account, and I have not run out of free deep researches yet. So I don't know if there's 3 a day or something like that. I don't do a ton of them. My work account, I have a license for Gemini. And so I don't know how many I get. I've never run out. So that is a really interesting tool to use for Fools. And you just need to have your Google account up and running.
I want to follow up on a quick question on this too, because it sounds, I'm sure it's really interesting. The thing that I've found with some of the earlier, I would say that, it's definitely not the free research stuff, but some of the LLM, like footnotes and things like that. How can you filter some of these for like quality of information? Like sometimes it seems
with
like
the Google ones, you see exactly like which website they are and so forth. So you can tell like, okay, that's janky. That's probably not, that looks okay. But since you can just click and go to the website, you can kind of judge for yourself there,
But I guess what I was asking, what I wanted to ask though was like, is there a way when you like code or prompt it, be like only use, I don't know, academic literature.
Oh, for
only
sure. In the
use-
prompt, you could just say only use SEC filings plus academic literature plus whatever. You can definitely do
Okay.
that, and it'll usually follow. And so I was somebody who was known as like the LLM hater for years here, to the point where I thought I was going to be fired. But the reason was the results we were getting were terrible. Like, so they were worse than not helpful. They were unhelpful because they were just so bad. You still have to be really careful, but now we're to the point where if you're using some of these tools the right way, I think they are time savers. Now I'll say that, you know, you can't trust like a table and math that come in through any of the deep research tools I've seen. Not only will they pull numbers from potentially janky sources, but they'll tend to do the math wrong. They'll put them in tables. If they put them into more of a spreadsheet, they may actually have the references to wrong cells and doing the math on numbers that then I don't even, you know, it might say like, oh, I'm multiplying this by this, but it might not be that. So there, I'm much more careful, but I'm just looking for kind of a general source of news information. And I wouldn't even know maybe where to start looking, you know, for comparative pricing information on cost per million of inference tokens under different circumstances or with different models. This is a great way to save hours probably to start looking into that stuff. And so that is something I want to point out to members, is that these tools have gone from being kind of a solution in search of a problem to becoming problem solvers or accelerators in a way. Now, I still don't believe in the agentic future that people are spinning, which is that like, oh, you'll just be managing 36 of these. That'll be your job. You will be HR for agents. Like they still make so many mistakes that you're not going to be HR for agents for quite a while. However, used the right way, I think they definitely save you a lot of time. And then in the end, you gotta dig in and use your brain. So in investing research, you know, you can ask deep research to just look at the SEC filings, tell you about a company. Now, we may, as contractors and fools, we may have tools that do a better job of that already. We can maybe bring, you know, vetted financials like right into an Excel spreadsheet through a plugin and know that those numbers are correct. But if you're somebody out there who doesn't have those kinds of tools, then some of this is going to be a time saver for you. But for me, the most useful thing is to try to get the sort of scuttlebutt kind of information and throw your net wider to get more of that information than you otherwise might. Because otherwise we tend to read like what comes across our news feed, and that's, you know, going to be maybe press releases or earnings releases and IR and stuff like that. So that's something I've been doing lately that has actually impressed me. But, you know, I wouldn't have said this a month ago. A month ago, I was trying these deep research tools from various providers and they sucked. Like, not to put too fine a point on it, they sucked. But Gemini's is really impressive. And Gemini also, it sounds like a Google commercial, but I have no connection to them. In fact, Google bugs me in a lot of ways. They have a new piece of their Gemini thing called what do they call it, Canvas or something. So it'll actually write code and stuff and put it in a window next to you and show you what's going on. Like, it'll write a calculator program for you, JavaScript, put that up. So it'll show you its work on the side of the screen, and you can kind of communicate with it and have it tweak what's going on over there. Again, these are the important investing lesson here, is that these are parts of service that people are actually paying lots of money for monthly, you know, from Anthropic or OpenAI. And these are starting to become available in very competitive formats, like almost as good, but free. So it's one of the things that if you're an investor in this space, you have to say to yourself, like, what kind of money is OpenAI going to make and how are they going to make it? Or the same with Anthropic. If Google is offering something for free that maybe it's not quite as good, but if it's 95% as good, free is going to win.
Yeah, I've been struggling with the monetization for a lot of these AI, in that same sense of like, if it's, you know, is it a subscription? Is it done on a subscription model? Because that's, you know, it seems like that's been the initial push for these, but then like, you know, almost in the sense of like, when we went from newspapers that were subscription based to they all went online and they went ad based, and it kind of blew up the model in this like rapid commoditization of LLMs, of these deep research things. Like, where is the monetization aspect to it? Like, how does Google with Google Gemini monetize this? You can give it away and you can blow up all the competition easily, because who's going to pay however much they want for Anthropic or OpenAI when Google's more or less giving it away? Where does Google come into the monetization aspect? Is it become another like I don't know the answers to this. I'm just asking some really open questions. It's going to be fascinating where it goes.
It'll be tough to figure out,
how
because
this becomes
they make their money on the back end, like selling to developers. So it's like it's priced per like $2 per million tokens or something. So for example, like as a user who's using one of these with a context window of 1 million tokens, a token is like 4 or 5 letters or something, or spaces. So a million tokens is like 250,000 words worth of input or output. I get that for free in a context window out of Google all day long. That might cost $4 for 1 million of output tokens from one service, and then DeepSeek supposedly that might cost you, if you use it at non-prime hours, it might cost you 1.4 cents, which price I believe has to be subsidized actually. Probably not a real price, and it depends on which models you're asking to use. And so, but the monetization such that it happens will be people tapping these through the APIs on the back end. Whereas for the most part, like I said, people pay, Anthropic and others, seat licenses for themselves, where you go to the chatbot and do stuff. And, some people, I guess, are paying OpenAI maybe $250, $300 a month for access to the highest level stuff. I feel like that business probably goes away. That particular piece of the business, especially if somebody like Google is giving you so much for free, that's almost the same.
Yeah, it'll be, I think it's a fascinating story to watch, because it's, much like, with the development of the .com times during the early 90s, there was like all these monetization schemes for how the internet was going to work. And we all thought AOL was going to be the way that the internet was bought, and that just got blown up. So, with these really nascent industries, it's fascinating to watch, because it's, you have no idea where it's going to go and who the actual leaders are going to be. I can certainly think of like, in the, where I'm going with my research now, and probably a little too cliche, I guess, if you will, is perhaps I could use some of these LLMs is looking a lot more at the European industrial industry as of late. I think one of the things that it's been interesting to me lately, watching a lot of what's happening in Europe with kind of this reindustrialization push that seems to be going on. In the absence of SEC filings, I feel like something like an LLM and a deep research type LLM model could be incredibly valuable in trying to track down some of those, niche players in the European industrial industry that could be big beneficiaries from kind of Europe's untethering of to Chinese and American based products. So that's something I've been looking at. That I can't say I've put any like definitive decisions down on anything as of late, but certainly something that's really been piquing my interest of lately, and something I want to follow in the coming weeks, and perhaps even longer.
And you can tell these tools, I mean, if you don't know anything particular on where you'd want them to look, you can say like, start with trade magazine or trade industry magazines and industry sources such as are available, and kind of, it would start there, because the search is smart enough and the LLM is smart enough to understand that. And you'll see with the Google one, deep research, it actually gives you what is called the research plan beforehand. You can like click a down arrow and see what it plans to do, and you can edit that. So you could add, you could add little pieces to the prompt, say, please check this, and then hit start. The start button there seems good to me. I usually forget to press start. So I come back 15, 20 minutes later expecting to see my thing. And I'm like, I didn't press the start button. It's just like that. It's just like the microwave or the toaster. You got to press the start button. Do you cover, do you follow insurance at all?
I follow insurance a little. I do have a little bit of insurance. Yeah. So Bessie's has a question about insurance. What stocks would be a good opportunity now? And the companies mentioned here, Kinsale, Progressive, Markel, Lemonade, and how will AI seep into this business? I do invest in insurance. I actually don't invest. Well, I own some shares of Markel, partially because I like to go to the annual meetings. And so I keep a few shares around just to go to the meetings. But I don't have any, I don't own any of Kinsale, Progressive, or Lemonade. This is going to sound, I don't know if it's like controversial or counterintuitive, but a lot of what was mentioned, Kinsale, Progressive, Lemonade, this is a lot of like of the traditional lines of insurance, property casualty, especially personal lines for a lot of people. Kinsale less so because they're specialty business insurance. They will do like kind of that oddball insurance, property casualty, like how do you insure an axe throwing bar or something like that? And that's been one of their like kind of, it's not all their business, but gives an example of some of the places that they go. At least me personally, I do own insurance, but I don't have a lot of property and casualty outside of like Berkshire and Markel, but those are kind of like such large conglomerates that the insurance aspect of it alone isn't the only real component to it. For the simple fact that it is an extremely profitable business. Insurance, the top 15, 20 insurers in the country can be incredibly profitable businesses that, stock performance can be great. So it's not like, I'm avoiding it because it's a bad business. It's just that it's a very crowded, competitive industry with lots of players, some of which can do well. The insurance that I actually have in my portfolio tends to be some of those like really weird and niche insurance components. So like, for example, Investors Title Corporation, which basically does title insurance. This is like an industry that is incredibly regional. It doesn't have nearly as much competition as like property and casualty. The risk reward profile on or the kind of the underwriting for title insurance is much different than property casualty. It doesn't tend to have to go through the pricing cycles. It is tied to the housing market a little bit, because it's based on the activity of how many houses are being bought and sold at any given moment. But it's one of those like niche businesses where you don't get like the big conglomerate, larger corporations in this industry. And so that's one that I own personally. And one I've been looking at a lot recently too is White Mountain Insurance, another kind of obscure off-ball, but one of their largest insurance lines is municipal bond insurance. So if a municipality, a city or something like that defaults on their loans, they're the ones that will actually pay out on the insurance. And so I think they are the largest and perhaps the only municipal bond insurer in the United States, or one of like the 2 or 3 with one of their insurance lines. And so when I'm looking at insurance specifically, I do tend to head towards the slightly less competitive markets within insurance, because I like it because they don't tend to go through the pricing cyclicality that you'll see in property and casualty.
Yeah. Insurance is one that I stay away from the most part because it's complex and a few storms can upend things. And I just feel like it's not one of my areas of expertise. I also wonder sometimes about like costs in terms of advertising and everything. I've got like had a couple Progressive accounts. And like as a customer, I thought they were awesome. And then like they tripled the insurance on my cabin in like 3 years, which was insane. And I did I finally called around and I found a company that gave me, it was a little company that gave me better coverage for 1/3 or 1/4 the price or something like that. So everyone out there is probably not as dumb as I am and probably would have bid it out sooner. But like you say, it's a competitive business. And it's tough to make things work.
Yeah, I thought that for a really long time as well. And I'm admittedly like, I'm not going to say I'm in like an insurance expert, but one of the things that I did a project a few years ago where I was like, okay, what are some like over 10, 15, 20 year periods? What are some of the industries, like the whole list of market beating companies, in the amount that were in the insurance industry, like the hit rate of outperformance in insurance was so high. I was like, I feel like I need to learn this because it was almost unfathomable to see like,
Yeah.
oh, the top 17 property and casualty insurers in the country happen to be market beating stocks. That mean this industry must be really good.
Yeah, they must be good at something. Yeah. Yeah. There's a question here. There's a couple I want to get to. I want to do the one from Besties at the top here first. With the AI tools you mentioned, can you obtain a good probability of the outcome of some events? How do you ask the question? Probability of XYZ doubles in 5 years. You can ask those questions of Google, Gemini, or other deep research things, and they may even give you an answer. I am not a fan, by the way, of prompt engineering, which was the first thing that came up where people were like, well, if you want a better answer, you have to have a 3-page prompt telling it what and what not to do, including saying things like, do not hallucinate. Make sure you don't make mistakes with Matt. Like, in my opinion, these things aren't AI if you have to tell them stuff like that. But anyway, as a quick test, just maybe last Friday, I asked Google Deep Research to rank 5 stocks according to, would they beat the market or something like that. And I compared them to, I think, maybe Perplexity and somebody else. And I ran the Google Deep Research, the same exact prompt, which was only probably 3 sentences saying which stocks and, examine, expectations, current earnings, blah, 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 and give me the rank order, which ones will do best. And the list was different between the different runs. So you can judge right there whether or not these are going to give you predictable stock market returns. And the answer is probably not, because you can ask them the same question 10 minutes apart and get a different answer. So what you get will depend. Remember, the way LLMs work is that there's a whole bunch of nodes. They call these neural networks, which is just a bad metaphor. They're just like basically long decision trees. And so, as the question or whatever it is, the thing kind of ping pongs its way through these billions or trillions of nodes to get toward its answer. Sometimes it makes a slightly different turn at this one than that one, which leads it down a different rabbit hole, which means it says, okay, I like AMD better than Nvidia in this scenario or something. By the way, they all said Nvidia was the greatest. That was number one there. They all agreed on that and didn't shift that one's position. Not that I'm saying therefore that's correct. I'm just saying that one tended to be there. And I think that could probably be an artifact of the sheer amount of press coverage and enthusiasm there is for NVIDIA. It probably colors not only the training of the models, which may be up to date, as of a year or two ago, which would mean plenty of NVIDIA enthusiasm, but also the news, to the extent they're looking at that news before they make their decisions. There's so much NVIDIA news. So that is my answer, besties. I would say you can ask them that question, and the answer you get back will probably be coin flip or worse, because that's how these things go. Cena, NYC down below said, I just noticed Garmin. I recall you mentioned it a few years back. It's done great. Thoughts on it looking ahead? I had Garmin in one of the earlier AI services that I was in charge of. It may have been a few years ago. I can't remember if I sold it or if we just closed the AI service. We've closed 2 AI services I've been in. They were both, this was before the whole LLM like craziness happened, and people weren't that interested in AI. Garmin I had in there because Garmin has an awful lot of mapping data. And then back then, the wearables section, so you're seeing a Garmin Phoenix 6 on my wrist, was doing pretty good business. And with a Garmin, everyone knows what Strava is for some reason, but with a Garmin, you pay for your Garmin and it crunches way more data than Strava does for free, because you bought your Garmin, so you get all the rest of this for free. Now, if you want, you can actually link your Garmin account to Strava, so you can still be doing your challenges and all that stuff, and they'll just send that information to Strava, and you don't have to do anything else. But one of the pieces of my thesis was that their fitness product becomes much more valuable because they have so much lock-in with a lot of pretty high-end athletes, because higher-end athletes tended to be using Garmin's at the time. And so they've got, I checked the other day, I have data in Garmin on running and biking going back to like 2002. So like they've seen me go from somebody who was running a few miles a day and then ran some more and could run like a 30-minute 5K in his early 30s or whatever it was, or not 5K, a 30-minute 5-miler in his early 30s, to a guy who wasn't running for a long time, to a guy who picked it up and started marathoning and, brought it down below 3 hours. And then, so they have all this, but they have all this on thousands and thousands of people. And years ago, they started, like, there's an AI powered coach, and it's not an LLM. This is before LLMs. This is when machine learning was powering things. And so, when if I go like click and I say, oh, I want to run today, and I'm just going to do this right now because I haven't run yet. Today, it says today you should run base training at like 45 minutes at a 9:15 pace. I never run that slow, but that's what it says would be good for me. And it'll put speed work in, it'll do all this. And I said, this is actually a really great value add, and maybe it'll drive their wearables division. And that was years ago. And I just want to note that, yeah, Garmin has done great. Like I said, I can't remember. I'm gonna go ahead and say maybe I sold it like at one of these lows, but Garmin is close to all-time highs still, trading at about 30 times earnings, about a 3.4% free cash flow yield, but generates a significant amount of free cash flow, like almost 20% free cash flow margin, doesn't waste it all on share buybacks. So that free cash flow actually is available to shareholders for whatever Garmin hopes to do. They've got 3.7 billion on the balance sheet with barely any debt and a $40 billion market cap. And when I check in on earnings recently to see, well, what's powering that, it turns out that it's outdoors and sports, which is, basically this or bike computers or similar handhelds for outdoors, hiking, backcountry skiing, right? You're pretty familiar with these. It's those devices, as well as automotive having a comeback, which surprises me because it just does. And I also would have expected, I haven't checked in with them for a while, I also would have expected like smartwatches to just have kind of eaten more of that market, because for most people, like an Apple Watch or an Android watch that does some stuff is probably good enough. It's not for me, and I don't like charging one of those things every day. And this thing, I don't have to charge more than like once a week, even if I'm running with it a lot. But it appears that there are enough people. For once, I'm on the right side of a trend. There's still enough people who like Garmin devices that it's powering some pretty good growth, some like 30% growth in that division lately. So there it is. I'm surprised, and I wish I'd purchased shares and not just recommended them.
Yeah, you kind of mentioned it earlier, was the idea of like, going to the higher end athlete and going towards somebody who's looking for a lot of the features where most, smartwatches, Apple Watch or whatever, doesn't come anywhere close to the features that are available in one of these things. And certainly not for free. Yeah, certainly not for free. And like you said, the logging, the training, all of that, you get the watch and then you have to get like 5 different applications on top of it to actually make that, get that sort of equivalent.
And then maybe pay them $15 a month or something. And, I know a lot of my daughter's in track, and a lot of those kids have Apple Watches, and I watch them, and like a lot of them are like, I got to get a Garmin, because like the Apple Watch, just like if I'm sweaty, it like I can't start and stop it, or I have to look at it to start and stop it. So if I'm in a race, I can't just like feel the button and do it. I mean, there's little things like that differentiate these devices, and somehow it seems to matter, to judge by their revenue.
Well, I mean, people will pay up for what they want.
What do you use when you're backcountry skiing now? I would think a Garmin InReach satellite device where you could press a button and although would you be picked up by a helicopter in Georgia if you fell off a cliff, or would that be the end of you no matter what?
Actually, that's a very interesting story, because the trip that I just went on, we couldn't get a helicopter for somebody because of bad weather, and we actually had to drag somebody out by hand. No, I just use my phone, to be honest. I mean, I'm very low tech. I don't
the
care
coverage will get
tracking.
you even in the backcountry. You'll get coverage.
Oh yeah, I mean, the cell phone coverage in the country is actually quite good.
That's incredible. Because in northern Minnesota, I've considered buying one. Even just there's some roads I ride my motorcycle on, so they're good enough to ride a motorcycle on where I'm not going to have cell coverage. And I think, like, man, if you go down on your motorcycle and get hurt, like, you wouldn't be able to call anybody. I've thought of getting an InReach, which for people who don't know, it's a very small satellite communicator that runs up to Iridium satellites. So you press a button on it, and it says, like, this person's hurt and here's where they are.
Well, the fascinating thing is that the country and the people of Georgia will put a village anywhere, like halfway up a mountain in really big mountains. And so there's cell phone coverage for pretty much all of them. And so, like, I guess I'm fortunate in that sense where I don't really need it. And I've never been one that's super huge on tracking stuff. I just kind of, I don't know, I go by the vibes. And so cell phone's always been fine for me. But yeah, it was, I know a lot of people that use them, and certainly a lot of very effective. I know that I actually, a friend of mine used it hiking, and, you know, kind of saved his life because of the tracking and the mapping and stuff like that. So they can be very valuable in very, very intense situations that might not be the typical wearables, which is why people will pay the prices that they have for them. So just a quick follow-up, because Vihan asked about the two the insurance companies I mentioned. Investors Title Corporation, the ticker is ITIC, and White Mountain Insurance is it's the opposite of Walmart, so WTM instead of WMT. So White Mountain Insurance, WTM, for Vihan, who is looking for those tickers. I want to hit a question that was a couple hours ago, and this can be a broad kind of discussion too, because it's not just specific to this ticker. But Jeff Mulvaney asked, it seems like Berkshire Hathaway has performed better than the S&P 500. Why not buy leveraged ETFs? And, you know, we could almost replace Berkshire Hathaway with, you know, 27, 30 other, name your company that's done incredibly well over the long period. Is, you know, why not buy a leveraged ETF for this? And the general I don't want to speak for everybody's thoughts on this, but generally what ends up happening is, yes, leveraged ETFs do better on the way up, but they can blow it. You know, it's not just like they can, you know, they go down faster when a stock go down. They can spectacularly blow up when stuff goes down at relatively rapid rates. Were some of the, I think I've seen recently some of the like triple leveraged ETFs for, I think it was, what is it, MicroStrategy. Some of those are really starting to like buckle because of what ends up happening is when you're running triple leveraged ETFs, you have to close out positions every day. It's not just, I was
going to say, it's something to do with the daily action they have to deal with that makes them even worse than people think.
Yeah. Like leveraged ETFs don't just buy and hold. You know, it doesn't just like take your money, you know, add 3x that money with debt and then just buy and hold a particular stock. It, you know, uses options every day that has to close out. And because of those options that they're using for these and having to close them out, when those positions unwind at the end of the day on big down days, it can have spectacularly bad results. And not just in like a 5% down day, I'm down 15%. It can be like liquidity events. This is, if there's a reason it's leveraged, it's a riskier bet. And as much as we want to say a company like, a Berkshire Hathaway is a relatively solid company that's not going anywhere. Stocks and equity are the most risky aspect of a business's capital platform. You know, you have the debt, you have the asset, you know, all this stuff, and the equity is what's left over. And so it is the riskiest position. Even if it is a safe company, it is still the riskiest position. And so you're adding risk on top of risk to by doing leveraged components of anything equity. I'm sure there's people out there that would say it's a good idea. If this thing's been going up, you can just triple your returns. Or, you know, I think we saw a lot of, there's been a lot of instances in the past of the triple leverage QQQ sort of, ETFs and things like that, which, you know, it sounds great on the upside, but they can blow up so spectacularly on the downside that for me, I will confess that I'm probably a little bit more of a conservative investor relative to maybe some other people who are a little bit more aggressive, more growth, maybe a little more forward thinking. It never seemed like the juice is worth the squeeze. I'm still in my 30s. Yes, I can take some. Actually, no, I'm 40 now. I forgot about that. You know, there's time. I don't need to be making these highly risky, controversial bets on, you know, triple leveraging into any position I have, because there's time, and it's rarely ever seemed worth it for me to do something like that when I can just buy and hold.
Yeah. Besties asks a Garmin follow-up, since we were just there. I'll go to this. I noticed several Garmin radar and sonar systems on boats at the marina. I don't know if Besties, if he's down there at the marina with his yacht, maybe he should be giving us the advice. That's what I say.
Well, add in a third person. They can talk about being at the marina and seeing all the Garmins.
Yeah, or at least bring us over for a cruise. Actually, I get seasick. But how significant is this segment within Garmin's overall business? Hey, thanks to some AI tooling that we've got here at the Motley Fool, it was easy for me to click on one of the things I had clicked on and then get straight to their quarterly report, where I can tell you for the last year exactly what that was. So net sales at the end of 2024 for Garmin were 6.296 billion. Marine was 1.07 billion, which was slower growth than some of the segments, 17%. Actually, outdoor was only 16% growth. So it's like 1/6 of their business as of last year. Fitness is the second largest bit of the business at 1.77 billion, and it grew 32% last year. And then outdoor was 1.96 billion, and that grew at a 16% rate for the year. Aviation is a little bit less than $1 billion at 876 million. Their aviation stuff is pretty interesting. It's generally for smaller plane pilots. And I know that they sell some well-liked, guidance and plane operating systems, for lack of a better term. One of the things that made me aware of them was that they came equipped on some of the airplanes that I was flying in on Microsoft's flight simulator. And I was like, oh wait, Garmin makes these AIs. And so I was looking, or not AIs, they're not AIs, they're autopilots. And they even have systems for smaller planes when they have enough control linked in that, you can push a button and the thing will attempt to right itself and then land at the nearest airport in case there's medical emergencies or other things going on.
That's how Garmin got its start, correct? Garmin got its start in aviation, right?
Yeah. They're out there in Kansas, Switzerland, but the U.S. business was kind of Kansas based. Whenever you get like a new Garmin product, it tends to like have something to do with Olathe, Kansas, if I remember correctly. So yeah, it's still a pretty significant piece, besties. About 1/6 of the business.
For chips and clouds, we're getting quite a few insurance questions.
That's all right. We just do whatever people
do whatever. That's the more component is, hey, more chips, clouds, and insurance, because
everybody wants to ask what they want to ask. So I don't even know why we try sometimes. That's fine. That's what this is about.
Yeah. So to tax accountant's question about insurance AI, as tax accountant mentioned, there's some stuff on the Motley Fool boards people can check out. It sounds like it's going to do some stuff in there. And one of the things that mentioning is Lemonade and Kinsale are approaching it differently from Progressive, and that's kind of been a pretty common theme with a lot of insurances, where you'll have legacy businesses where they'll have reams and reams and decades worth of data in these industries. And it can be incredibly valuable for your underwriting. One of the things that ends up happening with a lot of these businesses is they get stuck on legacy systems, and it makes them that much harder to compete when they're trying to acquire new customers. It's part of the reason I think Lemonade has been relatively successful lately is, user interface has been much simpler, much easier to use. And cost of customer acquisition has been pretty high for them. So I'm going to, it's not just like they're doing it better. They're also, spending a little bit more to get it done that way. But it has been something that like when I was at the Berkshire Hathaway meeting back in 2023, it was something they had mentioned specifically was that at Geico, they were talking about, Ajit Jain was talking at Geico, was like, we have been a little bit behind when it comes to telematics and some of our systems updates, not really talking to each other as well. So when we're, pricing home, auto, maybe boat insurance, trying to do those bundles and things like that. Some of our legacy systems haven't necessarily been as good at kind of integrating that thing. And so on the AI question, I think it's just going to, it's always been an immensely competitive business. Like everyone's always looking for that little edge, whether it be in user interfaces and getting people to sign up for it, whether it be, improving actuarial tables and trying to better underwrite something that's been hard to underwrite for a lot of recently. You look at California and Florida where insurance companies are leaving. It's a large part of the reason why they're doing it is because they're struggling with the actual underwriting of it, or it's the pricing of it is so high that it's hard to sell it. And so AI, I think for the most part, the even legacy companies like the Progressives, like the Allstates, the Geicos, what have you, they're not just going to stick within the, feet in the mud and say, this is what we've done for 100 years. We're going to keep doing it. I think all of these companies are going to be using AI to a degree at the rate at which they adopt them is going to change, or may not be, user results may vary, but if you're seeing one or two companies doing this and they're, getting progressively better at underwriting things, you're seeing, lower combined ratios across the industry. It's a copycat league. They're all going to start doing it. It's going to be competitive. It is, in a sense, a race to the bottom. It is a cyclical industry. So I would struggle to see like any one company being like, oh yes, well, we use AI. And it's like, that might give you a couple years head start, but I can't see it as being like, we are going to dominate AI based insurance for perpetuity, and all these other people are just going to get left in the dust. These things end up getting changed. They have to be competitive. These aren't companies that are just going to sit on their laurels and let somebody else just take all their lunch. It's way too competitive in the industry for it to happen. And for most of us, I struggle whether or not this is going to drastically improve like pricing for it. I think it might, you might get a little bit better depending on your profile, but I think on the whole, we'll just see it for the insurance industry. It's much more likely that you'll just see lower combined ratios than we will see like better insurance rates for this, because they'll just be better at pricing risk, and better pricing risk doesn't necessarily mean lower prices. It just means lower, probability of having catastrophic losses.
Yeah, that's the thing. It's just they're hoping they don't have to pay you, right? They're hoping they get super good at pricing that risk so they can keep that money, right? Thus buy a cabin in a place like where there's like no tornadoes really, and no hurricanes and no fires or anything. Like seeing the kind of increases that houses like on a beach in Florida or on a dry mountainside in California would have seen. So anyhow, let's see here. There was another one I wanted to address here. What was it about? AMD Shotgun Santa. We had a wreck on AMD in January. I don't know where that was, but we won't want to talk about that too much. But anyway, if someone bought AMD in January at 200 times free cash flow, it's now around 70 times free cash flow. Thoughts on investors buying some, or wait to see if there's more growth in data center stats? So I own AMD. I think I own it because I got it when they purchased, I forget whom, the company that made the programmable field gate arrays. I think that's how I got my shares. That's how we got it in one of the portfolios where one of the AI portfolios I was running. And AMD is just, the profitability at AMD is just kind of all over the place over the years, and free cash flow likewise. Like AMD has excellent street cred now for its CPUs, whether they're in laptops, gaming laptops, or whether they're, in servers, in data centers, and decent street cred on their AI acceleration chips, the GPUs that kind of do what the Nvidia chips are doing. They don't have the same ecosystem that Nvidia kind of commands with CUDA, but in many cases, they are competitive, at least on price, at least if you have enough brainiacs working at your business that you don't have to worry about the lack of CUDA. And so when I look at AMD now, it is down from a couple $100 a share, a year or so ago, down to, just close to 100, 110 right now. It's actually about 71 times free cash flow, but to me, it's worse than that, because AMD had a lot of share dilution over the past few years, and they'd spend a lot of their free cash flow on share buybacks. They spend so much of their free cash flow on share buybacks that, like, if you look at, so AMD had free cash flow, quote unquote, of 2.4 billion last year, but if you take out what they spent on share buybacks, it was only 815 million, and that didn't really reduce the share count much. That's just soaking up dilution. So that's the kind of free cash flow or the kind of share buybacks in my mind that aren't all that helpful for investors. And they command like a 9.3% free cash flow margin. The margins on the AI stuff, we haven't seen that turn the business margins around too much at this point. I'm kind of in wait and see mode on AMD myself as a shareholder. The sales are going to go up. I don't know where the profitability will end up. I forget if there's a breakout on whether they have much better margins on the GPU stuff. The overall gross margins are 53%, which is, way below like the 75% or something that Nvidia manages to get overall. And so, and just remember that even mighty Nvidia is seeing a little bit of gross margin decline in the GPUs, kind of at the bleeding edge, because when you first push out the new batches of the better stuff, the gross margins just aren't as good to start with. So I'm kind of in a wait and see mode on AMD, even at this price being like half of what it was, just because it's just so much easier to look at Nvidia's numbers and kind of interpolate or extrapolate where the profitability might be, and Nvidia's or AMD's are just all over the place.
On that, and kind of related to the free cash flow, let me just like follow up on that. Is it because AMD's like in one of those, because it is a cyclical industry that does require like significant CapEx ramps every once in a while to accomplish your goals? Is it in one of those periods? Is that why, like, free cash flows might be looking on the margin base, free cash flow margins might be looking thin because, like, CapEx is accelerated and it's kind of going through a big push right now? Or is this just kind of like the more of a inconsistent sales, inconsistent margins from, just from blocking and tackling of normal operations?
Interesting question. So being fabulous, you wonder what their CapEx is. I'm seeing the last few years, it's gone up like maybe 100 million a year over the past few years. Do I have a CapEx margin in my sheet here anywhere? If I do, I should highlight it. CapEx margin. Let's look at that instead. Now the CapEx margin has been dropping since 2020. It was 3% then. It was the year before that, it was 3.2%. It was 1.2%. Now it's like 2.4, 2.5%. So it's lower than it was like, say, 4 or 5 years ago, and never all that high. So it's just, it looks like it's just been kind of cash from operations sort of bouncing around in weird ways. I'd have to dig into the numbers to see the takes and puts every year. But AMD's sort of always been that way. Everybody like chuckles at Intel and everything and how they lost their business. It's even sadder because like Intel was sort of, again, one of these companies that was for quite a while much more kind of predictably profitable. AMD was the plucky upstart that was doing this. And AMD is still kind of there, even though they kind of won the war. They sort of lose the profitability battle a little bit, in my opinion. Although, Intel's profitability really went downhill once AMD started eating too much of their lunch, and Nvidia took the other part of their lunch.
Yeah. Again, chips is not necessarily my forte, so I'll do I have nothing to add, Charlie Munger line. Paula asked about Goosehead Insurance. I'm going to admit that I haven't actually looked at Goosehead Insurance, despite it being recommended in some Motley full services. However, Paula, if you do catch me, if we ever cross paths on Fool24 again, I will take a point to go look at Goosehead Insurance so I can give you an answer if we happen to cross paths again. But I will take this question from a few hours ago from Space Cadet 65, because this is kind of a little bit AI related, chips and clouds, because it looks like they were during the morning show, somebody was asking about Oklo and the potential restart of nuclear power. And the reason that they're talking about nuclear power and the resurgence of nuclear power in the United States today is more or less because of AI and, the accelerated electricity demand that we're supposed to be seeing. Oklo being a startup company, I believe it's backed by Sam Altman, of OpenAI. A very unique business model, to say the least. This is a nuclear energy company that wants to not just design reactors, but also wants to be the builder of them, as well as the owner and operator of the nuclear facility, the reactor, basically doing what nobody else in the energy nuclear business does. And the reason that nobody else is doing it this way is because it is so capital intense to do it this way. It's not only do you have to raise the capital to get your reactor designs approved, actually get these things sold, then you have to raise all the capital to actually do the construction and sign up. They don't even want to have partners. They're not going to sell it to a utility. They want to own it and operate it themselves. And so then you have to house it on your books. This is an immense amount of capital that has to be added to balance sheet at any time. And that capital has to come from somewhere. And not to be, I tend to throw digs at Silicon Valley every once in a while, because Silicon Valley, it seems to think that they can just raise money out of any problem that they have, and that seems to be the approach they're having with Oklo, where they're just like, look, we can raise enough capital to do this, but it is such a capital intense way of doing it. Nobody else in the industry does it this way. I guess the theory being is well, we don't have to give away the margin because we're not selling to anybody. We get to, once the electricity is produced, we're going to be the one that's going to be profiting from it. But that it's so hard to do it that way, because basically you're going to be inhaling capital for decades to actually make this work. I think the closest thing that I can actually think of, and this is a very, very weird simile, is if anybody knows the Howard Hughes Corporation. This is a company that basically makes master plan communities. It's they buy gigantic tracts of land to develop into mini cities and things like that. A couple 100,000 people in a city with they sell some to home builders, but they'll actually develop the commercial property themselves. And these things take decades to develop, and it's the amount of capital that actually has to come into this is it's immense. And I think that with Oklo, this approach that they're doing is going to be so capital intense. I really struggle to see it actually getting off the ground, because even if they have good designs, sufficient designs, especially in this small modular reactor sort of world, it's going to take 10 to hundreds of billions of dollars to execute the strategy that they want to do. And I'm just not 100% certain that investors are going to have the 10 to 15 year patience to actually pull this off, even if it is backed by a Sam Altman or something like that, and can wave his hand and raise $40 billion.
Although not as easily anymore. I was going to say, Tyler you sound downright enthusiastic compared to my take on this whole thing, which is I think we'll get a couple of startups, and in terms of companies, restarts of existing reactors. A couple are being planned, but though I do not believe the story on these small modular reactors, simply because it's just much harder than people are making it out to be. And the ones that Oklo is promising, I think the biggest one they say they can make is like 50 megawatts. They're talking about building 100, 200,000 megawatt individual data center campuses. So these things would just be would be barely anything. I mean, you need at the point they're talking about building gigawatt data centers. The average single nuclear reactor at a nuclear site in the US is a gigawatt. So I mean, that's the scale of what you would need to provide baseline power to these things. And nobody seems to want to say it. And this is all like, it's slow moving. And if you think people hate like solar in their backyard, which they do right now, wait till you try to put a 20 megawatt small reactor next to something. Unless something really weird changes, people are probably going to be even more angry about that. So I don't just believe this is going to happen the way a lot of people are assuming it will.
Yeah, the other component I think a lot of people, most people who are excited about nuclear seems to miss is like, you need cheap, you need reliable, and you need something quick to deploy, because data centers are not going to wait 10 years for the development of a nuclear facility. They're not going to wait 15, 20 years for a small modular reactor to finally get approved and whatever. The fast to deploy energy out there today, or the two fastest that we have right now, it's like if we need to add electrons to the system, it's natural gas and it's solar. And so if we're going to see rapid growth in data center and power consumption over the next 5 to 10 years, it's going to come from gas. It's going to come from solar. Wind takes longer to develop. Coal plants take longer to develop. Those gas and solar are going to be the only way that we can sufficiently add the power that they're talking about on the scales that they actually want to get done in a reasonable amount of time. Anything else,
I don't think gas can even do it right now, because there's a backlog of like 4 or 5 years on gas turbines. So it literally might be solar and batteries might be the quickest. And I've seen a lot of research indicating that it would be, but it has there's a huge groundswell of negativity against those because of political reasons.
Well, even those are backlogged as well, because First Solar has 3 years of backlog of orders that they have to actually fulfill today. So it's like everywhere you look, it's going to be hard to deploy anything relatively fast, but it pretty much comes down to solar and gas if you want to deliver electrons to the system like tomorrow.
Yeah.
And with that, that actually brings us to the 9 o'clock hour, and Seth is going to step out. Jayson is
9
going to
o'clock
jump
for
in.
you, pal.
Yes, 9 p.m. for me. I'm sorry. I always forget that you guys are on a different time zone.
Yeah.
Swapping
Jason.
Later, everyone.
See ya.
Thanks, Seth.
So for the rest of the world, where it is not 9 p.m., it is now time for the 1 p.m. Eastern time hour. Tyler Crowe. Ask us anything. I'm Jayson Hall. He's Tyler Crowe. Hey, buddy.
Hey, it's 9 p.m. where I am. I mean, this is absolutely the time to ask me anything. I mean,
there you go.
This late in the day, I'm surprised I don't have a couple cocktails in me and going off even more on nuclear power.
Fair enough. We will keep you within proper parameters. We've got you targeted in. What's news, buddy?
It's been like I mentioned it with Seth, took a little bit of a week off, went off the grid, haven't seen a whole lot of news lately. So, I gotta say it seems like there's been a lot going on, but, I can't say I know what it is.
Well, so here's one of the powerful things about investing is, as much as we are voracious consumers of news and information, for those of us that are individual stock picking investors, the remarkable thing is that we can actually unplug and disappear and do absolutely zero for extended periods of time. And generally it's fine. It's absolutely fine. So what you did is healthy. And I want to encourage everybody watching this, do the same thing every once in a while. You really don't have to consume everything. Taking the time to let yourself just process and be for extended periods of time is healthy. It's very, very healthy. As speaking purely as an investor, it's probably good for the rest of your life and relationships and health and all that stuff too. Right, Tyler?
Yeah, except when you and I are on. All the other time you can step back.
Oh
take
no,
away,
watch
but,
us, of course. Yes. Yeah, obviously. That goes without saying. All
Obviously.
right, get your questions into us. Slido.com. The event code is Fool24. Whether you are a Motley Fool member watching us behind the Motley Fool paywall or you're watching us on the YouTube channel, open up another tab, Slido.com. The event code is Fool24. If you're watching us on your PC, you can fire up Slido on your phone. If you're watching us on your phone, you can fire up Slido on your PC. There's lots of ways you can get questions to us and still continue to watch the live stream. Always too, just remember, we're happy to answer your questions, but we're not telling you what to do. You might feel like it when we're reading your question and then we give our thoughts and answers, but we're not providing anybody with individual or personalized financial advice. So just keep that in mind as you're making your decisions and consuming whatever wisdom or otherwise we're bringing to this hour. Tyler, do you see some questions here in the queue?
I do. We got a couple that are coming up, but you know what? Like I just said, I was gone for a week. I was off the grid. What did I miss, Jayson? What was the story that really caught your eye for the last week or so?
I mean, probably the one that stands out the most, and this is a little bit of recency bias, but again, thinking about the lane where you and I can typically be found, the BYD news. BYD, the EV manufacturer with 5-minute charging. The headline that stands out to me, Bloomberg's headline that's BYD of his past Tesla. I can't remember exactly what they said. Has established a lead over Tesla, and it only took 5 minutes or something like that. I think that's the one that probably stands out the most. We got FOMC reported last week. They met, didn't do anything. We all knew they weren't going to do anything. But that's the one that kind of stands out. What about you? What have you seen since you've reemerged from the frozen wastelands? What have you?
It was not wasteland. It was a beautiful land of white powder and waist deep snow. Don't call it a wasteland. That's heaven. You mentioned the EV thing because that is a story you and I have been kind of tracking quite a bit. Again, the waters we wade. We seem to be on this precipice of stepwise changes in the EV market. When it comes to charging, when it comes to batteries, when it comes to, some of the things that have been happening behind the industry. It seems like a lot of the push in the recent, the recent EV push, whether it be with Tesla, whether it be with Rivian, Lucid, a lot of these were, based on tech that came out probably in the 2012s, 2013 range, nickel, cadmium, batteries, things like lithium batteries. And with this, with the BYD fast charging, we've been talking about with QuantumScape, with solid lithium batteries. Toyota's coming out with their own. I think I just saw that Mercedes-Benz was coming out with their own solid battery. It seems like we are on this precipice in the electric vehicle industry that is going to, be that thing that makes them almost completely competitive with the traditional internal combustion engines in terms of the convenience, in terms of charging times being comparable to filling up at your gas station, range for those batteries being comparable to what you could get out of an ICE engine, as well as not having the degradation of batteries that we all seem to know with charging our cell phones, that after a couple of years it's like, man, why do I have to plug this thing in after just using it for a few hours? So it's going to be a fascinating story to watch. Like you said, we've been following QuantumScape. There's this all of these automotive companies seems like they've been keeping it really tight to the vest in terms of actually announcing these things. Like Toyota comes out and announces hey, we've got a solid state battery we're going to be producing in 2026. And it seems like it threw everyone to a loop because it wasn't something that they have been parrot or communicating out to the market. So I think it's going to be a fascinating time, and it could be another one of those big shakeup times for the automotive industries. and also one of the reasons that it makes the automotive industry so difficult to invest in because of things like this.
So that second part you're talking about is key. And this is, so the headlines that I've seen and the takes that I've seen broadly, they tend to ignore the lesson that investors need to learn and need to deeply internalize when it comes to technological advancement. It almost never creates a durable competitive advantage. Let me say that again. Technological advancement almost never creates a durable competitive advantage. BYD has announced something. I guarantee you within the next few years, this is going to become more normal than it is unique to BYD. I absolutely, as close to guaranteeing that as I can come within the realm of possibility that I'm going to be wrong. I don't believe I'm going to be wrong about this, Tyler, because history is littered with proof and evidence that we see parallel advancement of overlapping technologies, right? So here's what we also don't know. And I talked a little bit about this over the weekend. Lou Whiteman and I on Saturday morning were talking about this. I'm also pretty sure that BYD is going to put the things they didn't put in the press release. They're going to be in the instruction manual for those cars when they start delivering them in April, which is going to be, don't use this every time you charge. You can only use it this number of times, percentage of times, because there are competing capabilities with lithium ion batteries. You can either build a battery that can take in electrons really fast and spit them out really fast, or you can make a battery that's going to last a long time. It's pretty amazing.
It's practically impossible to do both.
Doing both is, it really, I mean,
it's the holy grail of
it is the holy grail. It really, truly is. So what is amazing to me that we've developed so far is what Tesla and a few others have done that's allowed us to get a couple 100 miles of range in less than 20 minutes. That's pretty great. That's pretty great, especially when those batteries are also still, holding 80+% of their range after 100, 200,000 miles. Like, doing those two things is pretty incredible.
Yep.
BYD did not say that they've built a battery that you can add 200 miles of range in 5 minutes that's going to hold 80% or more of its capacity for 200,000 miles. I guarantee it won't. Maybe I'm wrong. I'm not going to say that I'll eat my hat or anything dumb like that, but I'm very, very certain that what they're going to say is that this is a feature that's available on these vehicles for occasional use, the long distance trip. And they're still going to encourage 90% of the time that charging be done at home overnight or with fast charges that are not, rated at the amperage that they're talking about. So I may be wrong, but I'm almost certainly not. Now, here's the other thing. This is the last thing I want to say about it, because this ties to QuantumScape. In a lot of ways, there's a view that maybe the advancement of lithium fast charging like this is going to kind of supersede maybe the need for things like solid state. That's absolutely false. The batteries are still too big. They're still too range limiting because of the size and the weight to truly get to the actual holy grail, which is an EV that is a similar weight profile and a similar range to what you can get from an internal combustion engine with a gasoline tank. You need something like solid state that is going to substantially reduce the form factor and the weight of batteries. So that I think, if anything, this is going to accelerate some of the investments that we're seeing in solid state broadly across the industry. Everybody's waiting till what we actually see in April and May, though, right? Before I can really qualify those statements. But I think, if anything, this is more of a signal of the viability for those sorts of things, and maybe like how serious the land race really is to develop those technologies and implement them. Because if you're an automaker, as soon as somebody else does it, it becomes the table stakes, right? And if you're the company with the IP to do it, all of a sudden you're the one that can make money, while the automakers are just trying to keep up with Toyota and whoever else out there. BYD is bringing these things to market. So
on this, on the idea of it being a copycat league where it never is a durable advantage and everybody eventually does it. And all that advantage tends to go to zero. I'm going to transition to the question that Jeff Mulvaney asked about insurance, because I think that's the same thing. He asked, the question isn't Lemonade an example of a company that has monetized AI? Isn't monetization of AI going to become more important? Yes. The quick answer to, is it going to be more important? Yes. The thing is that everyone is going to do it. And I mentioned this in the previous hour with Seth, where insurance companies like Lemonade, they're the new ones. They don't have the decades upon decades of data and legacy systems, and they can be, more nimble. They can build it on AI, and they can do all the things that they say that they're doing in terms of, being able to underwrite faster, be more competitive, have a more, better user interface, claims better, everything that they claim that they're better at, because they've built it on these new systems, AI being one of them.
It's clean sheet, right? It's clean sheet.
Yep.
And what you find when you build something with a clean sheet is that what you end up with largely looks a lot like what was already there, but there are some fundamental things that might be different that can maybe turn into an edge for a period of time.
Yeah. And that's the critical part, is period of time, because I can guarantee you that no matter how big or staid or the company that's like, we're an insurance company and we've been here since the Mayflower landed or something like that, of like these staid insurance companies, as much as they, project this idea of like old and reliable and whatever, they are all just as much going to be running to the door when they see somebody like a Lemonade monetizing AI and better analyzing their data to better underwrite claims. If the companies in this industry see this and they see like, hey, this company was able to bring their combined ratios down by like 7 to 10% because they, of better underwriting through these AI models, I can guarantee you that every single CFO and CIO is going to be running to the door to try to, invest in these sort of things to improve, to do the same things. The whole point of, the insurance is an incredibly competitive industry. Lemonade is what, maybe like the 25th or the 30th largest underwriter of property and casualty in the United States.
I don't even know if it's that big. They've got their insurance book through February. The most recent information one of their executives said, because there were some claims that were put out there that they had passed $1 billion, and their CEO weighed in and said we haven't. So again, maybe by now it's close to $1 billion. Directionally, it's moving. That's tiny.
That is micro fraction of the entire like property and casualty insurance business. And all of these companies are going to see somebody like Lemonade doing what they're doing. They're going to see the Kinsale Capitals, these new upstarts, that with the clean sheets, with the, systems that talk to each other or whatever, they're going to be implementing them. User results or end results may vary depending on the company, but they're all going to do it. I remember you and I mentioned this in the previous hour, you and I went to Berkshire in 2023. And that's one of the things they even admitted, Ajit Jain admitted, was like, we have been a little behind the ball in terms of systems updates, using telematics, and we've kind of fallen behind the other companies, especially in our automotive division. And so, and then again, in this most recent Berkshire Hathaway letter, they started talking about the improvements at Geico and like what Todd, Ted, and Ajit have done to improve the systems there to make it a much more competitive industry, because they are they're not going to come out and say that like, oh yeah, we're using AI because it's Geico, it's Warren Buffett. That's like, they're not going to, admit to being the most tech fast forward, insurance company out there.
Not in their investor letter, but they will market those things. Right.
Yeah. And so the chances of them using it is incredibly high.
I want to build a little bit on Lemonade, because the question directed at that. So here's how Lemonade has actually used AI. We talk a lot about the underwriting, and frankly, the underwriting has been the thing that it took them the longest to get better. And I think they're starting to get it right now. Coincidentally, they started getting the underwriting better when they brought in experienced insurance executives with underwriting backgrounds. So how much of it was fixing the way that they use AI for underwriting versus just having a more insurance business approach to thinking about underwriting, we don't really know. But there are a couple of other ways that Lemonade has benefited from using AI in its business. That I don't know if you can say it's monetization as much as it's like operational thing. So using AI to process claims and try to automate that process as much as it can. We know that has certainly improved their customer service. You know, there were stories of them having claims come in Southern California when wildfires were still burning within miles of people's homes, and people filing a claim, and within minutes, Lemonade approving the claim. Right? There's still smoke coming off the smoldering ruins of people's property, and they've already approved the claim. Right? That's orders of magnitude better than everybody else. Now the question is, how good is the QA when they're doing that, right? And how necessary is it to approve a claim? And there's a lot of nuance in there that we don't really fully know too, right? So, but we do know that from a customer facing perspective, their use of AI with existing customers has certainly given them benefits of scale in terms of operating costs and being able to make decisions quickly with less people standing between the customer and the decision. When there's less people in between the customer and the decision, there's less cost. So we know that's benefited them. They've used it in other operational ways as well throughout their entire operating business to drive out costs and to improve efficiencies. And there's, again, this is the clean sheet advantage. Geico, Progressive, Allstate, State Farm. We can get into some of the private insurers that are not the non-publicly traded large insurers as well. There's a lot of acquisition and kind of growth by swallowing up more and more of the market that's created those businesses. And that means a lot of them are siloed because they would acquire an insurance business largely to either buy their book or to acquire their agents who are selling the insurance, right? So you're buying your top of the funnel. And a lot of them were using their own internal systems and that sort of thing. And they didn't do a lot of transitioning over to systems. So they got dozens and dozens of different systems that they're using at some of these insurance companies, which creates silos. It makes it harder to analyze data, makes it harder to do automation. And it's an industry that that wasn't necessary to do it, right? Because it's slow to move. It's slow to change because the most important thing is keeping your marketing control efficient and underwriting well. If you do those two things right, then you're probably going to make some money. And if you make a little bit of money, you're going to have float. And if you have float, then you can make more money off of the float, right? So that's the model. So the clean sheet approach, keep our operating costs down low, drive out the operating costs between us and the customer decision. And if we can underwrite well, immediately we can have a lower premium and be more profitable because we have scraped a layer of cost out of our business. So they've done 2 out of those 3 things pretty well. Their cost of acquisition is high and it's going up because they're continuing to accelerate marketing to take more market share. The question is whether or not the true monetization of AI for this business, which is using it to make better underwriting decisions, if they've really fully figured that out or not. We don't really fully know. It's too small of a business and its life is still too young to really know across markets and geographies and property types and demographics of your customers and age of properties and all of those things. There's just not enough data to really know. I'm a shareholder.
Jayson, I think I've done like 30 minutes on insurance and there's still insurance questions coming in. I feel like I'm in heaven right now. This is a great Fool24 for me. This is like your hour of Brookfield.
These are our people.
Yeah, exactly. I need input. This is a quick comment and then I'll go to the next question. I need input said, I'm not saying legacy companies can't do it, but it's very difficult. He works in IT, building software, and especially integrations are very, I don't doubt that. I don't doubt that in the slightest. But one of the things, like I mentioned, is this is an incredibly, incredibly competitive industry. And when you get into when you get into incredibly competitive industries, it's when things like this start to get like a little bit more necessary. I'm not doubting that, Geico's updating its legacy software and all the acquisition, things that they have bought over the years. I don't doubt it's going to be incredibly hard, but for these companies to thrive over the long term, these things are going to be necessary. And I think you're going to have the tip of the spear AI, powered insurance companies do what they're doing. And, the legacy companies are going to look around and be like, look, we got to do this. It's very much to the future viability of this business that it needs to happen. And so it's a copycat industry. It is. Yeah. Some of them will go dragging, kicking, and screaming. An example I think I could use here is like the railroad industry with precision scheduled railroading, which was like an operating model that like one company used. And they started, they went from having like operating margins in the 25% down up to like 40%. And I think it was a Canadian National that did it first. And everyone else looked around and like they fought it for the longest time, be like, oh, well, we're more resilient, yada, yada, yada. And then over the next 25 years, every single person, every single railroad company in North America decided to implement it, some faster than others, but eventually it happened. So that as much as I don't doubt that it would be a long and painful process for a lot of them to do it, they will do it. And then I
think it's possible I Need Input may have hijacked and taken over my brain when I was talking about these legacy insurers. There's legacy because I Need Input. It sounds like this is an industry that you work in, talking about some of the challenges with these legacy businesses, but eventually they're gonna kind of have to do it. So yep.
So and then this is a question, it looks like, from Rose from about 25 minutes ago. It says, I'd like your opinion on ticker AJG, Arthur J. Gallagher. And the comment says it's a competitor to Travelers, Aflac, and MetLife. And I'm actually going to push back and say that they're not really a competitor there, because Arthur J. Gallagher is different in the sense of it's not an actual underwriter of insurance. Arthur J. Gallagher is actually just a broker. That mostly working with businesses, doing a lot of kind of that. You're a unique commercial business that has to underwrite this strange thing, or I don't know, maybe you run a NCAA bracket $1 million competition and you need the insurance on that. You go to a broker like an Arthur J. Gallagher or its biggest competitors, Brown & Brown or Aon PLC or Watson Willis Towers. These are the companies that don't actually do the underwriting themselves. They are the brokers. These are the people that will go to the clients, who will, say like, hey, what are you looking for? And then they will go to, 5 or 6 different underwriters, either, a commercial company or reinsurance, or maybe they'll just, go to the Lloyd's Exchange and find somebody who will actually underwrite the claim that the broker is trying to set up and find the most competitive offering for that. It's not, you don't see it as common in like the personal lines, because we're all inundated with commercials these days, and we all go to the websites for State Farm, Geico, all of those. These are much more like an oil and gas company needs to insure their refinery. They're going to go to somebody like an Arthur J. Gallagher or a Brown & Brown to broker and get the most competitive underwritten rate for that. So these are actually, to me, fascinating businesses, because the brokerage industry is it's involved insurance, and there is some pricing elements to it, because they get a commission on anything that they or anything that they sell, or so they'll get a percentage of the premium, and that's their commission. But they don't actually take any underwriting risk. It's basically like kind of like a hunter gatherer, eat what you kill sort of thing. It's like if you find a client, you can actually get something underwritten for them, you get a commission on that. The incentive being is like you find the lowest price for them, but you get the business. So it's to me, it's actually one of the more fascinating elements of the insurance business. Are these companies that are in insurance but actually don't do any of the underwriting? One of the things that has made them so effective, aside from not having to worry about a float, not having to worry about being up to date with the most, recent AI models or telematics or whatever to, have better actuarial results or underwriting for your business. You just basically have to have good relationships with your clients. So when they need insurance for something, you can just basically go and price it out for them. But at the same time, this is an incredibly fragmented industry. I'm sure anybody who is on the call here, if you grew up in a small town, there was probably like one or two insurance brokers, and it was like some person who was an independent agent or maybe just like a family office or things like that. The insurance brokerage industry is incredibly fragmented. And when you have incredibly fragmented industries, companies like Arthur J. Gallagher have been spectacular at rolling up and consolidating the commercial insurance brokerage business to grow in a way that's not that hasn't been like destructive. I know one of the things that you and I talk about a lot is mergers and acquisitions being a value destructive thing, but a lot of these consolidators in incredibly fragmented industries where you're buying like a regional broker or a mom and pop for such small amounts of money, you don't even get a press release and it barely even shows up in the cash flow statement. Things like that can be incredibly accretive to value over the very, very long term, because it's like you're not trying to like integrate corporate cultures and a bunch of back office systems and things like that. It's just like, hey, you're now part of us. You're going to use our systems. You're going to learn how to use it. We get your clients and things like that. It's been an incredibly valuable and value accretive business in the insurance that I could gush even longer about it, but I think it kind of tells you what I think about it. But certainly, yeah, I wouldn't if you're looking at Arthur J. Gallagher, don't compare it to the Travelers or the Progressives or those of the world. Look at the other brokerages like the Brown & Browns, the Aons, and the Watson Willis Towers.
So tax account, I'm just going to share a comment here. Tax accountant dropped in a note and a link that for those of you that follow Lemonade and are curious about their process with claims, tax accountant shared a discussion with Lemonade's chief claims officer talking claims. Looks like a link to a Spotify podcast episode. So tax account, thank you for dropping that in there. Anybody that's curious, you can go to slido.com. The event code is Fool24. You can find that link. It'll be pretty close to the top. Dropped it in about 7 minutes ago. So, all right. Let's, I think we can maybe kind of double up on here too. So we got a question. Cena, we're going to skip your question about stocks and ETFs to buy after 3 to 5 cocktails for Tyler. We're going to save that one for like the 8 o'clock hour. There's not an 8 o'clock hour, but if there was, that would be perfect. That would be perfect for that. But Besties asked, what do you make of MCOR, ticker EME? What is your thesis for this business? And I want to tie that, Tyler, to I need inputs question that's a little more recently to one that they asked when I was on earlier this morning about nearshoring and thinking about small and mid cap stocks there. I know you could spend the rest of the hour talking about that, but let's start with MCOR, and then we'll talk about the other question. Next.
Well, I think you might be leading me a little bit by it's like, hey, why don't you integrate these two questions together, because they are very much
leading you. Yeah,
it's the the thesis for MCOR is very much tied to I need inputs question about nearshoring, about companies that are going to be in this space of how do we build or rebuild supply chains, manufacturing capacity, things like that in the United States. And companies like MCOR are going to be the ones to do it. For people who aren't familiar with MCOR, ticker EME, MCOR Group is, I think they're still the second largest. Who knows? Maybe they've surpassed, I don't know by now, but MCOR Group is one of the top 2 electrical and mechanical contractors in the United States. And so what that means is basically they're the largest group of electricians and like HVAC people. And so if there are very, very large jobs, whether it be, transmission lines or data centers or semiconductor foundries or electric vehicle construction manufacturing lines, anything that's going to involve a lot of electronics, a lot of like heating and cooling for HVAC purposes. Companies like, or MCOR is going to be one of the direct beneficiaries of that. It's not exactly a company that issues a lot of press releases. I think like you and I discussed its fourth quarter earnings last month, and not a thing has happened since, which is unsurprising for this sort of business. But it's a business that has a lot of tailwinds behind it when we're talking about a lot of the investing trends that we've been talking about recently: deployment of electric vehicles, electrification of everything, data centers, meeting all of this power demand growth, and grid resiliency. These are all things that are right in MCOR's wheelhouse, and you can kind of see it in what they've been doing. This is a business where it's like very much built on like, how much can we keep our electricians and contractors like moving from job to job and have the least amount of downtime as possible. And if you look at their current results, you can see it in their results, where it's like, what was it? Their revenues for the fourth quarter were only up 9.6% year over year, which doesn't
right at
sound great.
10%. Yep.
Yeah, just about a 10%. But then, if you look at it from I'm trying to get the
bottom line,
earnings per share. Yeah, earnings per share was up considerably higher. I think it was something like
40%.
Yeah,
That's
20.
It's a lot.
Yeah, it was up. It's up way higher, basically.
Business like MCOR, when growth is happening at high rates, they convert a tremendous amount of that revenue growth into earnings because they're running at maximum efficiency. Right? I mean, that's they've basically been running full out as of late, and I don't think I'm understating when I say that, because it's been an absolute boom time. Whether renewable energy deployment, you name any theme that involves electricity, and it's been a big thing for them. And it doesn't seem to be anything that's slowing down at any time either, because similar to like most other like long tail manufacturings, you have a thing called backlog. In electrician terms, it's called remaining performance obligations, and this is basically jobs that are going to take more than 12 months to complete. And right now, at the end of the fourth quarter, they had a 14% increase in their remaining RPOs, which means that, like, in addition to perhaps all of the work that they will get on the shorter cycles, that they're still growing on their long tail cycle developments as well. I think that if people are looking for those picks and shovels types of investments in AI, in electrification of everything, MCOR is very much one of those businesses that's going to do incredibly well. And to the question too of like near-shoring themes, I struggle to think of companies that are going to benefit as much on the myriad of themes that hits than a company like MCOR, because somebody's got to build it, and somebody's going to make a pretty decent profit building it. And I think MCOR is going to be one of them. Yeah, I think an MCOR strategy is important to understand too. I believe MCOR owns, they have three divisions: construction services, building services, and industrial services.
Yep.
And this is a business that has been built over some geographic expansion of just organic expansion, but a substantial amount of acquisition has driven their geographic growth. And I think I would have to look at their latest 10K to give you the exact number. But I think that the actual subsidiary businesses they own across these three divisions is probably 90 different company names. And a lot of them have MCOR in the name at the end, or maybe at the beginning, or somewhere in there. But this is how they've grown. And they just made a pretty sizable acquisition that they announced right around the time they reported Q4. Was about just under $1 billion, I believe, 900 and some odd $1 million that they spent.
It was 865 for Miller Electric Company.
Right. And Miller Electric, that works. Oh goodness.
Mostly Southeast.
Yeah, no, it's Sunbelt, Florida. Florida's the big, I think, really getting deeper into Florida. It was, I think, a big deal and a big part of that step. But the thing I wanted to get to is that the price they paid, the multiple, the EBITDA multiple, and I know you have to be careful with metrics like EBITDA, but when you're buying another company like MCOR and you're writing a check to buy them, looking at earnings before interest, taxes, depreciation, and amortization actually makes sense, because you're going to be rolling them into your own business. So the tax structure of the business could be changing. Depending on how you're capitalizing it, the amount they were paying on interest expense may or may not be relevant. Depreciation and amortization, of course, that's going to carry over, but to a certain extent, you can kind of reset some of that stuff. But the point is it kind of strips things down and it gives you a decent proxy for apples to apples of this business versus something else in its same industry. But the multiple is reasonable. And this is important because if a big part of your growth strategy is acquisition, you have to pay good prices. And they have a history of being a pretty good buyer, and they have a history of being a pretty good integrator as well. So I think MCOR is really compelling to me as a big overall driver for it of that whole strategy, or the whole secular shift of potential nearshoring, or whether we see that accelerate or not. Just the energy transition and the data trends alone are big opportunities before you bolt on the reality of a whole lot of improvements to infrastructure that need to be made that fall right into the core of what they're really, really good at. So we need to talk about some small and mid caps that are going to fit in here too.
Well, I mean, 18 billion for MCOR, that's small, right? Is that considered small, or is that mid cap?
So I got a little bit called out this morning. So I suggested Trex and Chart Industries. So Trex is like, they're the OG of nearshoring, right? They're a domestic manufacturer, and they leverage being a domestic manufacturer to actually be a low-cost leader as the manufacturer. Like their manufacturing cost is incredibly compelling, partly because logistically they know to get their manufacturing as close to the customers as you can and drive down logistics costs. And their process is really, really good. And then Chart Industries, because everything that's happening with global energy, as much as nearshoring is a thing, let's kind of think that like the anti-nearshoring, and where are there areas where we're still going to be, a lot of international commerce is going to happen. But then I threw in Steel Dynamics and said, hey, look, let's go up to $18 billion, because whoever said $7 billion is a mid cap said it a long time ago, right?
Yeah.
But I got called out because Steel Dynamics is in the S&P 500. I'm like, well, you know what? I don't care. And my response is, if we want to put MCOR in this bucket, which I would support, and it probably is in the S&P 500. I would guess that it probably is. But
I think it's mid cap, because 18 billion is nowhere near high enough.
Yeah, because again, the largest 500 publicly traded US companies, I would have to look and see, but I'll let you check on and see, because again, that's about the same market cap as Steel Dynamics. But even if it is in the S&P 500, and the idea here is that if you own S&P 500 index funds, that you already have exposure to it. No, you don't. It's such a tiny, tiny fraction as to being a rounding error from zero. So I would support putting MCOR in this bucket of nearshoring companies. While you're looking it up, I'm going to do a screen share here, and I do want to talk about part of the risk with MCOR. And
okay,
go ahead.
So I have to basically name another company on the nearshoring side of things.
Okay, if you're ready, let's do it.
That's the challenge.
I was stalling. All I was doing was stalling for you.
Let me see if it's small enough, because again, I don't even know what small and large is anymore. Oh, it's almost 9 billion. So I guess that does that count as small now?
It's close enough. That's close enough.
It's when Nvidia is like $3 trillion, and you are
that's kind of my point.
Less than if you're less than 1% than the largest company, I feel like you're a small cap these days, right?
Yeah,
so
I agree. I agree. Yeah,
I think I've mentioned this one before too, but I'm going to say Applied Industrial Technologies.
I knew you were going to say IIT. Yeah, I knew it. I absolutely knew it.
So this is it's a distributor. One of my favorite types of businesses. Applied Industrial Technologies is a distributor of basically mechanical components for assembly lines. Again, I think Jayson almost fell asleep when I gave that description because it is one of those very boring businesses. But if you are building a factory, if you're building a foundry, or if you're building anything that has an automated component to your assembly, or it could be continuous assembly like oil refining or anything like that. If you have AIT is going to be a distributor that not only will like supply the parts for building your automated assembly line, but often will do the design of it. So if, you know, building widgets, building automotive components, or doing whole automotive assemblies, a company like AIT is going to be one of the companies that you'll go to, kind of like it's one of the first companies in your Rolodex, and be like, hey, I need to build an assembly line for X. And they'll go out to their, I don't know, 15 or 20 different vendors, get all the supply all the components that you need, and then, you know, put it together. And sometimes do the design for it as well. As I've said before, distributors are one of those beautiful businesses where it's basically like all it is a pile of inventory. There's nothing else in the books. And as long as you can turn over the inventory on your books rapidly and multiple times in any given year, you can generate incredible returns despite it not looking like the most profitable business. You know, high single digit margins on an operating basis, maybe like 4 or 5% net income margins on a good day. But if you can do that, if you can do those kind of margins and turn over your inventory 3, 4, 5 times in any given year, you're going to generate spectacular returns over the long haul, because you keep a really, really high inventory turn means low working capital, means you know, high rates of free cash flow that you can either, you know, use to buy your regional competitors, roll up the industry, buy back stock. It's a really modest dividend for Applied Industrial, but just basically do like shareholder friendly measures when you're done with all this. And so this, I would say, is a quality business to start with. But on top of that, again, if we're looking at this period of completely changing supply chains, and in this nearshoring, reshoring, building up some sort of resiliency in supply chains, whether it be for tariff purposes, whether it be kind of a waking up to, you know, the risks of a globalized supply chain that we saw during COVID. You know, these things have, you know, come to the forefront, and everyone kind of all woke up to these risks. And as a result, you know, nearshoring is a thing. And I think this was a kind of I hope that also answers Bestie's question here too. It says reshoring has been talked about for a few years now. One of the businesses that have you know, profited and will profit is just political. I don't think it's political because it's not just, you know, the risk of tariffs. It's not just the risk of you know, the
global supply chain was exposed during the pandemic in some substantial ways, and businesses realize that they need more resilience, they need more slack in the system, and they need to shorten some of those lines. I mean, I think that's it. That's it. And I think it's been slow to really fully happen, just because it takes a long time, you know. You know, getting plans, acquiring land, getting everything designed, getting the permits, breaking ground. Like, it takes a long time to build these things, and you have relationships with suppliers that you don't want to upend, right? You have to manage those relationships because you need these relationships with these international suppliers, and it just takes time to do. I have an idea for another one that I want to throw out there, because I agree it's not necessarily political. I'm going to put QXO out there just as an idea. So this is Brad Jacobs' latest venture that's a roll up of building products, and what they're going after is largely distributors for building products.
We are trying really hard to put everyone asleep in this afternoon. We're going to talk about mechanical component distributors and Brad Jacobs roll-up vehicles. Whew.
So Brad Jacobs has a long history of being building excellent serial acquirer businesses, that their goal is to roll up industries and consolidate industries, to be disciplined about the things that you're buying, and to find industries where there's a lot of room to consolidate, and come out on the other side with a more profitable business, right? Because you and I have talked a lot about empire building that's been value destructive for shareholders. And it's the rare business that can actually create more value for shareholders than was deployed to acquire the businesses to build the empire. And Brad Jacobs has figured out the formula and has been able to do that. And so what makes QXO kind of an interesting way to invest in this is by consolidating the building products distribution. Yeah.
I'm going to stop you quick for people who are a little less familiar with Brad Jacobs. This was the person who founded United Rentals, which is publicly traded, as well as XPO Logistics. So you can go up and look up those companies. XPO Logistics also happened to have like, I don't know, was it like 3 spinoffs from its industry sense?
Yeah.
It's like GXO and RXO. There's like 3 other spinoffs as well, but these were Brad Jacobs businesses that he founded and kind of used this roll-up strategy, created a lot of value for investors. And this new one, QXO, QXO is his newest venture into this, build $1 billion enterprise.
Yeah. And basically what's happened after some initial mania that made the stock price completely detached from reality, I think everybody's kind of forgotten about it, right? It's fallen out of the animal spirits, and $5.5 billion market cap. I'm not going to say it's cheap or it's a value or it's reasonable, because they're still trying to build the business. I think they've got a deal in place to buy a roofing supplier for like $11 billion that they're still trying to work through some details on that. So they're still extremely early in this. So the hard work is really just beginning. But if this thing delivers, all of the tailwinds around nearshoring and connecting goods, and if you can build a larger distributor in the building supply business, it could be extremely, extremely beneficial for the tailwinds beyond this, the housing tailwinds, all of the things that we've talked about around nearshoring, the electrification trends, like all of those things, the aging of the infrastructure, whether it's housing or other infrastructure. Those are a lot of tailwinds that would be set to benefit QXO from. So it's worth some research, I think.
Yeah. And if anybody's having like doubts of like, man, what, distributors of building products, that doesn't exactly sound like the most, profitable industry, I would just beg you to go look at the stock chart of Builders First Source and Top Build and be like, oh, because being a distributor of building products can be a very lucrative business if you do it right. Going from the nearshoring, we're going to basically bounce back between, it seems like, nearshoring and insurance. We've really tapped a vein here.
So real quick before you do it though, I think Indy Pharma D, you probably heard me say this, but Indy Pharma D, do you like QXO's current price at this point? Just to reiterate the point, because the business is still so early in its stage of being built, if it doesn't deliver, if it stumbles out of the gate, this is too much. But it would be too much if it was $2 or $3 billion. I think the risk reward has finally gotten to where it's compelling now. At this point, it's gotten to a point where it's compelling, especially if they get a few acquisitions in and start bringing in some cash flow, and can start not having to rely as much on capital markets to fund growth.
Yeah. Well, yeah, it's QXO is right now. It's not a business yet. It's a pile of cash and Brad Jacobs combined together, and he's just kind of waiting for him to deliver a business on that promise. And so,
that is one heck of an attractive starting point. I want to say that.
But to try to like put a valuation on a pile of cash and a dude that wants to use it is hard because there's no actual business behind it yet. It's just it's a concept of a business, I guess, to use today's parlance. So I'll follow up from Rose on insurance brokers, because we asked about Arthur J. Gallagher. Are insurance brokers generally less volatile stocks than insurance companies themselves? What are brokers' greatest risks? Yes and no, more or less volatile, because number one, they're, like I said, they're not exposed to the underwriting risks. So if you have catastrophic risks like huge California fires or massive hurricanes or something like that can, cause catastrophic losses if you don't have enough reinsurance to cover it. Brokers aren't exposed to it. The ups and downs of the insurance brokerage business is going to come down to pricing, because it might not seem like it, but the insurance industry is cyclical in terms of pricing, like their ability to price and underwrite, claims or premiums or things like that do go through these cycles of profitability up and down. And the brokerages themselves, because what they do is they basically just get a sales commission, typically some cut percentage. It's normally fixed for any of these insurance brokers. It's at a fixed rate. Their profitability is going to wax and wane with the pricing of these premiums. So if premiums are going down because of, de-risking, or, insurers are being more competitive with their rates to try to bring in, increase the size of their book, that is going to proportionally impact the revenue that a company like this gets, because it's just a smaller sales commission. So that can be an up and a down, and it is going to come down a lot to like I was saying, it's kind of like hunting. It's like you eat what you kill. If they can't retain clients, if they can't keep clients with them, and they go away, those are some of the big risks. So it's very much like a relationship Rolodex, very people heavy sort of business. So yeah, I don't know if it's like in some like consulting industries or law industries, you have what are called like the rainmakers, if you will, company, like people you bring in that are like, are selling all the insurance to, I don't know, ExxonMobil or something like that. They're like if that person were to happen to like change firms, they, ExxonMobil might go with them. It's kind of like that key man risk, I guess, if you will. I don't know how much a company like Arthur J. Gallagher or the other insurance brokers are 100% exposed to this particular risk, but any business where the only asset you really have are the people that walk in the door and hit the phones and go woo their clients with a nice long lunch or a round of golf to sell them some insurance, that's going to be the risk, is that those people walk out the door. So you have to keep them happy. You have to keep their commissions high, things like that. And so those tend to be the risks specific to brokers that aren't necessarily true to insurers themselves.
So Matt asked about the XLE. It's the Spider Select Energy ETF, which is essentially you're owning the S&P 500 energy sector stocks. So the question, do I like it? I think there are things about it to like, but as a starting point, 72% of the assets are held in the top 10, and that's ExxonMobil and Chevron make up close to 40% of it. So you're basically buying super majors, and some of the big pipeline companies, right? I mean, that's really what you're going to end up owning. Which, I mean, in a way, that's not the worst thing you could do, right, Tyler? Because you're owning the stability of the oil and gas industry with less exposure to the things that can blow up in your face, like the services companies, the larger domestic producers, that they're just pure play oil and gas producers, the ones that you go out and buy because you think oil prices are going to go up, and then oil prices don't go up, and the next thing you know, you're down 30 or 40% in 6 months. You don't have a lot of exposure to those. So I think it's like maybe like a defensive play. It's interesting. I think there's a potential mistake that investors are making right now if they're looking at oil and gas stocks and they're maybe seeing how they've done over the past 5 years. They're all going to look really, really, really good, Tyler, because this week is the 5-year anniversary of the bottom of the market during the pandemic. This is the week. So if you're looking at a 5-year chart right now, anything is going to look really, really good for the most part. So I think be really, really careful for anybody that's part of their analysis is looking like at the 5-year chart, because it can make something that look like it's just been a monster that maybe just survived, right? So so just remember that. So again,
So
I think
there's a second anniversary though that we have to for the oil industry. It's a little bit different because we had the pandemic bottom for a lot of companies.
And then we had negative oil day.
And then we had negative oil day, which was sometime in April when all of those when all the oil futures contracts went to like negative $30. So if you want to do the 5-year chart, maybe we could do like an hour on that day and be like, look how great oil's done since then. It's gone from negative 30 to $70, $100 swing. It's a little bit different, but
yeah. So I mean, I'll say this if you want. I'll say this, and then I want you to weigh in. In short, if you want exposure to the oil and gas industry, because that's all you're getting is the oil and gas industry, to the stalwarts of the industry, whether it's for a defensive investment in your portfolio or because your thesis is that you expect oil prices are going to go up and these companies are going to profit, and you're looking at this as a long-term holding, I do think this is probably one of the better ways for most investors to be exposed to the oil and gas industry, because you don't have to do a lot of work to turn over stones to figure out which piles of what to avoid, which are worth buying, and then think about the timing of the cycle and all that kind of thing. I think it could be interesting. You could go through long periods of underperformance, but then there could be periods when it does outperform for maybe shorter periods of time. So yeah, that's what I think. Tyler?
So a couple comments. I need input, loving the ideas. Can show you both have my undivided attention, which I think is a rarity. People actually listening to us and not falling asleep when we talk about distributors and insurance brokers. Again, these are our people. Nathan R, I'm going to kind of punt on this one a little bit. And you know what? We're just going to leave this question in the queue. So perhaps somebody can give a little bit more articulate answer on this one. Because Nathan R was asking, for small industrials, any thoughts on Sterling Infrastructure? I know that Motley Fool just recently did an interview with the CEO of Sterling Infrastructure, and it's been, I think some of the services have recommended it. One of the things that I want to look into this company specifically, and because I haven't put enough research into this one to make a definitive conclusion, but one of the reasons that I really like companies like MCOR and the Top Build and sort of things in distributors as well is because it's not just the actual sale of the the job itself. There's also like this repair, maintenance, and operations sort of component to these things. It's almost like building out a fleet of services that you get to do in perpetuity for the life of the building, life of whatever. Sterling Infrastructure is a kind of a foundation specialist. That's what they were for the longest time, is basically like they were the go-to pourer of concrete for most of like the largest home builders in America. They have branched out a little bit more, and they've been doing a lot of they do a lot of site work, groundwork, foundation work for data centers, and starting to get into a lot of warehouses, things like that. I wouldn't call them like the most complex foundation jobs. We're not talking about 100-story foundation, a foundation for a 100-story skyscraper in New York City. We're talking about, thick slabs with some decent earthenworks, but not we're not talking about digging down 10 stories deep to build a foundation sort of thing here. The thing is with foundation pouring and that sort of industry, there isn't as much of that services industry. So one of the things I want to dig into with Sterling specifically is, is it that much more volatile during the construction cycles versus some of these contractors that have that repair, maintenance, and service contracts that can help them get through times when the build cycle isn't robust, because construction is cyclical. We're seeing this huge boom in data centers right now. Housing has been okay, but all of these things together, if we were to see a recession or we see a sharp contraction in construction, I really want to dig into the guts of Sterling Infrastructure more to see if they have that kind of ongoing repair and maintenance business within it, that they can use it to get through the down cycles of construction, which brings us to the top of the hour, because I know that Karl and Brian want to talk about foundation layers and industrial distributors, right? We're just going to keep going.
How about some civil construction, civil engineering projects, civil construction? Yeah, no.
There you go.
No?
Yeah.
Okay.
I've had to deal with my own foundation work in the past. I don't want to think about it anymore.
Fair enough.
Fair
All
enough.
right, well, Tyler and I, we're out the door. We're going to leave it to you guys.
All right. Thanks very much.
Thanks, guys.
That's crazy, Brian. I hadn't thought about it. It's the 5-year anniversary since the COVID market bottom. I mean, that's been quite a 5 years, hasn't it?
Yeah.
Yeah. Well, so we are here to talk healthcare for the next hour. You know, there's been some sort of interesting background stuff going on. I think one of the developments that interested me the most over the past week is just the data out of Immunovant. And if you're not familiar with Immunovant, it is a company that was spun out of Roivant, which is another hub and spoke biotech. It's a little bit like Bridge Bio, but a little bit different. They've been a lot more aggressive about kind of selling their programs, and as a result, they have just gobs of cash, which is a good thing in this environment. I think that's been pretty smart. But Immunovant is, I think, a particularly sort of successful company that they've had under their umbrella. They're 57% owners right now. And what Immunovant, among other things, is working on is a treatment for myasthenia gravis. And I hope I'm saying that right. And it's a disease in which basically certain type of antibodies called IgG immunoglobulins start attacking nerve cells, basically. And so it can lead to a lot of, it often shows up in your eyelids first, but it can lead to a lot of really negative effects. And the market is dominated by a European company called Argenex. Is Argenex? Are they from Belgium?
I'm not sure.
Yeah, I'm not sure either. Either Belgium or Denmark. Anyway, so and they have a drug called Vyvgart that is it's going to bring in over $3 billion in sales for 2024, just to give you an idea of the scale of this market. This is a really big, important market that had been underserved prior to Vyvgart. And so Immunovant has been gunning for this with their own molecule called batoclimab. And there was a lot of questions. I think there was a lot of skepticism, basically, about whether they could do better, because this was not really. I mean, Argenex has really kind of gotten out ahead of this, and I think just coming in with a sort of like we're about the same molecule really wasn't gonna cut it. And so what the company has argued is that they have a molecule that's basically able to be dosed higher than you can dose Vyvgart. And so they were saying at their low dose, they thought they were going to be equivalent to Vyvgart, and at their high dose, they were going to be better. And there was a lot of questions about you knock down IgG more, does that actually lead to better outcomes? There's a lot of controversy there. And so what came out in the data was that it was really, really strong. The low dose of batoclimab looks almost identical, in terms of sort of efficacy and knockdown to Vyvgart, and the higher dose actually performed kind of outperformed street expectations in how much it improved over the lower dose. So that looks really good. But what's interesting about it is that the company does not intend to submit for FDA approval based on this, even though this is a phase 3 study. And that's because they have a follow-on molecule to that called 1402, IMVT 1402, that they think is going to be better still. And they are planning on having, I can't remember, 5 or 6 phase 3s ongoing by 2026 that they think are going to set this up to hit the market really hard. And so what they don't want to come out with a somewhat better drug. They actually want to kind of turn this market towards them in a pretty aggressive way. If they can do that. And so the idea is that 1402 is going to be better still in terms of efficacy, that it's going to be better tolerated, that it's going to have lower side effect profiles, and it's going to be easier to dose. Both drugs are, I think ViveGuard is given by IV infusion, which is a little bit of a pain for people. The batoclimab is dosed by subcutaneous injection, but it's like a high volume subcutaneous injection. It's not exactly like a just go do it at home kind of thing. And I think the idea with 1402 is it's just an auto injector that you can do at home. So I think that's a really interesting story. And not only that, but they're looking at all of these things as being more than myasthenia gravis, which is really where argenx has been dominant. They're looking at it for things like Graves' disease and a number of other indications. So you're really looking at like a multi-billion-dollar possibility out of this program that I think is still kind of gone, underappreciated, both Immunovant directly, which, trades under its own ticker, IMVT, and also Roivant, ROIV, which owns 57% of them. And there's other interesting stuff to talk about. Brian, did you have anything you want to bring up?
No, I mean, I just think, it's not every day that you see a phase 3 that's successful and the company says we're not going to file for FDA approval. I mean,
Right.
I think they'd already said that before, right? This is not
Yeah.
new news, right? They'd already indicated that they were planning on doing that. I'm a little surprised. I don't know what's the advantage there. I mean, if it was like, it sounds like it's going to be a while before they can get the 1402 onto the market, right? It's not.
Yeah, I don't.
like-
I mean, my understanding is that they haven't absolutely said they're not going to file. They're still waiting for the final data. So I don't know, but yeah, I mean, I guess it's a matter of, that's their go-to-market strategy for it, and whether that ends up making sense, I'm not 100% sure. It's an unusual decision, I'll put it that way, but I guess they think they can get 1402 out, maybe 2027. I mean, that's still a delay.
Yeah, I mean, I guess a lot of times the first year or two of a launch is the drug isn't necessarily cash flow positive because they're spending a lot of marketing money and don't have that much sales. So maybe they figure that their likelihood of actually being cash flow positive in those years, even though it would generate revenue, it wouldn't necessarily, the drug might not be cash flow positive. And if they're just going to launch a new drug after that, then what's the point, I guess?
Yeah, and I will say that under Matt Glein, Immunovant and Roivant, they've tended to be very financially conservative companies, probably more than a lot of biotechs that just kind of go with the burn and pray model of trying to get something through and then hit the market with it running as best they can.
Yeah. So I guess Alnylam got approval last week, right? I don't know if we talked about it last week, but so they got approval for their TTR amyloidosis drug. I don't think that was really a big surprise. I think, it beat placebo, so it seemed like it was likely to get approved. So it wasn't a big surprise. Now it's a 3-horse race with Pfizer and BridgeBio. And the question is, how well can Alnylam compete against them? But shares went up, which, I guess there was a little bit of, that implies that there was at least a little bit of worry that the FDA wasn't going to approve it. But, so I think overall, I think it was, fairly, I don't know, it was obviously good news. I just think that with the fact that it has to be injected and the fact that it's the outcomes data doesn't seem as good as, at least not as good as BridgeBio, and probably maybe not as good as well. It's a little bit harder to tell with Pfizer's data because Pfizer's data came out such a long time ago. So comparing the two clinical trials doesn't exactly work since a lot of the patients were either on or had tried Pfizer's drug on the Alnylam study. So that complicates the comparison to Pfizer, the earlier Pfizer study. But I don't really have high hopes for this, for Alnylam's drug, just because of the oral nature of BridgeBio and Pfizer's drug compared to Alnylam's. What are your thoughts?
I mean, we'll see. I think one thing that's, when a stock moves on an approval like this, where exactly like you say, I don't think it was any big surprise that they got approval. I think, people are really looking at the subtleties of language in the label that they got approved. And I think one of the things that they liked is, and I can't remember the exact phrasing, but, there was basically the way they phrased the improvements in hospitalization and death resulting from it was a little different than how they phrased the BridgeBio one. And I think people regarded that as positive. I'm with you. I mean, I still think like you're at the level with these where it is really hard to say which drug is better because you're comparing not exactly equivalent trials to each other. But I mean, I still think BridgeBio kind of looks best in class to me. I guess the thing to say for Alnylam is it is a differentiated drug, right? And so if you look at a threat against BridgeBio emerging, it would be maybe Pfizer's drug goes generic in 2028, and so all of a sudden you have this one oral that's now generically priced versus BridgeBio's oral, and all of a sudden that market gets harder for them. I think they can manage that. I think they've got a few years and some advantages, and I think they can do a lot in that time. But that is a thing, and in the meantime, Alnylam would at least be differentiated. I mean, it's not that it's not an oral, but it also just works by a different mechanism of action. I mean, conceivably,
there's obviously a opportunity for them to get patients who aren't performing well on the oral medications, or especially they could there's no reason that they can't take the oral medication and the injected medication. So in theory, that should they have an opportunity. They have that opportunity because BridgeBio and Pfizer's drugs aren't 100% successful. So there's at least that opportunity.
And just from a 30,000 foot view, what I think's been really interesting about this, because I feel I personally I've kind of been like on all sides of this. It's like I like Alnylam as a company. I think it's and it's done really well, and I really like BridgeBio. It's one of my it's been kind of one of my favorite picks in the sector. What's been really interesting is that it has when it's usually a zero-sum game, like it hasn't been that. Alnylam got approved and it went way up. BridgeBio went up too. Like both companies have gone up. And if you step back and look at it, like it sort of makes sense, because a big thing with this market is it's still really, really an underpenetrated market. There's a lot of people who are not getting treatment who should be. And so there's still a lot of space for both companies to move into. And so you've seen both companies actually have a positive reaction. And I think that's just that, like, this is going to get more attention. So, it's been a good market to be in.
Yeah. And then BridgeBio was up today. He's up 6%. Last time I looked, based on the fact that they're presenting additional data from their clinical trial. I'm a little surprised there because I'm not sure what they could present that isn't already in the label that would result in their valuation going up. And I couldn't even find how. I mean, they announced they're presenting later this week at a conference in Chicago, but I didn't actually see the data being available anywhere yet. So I think that I guess maybe it's just by the news sort of things, and by the.
I mean, I haven't seen any new data. I mean, I wasn't like, is that the reason they're trading up, or is there just a little bit of just sort of an overhang removed just from having Alnylam get its approval, and you see the label and you kind of know what the playing field looks like right now? I mean,
that's certainly possible too.
All right, let's see. All right, let's go take some questions, unless you had something else, Brian. Sorry, I didn't mean to just cut it off. Go ahead. Yeah, okay.
Yeah.
So just the last one we got in from Counselor Rob. Said Mineralis, MLYS, is up 85% in the last month. Do you see it as a good value? So yeah, Mineralis reported out results from both of their phase 3 studies with lorundrostat, which is a hypertension drug. So it is a hypertension drug that's not intended to be a first-line drug, but it's intended for resistant hypertension, people who are not getting sufficient control off of other drugs. That's a significant number of people. I mean, obviously, this is a very large market. I do think that, like, despite the big jump in value, I think, what's going to happen here. I mean, obviously, I guess the negative side of Mineralis is they do not have a lot other going on other than this drug. And so everybody's going to look at this as like, well, now they'll get a buyout offer, right? And they very well may. I mean, it would honestly make sense for them to get a buyout offer. But that does make for volatility, because, if you have everybody like bidding into the stock on the expectation that a buyout offer is going to come, and then it doesn't come, you can see stocks drop off that way, independent of anything going on clinically or with the potential market for the drug. Or a specific rumor comes along and then it doesn't materialize. I mean, a lot of stuff can batter the stock around that way. But taking that out of the picture, I mean, you just look at I think it's AstraZeneca paid for a similar drug called begins with a B, Badrostat, I think. That I guess they're still. I had thought at one point they had given up on it because they had some bad clinical data, but I guess they are still plugging away at it. So that's a potential competitor to them. And I haven't really stacked the two up head to head to see, but I mean, I think Mineralis has to like the way things are looking in terms of competitive advantage for this drug. And, last I looked at what is Mineralis's market cap right now?
Just over $1 billion.
Yeah, I mean, AstraZeneca paid more than that for this molecule. I mean, I think they paid like 1.7 billion or something like that. I mean, so just from that point of view, you would still see some decent value in Mineralis. And I would expect that if they were holding out for a buyout offer, it would be, substantially over today's price.
I mean, you would think that they would not be planning on launching this on their own. I mean, hypertension is a pretty large market, and I think it's mostly treated by primary care physicians. So you would think that, small biotech probably wouldn't want to be fielding a sales force. So
yeah, that's a big sales force.
Yeah. So, and having nothing else in their thing, a licensing deal doesn't make very much sense, I don't think. So that pretty much only leaves a buyout offer. They did raise capital after, jumping up. So they raised, I just saw it, where'd it go? They raised 175 million a few weeks ago. So, which makes sense. I mean, that gives them options, but still it seems like if they're negotiating with companies, they don't have much. I mean, they have, I guess, in theory, they could launch by themselves, but the good thing is that, maybe it's mostly valued based on them launching by themselves. And in theory, the value to a pharmaceutical company launching it is that they don't, they can market it for a lot less than, the cost, because they have sales forces already going to primary care physicians. And so in theory, it's actually worth more to a pharmaceutical company than it is as Mineralis launching it on their own. So
yeah, I think that's
both
true.
can be true, that it's currently valued okay, but also a pharmaceutical company could potentially buy it at a higher valuation.
Yeah, I mean, they could theoretically launch with a contract sales force. That does exist. You can go, like, the same way that you go to a contract research organization, you can go to a big organization like IQVIA or something like that and say, we want a contract sales force. I don't feel great about that strategy. I don't know. I guess I don't. I'd have to look at like case study. I feel like the cases I know where companies have done that, it hasn't been awesome. But I'm also I might be forgetting about some really like great successes in that regard.
Yeah, and sometimes they're not even just these, like IQVIAs, but also just like, a adjacent company that already has a sales force where they can do a license, another biotech that has their own sales force that, wants to double down, and then they can, share a sales force basically for two, related diseases.
Yeah, and I mean, if they really wanted to do that, and you can have the idea that you structure that such that you have somebody else selling it while you slowly build up more commercial capability. But I don't think that's what the market's expecting. I think they're expecting a buyout.
Yeah. So SB asks about a rank for big pharma and companies, including Pfizer, tickers PFE, Novo Nordisk, tickers NVO, Gilead, GILD, Bristol Myers Squibb, ticker BMY, and Merck, ticker MRK. So any of those that you really like, Karl? I mean, I think we've talked about Pfizer being okay in terms of the valuation based on, they are going to face a patent cliff over the next few years, but it's a smaller percentage of their overall portfolio than it has been than other patent cliffs have been in the past. And then, obviously they have a great dividend. Novo Nordisk, I think is a good, I think it's actually a better value now after it's dropped, even though they had bad news on one of their combination treatments that didn't look that great. It didn't look that great. I mean, it looks like it's approvable, but didn't look that much better than Zepbound is from Eli Lilly. And so, I think that, but I think that the competition is going to come down to oral medications anyway. So I don't know that really affects their valuation for the long term. It does, potentially affect their sales in, 2026, 2027 range. Gilead, I think they're trying to do their best to expand beyond HIV. But HIV is such a big market for them and not growing quite, all that fast. They do have the PrEP, the pre-exposure prophylaxis to try to keep people who are, more likely to get HIV they take it, and then they're less likely to get infected if they're less likely to the drug will stop the infection if they're exposed to it. And then, but I think they're really trying to get into cancer, and I think they're doing okay, but it's such a large, they're working off such a large base that it isn't driving the needle that much. But the valuation, I think, is okay. And then I don't know, I haven't really been all that excited about Bristol Myers Squibb or Merck. So any thoughts on those, Karl?
Merck, I guess the elephant in the room is just the expiration of the Keytruda patent, which is, now within clear sight. I think it's 2028. And obviously Keytruda has been an amazing drug, but, they're going to have to kind of backfill in that. I think that's probably priced in. I think there's a lot of, obviously expectation, and, everybody knows that's coming. That's not like something that anybody's overlooking.
Yeah. They do have an injectable. That drug is infused, right? And they do have an injectable version that they're trying to develop. The question is if there's a generic version of the infused version and their patented version of the injectable version, will insurers pay for the injectable version? Obviously patients would prefer the injectable version, just because it's easier. You don't have to sit in the office for a while getting infused. But I'm not sure that, the big question is whether insurers will pay for it.
Yeah. And I will say on Bristol Myers Squibb, I guess, they do have some new product. They have Opdivo, which is the kind of the runner-up to Keytruda, maybe you would say. It's another like blockbuster checkpoint inhibitor. It hasn't been quite as flexible as Keytruda has proven to be, but it's been a very, very successful product. They have, one thing that I think is interesting just for opening up a new sort of market area is they spent a lot of money to acquire Karuna Therapeutics, but they did, I do think that's working out for them. They got what's called Cobenify now that's on the market, which is just kind of a different approach to treating schizophrenia that I think, we're going to see. We know what the data look good. We're going to see like how big a real effective difference that makes in people's lives over the coming years. But not only did they get that drug, but then a competing drug that was from Cerevel that got acquired by, I guess it's AbbVie. AbbVie spent quite a bit of money to acquire Cerevel, which had another similar molecule, and that one did not work out. So they've kind of gotten themselves some more lead time with that. And just kind of big picture, I mean, I'll say all these companies, I mean, big pharma has not been, a hot performing sector recently. So all of them are, none of them are exactly at massive valuations. I mean, Novo Nordisk more so just because the growth is obvious there. But these are these are mostly companies that are trading at pretty reasonable valuations and paying a dividend on top of it. So it's, I would say most of them are probably grist for a diversification strategy.
Yeah. I mean, and then I think that the difference between the best and the worst of these groups is not really that much different. I mean, we could rank them. I mean, I would probably go Pfizer, Novo Nordisk, Gilead. I would almost rank it in the order that, I mean, maybe I'd put Merck in the order that they're listed there. So Pfizer, Novo Nordisk, Gilead, I would go Merck, and then Bristol Myers Squibb. But I think even the difference between Pfizer and Bristol Myers Squibb is not that much different. I think they're all sort of, going to be slow growers, and you have to, the idea is that they're also probably not going to go down that much more than they've already gone down, because everything, all the bad news is already priced into the stock.
Yeah. Let's see. Is there a one you want to get to next?
No, we could talk about, I guess Paul asks about Novocure, tickers NVCR. He wants to know about clinical trials and the competition from any upcoming pharma molecules. I don't think that you have to worry too much about competition from pharma molecules, because the Novocure's Tumor Treating Fields device can be used in combination with pharma molecules. So the only issue is that, if you end up with something like with what happened with the lung cancer, where the standard of care changes, then does Novocure have to run a new clinical trial to prove that their drug works with the new standard of care? First line standard of care doesn't change as quickly as late line does. So any approvals that they have on first line is less likely to happen there. And then their current clinical trials, they've gotten approval for the lung cancer, and they've read out pancreatic cancer. They don't have any clinical trials that are major clinical trials that are scheduled to read out in 2025. So it's more of a 2026.
I mean, they're working. Yep.
Yeah. I think
I mean, they need to establish more around lung in order to get better adoption in that market. They need to prove that it works in the kind of regimens that get used today, particularly in first line, which is, that's where they are in brain, right? It's a first line treatment, or can be a first line treatment. They, would want to be in the same place with lung. Yeah. Pancreatic's already read out. I mean, they are looking at some other stuff in I think some stomach cancers and stuff like that, but those are further out, those readouts. So yeah, really I think we're looking more at them lining up launches. And yeah, I mean, I think you pretty much summed it up. There's not competition per se. If you look at Novocure long enough, you'll see like sometimes the Northwest Bio people will start coming at you. Have you ever seen this, Brian?
Yes, I have. Yeah.
Northwest Bio is this incredible sort of pump and dump stock that's been frankly abusive of their shareholders. But for whatever reason, part of the whole sort of cult around that is that Novocure must fail in order for Northwest Bio to succeed. I have no idea why. They're if Northwest Bio's vaccine works, God bless you, put it on the market. That's fine. It doesn't really affect Novocure from doing what they do. Anyway, okay. I mean, Paul also asked about Summit Therapeutics, success in the Harmony A phase 3 trial, eventually leading to ivonescimab becoming a combo standard of care for non-small cell lung cancer. Do you have thoughts on that, Brian? Or
No, I was just looking at this company. I can't believe the valuation.
Well, so Summit. I mean, the reason, Summit kind of jumped to fame. This is a crazy story, really. I mean, Summit was a few years ago working. They had nothing in their pipeline other than a C. difficile drug that then failed. Right? I mean, they just looked like they had, and then they did this licensing deal with is it Astellas or Takeda? It's not, I think it's a Japanese company, but anyway, for ivanescimab. So they're a licensee. They're not the original developer of this drug, but it kind of leaped to fame because it outperformed Keytruda in non-small cell lung cancer. So it really, and it's a well, you're looking it up right now. Is it a bispecific? I mean, it's basically working as both a checkpoint inhibitor and on EGFR. I don't remember if it's just doing it as a bispecific or, but anyway.
Yeah, it looks like, it says it's combining the effects of an immunotherapy via blockade of PD-1 and the angiogenesis effects associated with blocking VEGF into a single molecule. So it's
VEGF,
PD-1 and VEGF.
Yeah.
Okay, so this is the one where they did a clinical trial in China, right? And then it was successful in China, but then the issue was whether they were going to be able to get it approved with the China specific clinical trial. I remember, that's this company?
I don't remember that it was purely Chinese data from the Harmony trial. Well, now, all right, look that up if you don't mind. But in general, I'll say a couple of things about Summit. One is that I think this flies a little bit under the radar, but just people should know. So that PD-1 VEGF bispecific combination. Just BioNTech is also working on one of these. They're doing it a little bit different because they're going after instead of the PD-1 side, they're going after the other side of the checkpoint blockade. But I mean, it's the same basic strategy. I mean, they're further behind, and so I wouldn't, that's not an immediate threat to Summit, but it just like there is somebody else kind of working along in that area. Yeah, I mean, obviously, if you see the kind of sales that that Keytruda has been able to rack up, and if you make the argument that Summit can not only move ivanescimab into a leadership position in non-small cell lung cancer, which if they can, confirm and get approval based on the kind of stuff you saw in the phase 3 study, I mean, it does seem that that's what the market would move toward, because it was pretty impressive data. Then you question, like, can they move that into other indications? And so that's why the stock is valued the way it is. It has a very high valuation. So I mean, there's a potential for a lot of volatility there if anything goes wrong in the remaining clinical and regulatory process, or if meaningful competition emerges. Did you see anything else on that, Brian?
Yeah. So the Harmony 2 trial, which read out in September of 2024, that one was China only. And I think that the problem there is not only that it was China only, but that China has a different the first line indication, right? So I think this was comparing the Summit's drug to Keytruda, and then the question was I think in the US, Keytruda is used in combination with chemotherapy as a first line indication, and this was just Keytruda alone. And so the question is if they compared it to with chemotherapy or on its own, whether it would actually be able to beat Keytruda plus chemotherapy. So I think the issues was if they added chemotherapy to it, then it might the worry was that the side effects might be too strong, and that they wouldn't be able to get the necessary efficacy because patients wouldn't tolerate the drug. And then if they compared it to Keytruda plus chemotherapy, which is the first line for U.S. patients, that then Keytruda wouldn't actually be able to beat Keytruda plus chemotherapy. I believe that's the argument.
Okay. That's good. I mean, that's great insight. Yeah, because so I mean, again, that just heightens any remaining, clinical risk that it's fine. I mean, it looks really promising, but obviously, when you get big valuations like that, like things can get really volatile on little bits of doubt and worry that come up. I don't know, Brian, by the way, I don't know if anybody else can hear it. Like, it sounds like you're having some audio problems, but not sure what to tell you about that. You're just kind of all fuzzed out. Or maybe it's just me. Maybe nobody else is hearing that. Let's see. We had a question from SB a few minutes back that was any opinion on GEHC, so GE Healthcare. I mean, I don't have any deep opinions on this. I mean, they're kind of in more the device sides of things, I guess. So I mean, a lot of imaging and ultrasound, but also diagnostics. And I think diagnostics is I think there's a lot of tailwinds behind diagnostics in general, just because that just kind of plays into precision healthcare, and I do think that is going to continue to be the way that we go. So I haven't looked at the company in great detail. It's not trading at an unreasonable multiple, but it's generally done okay over the last 5 years, which is that makes it look better than a lot of biotechs in that regard, since it's had a decent run of it. I don't know. Do you have anything on that one, Brian?
I mean, I think the only issue is, it depends on the capital, the ability of hospitals to have capital, right? Because they're very expensive machines that they're generally selling are very, they're quite expensive. And so anytime that there's a capital constraint on hospitals, GE Healthcare is going to have issues. So I think you have to almost be a little more interested in the macro if you're going to buy GE Healthcare compared to buying, a more general company that's developing small lower priced medical devices or something where it's a small amount per actual patient, so I think that's just the biggest issue with GE Healthcare.
I mean, I guess another issue with them too, that's kind of like something we haven't discussed all that much, but is just a sort of broad issue in the sector, is that they've spent a lot of money kind of expanding out manufacturing in Ireland, and so I don't know where that possibly plays in when it comes to tariff stuff. Ireland is medical and packaged pharmaceuticals and stuff is a major part of the Irish economy at this point. I mean, there was so much years back when it was, people were talking about quote unquote tax inversion, people basically offshoring outside of the US to go to more attractive tax settings. Ireland was one that really did a great job in getting a whole bunch of pharma and medical companies in there, and it's that's been big ever since. But now I don't know how if that ends up stinging them. I mean, there's been already a lot of stuff around devices and tariffs, because a lot of devices almost have some of what you see in the automotive industry, where you're doing some assemblies in the US and some assemblies in, say, Mexico, and so a part's crossing the border maybe multiple times before it comes a complete system, and there's a lot of tariff potential complication there. So that's just another thing I guess I think about with devices right now.
Yeah, and also with the FDA, moving manufacturing is way more complicated than moving car part manufacturing, and that's in of itself is pretty complicated. So if you actually did want to move to the US, you have to get a whole bunch of approvals to to have a new manufacturer, having it manufactured in a different location than it was originally approved for.
Yeah. Let's see. We have a few different, I'm just kind of looking here. This is from Paul SF, maybe in San Francisco, maybe not. Which small company pre-trial molecule has the greatest potential, orphan or mass patient populations? It's an interesting question. I don't know if I've thought about it exactly that way. I guess I would say an orphan indication gives you more flexibility. When you're early in the process and you're trying to think about all the flexibility that you need to overcome all the hurdles you'll need to get to market, orphan indications give you some extra flexibility because they give you that there tends to be more ways that you can extend exclusivity, which can become important when it takes you a long time to get through the trial process, maybe longer than you expected. It often will give you more flexibility on how the molecule has to do, how it has to perform. In other words, like often orphan indications, you're facing less competition almost by definition. You're usually going to be addressing an underserved population. So, you can raise the bar a little bit. A mass patient drug, you're going to probably have to be raising the bar over something that's already probably pretty good. And those are very, very expensive drugs to introduce. But I don't know. I'll be interested to hear what you say about this, Brian.
I think the speed at which you can get a approval for an orphan indication is often a lot faster than the speed at which you can get a mass patient population drug approved for a couple of reasons. One, the clinical trial is likely to be smaller, so therefore there's less people to enroll. And then secondly, you may be able to read out fairly quickly whether the drug is working. Now, obviously, it depends on the individual orphan indication versus mass patient population. But I think in general, usually if it's an orphan indication, it either works or doesn't work, and you can usually figure that out fairly quickly in terms of at the individual patient level, right? So you don't necessarily have to treat for a year to try to prove that your drug works. Sometimes the symptoms will go away in a matter of months, where for a mass patient population, especially if you're comparing it to something else that's already on the market, now you've got a smaller delta, and so you have to run the clinical trial longer to show the separation of the curves. Plus, you've got to enroll so many more patients because the delta is smaller. You have to enroll more patients compared to orphan indication. So I think for a small pharmaceutical company, there's a big advantages to small biotech. There's a big advantages to orphan indications compared to mass patient populations. Obviously the downside is that you're sort of capped out on your ability on how much you can sell of your orphan indication, right? Like you're basically going to price it at, we know there's X number of patients, and so we're going to take that number, take 1 billion divided by that number, and that's going to be our price, right? And we're going to shoot for having 1 billion in sales. And I think that for the most part, insurance companies aren't going to let you price it any higher than that. So, that means you can price it pretty high compared to a mass market. But I think for a mass market, you can often get multiples of millions of dollars, where for an orphan indication, maxed out at $1 million. Sometimes they'll end up being more than $1 billion in sales, because oftentimes they find new patients after the drug's been on the market. Then doctors start looking for this disease that now they have a treatment for, and therefore there ends up being more patients. So sometimes you do see orphan drugs being more than $1 billion in sales. But I feel like I feel like they literally just the biotech company literally just takes the number of patients, takes $1 billion, figures out how much, $1 billion in sales for the number of patients is, and that's what they price the drug at.
Yeah, there's definitely some of that going on. I mean, but 30,000 feet again. It's like the top selling drugs in the world tend not to be orphan drugs. They tend to be mass market drugs, or at least larger indication drugs. So, broadly used cancer drugs, or obviously things like the GLP-1s. These are ultimate sort of mass market drugs. Let's see. I have a question. This was a while ago. Oh, wait a minute. We're getting we'll get. I see Paul is writing it with the clarification. We'll get into that in just a sec. Let me just knock this one out from Ed. He asked it a few hours ago, but I just wanted to hit it. He said, "Is Hims trying to skirt the issue of not following the rules about their compounding during shortages and the abundance of GLP drugs?" It's trying to skirt the issue of not following the rules. I mean, I assume what he's saying is, are they basically trying to play fast and loose with the rules about offering GLPs when GLPs are when semaglutide, say, is no longer in shortage, and therefore the idea that you can just kind of en masse manufacture compound versions of these is no longer legitimate? And the answer is, to the extent I know about it, at least, no, I don't think they're doing that. I think their plan is to do what is, I mean, you could say it's a gray area, but I think it's legitimate, which is basically to limit what they sell to things that are not offered by the manufacturer. So in other words, if you say, and this is just how compounding has always been, it's just not really been it's not been a popular subject or something that people dealt with. But if you have a doctor who writes a prescription and says, like, my patient cannot have a drug that has propylene glycol in it as part of the injection solution, or my patient cannot take the offered dosages of it, they need a different dose for whatever reason, then compounding continues to be legitimate even if the drug isn't in shortage. And I think that what Hims has said is more or less that that's what they're going to do. Obviously that limits the business, but it depends, I guess, how aggressive doctors are about doing, basically.
But it's their doctors. So, I mean, they have the doctors too, right? So obviously the doctors are just going to do that. So anybody who comes to them with their patients is going to do the, those doctors are going to sell they're going to prescribe whatever Hims, can potentially offer. And so I don't think that's not going to be the limiting fact. Whether the doctors use it or not could be the limiting factor.
Yeah, totally. And I mean, and I don't think that'll be the end of it. I think we'll continue to see lawsuits and everything else. So, we'll have to see. So what Paul SF was saying is that he wasn't actually asking us whether we preferred orphan or mass population. He was specifically asking, like, what in either of those categories do you think is some of the most promising molecules in early development today? While you maybe think about if you have an answer to that, I guess I would just say that, like, you're asking specifically about early stage molecules. So I guess my off the cuff answer is that I just wouldn't step into it thinking of it that way. I don't approach, like, early stage molecules with great confidence that, like, this is going to be great and I'm going to back it to the hilt, because it's early stage. I mean, you look at things that give you confidence. You look where you might have an edge in sort of interpreting how data has come out and how it's been regarded by others and how the market's regarding it. But I mean, you have to know that when it comes to anything that's early stage, you're playing with uncertainty. As a general thing there, I guess I would just say there are cases when an early state where phase 1 data is actually quite meaningful, say, for example, if you're trying to knock down, hepatitis C virus, and your phase 1 shows that you knock down hepatitis C virus, 99% plus, well, that's pretty good, right? I mean, normally you wouldn't want to take phase 1 data to the bank, but that's a case where, be like, that's a pretty strong indication. So, I mean, that's kind of my broad answer, but I mean, I don't know, I know you're looking for specific programs, so I'm kind of punting a little bit here. I don't know. You have anything, Brian?
I would rather buy a drug after phase 2 for 2 to 5 times the price of it before phase 1 and have a lot better understanding of whether it works or not. So, I mean, I think that's basically the same thing that you said, right? That it's really hard to figure out from an early stage, before there's any data, things can be promising, but that doesn't necessarily mean that you want to buy them, right? Because they're either a lot of times overvalued. If you look at all the CRISPR drugs before, a lot of those went public before they had drugs on them, in clinical trials. And, if you look at Editas, it completely blew up. And, I mean, I don't think obviously you did really bad no matter when you bought Editas before, even though you potentially could have bought it, what looked like cheap, it's still, super cheap right now. It's, $100 million market cap or something.
Yeah, well below cash, I think.
Yeah, because it just, it didn't work out where, maybe, and even if you bought CRISPR at the, certainly if you bought CRISPR at its peak, hasn't gotten back there yet, I don't think. So
Nope.
I think that anything that seems like it has a lot of potential also tends to run up, and the risk reward doesn't look good. And the things that where you're just like, I don't know, it sort of seems like it's a good idea, but I don't know whether it's going to work or not. Those tend to, I would still rather wait and pay more for it with a lot less risk involved than buying it at the early stage.
I just want to leverage off one thing you said, because you were talking about how you'd rather buy in phase 2. And I think that's like kind of an underappreciated point. I think there's a few different ways to buy and things you can do. I mean, one thing, just talking about Paul's original question, if you're looking at early stage stuff, I would certainly be looking for, I would prefer a company that is more of a platform company and a company that has a lot of cash and a broad diversity. But like, besides that, there are sensible places, I think, to buy in. You can be buying in for, I'm betting on clinical success and the stock appreciation that comes from that. You can also be buying in based on like the success that comes with the commercial launch. Like you can wait until some of the clinical stuff is de-risked and buy, when basically the writing's on the wall about approval or even after approval, and bet on a successful launch. I mean, that's a whole different strategy that can be really successful. But when it comes to betting on clinicals, phase 2 is actually, it's a really interesting spot, just because more so than phase 1 or phase 3, there's just this huge variability in how studies are conducted, how broad the phase 2 programs are. And that's, to me, that's the one spot where companies will often come out and say, we had a successful phase 2. And you can really, sometimes it's true and sometimes it's really not true. And it's often more visible there than it is at other points in the development process. So that can be kind of a sweet spot, I think.
Yeah. I mean, just something that if you're just looking for something that's interesting, that I think, is promising. I think Prime Medicine is really like their idea of changing individual base pairs is really, great. I'm not sure that I really like the strategy that they're going after, which is, going after indications where there's already drugs that are further along, genetic medicines that are further along in their process. So I'm not sure that I love the company's technology. I just sort of wish they were going after indications where there wasn't any other options, and they could, I understand that the idea, right, is that, you're already risking the fact that you don't know whether your technology is going to work. So why go for the technology plus the drug, plus the target. But, with a genetic medicine, I feel like the target is already somewhat somewhat reduced, right? You know that, like, you know what people normally have, and you know what the patients with the disease have. They have a mutation. So if you can change the mutation, you might as well go after that indication, I think. So I don't know. I like the technology. I think it's a great idea. So in case people don't know, they're using CRISPR. They're using the CRISPR part of the molecule that recognizes the DNA. And then normally what CRISPR does is just cuts the DNA, and then it gets shoved back together, and eventually it either doesn't make a mutation and then cuts again, and then it just keeps cutting until eventually it makes a mutation, and then that, then you can eliminate a gene. So that's the idea there, that you can turn off a gene. Where what Prime Medicine is doing is they use the CRISPR part of the CRISPR that recognizes the DNA, but they've removed the part that cuts the DNA, and instead what they do is it reaches over and changes a base pair that's on the molecule a couple of base pairs away, and so you can change a single base pair with this treatment. And so when there's a disease that has a single base pair change, in theory they can solve that problem and be able to treat it. So
yeah. I think it's interesting. Jim Wilson, who's kind of a pioneer of gene editing, gene therapy, really. I know gave an interview a few days ago where he's basically saying, like, he thinks we're kind of at trough disillusionment around gene editing and gene therapy right now. I mean, it's just been such a terrible nuclear winter for a lot of these companies. I mean, when you look at what's happened to Intellia, which has done nothing other than put out really impressive data, I have to say, for the most part. I mean, they've really scientifically done a really good job. Obviously, CRISPR Therapeutics has been successful in getting something to market. I mean, Editas not so much, but the field of gene therapy and gene editing has had a lot of achievement, but financially not so much. And so you're facing a lot of risks there. But I mean, I do also, I think what his argument at least was that the pessimism has become irrational at this point. And, the technology is so good that we are going to move back more into this, just kind of for what it's worth.
That was one of my bold predictions on Thursday, was that Intellia's market cap will be higher than CRISPR's market cap in, I think I said, the end of 2027.
Wow. I like it. It looks like we have time maybe for just one more. So this was from Rita S. a few minutes ago. She asked, Novo Nordisk and Neurocrine Biosciences, NBIX, what do you see in the next 5 years? Thanks very much. Novo we've talked a lot about, and I guess I'll get back to that in a sec. Neurocrine, their sort of their ballast and their foundation is their tardive dyskinesia drug, Ingrezza. And what I like about Ingrezza is that they have managed to get insanely long patent life on that. I can't remember, but I think their patent life runs out to 2040 or something for that drug. So they've got an absolute ton of exclusivity ahead of them. Which is nice because they're also, they dominate that market. There's another Austedo as a competitive drug, but there's no dynamic in that market that's likely to change anytime soon. But they've also recently added in the congenital adrenal hyperplasia drug, right? Am I thinking right, Brian?
Yeah, I think so.
Yeah. And again, I think that's one. Neurocrine's problem for the longest time was they obviously had this, this home run with Ingrezza, but then they just, neuroscience is tough to begin with, and they just weren't really able to come out with another success. I mean, they had this, a couple of really minor things that they partnered, but they just weren't able to really come up with a follow-on, and they had a fair number of clinical failures. I do think the CAH drug looks pretty promising. I mean, I think that could be a significant revenue driver for them, and it's already on the market. So there's not a ton. Obviously, there's no regulatory risk at this point, or no significant regulatory risk. So it's a matter of whether they can do the marketing to get it there. I like them pretty well, and I think they're a much safer bet than many companies in the space. And you weren't asking me to pick Novo versus Neurocrine, so I guess I don't need to weigh them up against each other. I mean, Novo's obviously in a really different position. It's a huge, diverse company. I mean, obviously they have their foundational insulin business, but I mean, everybody thinks about them as a GLP-1 company. Semaglutide, goes off patent in sort of 2032. Definitely, I mean, when you get a company that's this strong and incumbent, even though they look like a little bit like they're scrambling for a follow-on product, and that Lilly is kind of maneuvering ahead of them, which I think both those things are true. I mean, they've got such inroads and such strong manufacturing and a lot of cash, and they can do a lot to make sure that they keep relevant in the business. And I think the company is, since it took a big beat down late last year, I think it's looked much more attractively priced. So, even as we look at it now, I mean, it's under a 23 PE ratio with a 2.1% dividend yield. That's not cheap.
We're gonna have to wrap up, Karl.
Oh yeah,
we're 2 minutes past our thing. So
okay. Well,
Jayson and Rachel come in and take over.
Yeah. I'm just sure they'll pop up here in a sec. Yeah, that's not cheap as far as pharma companies go, but given the growth, I think it's reasonable. Jayson, I feel like I just saw you.
Yeah, I know. It's like it's the Karl Jayson sandwich here, right?
Yeah, there you go.
Karl's burger, I guess we could maybe say.
I am the meat.
There you go. There you go.
All right, Brian.
Anyway,
Karl,
have a good one, you guys.
You got it.
Thank you. You too.
Hey, Rachel.
Hey, Jayson. How are you?
I'm good.
All right.
Yeah, I know
Good
we're
to see you.
Just a little bit out of sync there. It's like we're kind of answering the same questions at the same time, but that's okay. It's good to see you too. And I'm glad we get to do an hour together because it's been since Friday.
It's been a few days.
Saturday.
I've been in withdrawal, Jayson.
It's okay. All right. Well, me too. We'll solve that right here. We got 57 minutes together since those two biotech wizards stole some of our time.
How could they?
That's okay. They were creating value for Motley Fool members and YouTube viewers who are watching here, and that's far more important than me and you. So how about we keep it going for another 57 minutes and change here? All right, cool. Okay, so just a reminder, we want to answer those questions, get them to us in Slido, slido.com. Event code is Fool24, all one word, whether you're watching through the live stream on YouTube or you're a Motley Fool member behind the paywall. Either way, that's the same way we get questions from everybody. So get those into us. Our 3 o'clock hour tends to be our valuation hour, so that is our theme. We won't only answer valuation questions, though. So if you have other questions about the things that you're curious about in investing land, get those into us. And just remember, too, that we're not going to give anybody individual or personalized financial advice. So if you ask something, we're going to give our opinion and our thoughts, but we're not going to be telling you what we think you should do. That's not what this is. For a million reasons, this is not the right format for that. So we're not going to be doing it. All right. You want to kick us off, Rachel? I'm sure there's a question in the queue you've seen.
Yeah, there were a couple here I saw that I thought were interesting, but one I wanted to hit that came in a couple hours ago from No Noise on Root Insurance. It's an interesting one. I follow it a little bit, so I wanted to grab that one. For anyone that's not familiar with Root Insurance, they are a car insurance company, but they use a mobile app to assess driver habits and offer potentially lower rates to good drivers. Their goal is to make getting car insurance easier and fairer. And the core concept of their business is really revolves around using data from your phone to understand your driving habits, such as braking, speed, route consistency, and using that data to determine your insurance rate. And so their entire process from getting the initial quote to managing your policy to filing claims is designed to be done through the mobile app that they provide. Their idea is to offer lower premiums to good drivers and really reward safe driving behavior with potentially, much lower rates. And they offer a range of traditional car insurance coverage options, including liability, collision, comprehensive, uninsured, underinsured motorist coverage. This is a business that I remember hearing about a lot a few years ago, and haven't had quite as many questions about it recently. And so it's kind of fun for me to look at. I haven't actually checked to see how the stock has performed in recent times. The business just very recently turned profitable. So that's something that's worth noting as well. Looks like the stock has had a bit of a run up in recent months. But that model that I mentioned is really how they work to distinguish themselves. This app that tracks driving habits during what they call the test drive period. And in rewarding good drivers with lower premiums, they hope to disrupt the more traditional auto insurance model. And again, using data from your phone through their app to assess your driving habits. They offer roadside assistance coverage, which I thought was worth noting as well. And they have a range of other options that are designed to meet different driver needs. And again, trying to make it easy to do things like file claims, which is something that you use the app for. Like other insurance companies, their core revenue comes from premiums that they collect from customers for providing auto insurance coverage. And then based on the data that they gather during those test drives that are performed, again, using customers' driving habits, collecting data on speed, braking, and other factors, they determine a customer's risk profile and set the insurance premium accordingly. And the difference between the premiums collected and the claims paid out is really what forms a significant part of their revenue, as is true again with other insurance companies, known as their underwriting profit. They do utilize reinsurance with both third-party reinsurers and their wholly owned reinsurance subsidiary, which is called Root Re, to share risk and manage their exposure. And they operate by selling directly to customers, but they also have different partnership channels. So customers can purchase policies straight through their website or app, but also in partnerships with other companies as well. Just to kind of give you an idea of how the business has been doing, their policies in force increased 21% in Q4 2024. Gross premiums written increased 18% year over year. Gross premiums earned increased 54% year over year. That figure was $331 million in Q4 alone. And their gross written premium cessation rate improved 12 points to 6%. It's also worth noting their renewal premium was 56% of gross premiums earned. They did experience something of a major, financial turnaround in 2024 in the sense that they moved from what was, I believe, $144 million net loss in 2023 to net income of about $31 million in 2024. And again, they've been seeing really solid growth in gross premiums written, policies in force, as well as gross premiums earned. Their strategy and management strategy has been really working on accelerating new writings with actions in pricing, underwriting, and marketing, but continuing to grow towards more consistent profitability. Underwriting from their partnership channel, again, as I mentioned, they sell direct to consumers, but they also have different insurance partners they work with to get their policies to consumers. New writings in their partnership channel grew by 115%. At the end of last year, if I'm remembering that correctly. And then again, in Q4, they reported net income of $22 million, operating income about $35 million. They also noted that their gross accident period loss ratio improved about 2 points to 61.4%. It's an interesting business. I haven't historically in my personal portfolio been one to invest in insurance so much, but this is a company that I have found interesting, particularly because of the way in which they operate their business. Their somewhat unique model that I mentioned in terms of how they assess and determine rates, which I think is something that's pretty attractive to the end consumer. I think that's something that we've seen has certainly been sticky for the business. I mean, shares are up about 220% over the last year, which kind of stunned me when I was looking at the chart, just given the volatility we've seen in the markets. There's certainly been a lot of excitement about the stock. So it's had quite a run up. I'm not necessarily sure if it can justify that current valuation, but I do think that it is something where this is a business that is improving while continuing to deliver its core, value proposition to consumers. For a business like this, For anyone who's looking, price to earnings is not the most useful metric right now because they're only newly profitable. So they have a price to earnings of about 105 at this point. So bear that in mind if you're looking at this business. They just recently turned their first annual profit. But I think that they are looking in much better shape than they were a few years ago when I first heard about this business. And the fact that they're working to get to consistent profitability, I think that's something that management has really outlined. And they're doing so while continuing to refine their core model and growing their cohort of partnerships that really flow into the premiums they write and earn. I think that those are good signs for the business. Those are some things I would be thinking about if this was a stock I was maybe gonna want to consider for my portfolio.
Yeah, so telematics is starting to become more popular across the insurance industry. We've seen Geico. It's kind of funny that this one came up. Tyler Crowe and I were at Berkshire Hathaway's annual meeting 2 years ago. I think it's 2022, 2023. It was the last year that Charlie Munger was there before he sadly passed away. But Ajit Jain, who runs most of the insurance operations he's a critical executive for insurance for Berkshire, has talked about how Geico has been slow to really integrate telematics. But let's look at Lemonade. They bought Metromile a few years ago. They bought Metromile because of telematics. Allstate's trying to get more traction with it. So we're seeing this become more and more a way that insurers can try to underwrite a little bit more effectively and price it appropriately around driving habits as much as they can. There are some limitations in a few states, but broadly it's becoming more interesting. The thing though, like for Root, the thing that they've done better broadly is just kind of manage their operations along with growing their business. It's a larger business now in terms of gross written premiums. It's over $1 billion in gross written premiums last year. It's bigger than Lemonade, even though Lemonade does, like, auto is actually kind of the small business for Lemonade as they're scaling up everything. Combined ratio was around 95 last year. That's excellent. And its gross loss ratio was, I think it was in the 50s. So again, across the board, they've done a really, really good job of building the business. Here's the stick to stick in like the bicycle spokes of this company as a stock. It trades for like 14 times book value. It's extremely, extremely expensive. And that's a price that's going to have to take a lot of growth to earn. Some of the good auto insurers, that's what Root is an auto insurer. They do trade for a premium multiple to book value, but 13 times book value, that's a whole heck of a lot of growth to earn that. So that's the one thing that's kind of kept me just kind of holding back. And a lot of that, if you look how much the stock's gone up just the beginning of this year, it's just book value multiple expansion. So just got to be aware of that. This is a stock that if you're interested in, maybe take a nibble. Anybody that's interested in it, do your homework and know what you own. But this is one that I'm convinced that we're going to get, just like with Lemonade, the market's going to give us better opportunities to buy it as long as it continues to deliver. But right now it's just trading for a really stretched valuation. All right. Besties, here's another one that Besties asked. This was at the end of the prior hour when I was on. So a couple of hours ago, a couple of like hour blocks ago, BLD, that's Builder's First Source, looks to be a good value. What do you think? What are your 5-year return expectations? Also, what about those for MCOR? That's ticker EME, and AIT, which is Applied Industrial Technologies. So Tyler Crowe and I were talking about those companies. So if you're curious, go back to the 1 to 2 p.m. Eastern hour, and you can hear Tyler and I talk, especially Tyler, kind of weighing in on Top Build and Applied Industrial. I will say that if you look, here's the thing. So we talked about this before with these businesses because they are. So Top Build is Top Build's core business. I want to share a couple slides here in just a second. It's focused on insulation, distribution, and installation. So it's steadily built this distribution business and steadily kind of bolted on an installation business at the same time. So it's in kind of one of the dirty job sector of the building industry because insulation is not fun to install if you've ever messed with it, if you've ever done it before. It's either very hot or very cold, and it's very dirty to do it. They've got a couple hundred locations. And what's interesting about their business is because there is cyclical demand as we go through peak building periods and softness across those different periods. Their installation business actually provides value across the cycle because of the flexibility and the variability of the cost structure for the installation business. A lot of their distributions business, you have a little bit of fixed costs, but you also have some variability there in terms of how much inventory you carry and your ability to turn the inventory. So they've done a really good job of growing across the cycle, and it's why it's been a big winner. Applied Industrial, totally different business. They're also a distributor, but they're distributing things that are used in like manufacturing facilities that might be on the floor of a manufacturing facility, like the stuff that might help move the product along the manufacturing line. So mostly a distributor, but they do a lot of close work with companies when they're building out factories to help them design manufacturing lines, procure the right equipment, make sure they have what they need. Again, very, very cyclical. They do have some earnings on the services side as well. So when capital spending is weaker, they can kind of pick up some of that on the services side. They can help soften the impact of the business. And then MCOR Group is just a giant electrician and mechanical, like HVAC contractor. And we're not talking about coming to your house to fix your electrical. We're talking large industrial, commercial kind of work. A lot of it's installation, but they also have a large secondary services part of their business too, maintenance and upgrades and improvements. So there is some risk right now of the kind of being at a peak of the cycle, because if you look at the cash flows for these businesses, they definitely all look really peaky. Here's the slide that I wanted to share. I'm going to send it over right now. Sorry for the pause. So you see when this, hit the wrong button there. So you'll see when this slide share comes up that the free cash flows, this is over the past decade, for all of these companies is somewhere near kind of all-time high levels. Top Builds is down a little bit because residential real estate's been kind of a challenging environment over the past year because of interest rates and a lot of the pressure that's put on the market. And it does do a lot of the work that it does is installation for the new build apartments or home developments, that kind of thing. So there's a little bit of pressure on its business right now, but we are kind of running the risk of some cyclicality. And you can look at them all. I'm going to pull MCOR's off of here just because it makes it so hard to see the others. And you can see they've gone through periods where they've been kind of up and down. Top Build is a more recent IPO, was a spin out. Oh goodness, I can't remember who it was spun out of off the top of my head right now. But when you go through these cyclical periods, the risk is you take a look at like the price to earnings ratio and you might think, well, these look pretty reasonable. And the risk that you run into is if the stock looks like it's reasonable, but we're at those high levels of free cash flow output or earnings output, that you're buying close to a cyclical peak. And the next 6 months or a couple of years even could be kind of painful. So I wanted to put that out there, particularly because part of the question was thinking about these over the next 5 years. It really depends on what happens with the spending cycles for their end industries, for their end customers. I think for MCOR and AIT, nearshoring, a lot of the spend for what's happening for energy transition, things that are happening with data centers, those are all positive tailwinds. And also there's secular tailwinds too, with like so much of population trends and economic trends in the Sun Belt, where there's a lot of economic growth there. There's a lot of manufacturing expansion, a lot of construction. I think those are both good for AIT and good for MCOR. But I think these are kind of businesses where we're in this part of the business cycle. It's really smart to be mindful of that risk. And not going whole hog and buying these and saying, okay, I'm buying now, I'm ready. This is the one, I'm going to buy it and I'm going to hold. I think you really have to build these out in dollar cost average over an extended period of time. The stock like MCore is a stock that I intend to probably buy 5 to 10 times over the next 4 or 5 years as I build out my position, just because there's so much economic uncertainty and potential cyclicality that we're thinking about. So I think they're all built to be market beaters. Again, depending on the cycle and what happens over the long term, you stretch it out 10, 15, 20 years, you get across multiple market cycles and they really can start to shine. But you're looking at a 5-year period. I mean, anything from market beating and the stock doubling to down 25% if we're in the midst of a downturn in 5 years. So I just be mindful of that, I guess, is what I'm really mainly trying to get at. Okay, what's next, Rachel?
There was a question that actually came in a couple days ago, geared towards Tim, asking about Toast. I want to grab that one since it's been in the queue a couple days, add my thoughts on Toast. Besties was inquiring about this one. This is one that when we do a lot of our themes around restaurant stocks, or just generally, we get a lot of questions about, and it's a company I've gotten to know pretty well over the last few months and studying it a bit more closely. And I do think this is a really interesting business to look at, you know, for anyone that maybe is looking at the restaurant space, which again is a very cyclical space. Toast is sort of a different way, I think, to approach this particular industry, right? So they are focused on providing an all-in-one cloud-based restaurant management platform. And this encompasses point of sale systems, digital ordering, payments, other operational tools. They have a comprehensive suite of tools that's really designed to streamline restaurant operations. And this again includes all of these different software services as well as hardware devices like point of sale systems that they sell directly to restaurants. Restaurants pay a recurring subscription fee for access to Toast's various software and accompanying features. And then they also make money from either sales or leases of restaurant grade hardware, like those point of sales terminals, handheld devices, kitchen display systems. They also process payments for restaurants, and so they charge a fee for each transaction that's based on the check size. So that's another area that significantly impacts their revenue as well as trickles down to profitability. One other part of their business that's worth noting is Toast Capital. This is where they offer financing options to help restaurants with their growth and expansion. And I do believe that they do earn some money on interest from those loans. And they really are catering to a wide range of restaurants, everyone from independent cafes and bars to food trucks to bigger restaurant chains are the types of companies that they work with. They have a real, modular system in terms of with their subscription fees. That is a huge element of their revenue. Restaurants pay a recurring monthly fee based on the features they choose to use. Payment processing fees are another big part of Toast's revenue model. Restaurants are paying a fee for each card transaction processed through the Toast platform. And then again, Toast makes money from their hardware, as well as some miscellaneous services and consulting fees that they offer to restaurants, helping with things like online ordering, employee management, back office tasks. And this wide range of features and services that they provide really make them, and I've said this multiple times, mission critical infrastructure for restaurants. Switching costs are inordinately high. And once a business has adopted Toast software and services, there is a very high incentive for them to continue doing so. They have a very large customer base. As I mentioned, it's quite diverse in terms of the types of locations that they serve. They work with customers in North America, but also in Ireland and the UK, and they are working to expand, I believe, in other areas internationally. They have seen really significant expansion and growth as well in recent years. Just in 2024, their gross payment volume was up 26% year over year to 159 billion. Their GAAP subscription services and financial technology solutions gross profit grew 34% year over year. GAAP net income was 19 million in 2024. That was compared to a 246 million net loss in 2023. So that's an area where they are working to consistently improve in terms of profitability. They are, however, continuing to really steadily grow their free cash flow and operating cash flow. That's something that they've been doing for a few years now. In 2024, they delivered free cash flow of about $306 million, net cash from operations of about $360 million. Their total locations as of the end of 2024 in which their software and other solutions were deployed in were 134,000 locations around the world. That was a 26% increase compared to the end of the prior year period. They also noted that their annualized recurring run rate increased 34% to over 1.6 billion as they closed out the year. One of the things that's interesting as well, and this was comments from management, they said our record location ads show the momentum with our core customer base and the positive signals across our newer customer groups, namely enterprise, international, and food and beverage retail. Because Toast has been working to expand outside of just restaurants only, and into perhaps less discretionary sectors of food and beverage sales. And that's still a pretty nascent growth opportunity for them, but one that I think they're probably very well positioned to address and expand in. And they are, continuing to do so while improving their profitability. They are not, sacrificing profitability for growth. At this point, they're in a stage where they're building a pretty consistent track record there while expanding globally. Something I've talked about a lot with Danny about this company, as well as other fools who follow this stock is, what is the impact of this business if recessionary headwinds actually do appear? And obviously, when we're looking at these businesses, we're thinking over the long term, 5 years or more, which could potentially, outpace what would be relatively short term within that time frame, which would be the period of a recession. I think that this is a business that in some ways might be a little bit more resilient than an actual pure play restaurant would be, because they are providing that essential software and hardware that these businesses need to run. Again, because some of their revenue model is tied to transaction volume, they would inevitably take a hit in that direction if indeed sales at restaurant clients slowed down. But things like their, recurring subscription fees and other areas that are also really core, lifeblood of the business, are areas where businesses like restaurants can't just cut back. They need that to serve their customers. And I think that does give Toast a real measure of resilience there. And one other thing I would note is we've seen a lot of different restaurant companies report earnings this earnings season. I've talked about quite a few of them on shows over the last few months. And while some companies are seeing fluctuations, we are still, broadly speaking, seeing consumers spending money on meals to go out to eat, not necessarily really expensive, high price point meals, but whether it's quick service restaurants or some of the more affordable categories, under the umbrella of companies like Brinker or Darden. We've talked about Cheesecake Factory. We're still seeing customers going out and spending money on these meals. And I think that that's something that is interesting to note, but also might indicate that there are some behaviors of the average consumer that could be a little bit more consistent, even if we see some short-term declines in spending. So I like this business. I think it's doing well. The biggest thing I'm watching with them is to see them really build a consistent track record of profitability. That's important for me with these types of businesses. I'm definitely becoming much more interested in the stock. They did also just announce an expanded partnership with Uber to give their guests more food delivery options. They signed an agreement with Mendocino Farms, which is a fast casual restaurant group with over 70 locations in California. So I think this is an interesting one if you're looking at the space, understanding that there is a certain element of cyclicality built into this industry. I think that Toast is a bit more resilient, however, for some of the reasons I mentioned, than perhaps the average restaurant pure play stock would be.
Yeah, I mean, like you're saying, with the software, it's kind of the operating system for a lot of its restaurant customers, and it unlocks a lot of the owners and the operators' ability to focus on the business versus just being an employee of the business. So there's power there, and I think it's the kind of business that if we do go through a tough economic period where we see a lot of restaurants fold up shop because they're one of like the first sorts of industries, the small local 1 to 5 location restaurants, they're the ones that get hit first, right? So
Yeah.
we could see that strengthen its business if a higher cohort of its restaurants survive, right, and come through the other side. That's a pretty good case study for Toast to be able to go to the market with and say, look, if you want to do better, if you want to survive the hard times and thrive in the good times, our platform is here for you. So I think that'd be interesting to see if they can lever that. All right, I got a few here that I can hit. So Dennis Walter Rahoy asked this earlier: what natural gas producing companies will benefit from coal to gas conversion? So kind of the background on this is there's a couple hundred coal plants operating in the U.S. roughly. And over the past decade, 15 years, we've already seen a lot of former coal burning facilities transition over to natural gas because of a lot of reasons. We could talk about the environmental benefits with coal. There's lots of particulates and negative aspects, things like acid rain that, remember back in the 80s, that was a big issue, the damage to the surrounding areas. Then the big benefit for a lot of these power producers, just the economic benefits. Natural gas generally is cheap, predictable supply. Instead of rail cars loaded with thousands of tons of coal and you have to stack it up outside your facility, natural gas, literally having it piped in. So making the logistics easier, reducing the logistics cost, the operating aspect of the logistics, and then the downtime for maintenance for these natural gas facilities. So there's a lot of reasons to convert a coal plant to natural gas. Dennis, I have a very all that to say I've got a very unsatisfying answer for you. I don't necessarily know that this is a significant catalyst for that many natural gas companies within, like, as tailwinds within the natural challenges of being a natural gas producer. It is a tough industry. You've got to be very close to the logistics aspects, the gathering and the pipelines to get your product to market cheaply, just to keep the lights on. This is like the one area of oil and gas that I've struggled with the most is natural gas producers. Scale is a big winner there. And there's a few that have gotten to scale that also have, like, they own their own pipeline operations, and those pipeline operations are connected to other gas producers so they can earn revenue on their competitors, providing transportation volumes. I just don't really like that sector, to be honest with you. It's just a tough sector to invest in. I want to take Paul F's question here. This one hits near to my heart. And it's one that I've thought a lot about, Rachel. Paul SF asked, Jayson, what's the blackest swan, however obscure, of your Brookfield antithesis? I'm going to take that one first, and then I'll talk a little bit about Howard Marks at Oaktree. So for those that don't know, those that aren't familiar, I have a pretty substantial exposure to across the Brookfield, ticker BN, that's the parent corporation, across the subsidiary businesses that are also publicly traded that are part of the Brookfield empire. I think I talk about it in an outsized way. I talk about it in a bigger way that actually is represented by my ownership in terms of the downside risk. But when we do own companies that we have a lot of financial exposure to, it's even more important than, it's always important, but it's even more important then to really focus on the risks and not just the upside stuff, right? So that antithesis, I love the idea. I think probably the blackest of the black swans is that over the past 25 years, the Brookfield entities have won in no small part because of the appetite to invest in alternative assets. So we buy stocks and bonds because they're the easy things to buy to give us exposure to upside, and then bonds for yield and downside protection. High net wealth investors want to invest in things that are uncorrelated from the stock market when possible. You think about a large endowment, $20, $30 billion endowment, or a pension fund where you have billions and billions of dollars, you also have commitments to outlay your money. You've got to pay pensioners when they retire. If you're an endowment, part of the rules of the endowment is a percentage of the endowment you have to spend every year on whatever the endowment's purpose is, right? Then you have high net wealth people with billions of dollars in wealth that are always on the hunt for ways they can invest their capital to make it safer, to improve the returns, to reduce volatility, all of those things, right? And we've seen, trillions of dollars that have flowed into these alternative asset managers over the past 25 years. And Brookfield, its primary capital sourcing tool is Brookfield Asset Management, which is an asset management company that has over $1 trillion in AUM. So all of that to say, one of the best ways to wallpaper over fractured businesses or less profitable or businesses that haven't performed as well, down to the point of businesses that are potentially failing, is to have people keep throwing money at you. Every Ponzi scheme in the history of ever has lasted as long as people were willing to throw money at whoever was running it, because you can take more money, you can lose a little bit, and you can pay the people that are asking for their money back. And as long as more people are still giving you money, you can keep that hamster wheel going. So the most obscure, blackest black swan for me would be the whole thing is a house of cards that has the guise of being cash flowing and profitable because they pay these dividends and they grow the dividends. And then we hit a wall of capital growth, the top of the funnel for AUM flowing through Brookfield Asset Management, passing along to help fund the infrastructure and renewable energy businesses. We find out that's, the returns have been very thin, and in a lot of cases haven't been good. And they've actually been able to fraudulently hide that. And it's a great big pile of house of cards that's worth nothing. That to me is the bleakest picture that I can possibly paint for the business. So position sizing is how I reduce that exposure. So I probably have 8 or 9% of my capital exposed to all of the Brookfield entities. So it's not a small amount of money, but it's enough that even in a worst case scenario, I would still have 90% of my capital left. So that's the worst one. All right, what's next here?
There were a couple questions on this. Scott Howard a few hours ago was asking about the CoreWeave IPO, and I have done some research into that, so I'm happy to talk a little bit about it. I mean, as Jayson noted at the top of the hour, we cannot give personalized financial advice. So just as we cannot tell you to buy or sell a stock, we cannot tell you to buy or sell an IPO. But I do think that it is important to talk through these types of questions. And we have not seen a lot of IPOs that have been really of note over the last few years. And so I do think that when we see news, obviously Klarna is another major one that recently announced that they were going to be making their debut on the public markets. I think it's fun to talk about these because I do think that there's a lot of interest. For anyone that is not familiar with what CoreWeave is, they are a cloud computing company. They provide infrastructure as a service specifically for AI developers. So they offer access to GPU-powered data centers for training and deploying AI models. They provide their clients with a range of computing and storage options that are priced on a per-use basis. So the core of their business is providing access to data centers equipped with GPUs, allowing AI developers to train and deploy their models without having to manage the underlying infrastructure. AI developers, companies working on AI, and users needing GPU-intensive computing power are the company's target audience. Their client base is concentrated among a few very particular companies, which I will name here in a minute. So they sell time and space on their cloud to clients with pricing based on the type of chip and resources that are used. For example, GPU versus CPU versus storage networking. And then they offer a range of pricing options for their different GPU resources, CPU, and storage. They really specialize in providing their GPU infrastructure, and their infrastructure as a service model allows clients to scale their resources up or down as needed, which offers significant flexibility. Their processes are also very suitable for various AI workloads, such as training large language models. CoreWeave's gotten a lot of attention, not just because of the clients it serves, but because Nvidia holds a very significant stake in the business. CoreWeave's data centers are actually equipped with Nvidia chips as well. CoreWeave, they, as I mentioned, the core of their business is this infrastructure as a service concept where they're renting out data center resources to clients for AI workloads. Major clients include Microsoft, Meta, OpenAI. Microsoft accounts for a significant portion of CoreWeave's revenue. I believe it's about 62%. And CoreWeave is working on expanding its data center infrastructure to really meet the growing demand for AI computing resources. And they do have plans to add more data centers, increase their GPU capacity. They have secured significant debt financing. Debt is a major issue for this business. I'm going to name a few of those figures here in a minute. And they've used their GPUs as collateral. But beyond their basic GPU computing solutions, they have a lot of different specialized solutions for data storage, networking, and CPU compute, all priced on a pay-as-you-go basis. One of the things that's worth noting, again, they recently filed their S1. They plan to market shares between $47 and $55 each. As many as 48.7 million shares could be available for purchase. The IPO is set to be valued at around $2.7 billion based on what we know right now. They are dealing with extensive net losses. Their revenue in 2024 was about 1.9 billion. That was a 736% increase from the year ago period, which is kind of mind blowing. But that obviously comes at a cost in terms of profitability. They are widening their net losses. Their net loss was 593 million in 2023. That expanded to 863 million last year. Now, again, this is a startup business. They were founded by 3 Bitcoin enthusiasts and has now grown to be one of the leading infrastructure as a service providers for the likes of Microsoft. Again, Microsoft accounts for 62% of its sales. That is a much larger amount than in 2023. Microsoft accounted for about 35% of their sales that year. Back in 2023, CoreWeave derived about 73% of its revenue from just 3 customers. They have very, very significant customer concentration, and that is something that is important to be aware of. Again, these are some of the biggest companies in the world because the entirety of their business is essentially infrastructure as a service, data centers, helping these companies that are using different AI applications, building and testing their large language models. There is a degree to which that makes sense to me, but I think it's something that also lends itself to pretty, significant risk there. Now, we know that companies like Alphabet, Microsoft, Meta are planning to spend hundreds of billions of dollars combined on AI infrastructure in 2025 alone. As I mentioned, Nvidia is a major investor in CoreWeave. CoreWeave's data centers run on Nvidia GPUs. At the end of 2024, CoreWeave had about 32 different data centers running on more than 250,000 GPUs. Other companies than the ones I've mentioned, like IBM, is also a customer of theirs. Obviously, Meta, who I named, Nvidia, and they have significantly expanded their revenue. But it is highly concentrated among a handful of customers, with currently Microsoft being the biggest one at 62%. So those are some things to think about with this business. I'm not personally one that usually invests in new IPOs, but this is one that I am watching closely, given the kind of integral infrastructure they're providing to some of the most well-known and the biggest players within AI today. The infrastructure they provide is really core to these companies' abilities to be able to build out their AI dominance and build out these AI applications. And so there is a real, long-term value need for the business and the cloud-based computing hardware that they provide. I think one of the biggest concerns I have is just the way that they're burning cash, the way they're expanding their net losses, and the reliance they have in terms of customer concentration on just a few names. But these are some of the biggest names in tech and in the world of AI at this point in time. So their capital-intensive infrastructure investments are where you're seeing that expansion and negative free cash flow and negative profitability. But that's also not uncommon to see with businesses at this stage in their growth story. So it's a really fascinating one to watch. It's probably one of the most intriguing IPOs I've seen news about besides the Klarna one. Again, there aren't that many IPOs that are catching our attention these days anyway, because it is a very slow time for new market debuts compared to a few years ago. But those are some things I would be thinking about if I was looking at, wanting to potentially take a position in this stock around its IPO.
Matt asked earlier about Agree Realty, ticker ADC. Described it as the younger brother of Realty Income. So it's basically the same age. I think they both went public in 1994. It's just not quite as big. It's delivered pretty solid returns over its long term. And it's funny. I think one of the things that can happen sometimes is you look at the stock. If you pull up a stock chart and you're looking at the dividend growth, sometimes it looks like the dividend got cut. Well, what happened was the company switched from a quarterly dividend payout to a monthly dividend payout. So the amount of the dividend fell, but instead of getting 4 a month, you get 12 a month, right? So you get 3 times as many payments. So it's a dividend grower too. It's done a pretty good job of growing its on an annualized basis, growing its dividend for the long term. I think it's a little expensive right now, I guess, is probably the main thing that I want to say. I shouldn't say expensive. It's reasonably valued, but the dividend yield's below 4% at recent prices. I think it's fair to say it's a little bit smaller business. That it certainly from the way that Agree Realty is going to grow, it's going to be the same way that we're going to see Realty Income grow, and that's consolidation. A lot of acquiring other REITs and really trying to buy the book of business as much as you can. Because what you want to do is you want to buy. You want to get partnered with a large company that has a lot of real estate that it's eventually trying to sell to the REIT and do a lease back. They're trying to monetize. So there's that's the best opportunity for growth for a lot of these players. So I think it's interesting, but I would want to see it at a better price than it's trading for right now before I would really get super enthralled, because it's not going to grow at a very high rate, most likely. So I think about like the dividend is kind of being the floor for the investment. You got a dividend well above 5% yield for Realty Income right now. And, Agree Realty's yield is in the 3s. So you don't have the same kind of margin of safety that's built in. And a lot of times when you're looking at these spaces, the advantage of buying the bigger player is a lot of times they just have cost of capital advantages too. So I haven't really done a full dig into Agree Realty's 10K to really look at their cost of capital and the rates that they're paying on their entire book of debt. But just as a guess, I would say that Realty Income probably has a pretty decent advantage in terms of a lower cost of capital. And that can really make a big difference in terms of the returns that you can generate for investors, just because it costs you less to finance a deal that's the exact same amount of money as your competitor. You get to keep more of the money versus what you have to give back to your borrower. So, or to your lender, I should say. So I can't give you a compelling reason why I would buy it today before I'd buy Realty Income. Okay. What's next?
This was a question from another one from Paul SF. Is Apple's valuation misplaced now that it mostly leans on subscription revenue, not customer delighting device breakthroughs? I have some thoughts on this. I think that it's worth noting that their services business is really impacting, positively their profitability, but they do still make most of their revenue from device sales. So their services business now accounts for about 21% of their total revenue. They still make about half or so of their revenue from iPhones alone. So I don't know that they mostly lead. I don't know that I would say that they actually mostly lead on subscription revenue right now. I think that is something that has continued to have a more notable impact on the business. It is certainly being a key driver of higher gross margins, particularly compared to their, high hardware division, obviously. And that makes sense, just given the fundamentals of how those businesses work. And that services business has been a really key driver of Apple's growth that has helped to offset slowdowns in iPhone sales. So I think those are really important points to make. But Apple is still very much reliant on sales of its hardware products like the iPhone, namely, but also Mac, iPad, and other, wearables being a smaller part of its business. iPhone is still over half of the company's total sales. So I think that's something to, consider in terms of what the product mix up for the company still looks like. Now, I've held this business for a long time. Their valuation has risen over the last few years, even though I still think, in my opinion, it's not outrageous for the business and what it is, and the level at which they're growing and continuing to innovate. I know this is probably one of the less favored of the big tech stocks that we talk about, but this is one that, even though it has maybe not been as high a performer in my portfolio compared to the likes of Amazon, or some of these other businesses, has been a really steady grower over the last several years, despite the volatility and some of the changes we've seen in consumer spending patterns. So I think that's something important to bear in mind when you're looking at the valuation. Is their services business is growing. It is driving the improvements in gross margins we're seeing. It is driving some really great results in terms of profitability, but it is still not by a long shot the biggest part of Apple's business. They are still very, very reliant on hardware sales. And we've seen some interesting announcements from them recently in terms of they announced they were going to be building a new factory in the US in response to some of the positions we've seen from the new administration regarding US manufacturing. We also know that Apple had in the past sort of made some similar indications in terms of their plans for future growth. They do have some U.S. manufacturing, which still represents a very, very small part of where their products are actually, sourced from and from where they ship out to the rest of the world from. So it's kind of a side note there, but something to think about as well with the business. I don't know if you have thoughts on this.
But it's growing. Their ex-China manufacturing footprint is going to continue to grow. I think we're going to see them expand into Mexico over time. I think we're going to continue to see them expand into the U.S. Probably not going to be iPhones in the U.S., but there are some things they're going to start making more of here. I want to make the case a little bit for the point about the question about thinking about valuing Apple more as like a software company versus a hardware company or a SaaS company. So you look at their this is just one quarter of their last fiscal year, so it doesn't include the full year, but directionally the numbers are going to work out to basically be about the same. So Apple generated about $44 billion in gross margin in its quarter ended last September. 18.5 billion of that came from services.
Right.
25 billion came from products. So again, 18.5 billion came from services, 25 billion came from products. Those numbers aren't massively different. Yes, 25 is a good bit bigger than 18, but that $18 billion in gross profit dollars came off $25 billion in revenue. It's not just a little bit more profitable, it's a lot more profitable. We're talking 75% gross margins from their services business. It is exceptionally profitable. But it only exists because of these, right? This is the ecosystem. right? So this is the ecosystem. So the answer is somewhere in the middle, I think, is kind of the point. I mean, it's starting to become like more of these guys too, right?
I just think it's hard to, and that was the point I was making as well. I think it's hard to fundamentally say though that it is I think it's hard to value it as a software business at this point. I don't think that they're there yet. I don't think they're fundamentally there, but again,
never will be.
I don't know if they ever will be, if I'm being honest, but I think the gross margin contribution, huge. Is it their more profitable business? Yes. But is it the leading driver of their business? It's not.
I think it's probably, it's the leading driver of their profit growth. I think that is important. I think you can say that. But I think it's also why Apple trades for 35 times earnings already. I mean, there's not a whole lot of companies of this scale that have grown at the rate that Apple's grown over the past 5 years, which is it hasn't grown over the past 5 years. That it's revenue, right? Its top line really hasn't changed much in, it's a much slower growth company is what I'm getting at. But growing that services revenue is growing the bottom line. And that's why it trades for 30. I mean, what more can you ask for a mature company like that that's trading for 35 times earnings?
I don't think it's too bad. I will say, I mean,
I think it's ridiculously expensive, and I'd never pay it. But I've been wrong. I've been wrong for years about Apple. So
I love it when you just politely disagree with me, Jayson. You're like, I would absolutely never do that.
Not a chance. It's an incredible company. I just showed the thousands of dollars that I've given them myself on the screen here, right? But I can't wrap my head around the valuation. So
I respect that.
I'm channeling a little bit of Paul SF here. How much longer will broad high valuation irrationality mock my growing barrels of dry powder? I feel seen, Paul. I feel seen.
Yeah, I think that's fair. I think that I will say with Apple, I mean, I've held this stock since my early days as an investor. This is a stock that's still over 5 years delivered a total return of almost 300%, including dividends. I'm not mad about that. I'm just gonna say I'm not mad about it.
I'm not gonna hate you over it either. I'm not gonna hate you over that. I'm not at all. I do want to point out, because I'm that guy. Over the past 5 years, you know what they say about pictures and words and all that kind of stuff. Incoming Adam. I'm going to share that screen for me. I'd appreciate it. The earnings multiple has also doubled over 5 years.
Yes.
So a lot of returns have come over people being willing to pay a higher premium for the stock. So, all right.
You, Jayson.
I'm not hating on you, though. I'm not hating on you, though. Make that money, friend. Make that money.
There we go.
What's next?
All right. Well, we only have a couple minutes left.
So Ed, no, I've never, Ed's question here. Have you ever participated in an IPO that was offered by Schwab, and do they usually offer secondary and not primary offerings to its member participants? I'm not sure. Different brokers have different rules around how they offer IPOs to their customers. I would suggest reaching out to Schwab's customer service folks, and they'll give you some vanilla answer that's probably wholly unsatisfying, but they actually might give you a little bit more clarity about it. That would be my best suggestion to you. Got questions coming in for Neil. Neil's coming on next. Is that right?
I see that. Yes. We have a minute left.
Neil and Will.
Ed was asking about Disney, mentioning Snow White hasn't been performing as well. Is their brand weakening? I think Toby and I talked about this a few weeks ago. Regardless of, I think, the media noise surrounding that release, and I have not dug into that too closely to be able to give.
The entertainment industry media loves to dunk on any giant company.
Yeah,
that falls short of expectations. I
don't think that this is a brand needle mover. I don't think that this takes the Disney brand and puts it, sets it back a decade. I think this is somewhat par for the course of some of what we've seen in the last few years. I also think that this is a business with so many other drivers of growth going for it that regardless of what maybe negative attention may or may not surround this movie, and again, I have not dug into it, I think that the core brand is still strong. I don't think that this disrupts that in any way.
I think what we saw for a couple things happening. Number one, the traditional media landscape is changing, moving from linear TV to over the top and streaming. and its biggest, most valuable property in terms of cash generation for 20 years has been ESPN, right? So that business is being disrupted, and we're finally at the point where we're seeing the transition to selling ESPN directly to customers, right? And being able to fully directly monetize that. And so we're still months away from that even happening. But once that happens, that's going to give us a better idea of the health of like that really important property. And then over the past 5 years, they made some big missteps with their strategy for movies, where they were trying to be a low-cost factory to produce these billion-dollar blockbusters. And they took a lot of creative control away from the creative people running the studios. That's one of the first things that the second time CEO, here we go again, changed back to the way they had run before. And it just takes time for that to fully work through for these projects when they get green lighted all the way through the process. So I'm hopeful about that. Just a lot of things that Disney's got to get right. I don't think there's any erosion of the value of the brand. All right, it is time, Rachel, for you and I to go away and to bring Neil and Will to the stage.
Sounds like a plan.
All right, guys, we are turning it over to you. Here's the keys. Rachel's got the she's got the controls.
Thank
you. There you go. All right, fools.
Thanks,
we'll
guys.
see you next time.
See you next time.
See ya.
Hello, fools, and welcome to another hour of Fool24. I am Will Healy, your co-host, and I'm joined for the first time by Neil Rozenbaum. How are you, Neil?
Yeah, first time. I'm very good. How about you?
I'm pretty good.
Pretty good day to start the week, I would say, with the market being green.
Yeah, it's a very positive day for the markets. I didn't check how much I made today, but I was seeing the individual stocks. I was very, very happy with what I saw.
Mm-hmm. No, I agree.
So, believe it or not, some earnings are still coming in. It has slowed down. We're almost to the next earnings season. Beginning maybe in mid-April, about 3 weeks from now. But there are still a few trickling in, and we're going to go through some of those today. I believe you're going to cover Micron and Nike, correct?
Correct. Yeah.
Yes, and I'll probably contribute some on Micron as well, but I'm going to go into Carnival Cruise Line. So that was a big one that happened Friday.
Yeah, we can maybe start with a question that came in for me, so we know that viewer is live watching, so maybe doesn't have to wait that long. So maybe I'll start with that. A question by Leviathan 5 minutes ago. Can you give your thoughts on Nebius Group, ticker symbol NBIS, and its future growth? So for those that don't know, Nebius got relisted on the NASDAQ late 2024, I would say October 2024. It was previously, you might have known the company called Yandex, the basically Russian Google. Very short explanation. Russian Google, of course, because of the conflict between Russia and Ukraine, they had to divest basically everything from their Russian business. So they created this company called Nebius Group. Under Nebius Group, you have the Nebius core business, which is cloud infrastructure, AI infrastructure build-outs, and all of that. That's the majority of their revenue. They have their presence in Europe and the United States, HQ actually in Amsterdam. Then you've got other smaller segments of the business. You've got AV Ride, which is autonomous vehicles, and actually these tiny little robots that deliver food as well. You've got Toloka and then Triple 10. Triple 10 is basically an education program, a boot camp, IT boot camp they call it, in order for skilled workers to basically change careers. So they learn about AI, IT, and all of that. And then Toloka was more about data labeling, helping the likes of Amazon's, Meta, Google, and all of that make their LLMs better. Right now, they're mixing it with generative AI, etc., etc. So they got the spotlight late 2024 when it was announced that in that $700 million investment round or raise, Nvidia got mentioned. And when Nvidia gets mentioned, of course, every company gets a lot more attention. And so Nvidia Nebius got the spotlight. Right now, Nebius I'm very bullish on Nebius, and for them to grow, because they still expect ARR for 2025 to be between $750 and $1 billion. That's a 10x growth on the revenue for what happened a quarter ago. So pretty fast grower. But for them to continue to grow, of course, they will have to build out their infrastructure faster than the rest and more efficient. And that's what they say, that's their moat. They can build it out faster and more efficient than the rest. The more energy efficient, the better the pricing. The lower the pricing, the more demand there will be for their services. So that's basically the short long answer here. Are you aware of Nebius Group? Or you know?
I do not follow that stock, so I have nothing to add here.
Then we can start with Carnival Cruises.
Okay, yeah. So Carnival reported Friday morning. Share my screen. So, it came up. Okay, good. So it beat on revenue and earnings, as you can see. Carnival's been in a very interesting position over the last few years. As you might recall, all cruise lines were forced to shut down during the pandemic in in March 2020 they were forced to shut down. They weren't even allowed to sail again on a minimal level until the summer of 2021. So you were basically looking at 15 months where these companies were forced to shut down. So they basically had to fire most of their employees, dock their ships. They were burning cash all that time, even though they didn't have cash or any revenue. So they had to borrow heavily. Borrow heavily to stay afloat. As they've gotten back, we're looking at more than 5 years now since that began, or a little bit more than 5 years. And looking at then versus now, nothing seems to have changed, or nothing much anyway. Carnival is still the leading cruise line, with Royal Caribbean second and Norwegian third. And this business is back to full capacity now. They are even expanding a little bit. So and you look at the revenue growth, about 7%. It had been growing in double digits. I think the fact that it's down to 7% tells you it's pretty much back to normal operations after the years-long process to get back. It has generally been profitable again, despite the $78 million loss in Q1. I believe they were, if I had to go in memory, but I think they were profitable last year by a small margin. So, but then if you look at the adjusted income, that's positive. It's operationally positive. It just, when you include the one-time charges, that's what leads to the loss. So, and you're looking at the same kind of revenue growth for Q2. But this is really firing on all cylinders, despite the relatively slower performance. Record operating income. Like I say, it was the interest and debt costs that led to the net losses. That was the non-operational expense. Their credit rating was upgraded. That's huge because they've had to borrow so much money. I think they were up to $35 billion at one point in debt, if I recall that, and they were maybe 11 to 12 billion in debt before the pandemic. So that tells you how much they had to borrow just to keep the company in business. And of course, that strained the balance sheet, that hurt their debt rating. So the fact that their debt rating is coming back a little bit is a good sign, as are the majority of 2025 sailings being booked. That's pretty interesting, because you hear rumblings about how sluggish the economy is, but if you look at the cruise industry, you wouldn't see that. They're seem to be as strong as ever. Occupancy is 103%. By the way, 100% occupancy is when there are two people in every cabin. So that tells you that they're getting a little bit more than two per cabin. So of course that's yet another good sign. Voted one of the most admired companies by Fortune. It is building ships despite holding on to a massive debt. That's because they want to capitalize on this business. They're booking all their cruises. So I think that makes sense, and it's good that they're in a position to do that despite all their debt. Despite that, the stock is trading at a 15 PE ratio. That's cheap, but I think the debt is still kind of weighing on the company. So and the fact that maybe the cruise industry could turn all of a sudden negative. So there are some uncertainties to deal with. that's why the PE ratio is at such a low level. But yeah, it's still worth considering, I think. So the debt level is about, I said, 35 billion at its peak. It's down to 27 billion now, and they seem to be paying off their debt as it comes along. So they haven't had to really issue a whole lot of new debt. So that's always a good sign, especially considering the position they've been in. But as I said, the economic downturn, a possible economic downturn anyway, could hit them, and this all could turn negative at any time. So it is a little bit tenuous, but I think it's an interesting position here. As you can see from the stock performance, it is slightly beating the market for the year. It didn't react that much on Friday to the earnings in one direction or the other. I didn't check it earlier. I don't think it was doing much today when I checked it earlier. I didn't get the final price, but I think it seems to be pretty strong. I think it's doing pretty well, considering all it's been through over the last 5 years.
I mean, they did say that the majority of 2025 sailings are booked, so I would assume that if there is an economic downturn, that wouldn't be felt this year unless there's a lot of cancellations and stuff like that.
Yeah, I think I agree. I think it would take a pretty severe downturn for everyone to cancel. So I mean, there might be a delayed reaction if it happens, but you can't really rule it out.
Yeah, no, for sure. I mean, I've heard some of the comments from their competitors, the Royal Caribbeans, and all of that. They all seem quite positive for the year at the moment. They're looking at the next 12 months or so. They seem to be doing quite well. So I would assume that the people that do go on cruises really like to go on cruises. Like, I think no matter what happens, you will have your cruise holiday, and it shows in the numbers. I mean, the rebound since that pandemic low has been quite something. I mean, the stock itself more than doubled since the lows from the pandemic, but it is trailing the likes of a Royal Caribbean, for example, right? Is there any reason why Royal Caribbean did rebound quite a lot, and the Norwegian and even Carnival are still behind, let's say?
That's a good question. It's been a while since I've looked at Royal Caribbean, but they seem to be handling their debt situation, I think, maybe a little bit better. So that I think that had something to do with it. Maybe I think they go after a slightly different demographic. Whereas Carnival's the biggest cruise line. A lot of their price points are at lower levels, so I think maybe they're looked at as a slightly more affordable cruise option as well. So I think that may play into it as well.
Okay, no, interesting. I mean, I previously liked. I mean, they did pay a dividend, right, before the pandemic. They didn't mention anything about paying a dividend yet.
Yeah, I mean, they're still heavily in debt, so I don't know that they would necessarily revive the dividend at this stage.
Yeah, no, it makes sense. Like if I was a shareholder right now, I would not expect a dividend anytime soon. I wouldn't even want a dividend anytime soon. Eventually, yes, but right now, I rather them just keep the cash, pay down the debt, and then grow. So yeah, I mean, pretty good company. Cruise lines were pretty good companies even before the pandemic. It's just that they got hit with something that nobody saw coming.
Yeah.
So yeah, no. If anyone has any questions, do submit them through Slido. The password is Fool24, and we'll do our best to answer some of the questions. I'll quickly go and talk a little bit about Micron. I do not have a screen to share, unfortunately. But Micron reported earnings Thursday after the market closed. A pretty good earning. You wouldn't think it was a pretty good earnings report because the stock went down on Friday 8% or so, and right now right now at the time of making this live stream, it was up 2.3% or so. So okay, we're still under $100. Now, for those that don't know, Micron sells semiconductors for memory and storage. There are two segments if you look at the business, two segments, DRAM and NAND. DRAM is great for short-term memory storage and rapid access, whereas NAND is great for long-term memory storage and the use cases that don't need the lowest data processing latency. Now, the memory business in the semiconductor industry is very, very cyclical, very, very cyclical. And you might even say that it has become a commodity. So why is it worth looking at a Micron? It's because of all of this AI story, data center build-outs, huge GPUs that you need. And in those GPUs, such as NVIDIA's Blackwell, H100, H200, you have something that's called HBM, which is high bandwidth memory. And this is something that Micron is making right now, something that SK Hynix is making, Samsung as well, although Samsung is now having some internal issues, which allows Micron to grow quite rapidly. Now, last quarter, Micron grew its HBM quite rapidly. I believe for the quarter, it's the first time where it generated $1 billion from HBM. They expect growth for HBM to continue, so that's great. Strong demand for available 2026 HBM supply is what they said. Now, pricing-wise, pricing for 2025, they are sold out for 2025. Pricing-wise, that's locked. So every time we see some reports where pricing for memory is going up, it's probably going to be for 26 and maybe orders after that. One of the reasons, or I think the main reason why the stock went down is because of margin. For the quarter, small margin miss. For guidance, small margin miss as well. And maybe that's why the market was a bit, I wouldn't say angry, but disappointed that, well, even guidance margins were hit a little bit. And that's why the stock was down. But all in all, from what I've seen here, Q3 revenue guidance beat by 3.8% compared to what Wall Street was expecting. EBIT guidance met estimates. Gross profit margin guidance, that was the small miss here. All in all, this is a company that is, they say, in its best position it has ever been in its history. So if the stock is down and the comments and the numbers are still good, in my eyes, that's still very, very good.
Yeah, that high bandwidth with memory, that's where the real growth came on the revenue side. I believe that's part of the DRAM segment of the business, if I'm not mistaken. But I think that was like over 50% growth, yearly growth of that particular segment, and it crossed 1 billion for the first time. So that's very uncommodity-like, which is unusual for a memory company, which has a reputation for producing commodity chips, which typically have not been great investments over the history of the semiconductor industry.
Yeah, it grew 50% quarter over quarter.
Oh,
actually,
quarter over
HBM.
quarter.
Yeah,
Okay.
even better, to cross that $1 billion mark. And the sold out part that I said, that's sold out for HBM capacity for 2025, not the whole business. They also said that they started construction on their HBM packaging factory in Singapore. This will support growth into calendar year 2027. They also collected the first tranche of the cash incentives for its Idaho DRAM facility from the CHIPS Act. Now, of course, whether or not the CHIPS Act will continue to exist remains to be seen. But yeah, with Micron, the focus is definitely on HBM growth, because that's the part that's right now not commoditized, and that's the part that's where the money's at, basically.
Exactly. I'm looking at the PE ratio on it. It's at 22 right now. That's actually been historically high for Micron, if you can believe that. I was going to pull up a chart here. Bear with me a second. Oh yeah, this is it. So if you look at this chart, this is the stock performance over the history of Micron. As you can see, between the mid 90s and about 2015, 2016, the stock had no net growth at one point. So in other words, every time there was a bull market, it would go up. I mean, and you can see especially how it went up, and right at the .com bubble. But then every time there was a bear market, it would wipe out all of that gain. Since the 2016, 2017 timeframe, we've seen it hold on to some of these gains through the bear market. So it's been a much better performer. And this is because, pre-2016, you basically had just PCs and smartphones. So there was relatively, I wouldn't say there wasn't innovation at all, but there was relatively less. And like I said, every time there was a bear market, they'd cut their prices. That would wipe out all of the gains of the stock. But now with AI and all this other technology using memory chips, we finally have a bull market in the stock. But I would be leery of that history though, because this has probably one of the most frustrating stocks among semiconductor stocks, just because of that history. And even though it is holding on to its gains now, if it becomes more commoditized, I think it could return to the, it can go back to where it wasn't really earning any returns long term. So you do have to watch for that. But as long as AI keeps driving innovation, I think the stock continues to go up.
Yeah, I mean, if we look, it's very cyclical, right? You can see that in the business, revenue goes up, then it goes down. But at least in the last 5 to 7 years or so, the peaks have always gone higher and higher. So at least there is that. They also mentioned something very interesting when we look at NAND, the devices side of things, actually now in DRAM, on the automotive side of things, almost said autonomous, robotaxi platforms, they need about 20 to 30 times more DRAM gigabytes than traditional cars. It has the industry's first SSD product for driverless cars, which is now testing with customers. So I guess that's also one of the paths forward where they can grow that didn't really exist previously.
Yeah, so it looks much better than it did about 10 years ago for sure.
Yeah, not for sure. Are there any questions you want to answer before I go into Nike, or?
I don't see any so far, so go ahead and touch on Nike if you could.
Okay, so Nike also reported last week after the market closed on Thursday. Now, before the earnings call began, the stock was green, but they only give us guidance during the call. So every time that you see these types of things, wait until the call is over to see exactly what has been said and why the stock reacts the way it does. Now, this was another ugly quarter for Nike, as expected. The new CEO that came in, Elliot Hill, he knows Nike inside out. He already told us 3 months ago that the recovery of this whole company will take longer than expected. It makes sense. So I wasn't surprised to see that, well, revenue was still down. I'm looking here at revenue. Revenue was down. Footwear was down. So the overall business is still struggling. Makes sense. There are restructurings happen. Lots of changes there. Lots of competition as well, which is probably why Nike has suffered a little bit, or more than a little bit. More recently, you have competitors in footwear like On, Hoka from Deckers. In the apparel space, you have the likes of Lululemon that also take more and more market share. So I'm not surprised to see Nike taking a hit. I'm not surprised that this was a bad quarter for the company. They also missed on margins across the board. And I think the part that hit the stock even more was guidance. So for guidance, people were maybe expecting, okay, maybe this is the worst quarter ever. It's going to improve. It's going to improve from here. Well, it's going to take, like I said, it's going to take a little bit longer. The struggling period, or the restructuring period for Nike, is still going to last, especially this year as they go through inventory, as they grow through all of the traditional channels. Because during the pandemic, Nike has really pushed towards online, which probably worked well for a year or so, but that was about it. Now they're trying to rebalance the whole strategy again, be very, very focused on making great products for athletes. What do athletes want? So they're trying to revive that core Nike spirit. Whether or not that will succeed is something else. Is something that we'll probably only know, I would say, 12 months from now, because you have to give the new CEO a couple of quarters to turn this huge ship around. They are now, the more recently, there was a partnership that was announced with Kim Kardashian's brand. So maybe that's one of the way to revitalize the apparel side of the business. With the shoe segments, again, we've seen lots of partnerships. I mean, there's still Air Jordan, very, very popular brand. But still, how many shoes does one person need? You have 2 feet, so I guess not unlimited. Plus, now that there are way more competitors playing the same game, you're going to have to wait and see if Nike's brand, if Nike's iconic brand worldwide is truly their competitive advantage. Because that's basically it. If you believe that Nike, the iconic brand worldwide, is their competitive advantage, then yeah, I don't know, it's at 60 something, $70 right now, took a huge hit, might be an opportunity. If not, then might be a value trap, I'd say.
Yeah, it's hard with apparel companies because it's really hard to get a discernible competitive advantage. And I think they were producing a quality product, and that gave them some. But I think the biggest part of their competitive advantage was marketing. And when they took their product out of the stores, I think that hurt them. I'm concerned that they may never recover from that. As Neil pointed out, they've made some new partnerships, and we'll see if it recovers. But I'm not a believer, but I could be wrong. We'll see.
Yeah, I mean, I did say previously that I am more on the bull than the bear side when it comes to Nike, but that does not mean that I think it outperforms. I can see Nike still being around 10 years from now, but does that mean that it's a worthy investment for me? That's something else. I mean, in the meantime, of course, you can collect a dividend for sure, but if you're buying Nike, that means you have interest in apparel, you have interest in footwear, and if that's really what you're looking for, then there are other companies that are growing faster than Nike. They have more momentum than Nike. Now, of course, if we talk about the On holdings, the Hoka, which is Deckers, they're growing faster, especially On. I think they grew 50% or so year on year. Smaller base, for sure. We don't know if they will last that long. Nike is already a brand that's known for a couple of decades. So yeah, it's a choice investors have to make. Do I want to go with the iconic brand that was great before, might not be great in the future? Or do I want to go with a brand that is growing much faster, but might not be relevant 10 years from now? I think that's the big question.
Yeah, that might just depend on what type of investor you are too. A more conservative investor might prefer Nike because of their past and their dividend, but a growth investor might go with a different player. So it's very much a personal decision from that perspective.
Yeah, no, for sure.
Okay, well, moving on to the questions. Casey Whited, if I'm pronouncing that correctly, had something 2 hours ago. More into Amazon, COOC, Trade Desk, which is TTD, RISA, ANET, Kyndryl, KD, and AMD, or some new stocks still like Intuitive Surgical. I honestly don't follow COOC, so I cannot comment on that one. And Arista, I haven't really dug into. Kyndryl, I've started to look at it again. I wasn't looking at it for a while. That spun off from IBM. That was IBM's managed infrastructure business that was put under new management. And the stock has suffered for most of its history, but I think the new management's finally starting to turn that into a more viable business. So that's starting to look interesting. Amazon, I still like. I think the valuations has come down. It is maturing, but I still think that the cloud and AI parts of the business are vital. And within the e-commerce section too, you have the digital advertising, third-party seller services, subscription. So I still like Amazon, even though it's gotten bigger and the growth has slowed down a bit. AMD, I actually bought some more a couple of weeks ago because it dropped 60% and fell below 100. I think with first of all, their data center business, which is AI accelerators, has grown very quickly, despite the fact that they are behind Nvidia. But I think with lower cost AI coming, I think that's going to be very bullish. And their their forward PE ratio, I think, is still into the 20s. So I think that's very cheap for a growth stock like AMD. So I like that one. Intuitive Surgical is very intriguing. I love the business. I think it's a little bit pricey at these levels, but long term, I think it's still a winner personally.
Yeah, no, I will agree. Intuitive Surgical is one of those companies I've been following, and it was always expensive in my eyes. But then again, great companies usually are expensive. But it's one that's always on my watch list. I would love to own it, but I want to pay less than the price I have to pay today. Amazon is my second largest position actually in the portfolio. I love it. I think it's one of the best businesses ever created, and somehow they always manage to expand their total addressable market. Like you said, advertising, subscriptions, AWS, you name it. So Amazon, still I love it. COOC, I have no idea what company that is. Kendrill.
It might be Coco. It might have been a typo. I don't know that one that well either.
Yeah, me neither. The trade desk is now very interesting. Not gonna lie, the trade is after a 50% haircut, if you can call it that, is now extremely interesting. Great management, great track record. One miss in 8 years, and the market cuts this company in half. The only issue for me personally is that I already have exposure to the advertising markets through Meta, Alphabet, and an Amazon. So adding a trade desk just means that I'm adding another advertising player, although of course not similar to those, but I don't need an extra player, I would say.
Yeah, sorry, I forgot to mention that one. I did actually add some shares of the trade desk last week because it's fallen so far in such a small amount of time, and I agree with Thiel here. I think that they way overreacted to that one revenue miss. Although, like I said, it's not a good look to miss your own revenue number, but I think it's a mistake rather than a long-term trend. So I think the market's far overreacted to that by bidding it down from like 140 to the low 50s. I think that's a little bit excessive. Although it was overvalued before, so valuation may have played a factor in that. But I even with that, I think it was overdone.
Yeah, no, I agree. I mean, when it went into earnings, it was very expensive, 120 plus dollars or so. Market cap was quite high for that company at that point. A 50% haircut is an overreaction, but for long-term investors, I think it's a welcoming gift. They explained also why there was a revenue miss. So one miss in 8 years, I'll give them the benefit of the doubt. I'm not a shareholder. I was 2 years ago. I was a shareholder. But like I said, I have enough exposure in the advertising market. And then Kendrill, I don't have anything to add to that. AMD, I started to like and love the company a lot as it went under $100, as it went closer to $100 as well. I own the position. It's also one of those companies where a year ago when it was trading at $200, it was the next Nvidia. Then when it was closer to $100, it turned into the next Intel. And usually when there is such and I own Intel, so I can make these types of jokes. But when these huge sentiment shifts happen, yet the company becomes better, that's usually when I start liking companies more and more. And that's exactly what has happened with AMD. Great management, good business. As you said, AI accelerators, AI revenue is growing quite quickly, although we didn't really get guidance for 2025. That was what the market was looking for. 2024, just above $5 billion for AI revenue. For this year, analysts are expecting above 60% growth, so around $8.5 billion in that. We'll see. I did a prediction with Jose on another stream. I said we're going to get that guidance probably in the third quarter's earnings call. We'll see if that's correct. But AMD, even if it's behind an Nvidia, the market is so big that even if they take a small part of that market, that's still very, very lucrative.
Yeah, I think another thing that's hurt AMD is their gaming segment was their revenue was down by more than half in the last quarter. A lot of their revenue depends on the gaming consoles, Sony PlayStation, Microsoft Xbox. They haven't had an upgrade in a few years. I think they've suffered mightily because of that. I think it's only 10% of revenue now, so I don't. I'm not sure it's really appropriate to hammer the stock, because that's becoming a much smaller portion of its revenue. As far as it's falling, it may get to where it has nowhere to go but up, or if it hasn't reached that point already. So I think it's wrong to hammer the stock for that reason.
Yeah, no, I agree. I think the gaming and the embedded segments are the one that have been dragging the business down a little bit.
Yeah.
Two headwinds for those segments, which they say should be turning into tailwinds for the second half of the year. So that's great, because the embedded one is a high margin business. I think they said they had $14 billion worth of design wins in 2024. Pretty big deal. And then gaming, although it's now a small percentage of the overall revenue, but an extra $500 million or an extra $1 billion in revenue for an AMD is quite a big deal, right? Compared to an Nvidia, an extra $1 billion, when you generate 40 billions a quarter, doesn't really move the needle much. But for an AMD, an extra $1 billion could be quite a big boost.
Yeah. So, Cherie Christensen asked about 9 months ago, what is up with TTD, the trade desk? E-Trade put out a notice of contact because of a securities fraud between May 9th and February 12th, 2025. To be quite honest, I haven't read much into that. Sometimes those are a big deal, and other times they're not a big deal. I think we have to wait and see how that affects things. It's something you should watch, because it could be negative, but a lot of times these don't turn out to be a big deal. So I think we just need to watch and wait on that one, in my opinion.
Yeah, I mean, I don't have E-Trade or anything like that, but I've also seen a lot of comments sometimes under my videos where people ask, oh, what about this lawsuit? And then I look it up. Is it a big lawsuit? Because sometimes we hear about this one lawyer takes a couple of shareholders, and then there is a lawsuit against a company because the stock went down 20-30% or so. Usually those are nothing burgers. Those are just scary headlines. But at the end of the day, nothing really big happens.
Yeah.
In the meantime, before if we find another good question we can answer, has there been any particular stock or stocks that you've been looking at closer in the last couple of weeks because they've been pulled back or something?
Well, like I said, I bought the trade desk early last week, or I added to my position because of the big drop. That was one that caught my eye. For the year, earlier in the year, I added Celsius stock. It had been down 75% because of inventory issues with their largest distributor, which is almost certainly PepsiCo. I don't know if they identified them directly, but there's not really anybody else it could be. I thought that was a bit of an overreaction, so I bought some, and since then they bought Alani Nu. So I think they kind of lead that. If there is a health segment of the energy drink industry, I think it's Celsius that leads it, even though it's technically third in the energy drink market. So it has risen in recent days. So that decision seems to have paid off well. And as I just mentioned, I also added some AMD a couple of weeks ago when it fell below 100 for the reasons we just mentioned.
Okay. On the Celsius side of things, that's interesting. I mean, the stock has been beating the market quite comfortably year to date, of course. But if you zoom out, not much. But what do you think? What would it take for the stock to start moving up more? Like it's now $32, $33 or so. What would it really take to move this stock back to a $40 or $50 eventually?
I think they need to ramp up faster internationally. I think in their last earnings report, international was about 7% of the revenue, but it was still growing at like 35% or around there, whereas the rest of the business was struggling with the inventory issue, the U.S. side. So I think as they ramp up more internationally, I think there's some opportunity to really grow, assuming they don't get bought out in the meantime, of course.
Yeah, I mean, I thought PepsiCo would have completed the acquisition. Like it would have just said, okay, we already invested in Celsius. Stock has been beaten down so much, valuation-wise, it might make sense. So we're buying the whole company when it was trading at $25 or something like that. Quite interesting that it didn't happen, and that actually Celsius acquired another player, another competitor, which of course should help them reaccelerate growth. So it's going to be quite interesting, especially as we lap those inventory issues year on year. maybe inventory issues are over and PepsiCo starts ordering back, and that should definitely help Celsius. But yeah, internationally they play for sure. But North America, USA revenue should start to reaccelerate, I think, before the markets react.
Yeah, I'm actually not as optimistic about the U.S. I think it will accelerate to a degree, but all of the other energy drink players, we're seeing some slowdowns too. So I'm not so optimistic about the U.S., but I think there is a future when you look beyond the USA.
Yeah. Okay. Do you like the drink?
I do like it. I still drink coffee and tea for the most part when I want a stimulant, but yeah, I do like it.
Okay. No, I mean that's important.
Yeah.
Let's see.
Well, this one I could touch on quickly. So Wade Tucker asked about 3 hours ago, will current politics get in the way of OTC, which I guess means over the counter, Kelly Partners Group from listing on a U.S. index? I'm not really seeing much politically that would prevent a company that wants to launch an IPO. I think the big problem with IPOs in general, that's not so much the politics. That companies tend to want to launch their IPOs during bull markets, so they get them out there during the bull market. Then the bull market quickly turns into a bear market, and suddenly that IPO stock doesn't look so good. So I think that's a worry. I don't know that the politics per se is a worry, though.
I don't follow that company, so
yeah,
can't add too much to that.
I don't either, but that's as far as I can answer that question.
There was, I can't provide that much information on that, but Build-A-Bear workshop, ticker symbol BBW. There was a question about that 7 hours ago from Full Fan St. Louis. Have any of you looked at and have feedback on Build-A-Bear? That has been a company that really surprised me, because let me just look up this stock. That stock in the last 5 years is up 2,500%. 2,500% for Build-A-Bear workshop. In the last year, it's up 33.10%. Year to date, it's down 11% or so. But when I first looked at Build-A-Bear a couple of years ago, actually in 2023, when it was around $20, I already looked at what happened since the pandemic lows. That was already up 1,200% for a company that I've known for a long time in my life. When I went to the States to visit, it was like a Build-A-Bear. Okay, great. I want to build my own bear. I never thought this was, one, a publicly traded company, and two, a stock that completely destroyed big tech returns, market returns in the last 5 years or so through very strategic growth levers. So, of course, you've got the stores. You've got the online segment for the company. They have now partnerships with a lot of IPs. So whatever you can think of, they will probably have a partnership with them. They also installed those types of vending machines, Build-A-Bear vending machines. That's also something new that I didn't know about before. But yeah, it's a company that's also quite profitable, buys back a lot of shares, and I was very surprised because my portfolio is heavy tech and growth, but I like to sometimes look at these other names that have really destroyed the market in 5 years, 10 years or so, and see what happened, especially a name that I am familiar with, like Build-A-Bear. I was, okay, that's quite interesting. I was sure that this company was never public, and two, maybe not that profitable, but it was the exact opposite. Very, very well-run company, and it's reflected in the stock price. So whoever owns it, congratulations.
And I have nothing to add on that one. So going back to Celsius, Chuck Wagon commented 2 minutes ago for Celsius, symbol CELH, Pepsi inventory lowered the price, maybe not enough for Pepsi to buy. As Neil was alluded to, apparently it wasn't enough. I still don't discount that possibility. I don't think they'll do it while they're trying to acquire Alani Nu, but after that acquisition is complete, I would put it on the table as a possibility again. Will it happen? Maybe, maybe not, but I don't think you could rule it out. It's still a good 2/3 or almost down from where it was last July. So it's still trading at a very significant discount. So it is very possible it will still happen.
There was this question from Stephen, apologies if I mispronounced that name, from four days ago about Arista Networks. So he purchased Arista on January 25th, down 35% since. Thoughts on Arista's future? Do you follow the company?
Not really. I have a little bit because it's come up a lot, but I'm not. I don't know it all that well. So
yeah, no. So Arista is an interesting company that definitely benefited from the capex, the build out of AI infrastructure, data centers, and all of that. If you believe that capex for data centers and AI factories, whatever you want to call them, is going to continue. Jensen last week during GTC said that, well, according to Deloro's projections, by 2028, capex worldwide for data center build out is above $1 trillion. Now, since Arista Network does play a very important role in data center build outs, more specifically when it comes to networking, network switches, you would assume that that's a company that would definitely benefit from it, especially through good connections with Meta, with Microsoft, for example. So short-term noise, I would say, as we've had in the last 2 months or so, could hurt a business like that, whether or not, big tech companies might slow down their build-out, might hurt Arista Network. But then if you actually look at the figures and the data and what these companies tell you, they're all continuing to grow, and AI infrastructure build-out continues as well. On the flip side, you might have more competition in the future. An Nvidia, for example, that could be a big competitor as well. But I think valuation-wise, right now, after the pullback, I think from the peak, it's now down 35% or so. It's not the cheapest name out there, but it's cheaper now than before. And they're still expecting to grow quite comfortably. Free cash flow margin is also quite high. I believe last time I checked was actually close to 50% or so. So pretty good company, well positioned as well. But you have to believe in the story. You have to believe in the AI story. If you do not believe in that, then Arista Network is definitely not a name that I would pick. Same with the other players, right? For an Nvidia to work out in the future, you have to believe that AI growth will continue.
So Rita asked about 45 minutes ago, the intended move of student loans from the Department of Education to the SBA, what impact will that have on loan servicers? Thank you. I don't know for sure, but I would expect very little. The government's still going to make student loans. They're still going to collect the revenue from the existing student loans. I don't really see it changing from that standpoint. So I really wouldn't expect any changes just because the department administering it has changed. Everything's still going to be the same as far as I can tell.
By the way, do you own any fintech names?
I own some international fintech names. New Holdings, Mercado Libre, and C Limited. I pretty much gave up on American fintech a couple of years ago when I found myself using Apple Pay all the time, and Apple Pay is too small of a part of Apple to make that investable. So it kind of told me that the American fintech was running out of new ideas to give customers more ways to pay. I don't think there's really a shortage of that. So I think that there's more opportunity internationally where a lot of customers are still using cash exclusively. So I see the opportunity there.
Okay, I mean I own Mercado Libre. I used to own Nu, and I wanted to buy back, but I consolidated everything into Mercado Libre. If you had to rank those international players, Mercado Libre, New Holdings, or NC Limited, how would you structure that podium?
Right now, I would go C Limited, Mercado Libre, new holdings. All things being equal, I'd probably pick Mercado Libre, but the valuation is much higher than it is for C Limited, so there might be more relative opportunity with C Limited. New holdings, I'm intrigued by, so I do have some shares. I think it's still too tied to Brazil, but I still see a bright future there. So because of that Brazil risk, it is a little bit more risky, but I like I said, I see a bright future. I think they're going to go into another country soon, and they're already growing fast in Mexico and Colombia. So I think that should continue to perform well for the foreseeable future.
Interesting. What makes C Limited so attractive today? I mean, there was a period where, of course, it didn't grow that fast anymore. It wasn't even profitable. And now we actually see that it can grow and become more and more profitable. Is that the reason?
Well, I think the fintech part of it was always strong. On the e-commerce side, they went into all these markets where they had no competitive advantage. They had to quickly pull out of those. And I think they finally came to their senses. So now they're investing heavily in logistics in Southeast Asia, where they are the leader. On the gaming side, I think that was the pandemic, where the pandemic front loaded a lot of the growth, and so that they suffered when that ended. Then their big game Free Fire was banned in India. They still have not gotten that back. Everyone says they're on the verge of returning Free Fire to India. It never quite happens, but I think that segment's finally growing again, and with that, the stock has started to go up.
Okay, no, interesting. Yeah, the concentration in Brazil is definitely something to look out for. Although last quarter, what was interesting was the fact that they said that they have plans to expand like outside of their core market, and that was something that the market, the Wall Street, didn't really like that much, because, well, usually when companies are quite strong in their core markets and suddenly they feel very comfortable growing elsewhere, usually that doesn't really work out, and that's probably why Wall Street was like, are you sure you want to do that? How much of the resources are you going to allocate towards expanding elsewhere? But I mean, it makes sense, right? When you are very popular already in Brazil and in the other markets that they're growing in, to start thinking about maybe expanding a little bit more. And they explained it during the earnings call that, look, we're still going to concentrate the majority of our resources in the core markets, but yeah, we are thinking about expanding, which makes sense. You as a shareholder, what did you feel about all of these comments?
I wasn't put off, but I think you make a good point. It kind of depends on where they expand. If they just go into another Latin American country like a Peru or an Argentina, I think that would probably be positive. If they went, to a different country or a developed world country, might be a little bit more skeptical. So I'm going to reserve judgment until I actually hear more about that part of the plan.
Okay, no, fair enough.
So I think Bestie's had a question on Garmin. I'm going to be talking about that in the next hour with Rachel, so I'll answer that question at that time. There was one I was wanting to cover, and I can't find now.
There was this. I'm also looking for that comment. I'm sure I can find it. Or maybe this one could be an interesting one. Sina New York as best stocks and ETFs to buy after 3 to 5 cocktails. I would assume even without the cocktails, maybe if you have a selection of stocks and ETF that you like.
Probably my favorite ETF is SMH. That's the Van Semiconductor Holdings. I mean, it began in 2011. It basically owns the top 26 semiconductor companies with probably about how much? Maybe 40% of it is Nvidia, TSMC, and Broadcom. But through up cycles and down cycles, it is roughly double the performance of the S&P 500. So if you're willing to take a little bit more risk than the S&P 500, and I don't think it's that much more risk, quite frankly. I think that's a good way to go. That's probably, I don't follow ETFs all that often, but that's the one that always catches my eye.
Yeah, no, I agree. I think I was actually about to say the exact same ETF, since we've been talking a lot about semiconductors in the last couple of weeks. The other one is probably the classic one, the VOO one, just to follow the S&P 500 classic. And if you want, of course, there are specific ETFs that follow specific industries, just like we just mentioned. One that follows the semiconductor industry. I believe there's also a cloud ETF, but I can't seem to remember the ticker symbol for that. So let me check and search that real quick. Okay, so it's the Wisdom Tree Cloud Computing Fund, so WCLD. That's one that gives you exposure to various cloud players, software players, especially. I'll see if we can find the holdings for that one.
I don't know if you'd be doing this after 3 to 5 cocktails, though. That's
yeah. I mean, 3 to 5.
A little bit more concentration.
Yeah, no, for sure. So it's more. I mean, the top 10. It says here the top 10 is around 16% of total assets. So you have Elastic, DigitalOcean, Twilio, Workday, Wix, Toast. These types of names in that. I would have assumed that you will have cloud names, like big cloud players in that list, but apparently I was wrong.
So, to be honest, I think this question might have been answered in the last hour, but I'll touch on it just in case to give my own opinion. Paul SF asks, how much longer will broad high valuation irrationality mock my growing barrels of dry powder? That's a good question. The short answer is I don't know. Will it come down eventually? Probably so, because it always has. But sometimes these bull markets can go on and on and on, and these companies can maintain high valuations for months or even sometimes years. So and you look at some of these businesses like Nvidia. Of course, the growth level is slowing down a little bit because it was so high before. But I don't see demand in AI accelerators falling off, for example. So I mean that business could keep going on, even though it is highly valued if you look at it from a certain point of view. So I always tell people that I'm a poor timer. I think I'm going to be a poor timer when it comes to this too. All I can tell you is it will happen eventually. We'll just a question of when.
No, I agree. I mean, I think yesterday we also had a very interesting question talking about when will value stocks get more respect, and when will growth stocks, those that are highly valued, come down even more. Even though there are definitely a lot of growth stocks that look way more attractive today than they did 2 months or so. Then for value stocks, it's always value stocks usually don't really get that high of a multiple unless they prove the market wrong, right? They suddenly reaccelerate growth, margin expansion, and all of that. For growth stocks, it's much easier to get that, because when you're growing 20-25% or so, high margin business, you might have a slowdown, but suddenly a quarter you reaccelerate. Usually the market gets excited and you get that boost. Now, like you said, when will that happen? We don't know, but it is a question of when, not if.
Yeah. So we only have about 1 minute left.
So I guess I can ask you, if it's just one, I can ask you, what was the best earnings report you had or you've seen this past earnings season?
No, that's a good one, because there were so many. Put me on the spot here.
Or one that surprised you, maybe. That's one better.
Well, the surprise definitely was the trade desk. To lose more than half its value just because of that slight revenue miss. I think that one was the one that caught me most off guard.
Okay, no, fair enough. Fair enough. I think mine would be probably an Nvidia. I mean, traders definitely, but Nvidia as well. Like good quarter. Yet the stock didn't move, and then it actually went down. I was like, okay, if that's a quarter where you go down, imagine if it's a bad quarter, how much more of a hit you would see if you miss. So it was a very interesting earnings season. Plenty of surprises, definitely.
Yeah,
We'll see what happens.
In Nvidia's case, I just don't think you can keep surprising to the extent they were. It's just impossible to keep that up. So even though it's growing very fast, the growth rate is decelerating. I'm a little bit negative in the short term on Nvidia for that reason, but because of how the market typically treats stocks that do that. But we'll see on that one. And with that, I think we're at time. So I'm going to bid Neil farewell, and we're going to bring on Rachel, and we're going to do another hour on sports and related stocks.
Oh, sports. That's interesting. So I'll keep watching in the background.
Yeah.
Have fun, guys, and see you the next time.
Well, on Neil.
Thanks, Neil. Hey, Will. How's it going?
I'm doing well. How are you, Rachel?
Doing all right. Well, this should be a fun hour talking about, we kind of kept the theme pretty broad because there's so many stocks that can sort of fit under this umbrella of sports stocks, tech fitness stocks, athleisure stocks. That was kind of the mindset that I had in mind when we were discussing this. But Fools, if you have any questions kind of related to this general theme that we've set up or any other questions, we'll do our best to answer. Go ahead and get those in the Slido. The event code for that is Fool24. Well, I'm curious, as we were kind of coming up with this theme, I know we both had kind of different angles that we approached this with. What's maybe, I guess to start off, I think we each probably have a few companies we want to talk about. What's maybe a company that you're thinking of or looking at right now as we get into the tail end of earnings season that sort of aligns with this theme?
Yeah, that's a good question because I focus more on the tech fitness side of it. But you look at tech fitness. Yeah, Fitbit was bought out by Alphabet, and then Apple has done some of their own research here. Unfortunately, the fitness parts of those businesses are really too small to affect the stock price one way or the other. So I didn't really want to focus on those. One I chose to focus on is Garmin. If you look at Garmin, you can see it's pretty significantly beaten the market, especially since about the November timeframe when it announced that I guess that would be two earnings reports ago that really set the stock flying high. Unlike this most recent earnings, that actually held on to those gains. But Garmin's been kind of an interesting company because it started out making GPSs. You would see back in the mid 2000s, I would say you'd see people with GPS systems mounted on their cars, and that came to a screeching halt when the iPhone came out, and GPS was simply one app on the iPhone, and that kind of destroyed that business. So it sounds like something that might have destroyed the business. And I was in Garmin stock, by the way, back then. I got a little pessimistic about it when I saw the business change so much. But to my surprise, they have made an eventual comeback, and they diversified into areas that a smartphone doesn't copy so easily. I guess kind of fitness may be the exception because Apple and Google and such have developed fitness products, but they've developed products for outdoor, for marine, for boating, for aviation, the auto OEM, which is kind of a system for automobiles. So in a way, they are getting back into that GPS, but with a different approach. So overall, in 2024, they grew the revenue by 20%. Net income grew by only 9%. That's not as bad as it looks, actually. They received an income tax benefit in 2023, which substantially boosted their net income in that year. So when 2024 came around and they actually had to pay income taxes again, that hurt the company a little bit. But you have to have a revenue outlook. It is going to slow a little bit, or they expect it to slow anyway to about 8% this year. We'll see how that pans out as the year goes by. But you see pretty strong growth, and next to auto OEM anyway, fitness is its strongest growing segment at 32%. And as you can see, the stock has been going up. It finally got back to its 2006 or 2007 high in the 2020. So that it has achieved its record high in the last year. Despite that, its PE ratio is 29, which is a little high, but not crazy, not crazy high. So it has improved in that in that way. You got rising watch sales. You have a dividend rising now 360 per share annually with a 1.7 yield. The S&P 500 yields between 1.3 and 1.4% now, so slightly above average. And with a 20% dividend increase, assuming that passes, that's going to be even more. A little bit of concern with a soft auto market. And, product launch timing, market headwinds. That's likely why they're expecting slowing growth with this stock. But I think it's still, if it still grows by revenue by 8%, net income should grow by much faster. So for that reason, I think the 29 PE is at least a fair valuation, and I think this is going to continue growing for some time to come with all the segments they're involved in and how fast a lot of those are growing.
Yeah, that's a really interesting business. And it's certainly been kind of a fascinating one to watch, I think, over the last few years. And it has been a pretty faithful dividend payer as well, as you noted. One company I was thinking about looking at this space, there's a couple maybe I'll talk about here. I talk a lot about, athleisure related businesses, got a lot of questions on Nike recently. So I kind of wanted to expand on that theme. One company that we tend to get a lot of questions about in adjacent territory to that is On Holdings, right? This is a company based out of Switzerland. They currently are doing exceptionally well in their space and have been really building on a track record of really superior growth over the years. They have just to give an idea of the scale of the company, this is a company with a market cap of about 15.5 billion at the time of this recording. The stock trades for about $48 a share. Shares are up about 40% over the last year, notably outpacing that of rivals like Nike. On Holding, they make money in a few ways, but primarily by developing and distributing sports products, athletic footwear, apparel, accessories. They have a wide variety of channels through which they do this, including independent retailers, global distributors, high-end stores, and their own, online presence. Their core revenue stream comes from selling sports products and particularly their footwear to consumers around the world. And they really focus on high performance running, outdoor training, all day activities, and tennis, targeting very specific segments of the athletic market. Their goal is to be one of the fastest growing athletic sports companies in the world. They have continued to make bets on high profile partnerships to boost their profits over the long run. And they have been growing at a rapid clip. But obviously there have been, issues, as is true with any of these businesses. They do trade at a pretty steep valuation as well right now, which is worth noting if this is a business that you're looking at. They're known specifically for their running shoe brand On, which is known for its cloud tech cushioning system and is also, their sponsorships of athletes like Roger Federer is one notable athlete that they have worked with for a number of years. On Running is their flagship brand. That's where, again, they're specializing in running shoes and apparel. Their cloud tech is this unique cushioning system that provides a, quote, running on the clouds experience. Clean Cloud is another proprietary technology of theirs that turns carbon emissions into running shoes. There's even the On Athletics Club, which is a professional running group that was founded and is sponsored by On. They're obviously a competitor to brands like Hoka, owned by Deckers, Nike, as well as many of the other businesses that we talk about in this space. And their success has really stemmed from a very innovative product line, particularly as it pertains to their running shoes, having a very strong focus on athleisure. Their shoes, which are known for their unique feel. This feeling of running on the clouds, so to speak, has been something that has helped to differentiate them in a very competitive athletic footwear market. They've also had collaborations with high-profile figures like Zendaya for one of their campaigns, to name another one. But they have seen significant growth in their core markets of the USA and Europe, but they're also rapidly expanding into the APAC region. They have plans to invest in retail and e-commerce in China, as well as other Asian countries. And they have continued to expand in a really effective way while also demonstrating really strong revenue and earnings growth. And this is something that, with these types of businesses that are in a real growth stage of their expansion, sometimes you see these companies that then sacrifice profitability for growth. And that has not been the case with this one. They have broken into the top 5 running brands in major markets, including the US, and Germany, and in Japan. So there's been a lot of excitement around the stock. But understandably, there's also been a lot of really good things happening with the business. And one of the critiques, I've talked a lot about Nike over the last couple of weeks, and particularly since they reported earnings last week. One of the critiques about businesses like Nike has been the ways in which that is a business that has relied a lot on older products, and the success of that maybe for newer generations rather than innovating lines pretty consistently. And On Holdings is, I think, an example of one of numerous companies that has really eaten into Nike's market share, and is doing so while maintaining their very own unique brand and value proposition to the end consumer. Now, they reported their results for 2024 earlier this month, just to kind of give an idea of how they're doing. Their net sales came in at about 2.3 billion Swiss francs. That was a 30% year-over-year increase. They also achieved a gross profit margin of 61%, net income of about 242 million Swiss francs, an adjusted EBITDA margin of 16.7%. They also closed out the year with about 1 billion Swiss francs in cash on hand, which is something notable as well. In Q4 alone, their net sales grew about 36% year over year. They continue to have a lot of success through just a robust omni-channel experience that they offer. So their e-commerce business and then their global retail stores and partnerships. Their direct-to-consumer share of net sales was 48.8% as of the end of the year. And they also achieved the highest gross profit margin in Q4 in the company's history. And that was a figure that came in at 62.1%. They're also forecasting pretty robust growth for the full year. And they achieved, numerous milestones last year as well. They unveiled their new light spray technology. They expanded their global retail footprint to nearly 50 owned stores. And then they also surpassed 100 million Swiss francs in apparel net sales, because that's an area that they have been working to really expand more into, moving beyond footwear, but also into making apparel a bigger part of the business in the long run. It's the 15th anniversary of the business. This is a much newer brand than the likes of Nike, but it's interesting to see how companies like this are doing as we kind of see the evolving world of sports retailers and athleisure businesses. This is certainly a company that's doing really well. They do also, which I find really interesting, they break down their sales by region. So their net sales in the EMEA region, so Europe, Middle East, and Africa, and then as well, the Americas and Asia Pacific increased by 18% in 2024 compared to fiscal 2023. They also noted that their net sales from shoes increased about 28%, apparel about 46%, and accessories by about 50% last year. So shoes are still the biggest part of the business by far, but they are expanding into apparel and accessories, and that is one of the newer and fastest growing areas of the business. So a lot to watch with this one. Interesting company, one I've found myself a little more interested in recently, and the one that I'm continuing to follow pretty closely, particularly as it pertains to this space.
Yeah, it's not often you see technological innovation in the athleisure space. As you can probably figure out, Rachel's doing most of the athleisure stocks in this segment. That's not really my area of expertise, because I don't read the competitive advantages as well in that segment personally, so I don't follow it as much. But it really is fascinating that you can still find some areas of innovation where you can build a competitive advantage in this space.
Yeah, absolutely. Maybe I could talk real quick about Lululemon. I mean, I've been talking about that business a lot in recent days, but it feels wrong to talk about athleisure stocks without talking about Lululemon. And then I'll kick it back over to you, Will. I know you had some other thoughts to share as well. Lululemon is also reporting their earnings this week. So this is a company I'm sure we'll be coming back to a few times. But they're one of the biggest things to watch with this. I mean, they've been known for a long time for, their athleisure and athletic apparel for women, as well as footwear, but expanding into new markets, as well as expanding their menswear categories and brands has been something that's been really key to their growth strategy in these last years and moving forward. They had initially launched this growth strategy back in 2019 called the Power of Three, that focused on numerous kind of key areas of innovation in terms of products, which partly included the goal to double their men's revenues, their omni-channel guest experience, as well as expanding, internationally. They achieved those goals and then introduced a newer strategy called the Power of 3 times 2. That essentially involved, doubling the men's and digital's revenues, and then as well as achieving other, international growth goals by 2026. So we're sort of getting to the tail end of that period, and that's something that they have been, doing a really good job of moving ever closer to. Part of that 5-year growth plan was to double their revenue between 2021 and 2026 to $12.5 billion. And that, again, seems something like they are well poised to achieve based on the results that they have been reporting recently. They've also continued to do a really good job of expanding internationally. Their expansion in Europe has been a huge part of their overall growth goals. And it's also worth noting that they have, introduced a series of region-specific e-commerce sites or country-specific e-commerce sites. That's been also part of their international expansion that has been really successful for them. The most kind of recent update we had from them was actually in January when at the ICR conference, and Lululemon released updated guidance for the upcoming fiscal period. And again, they report their results, I believe it's on Thursday of this week, if memory serves correctly. But they, at the time of that release, they had previously been projecting a decrease in their gross margin. They updated their guidance to factor in actually that they expect an increase of 30 basis points in their Q4 gross margin. They also elevated their revenue guidance and their diluted earnings per share guidance, both in upwards direction. And so that was something that I think was notable for the stock. In terms of how they've been doing recently as a business, you could look back to their results in the third quarter of 2024. Net revenue grew 9% year over year to about $2.4 billion. International net revenue is their fastest growing business. That's also their least mature business. So international net revenue increased 33%. America's net revenue increased 2%. They saw a slight decrease in America's comparable sales, but that was offset by a 25% increase in comparable sales internationally. They also reported that their income from operations increased about 45% year over year. Their operating margin increased by about 520 basis points. They also added 28 new company-operated stores during the third quarter alone, including 14 company-operated stores from the acquisition of Mexico operations. So they ended the quarter with 749 stores around the world. And they also had about $1.2 billion in cash and cash equivalents on their balance sheet when they finished out the period. So this is another one of the businesses in the space that I really like. I think that this is a company that is in a real stretch of growth, and that's something they've been, heavily focusing on. The market has obviously not been particularly kind to the stock in the last year or so. Shares are down double digits, although the stock is up about 27% over the last 6 months. I think the market has big concern, broadly speaking, about just how impacts, of consumer spending might lead to this business seeing a slowdown in growth if recessionary headwinds were to, take place. I think also there's been maybe some concern that some of their growth figures have decelerated. I would say this is a business that is maturing. It's at a much more significant and mature stage of its growth story than it was several years ago. I think that they have realized a lot of the growth within, the Americas region. I think that's something because they have a very mature presence here. And I think that's an area that they still have opportunity in, but broadly speaking, their international expansion, I think, is really what's key to their growth over the next 5-10 years and beyond. So that's been something that has been really interesting for me to watch, and that I will be watching particularly closely any comments from management in their earnings call later this week with regards to that part of their long-term growth strategy.
Yes. So before I go to the next company, I promised Bessie's in the last hour I would get to his Garmin question. So Bessie's asked, at the marina, I've noticed several Garmin radar and sonar systems on boats. How significant is this segment within Garmin's overall business? Garmin earned about $6 billion in revenue. I think $6.1 billion in 2024. The marine part was just over $1 billion. So you're talking roughly 1/6 of the company. And it happened to grow by about 17% year over year in revenue. The overall company grew 20%. So yeah, it's more or less following in line with the performance of the company. But yeah, I think this is one of its stronger segments. I think this is one of its first after Garmin remade itself after the collapse of the GPS business. So this is a way they could do the same thing without a smartphone app competing with them. So I think this is one key part of the business. But I think it's kind of 5 segments is about 1/6 of the business is the short answer. So with that, I'm going to move on to Peloton. Honestly, Peloton is not one I like as much as Garmin. This was a high flying stock, earlier in the decade. A lot of fools were in it. I was one of the few fools that didn't buy it and later get burned on it. I got burned on a lot of other stocks, which is a different story. But this is one I think that captured people's imaginations because it combined exercise equipment with a subscription segment that would monitor one's exercise. It would offer classes online, so on and so forth. And I think that combined offering gave it a competitive advantage for a while. Unfortunately, it looks to be like a flash in the pan compared to then. It's down 96% from its 2020 high, despite the fact that it did significantly outperform the market over the last year. So, it seems to be falling in popularity. That slide seems to continue. Revenue was down 9% in its latest quarter. Net income was up 53%. That was just about all cost cutting on its operations, more than it was improvement in the business. So I'm not really sure how sustainable that growth is. And they expect a further deceleration in the next quarter, down 14%. Membership was down a little bit. Connected fitness memberships were down. Like I said, they're cutting expenses to boost themselves. They still have positive cash flow. Still spending a lot on stock-based compensation, and I admit that was the reason it didn't earn a positive net income in the last quarter. But with the decelerating business, I'm still a little bit concerned. The PS ratio is only 1, which looks cheap, but it does not have a PE ratio or a forward PE ratio due to the ongoing losses, which I guess that can be okay for some growth stocks, but does make me a little bit uneasy with the other financials here. So, but the price to sales ratio is down to 1, which is cheap for a stock like this. But with revenue growth remaining negative, growth prospects are uncertain. I don't see a scenario where it ever recaptures that high in 2020. Now, they can always come up with some new technology that captures the market's imagination. Maybe then it comes up, but I just don't see anything obvious on the radar that would accomplish that. So this is one sports stock I'm not really bullish on personally.
Yeah, I remember a lot of conversations about Peloton several years back, and it has been unfortunate to see the ways in which that business has struggled so much over the last several years, and some of it for very easily identifiable reasons. But it is certainly a company that they're in the midst of, I think, what is for their part a multi-year, hopefully, turnaround. Still unclear to me what the outcome of that is going to be over the long run.
Yes.
Maybe there's one more company I'll touch on as we're kind of in this space, and then we can look through and see if there's some questions even from earlier today that we can get to. But we've talked a lot about Nike, and obviously they're in the midst of their turnaround story. And I still have said this is a brand and a company that I think can execute on that over the long run, but I think it's going to be a very bumpy few years. I think On Holdings is an example of a company that's younger, is doing really well right now, and is going to have to continue growing very intentionally and carefully to not get ahead of themselves, but is doing exceptionally well. At this point, I think Lululemon is an example of another business that I find really intriguing in this space. But speaking of companies that are struggling, and there's others, Under Armour is one that's had a tough time of late. They are a company that has dealt with issues, yielding market share. Obviously, despite its operational struggles, Nike is still a major player in this space. There are others. Adidas is another one, but they have significant market share, very strong brand loyalty, and that's made it very difficult for businesses like Under Armour to gain traction. That's a business that is trading down significantly from its all-time highs, which are at this point, I believe, close to a decade ago. And despite being very popular with a lot of well-known celebrity athletes, as we often see Under Armour's brand logo represented and easily recognizable. The business itself has been struggling, and they've also been dealing with, the rise of newer athletic wear brands like Skims. Alo Yoga is another one, Hoka, obviously, and that's really intensified competition in the athletic apparel market. And Under Armour, I think, has struggled to define its unique position in the market. That's maybe led to a perception of them being more of a generic brand. They've been dealing with declining sales, slowing revenue growth. They have had problems with overstocking, and that's led to deep discounts. And obviously that can have a negative impact on growth as well as just the image of the brand. They've been relying a lot on promotions to drive their sales, and that's also really eroded their margins. They've been dealing with restructuring plans, including layoffs and the closure of distribution centers to address some of these cost issues. They've had some major turnover in key leadership positions, including the CEO role. And they've also struggled to kind of effectively compete in the digital marketing space, where younger consumers are more likely to shop online, despite the fact that they do have a lot of optionality in terms of an in-person presence. Under Armour's earnings have certainly disappointed in recent quarters, and they did announce a fairly grim outlook for their fiscal 2025. And again, there is short-term, at least to be expected, pain from their restructuring plan that they've been enacting. And then there was the surprise departure of CEO Stephanie Lennartz and the return of founder Kevin Plank as CEO. There was, these were interpreted, I think, by many as signs that the company's turnaround was not perhaps proceeding as planned. So there's a lot going on with this business right now. It hasn't necessarily been the best time if you are a shareholder of this company. And they are continuing to struggle, I think, for a lot of the reasons that I mentioned. And the most recent financial results we have for them were in Q3 of their fiscal 2025. Revenue was down 6% overall, down 8% in North America, despite a 5% increase in revenue in the EMEA region. This was also offset by a 5% decrease in revenue in the Asia Pacific and a 16% decrease in their revenues in Latin America. They also saw a decline in their apparel revenue, as well as a slight decline in wholesale revenue. Again, they're reporting some major restructuring charges. They are still technically profitable. They reported net income of just around $1 million, though. So that's pretty slim at this point. They did announce that they were repurchasing about 25 million of Class C common stock in Q3, retiring about 2.8 million shares. By the end of 2024, 8.7 million shares had been repurchased for 65 million as part of a 3-year, 500 million program that the board of directors had approved in May 2024. May of 2024 was also when they announced their restructuring plan that I alluded to earlier, which is designed to improve their financial and operational efficiencies. And as mentioned, they also in September, they disclosed additional restructuring actions, including closing one of their big distribution centers in California. For the entire fiscal year, they're expecting their revenue will decline about 10%. They are expecting a slight increase in their gross margin and the amount of about 160 basis points. They are forecasting that they will finish out the year with an operating loss. And again, capital expenditures are expected to be about 170 to 180 million. That is a bit lower than the 190 to 210 million that they previously forecast. So a rough time for this business. I think that you could look at this space, and we've talked about a few. I didn't want to get into Nike because I've spent so much time in recent days talking about it. I'm sure that there's been a lot of coverage there. But when we look at this space, Nike, I think, is a solid business on the fundamentals. Financially, they are dealing with just really, declining growth figures right now as they're in the midst of this turnaround. I think they have a lot to prove to investors. But I tend to think that the company and the business over the long run can prevail. I look at companies like On Holdings and Lululemon. They seem to have carved out really successful niches for themselves within this industry. And then you look at, a business like Under Armour that at least for now is in a really difficult stage for the business. And certainly, Nike is in a difficult spot. They're an older business. I think in many ways they are a more well poised to recover in the future. But I think it also goes to show that this is a highly competitive space, and consumer changes in consumer sentiment and simply the dominance of established market players can make it very difficult for some of these businesses to succeed over the long run. And so it's a highly dynamic space. And there's a lot of shifting movements that we're seeing right now in terms of how these companies are doing. But I think that there's a few that might not, necessarily be here 10 to 15 years from now. And I think quite a few of these names we've talked about have a lot of room to run over the long term. So it's an interesting space to evaluate as a consumer and as an investor.
Yeah, you just, like I was saying, you see a lot of these competitive advantages, and they're just very tenuous in the athleisure industry. You have to compete on quality. You have to keep in style, and I think a big part of it too is you have to keep your marketing up to date. I think a lot of these depend on good marketing. So if your marketing slips, it could be very bad. It might be a death blow for some of these businesses. Nike, I don't know that it would be a death blow necessarily, but Nike's been struggling because they made that strategic mistake by going all online, and they've been trying to get back to that and haven't quite succeeded. like I said, I don't know that Nike will be taken out necessarily, but I'm not so optimistic that it's going to be a great growth story going forward. But yeah, Neil and I were discussing this a little bit in the last hour. As I said then, I think time will tell there.
I think that's right. And yeah, one of their biggest issues was they kind of went completely to this direct to consumer model and really cut out a lot of the established relationships they'd had with their long-standing wholesale partners. And not only was that not great for the business, really cut out a valuable area of growth for them, but that also gave an opportunity for some of these other players to come in and cement their own partnerships. And now that's something that Nike's working to sort of claw back ground with. And so I think there's a lot that's happening with these businesses, but yeah, I agree with Nike. It's going to be, at least for the near future, I think it's going to be an uphill battle for them.
Yes. So, as usual, we are accepting questions. I didn't say the reminder earlier, but for those of you just joining us, you can ask questions on Slido that's slido.com, and the code is Fool24.
I was looking through here because we have a lot of questions as well from earlier, and some of these are tickers I know, and some of them I'm not as familiar with, but it's still, fun to try to answer what we are able to. Let's see. There's this one question that had come in. I don't know all of these tickers, so I would only be able to answer about a couple of these. But Besties had asked about 5 hours ago, Battle Royal best one now, and listed off a bunch of tickers, CRM, VEV, which is for Viva Systems now, I believe Monday, Datadog, and Snowflake. Viva Systems is one that I know. This is actually a really interesting business that I feel like I don't get a lot of questions about, and maybe not as many investors know about it either. But it's kind of a fascinating company. If you're not familiar with what Viva Systems is or what they do, they are a cloud-based software company. They provide solutions for the life sciences industry specifically. They offer a range of software, data, and services, including CRM, content management, data analytics, but they focus specifically their software as a service platform on the needs of pharmaceutical, biotech, and other life sciences companies. And their solutions are really designed to effectively address the unique challenges and regulatory requirements of the life sciences industry. So, for example, their Viva Vault CRM helps companies do everything from manage customer interactions to sales processes to field engagement. Their Viva Vault content management helps companies manage and organize regulated content and ensure compliance and efficiency. They have solutions that help pharma and biotech companies support the digitalization of clinical trials, streamlining those processes as well. And so essentially their solutions are really designed to help these healthcare organizations meet regulatory requirements, maintain compliance, and take care of everything from designing clinical trials to running clinical trials to preparing to commercialize a new drug, to marketing that drug. Their solutions include everything like commercial operations, clinical trials, quality management, regulatory affairs. And they work with very large pharmaceutical companies and biotech businesses, as well as smaller life sciences organizations. So it's a really interesting business, and it is one of the few, software as a service businesses you'll find that is also kind of a unique play on the healthcare space, because that is essentially what they focus on, in their entirety. And to give you an idea of just how they're doing, from a business perspective, in their most recent report was for, so what we would say fiscal 2024, they reported as their fiscal 2025. And that period ended for them on January 31st. Total revenues in that year were 2.8 billion. That was a 16% year-over-year increase. 2.3 billion of that 2.8 billion total was subscription services revenue. That was also a 20% year-over-year increase. This is a company that has been habitually profitable through the years. They reported net income of about 714 million in their fiscal 2025. That was up 36% compared to the prior year. Operating income was about 691 million. That was up 61% year over year. They also finished with a really strong rate of customer growth. They had a total of 1,477 customers, including, as they say, from the top 20 biopharmas to emerging biotechs. And they continue to add new customers as well into their cohort of products that are designed around things like, drug development, ensuring clinical regulatory safety and quality. So that's one business from that list I really like. Probably one of the only other ones on there that I know really well is Monday.com. They have their subscription-based model, different plans and features and tiers for project management and workflow automation tools. It's a low-code, no-code platform, and developers can also create and sell apps on Monday.com's marketplace, which really allows users to extend the platform's functionality. So this is another classic software as a service business. And they also have been doing a really good job of improving their growth, growing their cohorts of customers. And I think overall just improving their profitability as a business. I think they're still operating at an operating loss under GAAP, but they've been shrinking it significantly. Their revenue was just shy of 1 billion in their most recent fiscal year. And they are free cash flow positive, which is something that I think is worth noting, particularly for these software as a service businesses that are, the way in which they derive revenue in their model. Free cash flow is one important metric to consider in terms of looking at profitability. They also have a really fantastic net dollar retention rate. It's like 112%, I think, in their most recent report, which is pretty notable. And the one final thing I'll say with them as well is that they continue to do a really good job of growing their customers with high recurring, annual recurring revenue, and growing these higher paying enterprise customers at a really, really rapid clip. So their number of paid customers with more than 100,000 in annual recurring revenue was up 45% in 2024 compared to 2023. So interesting business. I'd say probably of these, because I only know a couple of these tickers, Viva Systems and Money.com are probably the ones I'm most interested in from this list.
Yeah, I like Rachel. I don't follow most of these companies. I was following Datadog, DGOG a little bit because I was fascinated by their IT dashboard. Unfortunately, more IT companies are building their own dashboards, so I don't think it's been performing quite as well as the competition has heated up. One I've been fascinated by, and I do own some shares of, is Snowflake. For those of you who don't know Snowflake, they are a data cloud and analytics company. So they do data storage in the cloud. So this provides a lot of competitive advantages over traditional data storage, which was on servers, took place in data silos. Snowflake consolidated that in the cloud, and made it possible to perform analytics on the data. So it became a valuable tool for that reason. I think investors kind of soured on it around the 2022 timeframe. As you know, there was a bear market at that time, but also the valuation was extremely high, and I guess there was a perception it wasn't doing as much in AI. And to address that, in early 2024, they replaced their CEO with a guy named Sridhar Ramaswamy. He was more of an AI expert. It seemed to pay off slowly for the stock. It still has struggled a bit, but it is off its lows now. It's a different kind of business too, because unlike some of these subscription businesses, you pay by usage rather than just having a subscription to a platform. For that reason, it's net revenue retention, which is how much long-term customers spend this year versus last year. That was at 126%. So customers were spending 26% more on the platform in this latest quarter than they were a year ago. But the company grew product revenue by 28%. So not as strong as it has been, but still fairly strong revenue growth. It does continue to report losses. The stock-based compensation has been rather high with the stock, so I think some investors have soured on it. For that reason. It lost, amid total revenue of 3.6 billion. Product revenue is most of it, but it has other sources of revenue as well. So amid that, that was up from 2.8 billion in the previous year, but the losses were just under 1.3 billion for this last fiscal year. The losses came in at 836 million in the previous quarter. But if you look at stock-based compensation, stock-based compensation was nearly 1.5 billion. So it is very high. It is the reason that Snowflake is running a net loss now. But the free cash flow for the fourth quarter was 415 million, up 4%. For the year, it was at 884 million, which grew 24%. So it is growing free cash flow at a fairly rapid clip. So I think that means it's doing better than those financials might indicate, as it is at least operationally profitable. But this is a leader in this niche of the cloud, the data cloud. I think now that it's incorporating more AI into its product, I think that the stock's going to improve over time. Looking at the performance of the stock, sorry, I'm having a little bit of technical difficulty on that, but it is up a bit over the last year. And the PE rate. Let's see. Looking at the financials, you're looking at a forward PE ratio of about 145, which is very high, but it also indicates it is nearing profitability. Price to sales ratio, it's 15. Again, not a low multiple, but much less than it had been. Unfortunately, my information is coming in a little bit slowly, so I don't have that past number like I'd like. But that is way down from where it has been. Now, I think it really is starting to look intriguing at these levels. So yeah, I only know two of these, but the two I like, I prefer Snowflake here. So about 8 hours ago, I need input ask Jim, but I'll take it. What do you think of the current valuation for Murphy USA symbol, MUSA, and NNI at current levels for a long-term or at least decade buy hold? I don't follow NNI, which is Nelnet, so I'm not going to comment on that. Murphy USA has been intriguing because it pretty much started off as Walmart's gas station, for lack of a better way to put it. It has since diversified into gas stations away from Walmart, and they're doing more convenience store business. They recently acquired a convenience store chain, so it has been a fairly fast growing stock. Unfortunately, its valuation has gone up along with that. It's trading at 18 times earnings, which that is below the S&P 500 average but for a stock in this industry that is a little bit high, as it is not that fast growth of a stock. They're looking at current year growth of 5% for net income, so it's not the fastest growth stock. So 18 times earnings for that kind of growth, it's not hugely pricey, obviously, but it's a little bit more than I want to pay. A few years ago, it was trading at under 10 times earnings. So I kind of think it's a fairly valued stock here. I think someone who bought it would do okay. It is growing slowly. They are expanding. I think it's a pretty solid business. As a stock, I'm not all that excited about it, though, to be honest.
There was a question that had come in from LY winners win. Rachel, are you happy with the changes made to date by Starbucks' new CEO? Are there any Starbucks in Italy? I'll talk a bit about that strategy that we're seeing, really just the beginning rollout under Brian Nickel. There are Starbucks in Italy, and Italy is one of numerous countries in which Starbucks' long-term vision of international expansion plays a key role. There are, I believe, 3 Starbucks just in Rome alone, which is where I am. And there's now a couple in the old center of the city, which is a pretty big deal here. There were quite a few Starbucks enthusiasts that were waiting a very long time for that to happen. There were rumors for years. I had been hearing for many years the Starbucks would be coming here. And so when in fact we've had 2 stores launched in the center in the period of a year and a half. It's been kind of crazy to watch, but and there are many others throughout Italy as well. But that just is where I live. But going back to just kind of the broader subject of Starbucks's turnaround, so to speak, we know that Brian Nickel, he became chairman and CEO of Starbucks on September 9th, 2024 of last year. Obviously, he was previously the CEO of Chipotle. There was quite the flutter of news around that when he departed from Chipotle and came over to Starbucks. His strategy for the business over the long term is kind of multi-pronged. A huge part of that is what has been called the back to Starbucks strategy, essentially refocusing Starbucks to its core values, emphasizing a welcoming coffee house experience where people gather and enjoy handcrafted coffee. He has said that he plans to address customer complaints about wait times and long lines by focusing on faster service, better organization. He said that they intend to simplify the menu, reducing the complexity of it and maybe focusing on fewer but higher quality offerings. Starbucks has also been working to improve staffing levels and optimize operations in those and other similar ways to ensure, efficient order fulfillment. He's also been saying that he wants to bring back elements that have been more popular in the past and nostalgic with Starbucks's customers. We've talked about improving the mobile ordering experience, making it easier for customers to place and pick up orders. He had set the goal of delivering orders in 4 minutes or less as a North Star for Starbucks, kind of trying to balance that design of speed and quality. And we've been seeing some changes in the executive leadership as well of Starbucks as part of this kind of long-term, turnaround strategy. So simplifying the menu, improving the customer experience, prioritizing the store experience. These seem like basic but important changes that would need to be made over the long term. Refining their mobile ordering, separating as well the mobile order and cafe experience is something else. But this back to Starbucks campaign is something that they've mentioned in recent earnings calls. But there's also their longer term growth strategy in terms of their actual expansion. So, kind of talking about these things like make mobile ordering more efficient, bring customers and the customer experience back to its nostalgic roots. But then it's important to have, actual, I think, number focused growth goals. So they have a growth strategy that has been called triple shot reinvention with 2 pumps. And that's essentially focusing on elevating the brand and strengthening their digital capabilities, expanding globally, which is a huge, huge part of their long-term growth vision for the business as well. So in addition to things like, enhancing the in-store experience, they've talked about returning the condiment bar to some of their Starbucks locations, more ceramic mugs, better beverage customization, maybe more options with food menus. Accelerating their store expansion is huge. So they aim to expand their global footprint to 55,000 locations globally by 2030. They also plan to open more stores in countries where they have a very weak or limited presence, in regions including Africa and the Middle East. And they also were very much focusing on tailoring their products, their marketing campaigns, their store designs to really suit the preferences and customs of each local market. Now, obviously, they've also been looking at ways to make the business more efficient and save money. One of the biggest issues and challenges that Starbucks has had has been the competition that it's facing in China, which is its second largest market and is its largest international market. The US and China combined make up 61% of Starbucks' total sales. And again, China is its largest international market. They continue to see significant potential in China, which again is dominated by players like Luckin Coffee, which has had a real comeback over the last several years. So part of Starbucks' ability to grow over the long run is not only to have disruptive potential in some of these other emerging markets, but to really expand in other regions where it has limited to no presence. They've also said they see significant potential in India as a place of expansion for the business. And there has been a company called Tata Starbucks Private Limited, which is part of the Starbucks umbrella, that's announced its ambition of operating 1,000 stores in India by 2028. They also have pretty aggressive growth goals in the Asia Pacific that they want to achieve. In Italy specifically, which is kind of fun for me to talk about as well, this is one of numerous European markets that Starbucks has targeted over the last few years. They have significant operations planned. They expand in France, in Germany, I believe, as well, in the UK, which is another huge area of growth for them. In Italy, they hope to have 37 to 38 new stores opened, I think, in the next year or two. They're known for some of the more unique stores that they've opened here. For example, in 2018 is when they first entered the Italian market with their Reserve Roastery in Milan. And they partnered with Percassi, which is an Italian brand management and real estate group, to help understand the market and ensure a smooth transition. And then, of course, they opened their first store in the heart of Rome in 2023 and have expanded since then. And that's just one example, here in Europe. I think that this is going to be something that is going to take time. Obviously, they have very aggressive growth goals. They are really looking specifically towards their expansion within Europe. The Middle East and Africa is really key to their growth over the next 5 to 10 years. And I think that that's very much the case. I think that there are opportunities for them in China, but I think there are so many quality local coffee operators that already have and control such substantial market share with consumers. I think it's going to be very, very difficult for Starbucks to compete there. And obviously that is also the case in some of these other regions as well. But I also think that there is tremendous opportunity for them. And I think that that's something that, we're only really a quarter into, Brian Nichols' tenure as CEO. So it's very early on to be seeing how the actual rollout of that, back to Starbucks strategy, as well as their expansion strategy, is going to look like. We know that they're making progress where that's concerned. Obviously, right now, sales are declining slightly. They did open 377 net new stores in Q1. 53% of those were company operated, 47% of them were licensed. So they're only a quarter into their turnaround. There's a lot still, I think, for the business to show over the next few years. It's certainly a turnaround I'm watching. I think it's one that they can achieve, but I think they're going to have to be very intentional with their international expansion. I think that is where the key to them recovering ultimately lies, not necessarily changes to their menu or things like that.
Yeah, I find them going to Italy fascinating because I had the impression it was, Starbucks was kind of, for lack of a better way to put it, a ripoff of an Americanized version of the Italian coffee shop. And I know culturally that Europeans cringe when somebody Americanizes one of their institutions. So
I have to say I've been surprised myself to see the response. I mean, again, some of this is a bit anecdotal, right? But I remember going to the Reserve Roastery in Milan a few times over the years. And I remember going for the first time. And obviously there were tourists in there. But I remember being so struck by how it was, at least when I was there, primarily filled with Italians,
Mhm.
and a lot of Italians on their lunch break, for example. And that was something that surprised me. And you can see the ways in which that they have catered to the local markets they're in. And I've even noticed here in Rome, one of the locations they opened, and again, it was a huge deal because there had not been anything in the city center that was a Starbucks. And that was very long lines of tourists and some Italians.
Yeah.
Then there's another one they opened recently, and that seems to be filled mostly with Italians. So it's kind of interesting to watch. As a half and half myself, half Italian, I find it fascinating. Who knew that this would be key to their international expansion? We'll see how it goes. Italy ran out Domino's, so
Yeah.
we'll see.
We'll see, yeah. But I do find it fascinating that they brought in Brian Nichol because he built a reputation as sort of an operational guru at Chipotle.
Yes.
He was the first CEO that was successful, save for the founder, of course, and he really fixed a lot of the operational problems. They got rid of the outbreaks and such. So it is sort of an intriguing hire from that standpoint, because I know Starbucks has had a lot of operational problems, and they always have a lot of competition. Their strategy of going into China, U.S.-China relations aren't the best, so I'm not sure how comfortable I feel about that. And plus, their PE ratio is in the low 30s, I think, which I thought was a little high for what's basically a mature company. So I haven't been too turned on by Starbucks, but maybe Brian Nichol will change my mind. We will have to see on that one. And I think with that, we are at the top of the hour now.
We are indeed. And I'm sticking around for one more hour. And then Danny is going to be joining me here shortly. I'm just waiting for him to get ushered into the room. Well, hello.
And ushered I am.
Well, thanks, Will.
Full on,
Will.
All right, Danny, how's it going?
It's a warm and sunny day in San Diego. Me and the little guy just went for a walk, and
nice. What? Kid. Okay, I think we might have lost. Did we lose Danny for a minute? I'm not sure. We're going to be talking about food and beverage stocks on this fine Monday evening. Can you hear me okay?
Yeah, all of a sudden I had this weird music in my ear and talking, and I was like, what is going on here? And it turned out
I'm singing quietly in your head, Danny.
Yeah, in my head.
Well, we're talking about
introduce you to all my friends.
Yeah. Let me introduce you to the friends in my head. Yeah.
Alrighty then.
We're talking about, what are we talking about? Food and beverage stocks, Danny. We talk a lot about food and beverage related stocks. Usually it's restaurant stocks. So I was like, why don't we just make it broad? Why don't we do food and beverage stocks and see what the people like? But Fools, if you have any questions about stocks in this particular area or theme, feel free to go ahead and get those questions in the Slido. The event code for that is Fool24. And as we often like to say at the top of the hour, we are here to share our motley opinions about companies, about stocks. It is great fun to do so. And we often have different opinions and takes on companies, which makes it even better. But we are not here, nor can we give personalized financial advice, personalized stock advice. We cannot tell you what stocks to buy or sell. We cannot tell you personal movements to make within your portfolio. We don't know your financial situation. We do not know your personal, financial portfolio, and that is beyond the purview of our ability here as full contributors. But with that said, it's a fun subject to talk about today. I know both you and myself have a few companies that maybe we wanted to talk about along this theme. Danny, what were you looking at as we kind of start off the hour talking about this particular theme?
You guys offered me a nice segue at the end of the last hour because I was going to talk a little bit about Starbucks.
Oh, nice. There we go.
Oh, nice. It's interesting because it's a company that I have owned for a very long time, and I have seen it go through some ups and downs, some peaks and valleys. Every once in a while, it just seems like there's a cycle of everybody loves Starbucks. Wall Street lost its confidence in Starbucks. Everybody loves Starbucks again. So I think we're in the the doubting stage of the Starbucks cycle right now. But honestly, I think they could have done worse than their choice of bringing in Brian Nichols. If you go back, Brian Nichols was first brought in to usher in a turnaround for Yum Brands Taco Bell, ticker YUM for Yum. But he did a few things that were simple, yet they were innovative. He partnered with Cheetos, and he had a Cheetos flavored taco shell. And then they had a Doritos nacho cheese flavored taco shell. And just little things like that. He also used quite a bit of the time honored for a limited time only option. So they'd bring in something special, only keep it around for a short time. People were clamoring to get to whatever the latest special was. And then, it would disappear off into the ether again. So I think that, he did a really good job of focusing on these simple yet effective strategies at Taco Bell. When he was finished at Taco Bell, it's not surprising that he got pulled into Chipotle. A similar theme there, restaurant wise. And I think he did a remarkable job there too. Under his tenure, Chipotle stock did remarkably well. So now Starbucks is thinking, you know what? He's got a proven track record of, focusing on the important things, having a simple but effective strategy, bringing it home. And I think that's what he has started to do at Starbucks. One of the things that, we have heard talked about is he's taking Starbucks back to its roots. And so one of the things that he's doing is he wants to make Starbucks back into what it once was, which was the third place. People have home, people have work, and then Starbucks was, they made it a destination, and it became a third place for people to go. Folks were encouraged to come in, sit around, bring their laptops, do some work, listen to music, hang around, and drink some Starbucks while they were there. And I think, I think his focus on, back to Starbucks, I think is the actual name of the strategy. And so far, he only has one quarter under his belt thus far, but he has done a pretty good job. The company went from a more than 3% year over year decline to a 0.3% decline. So he's headed in the right direction. And hopefully in the next quarter, he'll be able to, bring that back in the plus side for revenue. He also had similar success with earnings and free cash flow. Those seem to stabilize. And so I think that, we probably need to give him a few more quarters. But that said, and given the success that, Brian Nichols has had first at Taco Bell and then at Chipotle, I think that and what we've seen so far probably bodes well for Starbucks. Now, this is a company that, we had seen that had dropped, let's see, it was about 15%. Actually, it was a little more than that, about 17% off of its peak here recently. But, several times, even if you go back to July of last year, And back to April of last year, there were a couple of times when it was down more than 20% from its peak, and it just hasn't been able to, continue the growth that it had seen previously in the stock price, because obviously the stock follows the fundamentals. So I think Starbucks is a company that I own and that I have been watching. And I think this is a case where, that, like I said, the sentiment is kind of weighing against Starbucks right now. And given the company's track record, given Brian Nichols' track record, I think this might be an opportunity for investors who either want to initiate a position or who want to add to their position. This might be a good opportunity to do that with Starbucks.
Yeah, it's kind of interesting. Bestie said espresso, the real thing every morning. Agreed. That is the Italian way. Starbucks authority in Italy, no self-respecting Italians would go. Well, I got to tell you, and this has been surprising to me. And I also, as a half Italian, start my morning every morning with espresso. But that being said, I have noticed, depending on the Starbucks location, quite a few Italians. It depends where you are. It depends where they're located. Some of them have a lot of tourists, right? But again, if you're in a highly transited area where there are also a lot of travelers, that's an opportunity as well. But I have certainly been, as I was mentioning on the prior hour, in ones in Milan that were primarily filled with Italians. To my surprise. I think it's, in my experience, with a wide group of Italian friends, people either love it or they hate it. I don't know. I don't think it's the best quality coffee, but I do think there's that experience that maybe some people enjoy. And I will say also, and this is more, again, kind of anecdotal, here in Italy, it is not particularly, depends what part of the country you're in, but especially in Rome, which is kind of like the beginning of the South, going and taking your laptop to a coffee shop is not the most socially acceptable thing, or here we'd call it the bar. You go to your local bar, you get an espresso, maybe you sit at a table and you have a coffee with a friend, but you're not really bringing your laptop. But at these Starbucks locations, you actually can bring your laptop and it's not going to be a problem. And depending on where you are, and this is something I've noticed much more in Italy than other parts of Western Europe, where it's much more socially acceptable, having a place to be able to bring your laptop and actually work outside the house, if you are, say, a remote worker, is pretty nice. So that's just some random anecdotal context there.
Well, and here's another, random anecdotal with a sample size of one. Well, the first time that my family traveled to Europe together as a family, my daughter was a teenager, and she was not in the least bit interested in getting to know any of the local customs, cuisines, you name it. But we could count on every day, no matter where we were in Rome, we would come across the Starbucks and she could get that little piece of home, and we better find her one. So yeah, we were able to keep my daughter civil.
Well, that's good.
we Italy.
We want that. The one other thing I'll say, because I know we've spent a lot of time talking about Starbucks, but it's interesting because I think it gets a lot of, a lot of questions that are kind of fascinating. But, for example, that we've talked about how their expansion internationally is going and how they are really focusing on customizing their stores regionally. For example, here in Italy, they invested or they partnered with a well-known Italian baker named Rocco Princi, and they essentially made his baked goods very, very much a focal point in their premium reserve stores and roasteries, starting with the roastery in Milan. And then a lot of the Princi goods are also based in other locations now as well, for example, stores in Tokyo. But they have had a very interesting pattern in their international expansion of trying to really make their local make these stores have much more of a local element that they're catering to, whether it is the way the stores are built, the types of products that they feature are different. For example, if I go to a Starbucks store here, or I've been in many other countries as well, I have often found that the quality of the items that they sell varies significantly and is probably much wider and broader than what when I was a kid growing up in the US was used to. So that's also been kind of interesting. The business has, I think, a ways to go. I've said before, I've talked about this as well, Danny, in recent days, that their reliance on China right now is their biggest international market, which I know they're working to get away from. I think is where they're having the most problems, not because China is not an incredible opportunity in terms of expansion, but because that is a great example of a country where the market is heavily dominated by local players that are doing really, really well at eating up Starbucks's market share. And so that's where I think that they need to be really intentional with where they expand to next and go to markets that are really ripe for disruption for them.
And that's it for Starbucks.
That is it for Starbucks. There were a couple companies I wanted to talk about. Maybe I'll start with kind of a less exciting one, but one that I thought was interesting to talk about. As I talk about like a lot of the same food stocks. One is the global snack food company Mondelez. So they sell all these different, biscuits, chocolate, candy, gum. They are known for Oreo, Cadbury, and Ritz, to name some of their most well-known brands. They operate in over 150 countries. They cater to a very vast global consumer base. They have grown a lot over the years through both, with their internal business development as well as, external acquisition. They are definitely an example of like a classic blue chip stock. This is not a fast growing company. They are not a business that is going to be delivering, high levels of growth. What I will say is that they have been a pretty faithful dividend payer through the years. The stock has not been the best performer of late. And this is a massive company. I mean, they have like an $87 billion market cap, and they trade at a price to earnings of about 19. But their dividend yield is about 2.9% right now. And the average S&P 500 stock that pays a dividend yields about 1.2 to 1.3%. So quite a bit above that average. But they operate in about 160 countries globally. They've been seeing some pressure on some of their growth figures in certain markets recently. I think that it's also a business that they're not necessarily targeting essential food shopping. I think that customers like to snack and like to buy packaged snacks, but maybe, in a market environment where consumers are focusing a little bit more on essential items, that could also be impacted somewhat. In their fiscal 2024, net revenues were up about 1.2% year over year. Organic net revenues were up about 4.3%. They did deliver cash from operations of about $5 billion, free cash flow of about $3.5 billion, and they returned about $4.7 billion in capital to shareholders in 2024 alone. So this is one of those businesses that is maybe not the most exciting, but they are one of those sort of classic value-oriented businesses that do tend to deliver growth in a wide range of environments, and have been a very consistent, dividend payer through the years. They also delivered net earnings of about $4.6 billion in the full year 2024. And that was a slight decrease from the prior year period, but still a very solid number. So kind of an interesting business to look at in this space. Another one that I find kind of interesting as well. I mean, there's so many different ways to invest in this particular space. There's a company called Treasury Wine Estates. I don't know if anyone is very familiar with this one. They are an Australian global winemaking and distribution business. They are headquartered in Melbourne. They were formerly the wine division of an international brewing company called the Foster's Group. They shares trade on the OTC markets. The company has a market cap of about $8 billion. Their wines are drunk by consumers in 70 plus countries around the world. They have 3 different brand portfolio divisions, including Treasury Americas, Treasury Premium Brands, and Penfolds, which is another one that they operate. It's just kind of an interesting business. I think that I don't know if I per se would invest in wine stocks. I've thought about this before because it's kind of fascinating to see, how these businesses run and how they operate. They also have been, growing steadily through the years. They have grown as well by acquiring often smaller vineyards that have helped expand, their footprint through the years as well. And I believe they also completed some vineyard and production assets in China for their Penfolds portfolio, which is a huge part of their international business. So kind of interesting. Not a stock I currently own. One I've been more interested in. They saw a 33% jump, I think, in their net profits in their recent financial results. And they've been seeing a really strong growth in terms of luxury wines. So sales of luxury grouping of wines, which I believe now generate about 56% of its revenues. Luxury grouping of wines grew about 52% year over year. They recently purchased vineyards called Dow Vineyards in California, and they saw earnings there increase by about 11%. And then again, their net profits jumped 33% to about 239.6 million Australian dollars. They were forced to slash some of their forecasts for their full year growth to be on the lower end of previously cited expectations. And some of that is related to changes that they're seeing. Drinkers are turning away from cheaper wines in their home market. They're still dealing with a lot of oversupply, particularly in Australia, which is, again, their home market. So kind of an interesting business. They've been doing a good job of expanding internationally over the last few years. I find it fascinating that they are seeing so much success targeting the luxury wine segment. I mean, you think about how you've got a multinational conglomerate like LVMH with their, Lux wine and spirits business, and that is a business that has really been struggling in recent years. So kind of interesting to see. They're not a business that I probably would invest in right now, but I find it kind of fascinating to watch and follow this space. And that's definitely a company I'm following. And maybe if I wanted to just have a little bit of skin in the game, I would scoop up a couple shares. But on one end of the spectrum, a snack business, on the other end, a wine stock. I thought it'd be fun to talk about a couple of companies that maybe aren't as broadly covered. Mondelez and Treasury Wine Estates. There you go.
Wine and snacks. I don't know what more
Why
you
not?
could hope for.
As
long as some of those snacks are chocolate, because you can't have if you're going to have snacks with wine, it's got to be chocolate.
I agree with you there, Danny.
The more the merrier. So there was a question in the queue. Actually, this was from about 9 hours ago. Jeff Mulvaney asked, would you buy CoreWeave IPO? And what is a good strategy for buying IPOs? Buy the day of the IPO or wait a week or two? Seems like they often come off highs. I can tell you what my opinion is, and I will preface this by saying that at one time, I was one of the contributors to the weekly newsletter for the Motley Fool's IPO service. So I followed a lot of IPOs over a period of time. And in my experience, buying on the day of the IPO can be fraught with risk. Generally speaking, particularly if it's a company that investors are interested in, if there's a lot of excitement around the company, the initial asking price for the stock will be bid up several times leading up to the IPO. And then when investors actually can get their hands on it, the stock can skyrocket on day one. And the problem with that is that by the time we as investors can get our hands on the shares, it's already peaked, generally. Not always, but fairly often. The stock price peaks soon after the IPO, and then there's kind of a settling out that occurs because most investors want to wait to see what's going to happen in the first quarter, in the second quarter, post a company going public, so that they have a good idea of what's going to happen. And so generally speaking, my recommendation is to wait until after, the company delivers its first quarterly earnings report, maybe its second quarterly earnings report, so that you can see the trajectory of the business as a public company before you go plunking down your hard-earned money. For me, I very rarely get into a company earlier than that. And in most cases, it doesn't work out so well. So that would be my advice. However, to each their own. If it's something that you feel strongly about, you think you're going to get in on the ground floor, make sure that the amount of money invested is money that you could potentially live without, because it may be tied up for a while and it may not work out as well as one might hope. So that's my advice for dealing with an IPO.
Yeah, we had gotten a question about that particular IPO earlier, and I was talking a little bit about the business and what they do, and kind of Microsoft is their biggest customer, which comprises about 62% of the business. So I walked a bit through that in an earlier show, but I think that's really important thoughts you shared as well on just generally approaching the business of IPOs. We had another comment from Besties on Starbucks. They're not doing so well, saturated in the US, outplayed in China. Italians have a lot better options. On that, Besties, I do agree with you. Jury is still out on Nichols' turnaround. Hopes abound. We shall see indeed, Besties. We shall see. One company I'll talk about really quick, and then there's a question I wanted to answer about Sweet Greens, is on this theme of food and beverage stocks. It's worth talking a little bit briefly about McCormick. They actually report their, I think it's their first quarter of their fiscal 2025, and they report that tomorrow, I believe. So we might be talking about that on the earnings show.
Definitely this week.
Yes, definitely this week. I'm pretty sure it's tomorrow though. So the global flavor company, they know for all the different spices and seasonings and condiments. Yes, spicy things, right? And they sell those to retailers, food manufacturers, food service businesses. Again, a very integral business for a lot of different operations across the food and beverage industry. They've got that broken down into two main reportable segments. Their consumer segment, which focuses on selling products directly to consumers through retail channels, such as at the grocery store. And then their flavor solutions segment. And that's where they actually sell different spices, flavor solutions, ingredients directly to food manufacturers, food service operators, and restaurants. They operate in over 150 countries and territories, and they source their raw materials and ingredients from roughly 75 different countries. And just to set up the picture a little bit for what their growth might look like when they report tomorrow, this is a company where single-digit growth figures are common. Again, this is a fairly low-margin business. This is an incredibly established business. They have been around since 1889. They are a leader in their respective space, but this is not a high growth company. This is very much a value blue chip dividend stock for anyone that is following this business. That's essentially what one would be investing in them for. In their fiscal 2024, sales increased about 1%. year over year. They saw that increase driven by a couple factors, including just an increase in overall sales volume, but also some price increases that they had implemented. They also reported earnings per share of $2.92 compared to $2.52 in 2023. They also delivered $922 million in cash flow from operations for fiscal 2024. It's one other thing I would note is that in November, they had the board of McCormick authorized a 7% increase to the company's quarterly dividend. That also was the 39th year in a row that McCormick has increased its dividend. So they have continued to do so through many different types of economic environments. So wanted to mention that real quick. We'll talk about them more. I'm sure either tomorrow or the next day in coming shows as it pertains to their earnings. LY Winners Win had asked, what do you think of Sweetgreen's recent quarterly results? So I wanted to answer that really quick, and then I'll bounce it back over to you, Danny, if there's a question you want to answer. Sweetgreen's had a pretty good quarter and fiscal year that they reported. They're known for their premium salads and bowls. A significant portion, though, of their sales come from digital channels, including, their mobile app. Partnerships with delivery services like DoorDash are huge for them. They've been really actively expanding their restaurant locations, introducing newer menu items. They also have been building out their Infinite Kitchen system, which I've talked about quite a lot, which is these robotic make lines that help speed up service and improve their throughput and overall just enhance order accuracy, where essentially Sweetgreen automates parts of the salad making process, including dispensing ingredients, moving the bowls along a conveyor belt. And humans are sort of involved at the beginning and the end of the processes, but a lot of the really repetitive elements are automated by these robots, saving human workers time as well. And they first began investing in building out these Infinite Kitchens, I think almost 2 years ago now. And this is partly because of a acquisition they made back in 2021 of a company called Spice. This was a robot-powered kitchen startup, and that's been key in their ability to really develop and build upon their Infinite Kitchen technology. Now, the investment in Infinite Kitchens is huge. There's been estimates I've seen that can cost up to $500,000 per store just for the technology's development and installation, in addition to any other costs, whether the store is being retrofitted, to be an Infinite Kitchen, or they're buying a new retail location, and obviously there would be costs involved there as well. I've seen some articles talking about the expansion of this. For example, there was a story about a new Sweetgreen restaurant location in Seattle's Capitol Hill, and they had done a whole interview about how that was working. And there was an area leader at Sweetgreen that had said that beyond speed, consistency, and control, these robots are improving the quality of the work experience for employees because it removes some of the really repetitive elements of things like putting ingredients in bowls. And so how it works is customers can order a salad, grain bowl, a protein plate through the app or via touchscreen tablets at the front counter. And you can customize your order. And then when the order is submitted, it's sent directly to the Infinite Kitchen. And then the human worker, right, places the proper container for the order in the right slot on what's called a smart track, and it moves the bowl through the system. And then along the way, there's more than 40 different tubes that dispense ingredients into the container, depending on what the actual order is, right? And so the bowls might rotate or spin at certain spots on the track so that ingredients don't get clumpy or all mixed up in one spot, to help mix any dressings that need to be put in. It's fascinating to kind of read about and think about. And this is a huge part of their growth strategy moving forward, which is why I mention it. When they reported their financial results, that was about a month ago now. So a couple things. They're still dealing with, unprofitability. That is something that I've been watching with this company and why I've probably been a little bit more intrigued by a kava type of business that is already profitable. But I still find Sweetgreen interesting. Their total revenue in 2024 was about $676.8 million. That was a 16% year-over-year increase. Same-store sales grew 6% year-over-year. Their total digital revenue percentage as a measure of overall sales was 56%. Loss from operations was $95.7 million. That was down slightly from the loss from operations they reported a year ago. They did report restaurant level profit margins of about 20%. That was up from 17% 1 year ago. Restaurant level profits were $133 million compared to about $102 million a year ago. So that's notable. That's impressive to see. In terms of their actual net loss under GAAP, that was about $90 million. And that was down slightly from the net loss they reported in 2023, but a net loss none the same. Now, on an adjusted EBITDA basis, they reported about $18.7 million. That was compared to negative adjusted EBITDA 1 year ago. They also achieved 25 net new restaurant openings in 2024. That was a slower pace than 1 year ago, but they are still continuing to really invest in their growth. The CFO noted in their financial results that since their IPO in 2021, the company has delivered 4 years of double-digit revenue growth and 4 consecutive years of restaurant-level margin expansion. In 2024, restaurant-level margin expanded over 200 basis points. And like I noted, they also turned their adjusted EBITDA positive, even though they are still quite unprofitable under GAAP. And then they also delivered AUV of 2.9 million, which was pretty much the same as 1 year ago. So I think it's an interesting business. They're targeting 40 net new restaurant openings in fiscal 2025. Half of those are intended to feature an infinite kitchen. They're targeting revenue between 760 and 780 million compared to the 677 million that they just reported. They're targeting restaurant level profit margins of between 19.8, 20.5%. Does not look like they are expecting to be GAAP profitable this year based on any guidance they've provided. But on a non-GAAP basis, they are targeting adjusted, I should say, EBITDA between 32 million and 38 million for fiscal 2025. So those are some things to think of if you're looking at the business. The biggest thing I've been a little hesitant with is just the fact that they seem to be so far away from any time of profitability for the business. But I also know that they're investing heavily in their growth right now, which can lead to profitability in the future. Those infinite kitchens, as I mentioned, are very capital intensive. Half of the new locations they're planning to open this year will feature them. That is a huge investment for the business, but seems to have been a very successful one in their very early rollout of them. And obviously, over the long term, that could also improve margins, having those kitchens, and streamline the process overall, both for employees as well as for customers. So I think, for anyone looking at this company, if you think that all of these changes and strategies that they're enacting are going to help them become profitable over the long term, could be an interesting business to look at.
One thing I wanted to mention about Sweetgreen is that, they did have one kind of major headwind during the most recent quarter. And generally, I don't like to give companies a pass when they say, oh, well, it was the weather, or it was this, or this was that. Sweetgreen said, well, we were dealing with wildfires in California. And
right.
They have about 15% of their 15% of their revenue comes from the Los Angeles area. So okay, when you get 15% of your revenue bases in one geographical location, and a lot of that geographical area is shut down or adversely impacted by not only the wildfires itself, which were all around the LA area, but also you had issues with smoke that were basically blanketing entire towns. So I'm willing to give them a little bit of a pass on that. but I think I want to see them do, better in the coming quarter because they won't have that headwind.
Yeah. And they still had a pretty solid quarter and obviously full year overall, despite that that very notable headwind you mentioned as well. But it's a interesting point to make for sure.
So we did have a question from Besties a little bit ago, asking about expectations for the next 2 to 4 years for Celsius, ticker CELH. Celsius is, I think, an interesting company and worthy of a case study, because I think one of the things that we've seen is Celsius was doing really well. They were continuing to grab market share from the biggest names in the energy drink space. And if you go back a couple of years, they announced this groundbreaking distribution agreement with Pepsi. And then the stock went through the roof. And I want to say that maybe got a little bit ahead of itself. Investors were expecting, a massive change in the results. What they didn't realize at the time was that you're going to have a big bump initially from that distribution agreement, and then things are going to level off. And then there's going to be some in and out and some back and forth as they figure out the proper inventory levels related to that distribution agreement. And that's what we saw. And from its peak, going back to, let's see. Yeah, to its peak back in, let's say, early 2024, the stock has fallen considerably over the past 4 years, past full year, sorry. And the reason that the stock is down so much is because people were not understanding, the leveling off that was going to happen. So now the stock is down about 64% from its peak in early 2024. Now you've had, 4 quarters now worth of tough comps. I would say that within the past, month or so, the stock was at its peak pessimism. And that's generally, if you listen to Warren Buffett, if you have a solid business with good leadership, then you want to, be greedy when others are fearful. And I think that's the case here. I think Celsius already had a solid business. They were gaining share on their bigger competitors and doing that consistently. They had innovative flavors. It was something that, was serving the company well. And frankly, they were a victim of their own success in that investors really were not focusing on, the downside to that agreement with Pepsi, albeit temporary. Now, we have the situation where Celsius is now is acquiring, I think it's Alani. I had the window here.
Oh, Alani, yeah, Alani Nutrition. Mm-hmm.
There you go. And I think this is not only going to bring their sales up because of the acquisition of this already existing customer base, but now they're going to be introducing their existing customer base to a whole new product, potentially expanding beyond that core customer base that they have now. So I think this is something that could propel the company higher. And particularly now when they add those in, I'm interested to see what impact that has on their market share in comparison to, their 2 major rivals. I think this is really a compelling opportunity for Celsius, and I want to see how they handle it. Anytime you have an acquisition, there's always the potential for a problem with culture clash, or the integration doesn't go as well as perhaps they had hoped it would go. Now, the fact that they are still have a distribution agreement with Pepsi, seeing this new brand get integrated into their distribution channel, I'm watching to make sure that goes well. And then also, to make sure that they don't have any issues with the, maybe clashing cultures between the folks at Celsius and the folks at Alani. That said, I think this represents a really good opportunity. Now, it remains to be seen whether or not Celsius will be able to capitalize on that opportunity. So I would say, I'm not willing to go on record and say I think the stock price will be this or that. I do think that once the company has gotten past those 4 quarters of tough comps, I think we're going to see gradual improvement over time. I think as that improvement comes, I think investors are going to be more bullish on the stock than they have been. And I think we could see over the next couple of years, I think we could see Celsius take new highs.
Well, there's a question that talks about Celsius from Roberto and also names a couple other companies. So maybe we can both share some thoughts, but I'll take a first stab at it. Roberto was asking, hi, what do you make of Celsius and Toast now and their future? I think Danny just gave a great rundown of Celsius. What is your opinion on Restaurant Brands International? Toast I talked about a bit earlier. I'll give my thoughts on that as well as Restaurant Brands International. And then if you have any thoughts, Danny, that you want to add. Now, Toast is a really interesting business. I think that they have a really sticky model, and that has been really popular with the restaurants that they serve, which can be everyone from, mom and pop shops to, food trucks in some cases, to like these much larger chains of restaurants. So they have a really diverse customer base. And I think that has really lent itself to a lot of growth for the business. But they have this really comprehensive cloud-based restaurant technology platform. They have this entire suite of tools designed for restaurants, including point of sale systems, payment processing solutions, online ordering solutions, inventory management. They even will help restaurants administer their loyalty programs, for example. Restaurants will pay a monthly subscription fee for access to the platform and its features. Toast also makes money not just from subscription fees, which were a huge, element for the business as well, but also for processing each transaction made through their point of sale systems. And so they do make money tied to transaction volume. And then they also sell restaurant grade hardware like point of sales terminals and kiosks. So they help restaurants do everything from manage, accounting and payroll for their employees to managing orders. They will sell the kiosks that are used by kitchen staff in the back to track orders as they're coming through the kitchen. They help process payments both through their software as well as hardware solutions. So it's really full service, the entire, kind of optionality that a restaurant would need to grow and scale is something that is very well served by a business like Toast. And they also offer financing options as well through Toast Capital. And I think they make some money tied to interest as well as other fees related to those loans. And Toast has been doing a really great job in terms of their growth strategy as well as their growth story. They are more newly profitable. I think that 2024 might have been their first full year of GAAP profitability. They reported GAAP net income of $19 million compared to a net loss of $246 million in 2023. Their subscription services and fintech solutions gross profit grew 34% year over year to $1.4 billion. in 2024. Gross payment volume increased 26% year over year. They also, I will note, are free cash flow positive. They delivered free cash flow of about $306 million in 2024. That was compared to $93 million in 2023, so a significant uptick. And where they reported cash from operations of $135 million in 2023, they grew that to $360 million in 2024. Notably, they also had their software and hardware solutions deployed at 134,000 locations at the end of 2024. That was a 26% increase compared to the same period the prior year. I think that this is a business that we've talked about this before, but there are very high switching costs for restaurants that decide, if they're like, we want to use a different business or a different company. I think that Toast's offerings are incredibly sticky because they make it very, very easy for restaurants to address all of their needs, both in serving customers as well as managing the back end day-to-day minutia of running a restaurant. And all of that is available through Toast's solutions. And I think that's something that has made it a really valuable tool and software solutions and hardware provider to these restaurant brands. They've also been trying to expand into newer customer groups, which I think is something that will be key for the business over the long run as well. They've said we're going into enterprise, international, food and beverage, retail. Those are much newer areas of growth for the business, but I do think will also be key for them over the long run. So I think that restaurants are what Toast is known for, but I think perhaps there's a lot more for Toast to expand into over the coming years. And I think their ability to keep doing what they're doing and demonstrating that value proposition to these brands is going to be really key for them. Restaurant Brands International is obviously a totally different business, right? As the viewer mentions, this is the parent company of Burger King, Popeye, Tim Hortons, Firehouse Subs is another one. They generate a significant portion of their income through franchising. So franchise and property revenues, which includes royalties from franchisees and income from properties that they lease or sublease to franchisees. They do also directly own and operate some restaurants, so they do earn revenue from sales at these locations. But their core model really revolves around managing and supporting their various restaurant brands through franchise operations. And they've grown through acquisition. So there was the 2014 merger of Burger King and Tim Hortons, the 2017 purchase of Popeyes, 2021, I think, is when they purchased Firehouse Subs. And they have a really global network of restaurants. They have a significant presence in North America, but very much internationally. They actually just announced that they are expanding Firehouse Subs. They're going to be launching in Australia. They plan to open 165 Firehouse Sub restaurants across Australia in the next decade. I think it was the same day they announced that, Restaurant Brands also announced a plan for Burger King in China. They said that a subsidiary of RBI has acquired from TFI Asia Holdings and Pangaea 2 Acquisition Holdings all of their equity interests in Burger King China. As a result, RBI now owns nearly 100% of the business. They said that TFI had been a valued partner in Burger King's expansion in China, helping bring the brand from 60 restaurants in 2012 to 1,500 today. And that will be a continued core brand partner for them, for example, in Turkey, which is an area they are also working to expand to. But today, Restaurant Brands International, they are one of the world's largest quick service restaurant companies. They have over 32,000 restaurants located in more than 120 countries and territories. In their most recent fiscal year, global system-wide sales grew about 5.4% year over year. They also delivered income from operations that grew 18% year over year in 2024. Their net income was about $1.5 billion in the 12-month period. So interesting business. I think that Restaurant Brands is a very different business than the likes of Toast, and also very different than the likes of Celsius, right? With Celsius, you've got a major popular drink, a beverage brand. You've got Toast, which is basically providing that essential critical infrastructure, software and hardware for restaurants and other food-centric brands, and then Restaurant Brands International, which is one of the largest quick service networks of locations in the world. Very interesting to see their international expansion. They're a very consistently profitable company. Revenue growth is slim. That's pretty common with a business of this type. But again, most of their restaurants are franchised, which I think is important to note because that varies depending on some of these businesses. And their dividend yield is pretty robust at this point because the stock performance has been quite lackluster. So that yield is about 3.7% right now. I think Restaurant Brands International will be just fine over the long run. I don't think this has been a great performer in terms of share prices necessarily. The stock's up about 70% over the last 5 years. But I do think that it is it is a solid business if you're looking at this space because they are just by nature one of the dominant players. And their continued expansion, and now particularly in China, and in Australia, I think shows that they have a lot of room to run with their iconic brands. So a lot of different ways for these businesses to grow and from very, very different growth trajectories. I'm curious what your thoughts are, Danny.
So I don't really follow Restaurant Brands that much. But again, like you said, kind of a larger player, slower growth, dividend. So that's probably going to appeal to maybe a different investor than Toast would. The one thing I wanted to say about Toast was I was doing some research here recently just to kind of get an idea of their customer base. And what I found was interesting was that some of the largest restaurant chains in the country use the Toast platform, even though they're primarily focused on the small and medium-sized business market. So you've probably heard of Darden restaurants, right, Rachel?
I have indeed, yes.
Yeah, they also serve the Cheesecake Factory, Red Robin's Gourmet Burgers, and Bloomin' Brands, among others. So that's another area for potential growth for them. Is the fact that some of these bigger restaurant chains are recognizing the ease and simplicity of instituting Toast's excuse me, what they call their restaurant operating system. So I thought that was pretty interesting.
Oh, that is interesting. Yeah, I did a whole breakdown of Darden's results last week. I did not know that they were a client of Toast. How interesting. Well, hopefully that was helpful. Roberto said, "Thanks from Italy, Rachel." We have another viewer here in Italy. Lovely. Happy to see it. Hopefully that was
Maybe
helpful.
each other over espresso.
Yeah, maybe we will. Besties will be proud that we're drinking espresso
at Starbucks.
Oh, God. No. The funny thing is I still haven't been to any of the Starbucks locations here in Rome. The truth is, after this many years in Italy and, being half Italian, I do still go to Starbucks when I'm in the US, and occasionally I will order delivery if I'm having like a day where I want a really big coffee. But usually I do just drink my espresso or a cappuccino if it's before 11 a.m., which is a weird rule we have here.
Oh, that's a rule, huh?
Yeah, if you drink a cappuccino after 11 a.m., it's bad.
Oh, I see. I guess, you're going to get grounded and get your caffeine card taken away.
Pretty much. It's okay, Danny. Whenever you come visit, you get a cappuccino anytime you want.
There you go. So we have a question from Matt in the queue from about 43 minutes ago, asking my opinion on Pubmatic. And Pubmatic is an advertising company. We've talked a lot about the Trade Desk, ticker TTD, and the Trade Desk is one side of the advertising coin, and Pubmatic is essentially the other side. I have looked at Pubmatic. One of the reasons that I kind of stuck with, the trade desk, is that, you have the supply side and the demand side. And the trade desk is a demand side platform. And they primarily focus on that. And that is where helping advertisers buy their ad spaces. So this is ad buyers focus. Now you've got your ad sellers, people that are selling those advertising spaces, and that market is kind of fractured. So you have a lot of smaller players in that space. You've got Pubmatic, and you've got Magnite, and you have some other supply side platforms. So I guess that's both an opportunity and a challenge, in that you have so many smaller players in this market competing against each other. Whereas with the trade desk, excuse me, the trade desk is one of the leading suppliers on the demand side. So I looked at Pubmatic's most recent results for their fiscal year. They had revenue of just short of $300 million. It was up about 9% year over year. They had about a 4% margin. They had net income of about $12 million. So, much smaller player in the space. So while I am familiar with who they are and what they do, I'm much more focused on the opportunity that the trade desk offers, simply because there's so much so much bigger an opportunity, so much bigger of a total addressable market on the demand side than on the supply side. So I do not own Pubmatic. I think I own a small piece of Magnite from when I acquired it years ago and never really added to it. So I wasn't between Magnite and Pubmatic. I liked what Magnite had to offer. So my feelings on Pubmatic are kind of neutral. Certainly, a business that's growing there, but not one that I was interested in owning.
I think we're at the end of the hour, guys.
Already.
We are, but you're staying on for another hour, are you not?
I am. I'm going to be sticking around with Brian Orelli, and we are going to be making some bold predictions as soon as they bring Brian on stage.
Oh, fantastic.
And speaking of Brian.
Well, all right, gentlemen, I'll leave you to it. Thank you.
Thanks, Rachel. Fool on.
All right, the San Diego crew is back together, and
we are
do a little sparring and try to figure out whether our bold predictions will actually come true,
and whether or not we can get all 6 of them in the allotted time.
I'm sure we can do that. That's child's play. We've both been through this once already, at least, so we're ready to go. I think. You want to start off with your first one?
All right. Well, let me pull up my my first prediction here. I think I'm going to start with the Trade Desk. The Trade Desk is a company that I have talked about a lot on Fool24 in the past couple of months. The stock got hit hard after the company reported for the very first time in 33 quarters, they missed their internal guidance. And there was much wailing and gnashing of teeth. And, after a long history of consistent growth, investors had lost confidence in the Trade Desk. And I think that loss of confidence is a mistake. So my bold prediction is that the Trade Desk stock will more than double over the course of the next year. from last week's low, which was $53.59. And I want to start off by saying, every company goes through a period where, they hit a speed bump in their growth. And the trade desk is no different. In fact, they almost missed their own guidance once before a couple of years ago during the pandemic. The issue that they had now is that they had ran into some logistical issues switching their customers from their existing Solimar platform, which was their ad buying platform, the self-serve platform that their customers use, to their new AI or more AI infused Kokai platform. And you have an issue where the company didn't meet its own guidance. They didn't meet Wall Street's guidance. It was a perfect storm of a high valuation, disappointing results, macroeconomic factors, and the stock just took it on the chin and fell as much as 60%. This kind of thing happens, particularly with high growth companies. And I want to say that I think the stage is set for the trade desk to come back and surprise Wall Street in the next couple of quarters by returning to their growth trajectory and the stock doubling from last week's low.
All right, so the poll is up on Slido. The code is Fool24, and you can also ask Danny questions if you have any about his prediction. I'll start with one of my questions. So the trailing 12 months earnings per share is at 78 cents. The 2025 estimate, I guess, according to analysts, according to Y charts, is $1.80. So that's more than double right now. So I think, assuming it just keeps its current PE of 76, your prediction should come true. So I guess the question is, if it doesn't keep its current PE of 76, what do you think has happened? Or do you think that it's going to increase higher than Wall Street's estimates, or do you think that the PE will actually go up and then maybe they don't even hit the Wall Street estimate of $1.80?
Well, I think one of the things that we have seen with the trade desk is the fact that it had a much higher price to earnings ratio running into that report.
Yeah, it was 150. It was 155 the last time the price was double where it is right now, just to give some context. And then price to sales was 20 versus 12 right now. The forward PE was 65 versus 33 right now, and the price to free cash flow was 99 versus 47 right now. Just to give some.
So I suspect what's going to happen, like you said, even if the company was to just keep its current PE, and if it turned in the earnings that Wall Street is expecting, then the stock would double. I think that the PE is actually going to go up. We've seen a lot of margin compression because of what has happened, and so I think that we're going to see that expand from where it is now. So we may not see it go back up to, say, 150, but historically speaking, I think we're going to see the PE higher than what it is now, and I think that's going to propel your stock price higher.
And so do you think PE is the best indicator of valuation at this point, or is it price of free cash flow or price of sales or some other metric?
Generally, I think the PE ratio is one that I'm going to watch because this is one that has always been high for the company. And if you go back and look, I want to pull up what the average PE ratio was over the past 3 years, because I think that's more indicative of what we can expect going forward. And yeah, see, you're including some of the early excitement from 2023 in there when it spiked above 1,000. So maybe I'll go back 5 years. But the average PE over the past 5 years has been about 261. So, you can see that at 76 right now, that's much lower than what it has been. I think the company is going to, return to their growth trajectory. I think the revenue growth is going to accelerate compared to what we saw in the most recent quarter. And I think the combination of those two things is going to be enough to drive the stock higher over the next year.
All right, you got about a minute left to get in your vote. I think I agree with you that it doesn't have to get back up to 155 PE to justify the current growth. I mean, basically, we're looking at the trailing 12 months earnings compared to the 2025 estimate, more than doubling. So, if they can double earnings, I think that it's not unreasonable that they should have a PE of 76. Maybe that's a little high, but they probably don't even have to hit 76 to result in the stock doubling, even, assuming they hit that trailing 12 months earnings or 2025 earnings. A year from now, it'll be trailing 12 months earnings of $1.80. So I go ahead and get your last votes in, and I will read out the poll. But I'm definitely going to vote yes. It had a temporary setback and will regain its momentum. And then if we look at the poll, it looks like 83% of people agree with you and I, and 17% think it won't actually hit it. It won't actually be able to double from its 53.59 low last week.
Wow, and I thought that was going to be a controversial call, saying that the stock would double in a year, but apparently not that controversial.
Apparently not. All right.
Brian,
so I'll go with off my first one. So I've got all three of mine are in the obesity space. So I started off in the obesity space, and I was just like, why don't we do all three in the obesity space? So my first one is for my first one's for Viking Therapeutics. Ticker is VKTX, and my prediction is that they will not have any M&A or licensing deal with a large pharmaceutical company before it reads out a phase 3 clinical trial. So Viking hit a market cap in 2024 over $9 billion. This was after they had read out their phase 2 clinical trial, and there was a lot of speculation that they would probably have a buyout, but the market cap currently sits at just $3.3 billion. So, almost basically a third of what the maximum market cap was. And then earlier in March, the company ended up doing a manufacturing agreement with a contract manufacturer. So that allowed them to both produce the product for the phase 3 clinical trial, as well as have an potential expansion to grow if it gets approved, to have product for sale once it gets approved by the FDA. So you could argue that that's exactly what pharma maybe wants, especially a pharma that doesn't necessarily have manufacturing capacity for a peptide, because a peptide, this is a peptide-based drug, and so they're a little more specific than small molecules or protein-based manufacturing. So you could argue that, but then also maybe it's a signal that they plan to go it alone, and so that they don't actually need a pharma. The phase 3 program is expected to start in the second quarter, and they had $903 million at the end of 2024. So that seems like they've got more than enough cash to run through the phase 3 program. So, and then, finally, I think that maybe the main reason why they probably won't get taken out is because they were a $9 billion company, and now they're a $3.3 billion company. And I think there's a high likelihood that management is pinged to that $9 billion valuation, and they probably don't want to take a buyout at less than that $9 billion valuation. I think they'd get a lot of flack from their current shareholders if that was the case. And so, they probably, they may be getting offers, but if they're in the $5, $6, $7 billion range, even though that's a huge step up from the $3.3 billion that there are right now, I think that they may be turning those down and investors will never know about them because they're sort of pinged to that $9 billion valuation, and maybe they want, closer to a 10, or even, maybe they'd even accept a $9 billion valuation at this point. But I'm not sure pharma wants to pay 3 times as much as the current valuation. So, maybe if the valuation goes up, maybe they get an offer, either a licensing deal or a M&A between now and when they read out their phase 3 program, which should, assuming they started in the second quarter of 2024, it should end, I think, towards the middle half to the final quarter of 2025. And so I think that they're probably not going to get a licensing deal or an M&A between now and then.
So my question is a little bit more general to start off with, but is Viking Therapeutics, that is the drug that they are sending into phase 3 trials, is this one of the GLP-1 kind of drugs?
Yeah, and so they do seem to have an advantage over the current offerings in that their drug, at least in phase 2 clinical trials, seem to be more tolerable than the current offerings from Novo Nordisk and
meaning not
Viking.
so as many side effects.
Yes, yeah, in terms of side effects. So, so tolerability in terms of it's not something that would kill somebody, or but it might make you not want to take the drug. So
Right.
think like your nausea and vomiting and GI issues, gastrointestinal issues. So that seems to be the main advantage, and the reason why after the phase 2 clinical trial results read out and it looked like it was better than Eli Lilly and Novo Nordisk's drugs, that they thought somebody else was going to come, probably not Eli Lilly or Novo Nordisk, but some other large pharmaceutical company was going to come along and acquire the company, or at the very least do a licensing deal. And that hasn't happened. Maybe there's some that have interest, but management hasn't been able to agree with the pharmaceutical company. And obviously those end up being behind closed doors. And so we don't know about the results. There was a rumor maybe a month or two ago that Pfizer was going to potentially acquire them, but that obviously didn't pan out, at least not currently.
So that kind of leads to my second question. If I kind of understand from your math there, and the fact that management may be price anchoring as to why there wouldn't be an acquisition, but why wouldn't there be a licensing deal?
Yeah, I think the answer is I don't know. I think probably there's a lot of options for combinations, so you almost need the. I think there, we've seen some licensing deals, like Roche just did a licensing deal where they actually have a GLP-1, but they were looking for an amylin drug to complement it, and they did an amylin. They did a licensing deal with a company that had an amylin product. So obviously Roche wasn't going to license a GLP-1 because that's a like to like comparison. They're not going to combine those two drugs. So I think maybe some of it is that the companies that are most interested in the combination, in the space, want a combination drug. I think Pfizer, we thought might be most likely, just because their GLP-1 doesn't seem that great. I think Amgen also is sort of in the iffy, for their GLP-1. And so I think those two seem like the most likely, but also they already have one. So they have to hedge their, they have to be willing to hedge their bets and spend even more money on a secondary product in case their lead product isn't as good, and they don't really know what the phase 3 is. So that's why I think that it makes sense if they wait till the phase 3 data, then maybe Pfizer or Amgen might be like, oh, this is much better than our lead product that isn't going to be able to compete with Zepbound from Eli Lilly, and so we'll go ahead and license in that drug. So I think there's still a possibility that a licensing agreement happens, but I think it's much more likely that it'll happen after the phase 3 clinical trial.
And just for, is there an estimate on how long before the phase 3's finished?
Yeah, so we don't actually know because they haven't actually given us the what the phase 3 program is going to look like. Presumably, it'll be multiple clinical trials. So I think it's probably going to be a 52-week trial, but it could be a 70-something week trial. So maybe a year and a half, either a year or a year and a half. And they've been guiding for it starting in the second quarter. So we should know fairly soon when the clinical trial will start. And when they start the clinical trial, they should give us more information on exactly how the clinical trial is going to look like.
Okay, well, it looks like the poll is closed now, and I'm looking at it, and 50% of the participants said voted, "I need more information," and 25% said agree, 25% disagree. I went with disagree just because I think the potential is there for a licensing agreement. I get your math on the M&A, but you never know. And 52 weeks is a while, but 70 some weeks is even longer. So we have our first disagreement of the day.
All right.
All right, we're going to go to let's see, almost time for Danny's second bold prediction. I predict that Netflix will initiate a dividend sometime over the next 3 years. Now, there's been a lot of speculation about Netflix because the company has become a cash flow machine. They generated almost $7 billion in cash flow in 2023 and another $7 billion in 2024. Mind you, this is a company that only a few years ago, Netflix was burning cash rather than generating cash. But they got to that point where they were generating enough original content where they had it at the level that they wanted. Wall Street is expecting cash flow to jump to $10 billion by 2026. Now, there have been questions, excuse me, about whether or not Netflix would, change their capital allocation policy. And whenever they've been asked that on the conference call, generally speaking, Spencer Newman, the company's CFO, said, currently there are no plans to change our capital allocation policy. We prioritize profitable growth by reinvesting in our business. We want to maintain ample liquidity, which is our second priority. And then we return excess cash to our shareholders through share repurchases beyond the several $billion of minimum cash that we have on our balance sheet. And then, use any that we can for selective M&A. Here's the thing, though. I think Netflix has been kind of cagey with their wording. And what they said that, there was no current plans to change their leverage, meaning that they have the level of leverage that they want, but their cash flow is continuing to increase. So I think what we're going to see is they're going to get to the point where they still have plenty of capital so that they can fund the content that they have and that they need. I think that, when you look at the signups that they have, 50% of their new signups is going to their ad-supported tier. They currently have 70 million viewers in their ad-supported tier. And they have not quantified this, but they have said that their ad-supported tier is more profitable for them on a per viewer basis than their lower tier. So I think what we're going to see is as they add more viewers to their ad-supported tier, it becomes more valuable to advertisers. They're going to end up making more money. And you add that to their existing, subscriber base. I think you're going to see the opportunity for cash flow to increase more quickly than what Wall Street is expecting. Right now, they're one of only two FANG stocks that has not announced a dividend, the other being Amazon. And they're forecasting revenue growth for next year of about 13%. I think that's going to be conservative because of the run that we're seeing on their ad-supported tier. So at this point, I would say I think Netflix could initiate a dividend as soon as some point over the coming 3 years.
All right, so the poll is open, and then also the Q&A is open. So if you, both of those are at slido.com, and then the code is Fool24. So if you have questions for Danny on whether you think that there'll be a dividend, go ahead and get those in, and also vote in the poll. It's 2 different tabs, so pick one and then pick the other. So we've got Roberto. Danny says, speaking about Netflix cash flow, why does Nvidia reduce their gigantic pile of net income by dramatically increasing their dividend? It escapes me. So I guess that's sort of a related question in terms of dividends. How much do you think that a dividend makes sense for a share for a shareholder? So like my question to you was, at what level does a dividend make sense? Like if they were going to release a 0.1% dividend, I'm assuming that you would say that doesn't make very much sense. And obviously if it was a 4 or 5% dividend and they had that much free cash flow, that would make sense. By my calculations, based on their trailing free cash flow and their current market cap, it would be a 1.7% dividend. So does that make sense, or would you expect they should have a higher dividend yield than that before they should actually start offering a dividend?
Well,
just to qualify, my
Sure.
my numbers assume that they use 100% of their free cash flow in a dividend, which presumably they wouldn't do. So obviously my number would be the presumable dividend would be slightly lower than 1.7. But do you think 1.7 is a reasonable dividend, or would you expect something they would try to initiate with something higher than that?
I think they would actually initiate with something lower than that. I'm thinking somewhere in the neighborhood of 0.75% to a 1% dividend yield would be the most that we would expect to see. If you look and see what the dividend yield is right now for, say, Meta Platforms, for example, who just recently they initiated their dividend last year. And they've got a dividend yield of about 0.35%. Alphabet was another one that recently initiated their dividend. And looking at, looks like right now that's about a 0.5% yield. So I don't think I would expect Netflix to come in really high on the dividend meter. But I do think that they could initiate their dividend. I think they will have the resources to do so.
Yeah, and just to go back to that initial question, Nvidia's dividend yield is 0.03%. Obviously, that's because the stock has run up so much, much
Right.
faster than the dividend. So what would they do with the rest of the free cash flow? Obviously, free cash flow is, they're not spending that on new programming because it's free, right? It's free cash flow. It's money that's not being spent. So they're just going to pocket that difference if you assume that they've got a 1.7% dividend yield, potential 1.7% dividend yield, and you're saying that they might go as low as 0.5% or 0.75%. What, they're just going to pocket the rest of that cash for a rainy day, or what?
I think generally speaking, what we're most likely to see is that Netflix will start by buying back shares, which is something they have done in the past, and they just have not done that much lately. And then once they get to the point where they start buying back shares regularly, I think they will move from buying back shares to initiating the dividend. And I think they continue to buy back shares as well. I think we could also see perhaps an increase in the content spending. The last time I looked, I think Netflix was planning to spend about 18 billion on content in 2025, and that includes both their original content and their acquired content. But I do think that they're going to end up with cash flow that exceeds that. So I think they could potentially use that after they buy back shares to initiate a dividend.
Yeah. So the poll's about to close, so please get your last set of votes in, and then I think that they have plenty. I think that they have more opportunities to use their cash to grow their revenue by having new content, and so I think that I would like to see them continue to do that. So my vote was that that they're not actually going to initiate a dividend in the next 3 years. I think that they'll continue to use their cash wisely by increasing their content, which will result in them growing revenue faster by having more people subscribe to their content. And they, if they have excess in any given year, they'll use it by doing a share buyback, and that allows them to not have to feel like they have to give that dividend away every year. They can choose to make a share buybacks in years where they have excessive cash, and in years where they don't have excessive cash, they can choose not to buy back shares. So it looks like for the poll, it's closed, and 83% voted with me and against you that they will not actually have a share buyback, or they will not have a dividend in the next 3 years, and 17% were agreed with you that they will have a dividend for in the next 3 years.
And that might have only been my vote. So.
All right. So then my second prediction is that Hims and Hers Health, the ticker is HIMS, will fail to reach its all-time high that it set, I don't know, a month or two ago at 72.98 by the end of 2026. So all of this year and all of next year. It closed at 37.41 today. So we're looking at basically almost a double to get back to there. They grew their share price mostly on the hopes that compounding of obesity drugs was going to continue. And I think that that's fraught with issues. First of all, they've been doing a lot of compounding based on the fact that Eli Lilly and Novo Nordisk couldn't meet demand. And so that allows them special considerations for their ability to compound the medications and make it, even though they're not FDA approved to make it, they can use their compounding ability to make it. And then now that that's occurred, now they have to go back to the more strict compounding rules, which is that you have to manufacture it specific to a patient. So compounding exists for a reason, right? So like, let's say there's a oral tablet that where the drug is approved and it's only approved as an oral tablet, and there's a patient who just can't swallow tablets. Well, that patient needs to be able to take the drug. And so one way that we can get around this issue is that a compounding pharmacy can change that tablet into a liquid solution, and then the patient can take that liquid solution where they wouldn't necessarily be able to swallow a tablet. There, other options are, there's an inactive ingredient in the drug that the patient would, have an allergic reaction to. So, well, obviously we can't give them that active, that one formulation that the drug company has got approved. So we can use the, active ingredient and make a new formulation that doesn't include this inactive ingredient that the patient would have a reaction to, and then we can give them that formulation. If it seems like it's really like specific, that's because that's the whole point, right? That compounding is supposed to be specific to individual patients. So they're they seem like they're probably trying to get around this by saying like, well, okay, the third option is okay, well, the patient needs a 8 milligram dose and only 7 and 9 are available, so we're going to prescribe an 8 milligram. The doctor is going to prescribe an 8 milligram dose, and then the patient is going to, then we need to be able to make an 8 milligram dose, so we're going to get around the rules, the patents on this drug by doing that. And I think that's I don't know. It's certainly not fair to the companies that have patents on their drugs. And so I think that they're going to have a whole bunch of legal issues that continue. And, the reason why it's fallen so much is because there was high hopes that they were going to be